This is CA Sandesh. Hope you're all doing good. Exam is around the corner, so I'm sure all of your preparation is going on in full swing. Okay, so in today's session, we'll be doing a revision on advanced accounting, or a marathon on advanced accounting, as these days they're called. Okay, so we'll be trying to cover the entire syllabus of advanced accounting in as less time as possible. Maybe in around 10 to 12 hours, we'll try to finish it. And as part of this session, we'll be going through all the concepts as well as the questions backing that. Okay, some of the questions also will be covering. All right. So before I get started with the session, I'll let you know how I would like to cover this particular revision session. One, we'll be doing this revision session with the help of our chart book. This is our colored chart book. I'm sure our students who have taken the class from us are aware of this. So if any of the new students, if you want to buy colored chart books from us, which look something like this, you can visit our website, that is learn.arivupro.com. Pop into our website. This is our homepage. Under that, select CA, and if you want to buy chart book for CA Intermediate, select CA Intermediate and select books. Once you select the books, select the subject that you want to buy the books for. Let's say you want to buy it for advanced accounting, so select that. We have two types of books. One is our regular class notes, which we call it as study book. Another one is the colored chart book or revision book. Okay, select that, add to the cart. So you will be able to, the books will be delivered to your address. Okay, so that's about it. And if you want to buy our classes also, it's the same thing. Select CA. Let's say you want to buy CA intermediate classes. Select online classes, where you will be able to get all the subjects where we provide the classes for. So you can add to the cart, and it's a quick buy, meaning once you buy the product, immediately you will be getting the access. There is no code or any delay or anything. It's an immediate access. Okay, cash and carry system kind of a role. All right, so that's about the few things. All right, and one more disclosure I would like to give before I start with the session. One is, sir, this is a revision session. So as I told you, we'd like to cover almost all the things in as less time as possible. So the pace at which I'll be speaking will be a little faster compared to our regular batch. I hope it's understandable for you. All right, that is one. And the second one, one of the prerequisites of you watching this video is, once you should have already covered your syllabus, meaning you should have already taken the coaching, okay, either from me or from somebody else, or at least if you are doing self-study, you should have already covered the syllabus once. Only then this revision will be a lot more effective. Okay, this is not a substitute for regular classes. This is just an extra help that we are trying to do. Okay, so it's just kind of revisiting the things that we already know. Okay, refinement is what you can say. All right, another thing is, kindly make sure that you watch this session in shortest time as possible, maybe in 2 or 3 sittings only. Don't delay it. I'm sure, studying is something which many of us don't like it so much. Yes, but unfortunately or fortunately, you have taken a course CA which is of high in demand, and it requires certain prerequisites, guys. Okay, certain efforts is required for you to clear the course. Just like that, course will not be given to you. It's not your BCom wherein 1 week before your examination you start your preparation and expect to score good marks. That is quite not possible. In fact, it is not possible when it comes to these professional courses like CA. Okay, because it has that much value. You need to put in certain efforts as well. So you need to have that motivation to sit and finish it off. No taking breaks in between and whiling away the time and all. All right, now exam is already almost around, quite nearby. So you need to have that motivation. Okay, always look for the motivation inside you, not somewhere else. You know, these days in YouTube, the big hit is motivational videos. All right, see, the people who keep searching for motivation videos, now once you see motivation videos for 2 or 3 days, you'll be motivated. After that, what? The josh will reduce. But if you motivate yourself, if there is a self motivation, then you don't need any external help. Automatically the vehicle will keep going. Okay, how do you do that? Just keep reminding yourself every day, why did you take up this course? Whom are you doing this course for? Think of your parents, think of your friends, think of your family and other people, your teachers, how much efforts they are putting so that you could clear the examination and you could make a career out of this. Okay, so remind yourself day in and day out about all that, and automatically that motivation, that zeal will automatically come for you. All right, so you come what may, we have taken it means we have to see it through. Giving up is not an option now that we have already taken it. Yes, So with that, Josh, let's get started with our first topic in our marathon session, that is internal reconstruction. Internal reconstruction. Normally, internal reconstruction is done by a loss-making companies. The companies which are doing losses or which have accumulated too many losses, they go for something known as internal reconstruction. Generally, in these sort of companies, assets and liabilities will be overstated. Assets and liability will not be shown at their correct value, they'll be overstated or understated. To show the assets and liability at its true value, we do something known as internal reconstruction. Getting the assets and liability at its correct value. Alright, that's one intention. And how is this internal reconstruction done? In case of internal reconstruction, what we do is the company or the management will approach the stakeholders. Now, I'm not using the word shareholder, I'm using the term stakeholders. So the company will approach stakeholders. Stakeholders means equity shareholders, preference shareholders, debenture holders, bank loan people, creditors, etc., etc. All these people will be approached, and all of these guys will be asked. The company will ask all of these guys to sacrifice a portion of their claim. To sacrifice something. That sacrifice portion could be 10%, 20%, 60%, 80%, doesn't matter. We will ask those stakeholders, the company will ask these stakeholders to sacrifice a portion of their claim. Alright, saying them, no, currently we are in a tough position, please forego some of your claim or leave away some of your claims. In future, when my company does good, we will compensate to you. For the time being, help me, otherwise the company will not survive. Okay, so you will approach the stakeholders to sacrifice. And if they sacrifice, all that will be done, and shareholders will be ready to sacrifice, or stakeholders, that they will give it to you in the problem. All that sacrificed portion, right, whatever is the element, will be routed through a particular account. And the name of that account is reconstruction account or capital reduction account. Meaning all the adjustments that happens through internal reconstruction will be done through an account known as reconstruction account, also known as reorganization account, or also known as capital reduction account. Our study material, I say study material, uses in some problem may they use reconstruction, some problems may they use capital reduction. So one of the two you can use in your examination. So this is about internal reconstruction, basically done by the loss making company, whereby they ask the stakeholders to sacrifice a portion of their claim. And all that sacrificed portion or all that adjustment will be done through a particular account known as reconstruction account or capital reduction account. That's all. Alright? Okay. I've given you certain basic entries that comes in these sort of adjustments. One, face value of the equity shares are reduced. Like, to give you an example, let's say company has one company, let's say it is X Limited. They have 1 lakh equity shares. They have 1 lakh equity shares of, let's say, 100 each. The company already has 1 lakh equity shares of 100 each. That means what is the total face value of equity share capital? 100 lakh. Yes or no? Or this is about your equity share capital. Now this particular company, they approached these equity shareholders and told, hey dude, my company is not doing good, please sacrifice some portion so that in future we will compensate you. The shareholders asked, what should we do? Okay. We will reduce the face value of the share from 100 rupees, we will make it as, let's say, 70 rupees. From 100 face value of the share, we will make it to 70 rupees. That means what will become the face value of equity share capital now? 70 lakh. From 100 lakh, it is coming down to 70 lakh. That means how much is the reduction in value? 30 lakh. That is what we mean by sacrifice. That sacrificed element will be routed through an account known as reconstruction account or also known as capital reduction account. If this is the scenario, what journal entry you need to pass? Now see, shareholders means they'll have share certificate with them, equity share certificate they'll have. The value printed on that share certificate, we call it as face value. The value that is printed on your share certificate, we call it as face value. What is the face value of the share printed on old certificate? 100. But is the value of the share 100 now, face value, or it is 70 now? 70. That means what do you think equity shareholders will tell? They will say, boss, I have a certificate which is showing the value as 100. But right now the value of that is only 70. Take back your old certificate and give me new shares or new certificate. Okay, this is what will happen. So for this, the journal entry is, you have to cancel the old shares and uske badle mein, or instead of that, you have to give new shares. So if you have to cancel old shares means if you're cancelling equity shares means for company it is equity share capital. Yes. So old equity share capital will get cancelled, and instead of that new equity share capital will come into play. So the journal entry will be equity share capital account debit. How many equity shares we had before? 1 lakh. Each ka face value, original face or initial face value was 100. That means the total is how much? 100 lakh. Instead of this, what did the shareholders are getting? They are getting new share certificate to equity share capital account only. Same number of equity share capital is number of equity shares is 1 lakh only, but the face value of the share is now only 70. That means here you will write to equity share capital 70 lakh. This is okay. Journal entry is not matching. There is a difference of how much? 30 lakh. That we have to credit reconstruction account or capital reduction account. This is what I have given over here. If the face value of equity shares is getting reduced, the journal entry is equity share capital account debit, meaning old face value. To the extent of old face value, you debit to equity share capital account to the extent of new face value. If there is any sacrifice, that sacrificed element goes to reconstruction account or capital reduction account. If the same component is happening for preference shares, you can pass the same entry. Instead of equity share capital account debit, you will write preference share capital account debit. So on. Like that. Is it okay? Or as I told you, in case of internal reconstruction companies, their assets will be overstated or not shown at the correct value. So we have to bring it at correct value. So if the asset is overstated and if the value of asset is getting reduced because of internal reconstruction, what is the journal entry we need to pass is what I have given out. So asset value is shown more than what it is required. Let's say one plant and machinery. The company is currently showing that plant and machinery at 10 lakh rupees. Currently, the company is showing that plant and machinery at 10 lakh rupees, but its correct value is only 8 lakh rupees. Okay. Currently, the company is showing at 10, but it is revalued at or its correct value is only 8 lakh. That means from 10 lakh, we have to bring it down to 8 lakh. So that means what is the reduction in this asset value? 2 lakh. So assets have what balance? Any assets have debit balance. Something which has debit balance, if you have to reduce, what you have to do? In accounts, there is no plus minus. Something which has debit, if you want to reduce it, you have to credit it. Yes or no? So that means the journal entry will be, you have to debit something, right? Debit will be given to reconstruction account or capital reduction account. So reconstruction account debit to asset account. Whatever asset that you are reducing, you will credit that. That's the scenario for asset reduced. Is that fine? Alright. Okay. Next is P&L to be written off. As I said, these things are done by loss-making companies. Even after doing internal reconstruction, if you still show the losses, then the question will be raised, what sort of internal reconstruction did the company do? Yes or no? Correct? So hence, alright, as part of this internal reconstruction, whatever losses the company already has in their books, that will be written off. I'll repeat that. Once you are done with the internal reconstruction, whatever loss balance the company already is showing in their books, that has to be written off. Loss means P&L account will have what balance? P&L account will have a debit balance. Yes. So how do you cancel something which has debit balance? By crediting it. So the journal entry for this is reconstruction account debit to P&L. Okay. This is something in some problems they will tell this adjustment, write off P&L, like that they will mention. Okay. But in many other problems, they may not mention this adjustment also. Meaning this P&L write off adjustment, they may not mention sometimes. Whether they give it in the question or they don't do it, you have to compulsorily do this particular adjustment at the end. Is that okay? You do this adjustment, okay? You have to do it provided reconstruction account has a balance. Only how much ever extent balance is there in reconstruction account, to that extent you can write off P&L. Just to give you an example, let's say P&L account has a debit balance of 10 lakh rupees. Meaning that this particular company has accumulated or has made a total loss of 10 lakh rupees. Okay. As part of internal reconstruction, can we still show this? No, we need to write off. We'll write off with what? Reconstruction account ka balance. Yes. Let's say your reconstruction account, I just write like this. Reconstruction account has a balance of only 7 lakh rupees. Assumption. Okay. Reconstruction account has a balance of only 7 lakh. How much P&L is there? 10 lakh. So how much ever you can write off entire P&L balance, provided you can write off entire 10 lakh, provided reconstruction account has enough balance. Here, is there any enough balance? No. So how much ever balance is available, to that much only you can write off. How much balance is there? 7 lakh. So that means the journal entry you will pass is this same entry, reconstruction account debit to P&L, but the amount you will only pass it for 7 lakh. You can't pass it for 10 lakh because reconstruction account does not have enough balance. Is that okay? Suppose reconstruction account has 15 lakh balance, then entire P&L loss of 10 lakh can be written off. So in that case, same journal entry you will pass, but entire loss you can write off. So you will pass this journal entry for 10 lakh. Like that. Check and accordingly do it in the questions. Fair enough? Okay, these are some of the common adjustments that you see in almost all the problem. Now some other points also, problem specific adjustment, I have called it out. Let's go through this and let's apply it in one of the problems as well. Okay? Alright. As I told you, first adjustment, whether they mention in the problem or not, P&L debit balance has to be written off. Okay? Always keep this in mind. Same goes with preliminary expense and deferred revenue expenditure. Normally, as part of internal reconstruction question, they will give you a balance sheet, okay, to solve the internal reconstruction adjustments. Check in that balance sheet if you are able to see any preliminary expense or deferred revenue expenditure. If at all these are there, even they need to be written off, okay, if reconstruction account has a balance. Check. Fair enough? Same thing, same entry. So preliminary expense has a debit balance. How do you write off? By it has debit balance. If you have to cancel it, you have to credit it, right? So the journal entry you will pass is reconstruction account debit to preliminary expense or deferred revenue expenditure. Okay, this is the entry you will pass, provided the question has this adjustments. Check, watch out for this and then do it. Alright. Alright. Other one is, if any reserve like a general reserve, capital reserve or security premium, before you do internal reconstruction, okay, if company already has some reserves like this, like general reserve, capital reserve, pretty rare, okay, but if at all they have, then they transfer these sort of reserve balance to reconstruction account, meaning these reserve balance can be utilized for our reconstruction scheme, for our internal reconstruction purpose. So if at all, let's say you have a security premium balance of 10,000 rupees. Before internal reconstruction, you are seeing in the balance sheet that company has security premium balance of 10,000. This can be utilized for internal reconstruction scheme, meaning this security premium balance or whatever it is, general reserve, security premium, capital reserve, whatever balance is there, first you transfer it off to reconstruction account. Reserve means where will you show in balance sheet, sir? Asset side or liability side? Reserves and surplus you will show it under shareholders funds on the liability side, yes or no? That means reserves means it will have what balance? Credit balance, yes. Something which has credit balance, if you have to transfer, what you will do? You have to debit, yes or no? So the journal entry will be security premium or general reserve or capital reserve or whatever that you are transferring. This account debit to reconstruction account, how much ever balance they have. In this case it is 10,000, so we'll pass this entry for 10,000 rupees. Check this, these sort of adjustments will not be there in every problem. In some of the examination questions, they have given this as well. Basically, any reserve you have that can be utilized for our internal reconstruction activities. Meaning, transfer that reserve balance off to reconstruction account first and then do your other activities is what I'm trying to say. Okay? Or, if dividend is sacrificed, then no journal entry is required for the same. This is one of the common adjustments in problems. They will give you in adjustment that the company has some preference shares. Okay, preference shareholders are ready to sacrifice 2 years of dividend, they will say. Preference shareholders are ready to forego or sacrifice 2 years of dividend. See, in internal reconstruction, what happens is they will give you various adjustments, 10, 12 or 15 adjustments they will give you. For those adjustments, you just need to pass journal entries. That's all. That's all is the scope of this topic. After that, at best, they may ask you also to prepare balance sheet after internal reconstruction. That's all is the scope of this particular topic. Some journal entry for some 8 to 10 transactions, they may ask you to pass journal entries, and after doing all those journal entries, they may ask you to prepare balance sheet after internal reconstruction. That's all. Okay. Now let's say one of the adjustment is preference shareholders are ready to sacrifice 2 years of dividend. Let's say that dividend amounts to 20,000 rupees for 2 years put together. The total dividend for 2 years is 20,000. This preference shareholders are ready to sacrifice. You need to pass a journal entry for this particular scenario. The journal entry for this scenario is no journal entry. Okay, no journal entry is required for this particular scenario. Sir, why sir? Sir, journal entry is required for those components for which you have to cancel. Like, let's modify the adjustment. Let's say there is a creditors of 10,000 rupees in balance sheet. They told we will sacrifice. They told 100% we will sacrifice. Just for the sake of simplicity, 100% nobody will sacrifice. Just for the sake of example I am taking. There are some creditors which the company has to pay them 10,000 rupees. They are so nice that they are telling 100% we will sacrifice. Meaning the creditors is telling the company no need to pay anything. We understand your position, your pain. No problem. For now, it's okay. Okay, we'll see later. For now, you don't have to pay me anything. Okay. Now, the question is, do you show this creditors in balance sheet? Will this creditors be appearing in balance sheet? Yes. Yes, creditor will come on the liability side. Under current liabilities, you show creditors, okay, to the extent of 10,000 rupees. Yes. Now, as part of internal reconstruction scheme, okay, what did the creditors agree? That I am ready to do maafi. Okay, I am ready to sacrifice. How much? 100%. Now, is this liability that you are showing in balance sheet at 10,000, is it still required? No. See, as long as you have to pay somebody, you have to show it as a liability. Now, is the company required to pay these creditors? No. That means, what is the point in showing this creditors? Because we are not anyway going to pay them. So, cancel it. How do you cancel? Creditors has credit balance. Something which has credit balance, if you have to cancel, what will you do? You'll pass the journal entry as creditors account debit. How much? 10,000. To what? I told all these adjustments in internal reconstruction will be done through an account known as reconstruction account or also known as capital reduction account. So this is the journal entry you will pass for this. Okay. Why are you passing this journal entry? Because you have to cancel. Since you accounted creditors and they are ready to sacrifice, to cancel this, we have to pass this particular journal entry. Because creditors is already shown in balance sheet. So it is shown at credit balance too. So we have to debit it and cancel it off. Now use the same logic for preference dividend. Here this particular scenario. Okay. Is preference dividend shown in the balance sheet? Normally if you just check question ka balance sheet, they will not be showing a dividend, preference dividend in balance sheet. Okay. It will not be shown in the balance sheet. Okay. Because only if the company has a profit, no, they will pay dividend. It's a loss making company. How will they pay dividend, sir? So they would have not shown this liability in balance sheet because company is going on making losses. So this particular preference dividend or equity dividend or whatever is not shown in balance sheet. It is not shown in balance sheet, meaning this particular dividend the company has not even accounted because there is no profit to pay the dividend. If you have accounted this, then you can pass some entry to cancel it. Like here you are showing creditors, okay, we don't need to pay them, they have sacrificed, hence we cancelled it. But dividend, are we accounted it? No. Since we have not accounted it, there arises no need to cancel it. Hence no journal entry is required for this particular preference dividend sacrificed or equity dividend sacrificed. Okay, watch out, only if they have sacrificed, no journal entry is required. Okay, suppose the preference shareholders are telling total dividend payable to preference shareholders is 20,000. They are saying 80% we will sacrifice. They are telling 80% we will sacrifice, 20% we need cash. Preference shareholders are telling the company 80% we will sacrifice, 20% you need to pay us. In this case, what you do? For this 80% sacrifice portion, is there any journal entry required? No journal entry required. Why? Because you have not accounted preference dividend. Okay, and if that is sacrificed, there arises no need to cancel that. Only if you have accounted something, then you can cancel it, or there arises a need to pass cancellation journal entry. Hence, for this particular component, no journal entry is required. How about for this 20%? For this also you will say no journal entry. Yeah? No. This you are paying in cash. No? How much? 20,000 ka 20% will be 20,000 into 20%. If you do, that will be 4,000, right? For this 4,000 you are paying cash, right? So you need to pass journal entry for this. So what will be the journal entry? You'll write preference dividend account debit to cash, right? And that preference dividend, you will transfer it to P&L. But here, what journal entry will pass is all the expense, whatever that you are passing, no, will be routed through reconstruction account itself. So the journal entry will be reconstruction account debit to cash or a bank, that is 4,000 rupees. This will be the journal entry. Actually, there are two entries for dividend, right? Preference dividend account debit to bank account is the first journal entry. Second journal entry is P&L account debit to preference dividend. That's what you used to pass. Alright. But here, okay, if you want, I can show you that entry also. First journal entry is preference dividend to bank 4,000. Alright. And the second journal entry is P&L account debit. P&L account debit to preference dividend 4,000. These are two entries we pass. Yes. If you add these two entries, what are you getting? Preference dividend debit, preference dividend credit. So effectively the journal entry is what? P&L account debit to bank account 4,000. This is the journal entry, right? But in case of internal reconstruction, it's a loss-making company. That means all this P&L, are you keeping it or are you writing it off? This P&L also should be written off using what? Reconstruction account. Hence all the adjustments, for all the expense, for any expense paid, the journal entry will not be P&L to bank. Instead of that, we will write reconstruction account debit to bank account. Because as such, P&L only is getting cancelled because of the internal reconstruction scheme. Because it's a loss-making company. So whatever loss balance is there, we are nullifying that. Hence, instead of P&L to bank, we will pass the entry reconstruction account debit to bank account. Okay, that's one more thing you need to keep in mind. Okay, alright. After doing all this drama, see, these are all the problem-specific adjustment. I've called it out in the chart book. Okay. After passing all, as I told you, they will give you many adjustments for which you need to pass journal entry. After you pass all the journal entry, after doing all this drama, okay, showing the asset at right value, accounting for all the sacrifices, okay, doing all the entry, if your reconstruction account still has any balance, after doing all the adjustment, if your reconstruction account still has any balance, that will be transferred off to capital reserve account because it represents capital profit. Because all this transaction, how often do you do? Is it a recurring or a non-recurring item? It's a non-recurring item. That means these are all non-recurring profits or capital profits. All capital profits will be transferred off to capital reserve. Hence, any balance in reconstruction account after doing all the activity will be transferred off to capital reserve account. That's all is the fund. Okay. Okay. Let's do a thing. Let's quickly apply what we've learned in one of the questions as well so that we understand it a little better. Alright. See, as part of our regular batch, we have done more than 25-30 questions on internal reconstruction only. But in the revision session, I can't afford to do all of those problems again. Yes. So I have picked a few problems which has good adjustments and I'm trying to do it over here as a revision. Alright. Okay. Following is the balance sheet of Week Limited as on 31st March 20x1. They've given share capital, reserves and surplus. See, if you are able to see reserves and surplus, it is negative. It's negative because this reserves and surplus, note number 2, if you open, P&L account will have a debit balance of 6 lakh. Check if you want. If you open notes to accounts for reserves and surplus, there is a debit balance of P&L 6 lakh rupees. It is a loss-making company. That is the reason they are doing internal reconstruction. So let's see, nothing fancy over here. Looks pretty straightforward. Long-term borrowings and all. And then they've given on the non-current asset side, non-current assets we have, investment we have, current assets. For all of it, they've prepared notes to accounts. Company has 1 lakh equity shares of 100 each currently. And they have 50,000, 12% cumulative preference shares of 100 each. These 100 and all is the face value of those instruments. Okay. P&L already has a debit balance, meaning debit balance of P&L means it's a loss. If P&L has credit balance, then it's a profit. P&L has debit balance means it's a loss. Okay. Then we have 40,000 debentures or 10%, 40,000, 10% debentures of 100 each. Again, this 100 is the face value of the debenture. We have provision for taxation. The tax that we have to pay to the government is 1 lakh. Non-current investment, they are saying note number 5. Market value of the investment is 9.5 lakh rupees. But currently the company is showing that investment in their books at 10 lakh. Okay. They have given you the balance sheet in this format. Like this only, you will be able to see the question in your balance sheet. One big balance sheet followed by notes to accounts, followed by all the adjustments which they'll give. Okay. Let's see the adjustments one by one. Following scheme of reorganization as an internal reconstruction has been sanctioned. The company has already taken necessary formalities for internal reconstruction is already completed. Now, they have, as part of the scheme, they have agreed upon many things. For those agreed upon things, we need to pass the journal entries. 1. All the existing equity shares are reduced to 40 rupees. They are reduced to 40. Currently, the face value of the equity shares is 100. From 100, it is being reduced to 40. That means how much is the sacrificed element? 60 rupees. Yes or no? That means what do you think will happen? Existing shares has the face value of 100. That means the value printed on the old share certificate is 100. But the revised face value of that share certificate is only now 40. What do you think shareholders will say? Take back your old certificate and give the new share certificate. So the journal entry for this will be what? Equity share capital account debit. How many shares? 1 lakh shares of 100 each. That is 1 crore. Those old shares will be getting cancelled. So debited. To what? To equity share capital. How many shares? Still 1 lakh shares. But the face value is only 40. So to equity share capital 40 lakh. So how much did they sacrifice? They sacrificed 60 rupees on 1 shares. How many shares we have? 1 lakh. That means the sacrificed element is 60 per share on 1 lakh. That will be totally 60 lakh. That sacrificed element will be going to an account known as reconstruction account or capital reduction account. This is the first journal entry for first adjustment. That's all. Okay. Alright. Next. All the preference shares are reduced to 60 rupees. Are reduced to 60 each. Okay. Currently the face value of preference shares is 100. From 100 you have brought it down to 60. From 100, if you have brought it down to 60 means what? How much are the preference shareholders ready to sacrifice? They are ready to sacrifice 40 per preference shares. Again, in old preference shares, 100 will be the face value printed. But now the face value is only 60. So old preference share capital you need to cancel and issue new preference shares whose value is 60. So the journal entry will be what? The old preference shares is 12% cumulative preference shares. So the journal entry will be 12% cumulative preference share capital account debit. Same. How many was the preference shares we had? We had 50,000 preference shares of 100 each. That will be 50 lakh. 2. Same. 12% cumulative preference share capital. Same. 50,000 preference shares only. But the face value is only 60 now. So 50,000 into 60 will be 30 lakh. Balance 25 is your sacrificed element which will going off to capital reduction account. Either you can calculate or get this as a balancing figure. It is fine. Right? This is the second transaction ka journal entry. Okay. Next, the rate of interest on debentures is increased to 12%. Currently, what is the rate of interest? 10%. The debenture holders are telling from 10% make my interest to 12%. Okay. The debenture holders surrender their existing debentures of 100 each and exchange the same for fresh debentures of 70 each for every debenture. That means even debenture holders are ready to sacrifice. The current existing face value of the debenture is 100. The debenture holders are selling, okay, currently my debenture is having a face value of 100. The new debentures they are telling let the face value of that be only 70. That means how much are they willing to sacrifice? From 100, it's come down to 70 means the sacrificed element is 30 per debenture. Okay, that means old debentures certificate you need to cancel. So the journal entry will pass as 10% debentures account debit. How many debentures we had? 40,000 debentures of 100 each. 40,000 into 100 will be 40 lakh. To what? To not 10% debentures. Now, since debenture holders are ready to sacrifice, they are telling instead of 10% interest, now you give me 12% interest. That's what they have agreed upon. So you will credit to 12% debentures. How many debentures still? 40,000. But the face value of each debenture is only 70. So 40,000 into 70 is 28 lakh. Balance is a sacrificed element which will be transferred off to either capital reduction account or also you can use reconstruction account, whatever you feel comfortable. Okay, study material uses both. In some problem they use reconstruction, some may use capital reduction. So anyone is fine. Right? Next, one of the creditors of the company to whom the company owes 20 lakh rupees decides to forego as in sacrifice 40% of his claim. Totally company has to pay that creditor 20 lakh. And he is saying 40% of that I am ready to sacrifice. So 20 lakh of 40% is 8 lakh. That much he is ready to sacrifice. He is allotted 30,000 equity shares of 12 each in full settlement of his claim. So he is saying the remaining amount you settle. 40% I will sacrifice. That means 60% you have to settle. He is saying no need to settle for me in cash. You can pay me or you can settle me by paying by giving me your company ka equity shares. How many equity shares? 30,000 equity shares of 40 each. So 30,000 into 40 if you do, that will be what? 12 lakh rupees. Basically, it's like this. Creditor, you have to pay them totally 20 lakh. 40% is ready to sacrifice. That means 8 lakh will be transferred off to reconstruction account. Balance 60%. 60% of 20 lakh is 12 lakh. This you have to settle by giving him equity shares. That's all. Of what value? 40 each. So the journal entry will be, if you pay cash to creditors, what is the journal entry? Creditors to cash. So here what are you giving? You're settling in equity share. So the journal entry will be trade payable or creditors account debit to equity share capital. You gave worth 12 lakh. But totally you have to pay creditors how much? 20 lakh. Balance 8 lakh you have to pay? No. So that sacrifice element will, 8 lakh sacrifice element will be going off to reconstruction account. That's all. Alright? Okay, awesome. Next. Property, plant and equipment are to be written down by 30%. Value of the property, plant and equipment. One asset you need to reduce. What is the journal entry for this? Reconstruction account debit to plant and machinery account. There could be many assets that are getting reduced. So hence they would have done compound entry also. Okay. This is your capital reduction account debit to property, plant and equipment. Check how much is property, plant and equipment, the given value. 1 crore 25 lakh. Okay, or 125 lakh I'll write. How much was it sacrifice or how much is it written down by? How much value are you reducing? 30%. So calculate this. 125 into 30% will give you 37 lakh 50,000. That much of property, plant and equipment value you are reducing. So the journal entry will be capital reduction account debit to property, plant and equipment 37 lakh 50,000. Have they done? Yes. They are doing a compound journal entry for all this. If you want, you can, for each of them, you can also pass a single journal entry. But by passing compound entry, you can save a lot of time because for every journal entry, you also need to pass narration. Whether they ask or not, narration is compulsory. So when you do compound journal entry, that way you will save a lot of time. This also. Compound entry is what I suggest. But if you want, you can also pass single journal entries also. Current assets are to be revalued at 45 lakh. What is the current assets value shown in balance sheet? 1 crore. But they're saying its revised value is only 45 lakh. From 1 crore, you have to bring it down to 45 lakh. That means how much is the reduction? It is reduced by 55 lakh. What is the journal entry? Same. Capital reduction account debit to current assets 55 lakh. Which current assets they have not called out? If they don't call out, we don't have to worry. This current asset could be inventory, debtors, whatever. If they call out which asset in the name of the asset individually, we'll also in our journal entry call it out. Suppose they say inventory is reduced by 55 lakh. The journal entry we passes capital reduction account debit to inventory. If they just say current assets, you credit current assets only, like that. Okay. Alright, next. Taxation liability of the company is settled at 1,50,000. How much was that provision for tax? 1 lakh. It was settled at what value? 1,50,000. So why are we paying more? Will the government not sacrifice? Sacrifice will be made only by the other parties like creditors, preference shareholders, equity shareholders. Government and all will not sacrifice their tax. Okay. So why is it increasing then? So provision is just an estimate. Provision means it's just an estimate. It's not a short number. Okay. So the company initially estimated that the tax payable to the government will be 1 lakh. Later on, the final value could be more than 1 lakh or less than 1 lakh. It is fine because provisions are just estimates. Estimates can get revised. Okay. So this you are settling. So what is the journal entry? Tax you are paying. Provision for tax you are paying. So the journal entry will be, if you are paying salary, if you are paid means the journal entry will be salary to bank, right? Same thing, provision for taxation if you are paid means the journal entry will be provision for taxation account debit 1 lakh to bank account. But you are not paying 1 lakh, you are paying 1,50,000. So to bank account 1,50,000. There is a difference. How much? 50,000. That differential portion. Here whatever adjustment, any component, any differential value will be adjusted through capital reduction account or reconstruction account itself. This is your tax adjustments. Investments are to be brought down to their market value. Currently, you are showing the investment at 10 lakh rupees. Okay, here they have shown notes. Okay, but they are saying the market value of the investment is only 9.5 lakh. So you have to bring it to market value. They're saying. So you are showing the investment at 10 lakh, but correct, you have to show it at only 9,50,000. They're saying. So from 10 lakh, you have to bring it down to 950 means there is a reduction to the extent of 50,000. Investment value is getting reduced. So the journal entry will be capital reduction account debit to investment account 50,000. Alright. Okay. Next is, it is decided to write off debit balance of P&L. As I told, right? Some problems may they'll mention this adjustment. Some problems may they need not mention as well. Whether they mention this adjustment or not, still we will do it. Okay. So P&L account debit balance we need to write off. How much is the P&L debit balance? 6 lakh rupees. What is the journal entry? P&L debit balance you need to cancel. P&L has debit balance. To cancel we will credit. So debit will be given to capital reduction. So the journal entry will be capital reduction account debit to P&L 6 lakh rupees. This is your journal entry. They passed a compound journal entry for all this. So if you add all this, you're going to get 99 lakh. Okay. That's all. Then what have they asked? Show the journal entry and show the balance sheet after giving the effect to the above. So I told you, after doing all this adjustment, if your reconstruction account still, if it has any balance, after doing all this, if your reconstruction account still has any balance, that balance you have to transfer it off to capital reserve account. Here they are saying, after doing, normally they would have put a working note for this to know the balance. Here we prepare something known as one working note for capital reduction, ka ledger account will prepare. It's not necessary you have to do it as ledger only. You can pass it however you want, but ledger is something which we are comfortable, so we'll do it. Whatever journal entry you pass, post all of them into capital reduction account. There will be a balancing figure. This balancing figure only is the amount remaining in capital reduction account that should be transferred off to capital reserve account. Okay, this is arrived as a balancing figure. Right? Any balance in capital reduction account finally has to be transferred to capital reserve. That is your last journal entry. Capital reduction account debit to capital reserve. This you will get it when you prepare that working note. First do that working note and then show this particular entry. Okay. This is the way the question will be asked. And one more step that they can ask you, that is to prepare balance sheet, which they have asked. After doing internal reconstruction, they will ask you to do balance sheet. Okay, the balance sheet is pretty simple. Balance sheet of week limited. The heading is important. Here you have to use the term and reduced. When you use the term and reduced over here, it is the information that you are giving to the users or readers of financial statement, saying this company has done some internal reconstruction. The moment you write the word and reduced, the people will get to know that this particular company has done internal reconstruction. Okay, balance sheet is very straightforward. You just need to check, due to this internal reconstruction, your asset and liability balance would have increased or decreased. That effect you need to give. That's all over here. If you want, you can just check quickly. We can do it off. Equity share capital. Okay, now check your journal entries. Where and all have you credited equity share capital? Take that. So equity share capital, see, first journal entry of credited by 40 lakh. So equity share capital 40 lakh here. Anywhere again you have got credited? Here 12 lakh. That means 40 plus 12 lakh. Okay. Then anything else? No. That means total equity share capital will be 52 lakh. Similarly, you do preference share capital. Where and all it got credited. Because capital means it will have credit balance. From journal entry only directly you can prepare balance sheet. Preference share capital 30 lakh here credit. Then anywhere else is there? No, that's all. That means what is your total paid up capitals? So total paid up capital will be these two addition, which will be 82 lakh. Check, have they shown that in balance sheet? This is your balance sheet. Share capital is 82 lakh. This breakup you have to give it in notes to accounts. Meaning your equity share capital is 52, preference share capital is 30, like that. But total is 82 lakhs. Okay. Then in balance sheet, you know, below share capital, what do you show? Reserves and surplus. One reserve is there in this problem. The balance in capital reduction account, where did you transfer that to? Capital reserve. How much did you transfer? 50,000. That is your reserves and surplus ka balance. Alright. But what about question ka P&L debit balance, sir? That will not come because it's already written off. So that's over. These adjustments are over. Then debentures. Will you show 40 lakh? This is the data given in the question. Can I show this? No. Check the journal entry always. Because 40 lakh is the old debenture. Before reconstruction, that is. After reconstruction, the debenture ka value is only 28 lakh. Check if they shown 28 lakh. Yes. Like that. Then come back to the question. What else after there was debenture? After the debenture was there? Provision for taxation. This will not come because it's already settled. We already paid that tax. So it will not come in balance sheet. Okay. Rather, I'll just go main balance sheet over here. Okay. Share capital over. Reserves and surplus over. Long-term borrowings over. Short-term provisions over. Tax over. What about trade payable? In trade payable, no, some of the creditor was ready to sacrifice. How much was he owning? One of the creditors to whom company owes 20 lakh rupees. That means in this 50 lakh to 20 lakh of creditor, now we have settled. Some portion he sacrificed, for some other portion he accepted equity shares. To the extent of 20 lakh, we have settled this claim. What other creditors remains? 30 lakh. So 30 lakh is the value of the creditor that will come in your new balance sheet. Check. Yes, that's all. Okay. Check the original balance sheet to find out the components. Check your journal entry to find out the value of those components in your new balance sheet. That's all. Okay. Liability side over. Similarly, on the asset side, if you just check property, plant and equipment, that got reduced by 37.5 lakh. No? Yes, that's what we wrote over here also. 37.5 lakh, the asset is getting reduced. That means from 1 crore 25 lakh or from 125 lakh, if you reduce 37.5, that means the revised value my calculator is showing it is 87.5. Check if they shown that. Yeah, property, plant and equipment is 87.5, like that. Okay, then what component is there? We have non-current investment. 10 lakh is what we are showing previously, but they told investment to be shown at market value. What is the market value? 9,50,000. Check in the new balance sheet. Are they showing investment at 9.5 lakh? Yes, that was one. Alright. Next, check the original balance sheet. We had current assets. Current assets, they told it is revalued to something. It is this somewhere they told. No? Current assets are to be revalued to 45 lakh. That means the revised value of current asset is 45 lakh. But hang on. Current assets means it includes inventory, debtors, cash, etc. etc. Did you pay any liability in cash? Did you pay creditor or anybody in cash? I think one we paid, no? Tax, check. Taxation we paid through bank account. How much did we pay? 1,50,000. That means your current asset no will not be 45 lakh because you settled tax liability of 1.5 lakh, no? That means your current asset balance will only be 43.5 lakh. Okay, this is the total current assets. Huh? Total current assets means there could be some inventory, debtors, cash, bank, whatever we don't. That breakup they have not given. Okay, so hence 1.5 lakh taxation paid also will reduce your current asset value. So that will become 43.5, which they have shown. So balance sheet got matched. This is how a question on internal reconstruction could get asked. Okay. Alright, so hope it was helpful to you. Very simple question. They'll give you various adjustments. All that adjustments you have to route it through capital reduction account or reconstruction account. Basically, some sacrificed element will be there. Route that. Okay, and also do remember that P&L debit balance we need to write off using reconstruction account, provided reconstruction account has a balance. And after doing all this drama, if reconstruction account or capital reduction account still has any balance, that will be transferred off to capital reserve. Okay. So that's all with respect to internal reconstruction. Alright, moving forward to the next topic, which is buyback of shares and equity shares with the differential rights. Okay, there's one topic. Before I dive into it, I'll just give you a little background so that it'll help you to understand the adjustments a little better. And given the same exercise, we had done it in our regular batch also, but just maybe some of them might have some new audience. So for that benefit, we'll have a quick background on this. Excuse me. So first of all, buyback of securities. By securities here we mean equity shares. Okay, this particular chapter deals with buyback of equity shares. The term buyback means cancellation. So the company is buying back equity shares means the company is cancelling equity shares. Initially the company, let's say there is a company X Limited, they had already given some equity shares, okay, that they are cancelling. So why do you think company should cancel? So company has a lot of money, okay, it's a profitable company, let's say, company has a lot of money, but they don't want to expand. They have a lot of money, but they don't want to expand. Then what do you think the company will do? Alright, see, when the company needed money, equity shareholders subscribed equity shares and gave money to the company. Yes or no? When company has excess money, alright, which it doesn't want to expand also, what do you think will happen? It will give the money back to the equity shareholders in the form of buyback. Okay, so that's all is this particular portion. Or one of the other common reasons why buyback is done is to avoid that hostile takeover. To avoid some takeovers, we do buyback. What do we mean by takeover? Okay, let's maybe take this example only. Let's say X Limited has 3 shareholders, Mr. A, Mr. B and Mr. C. Okay, let's say A owns 60% of this company, B owns 20%, C owns 20%. Okay, alright, A owns 60%, B owns 20 each. Now Mr. A, he is not interested in running this company. A is not interested in running this company. Earlier A was very enthusiastic, so he only started this company, and later B and C came and all. Now probably he's aged, okay, he's feeling like, why to do the company and all, what is there, he's become full spiritual now, he's gone into Buddha zone, okay, why is the company, why do I need money, what is life, he's doing all that drama, okay. So other partners got scared here, where what did we get here into, okay, this guy is not even interested in running the company, but he holds 60%. Now let's say there is another person, Mr. Z, okay, alright, he wants to buy off this company, right? It's because he feels this company is very good, let's buy off. So B and C are scared now, saying what? If A sells off the shares to Mr. Z, that means Z will become owning how many shares, how much percentage shares in this company? 60%. You already know. If you own more than 50% shares in a company, you will get control over that company. Yes or no? That means what? All the decision of this company can be done by Mr. Z. If he can convince A to sell the shares to him, If Mr. Z can convince Mr. A that sell your shares to me, then the Z will be having the control over this company. Yes or no? Right? So it will be unfair for these guys. Yes or no? They have put in their sweat, blood, everything for this company. Suddenly one guy with money comes in and takes over the company. It's not fair. Yes, correct? So what B and C can do is, B and C can all of these guys can take a decision saying, anyway, A, you are not interested, right? Alright? The company will buy back your share, meaning they will cancel your share. Alright? So this way what happens, the 60% shares will be routed back to these guys. Okay, let's say 30. This will be routed back equally, let's say. So 30% will be added. That means B ka revised holding will become 50%. C ka will be 50%. And company will give the money to Mr. A and saying, yes, Tata bye bye. You don't want to do anyway company ka shares. I mean, to run this business, no? We will buy your shares back so that you can say Tata and do whatever that you want to do. This way what happens, the control will be still with these two guys. To avoid these sort of hostile takeovers, we have buyback provisions. Alright. This and all is just for your knowledge sake. And this and all they don't ask you in their examination. What you'll be expected to ask is, the company would have passed the resolution for buyback. There will be, as part of buyback, there will be many transactions that would take place. For those transactions, we need to pass again journal entries, and they may ask you to prepare balance sheet after buyback. This is the scope of this particular topic. Okay. Alright. This is one. And another one which I want you to quickly run it by is, alright. Sir, there are three methods to do the buyback. One we say profits, or our books will say reserves and surplus method. Another one is shares or securities. Shares and securities they say. Last one we say is combination. Okay, I'll just give you 2 minutes, a quick background about this. This will help you to solve a lot of questions with ease. Alright, let's say there is a balance sheet. It's a balance sheet of A Limited, we will say. Okay, sir. In balance sheet, you will have various components, no? Equity share capital, blah, 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 preference share capital, creditors, bank loan, etc. Let's say equity share capital is 1 lakh rupees. Alright. Then let's say we have P&L to the extent of 3 lakh rupees. Then we have some bank loan. The company has taken a bank loan worth, let's say, 2 lakh rupees. Okay. That's all. For simplicity's sake, I've assumed this number. On the asset side, I don't need I'm not interested. So it's fine. Okay. So the topic name is buyback of equity shares. Buyback of equity shares means cancelling equity shares. If equity shares are getting cancelled, that means effectively equity share capital also will get cancelled. Yes or no? Correct? When you're cancelling equity shares, you're nothing but you're cancelling equity share capital. Okay. Alright. That means what do you think this 1 lakh will become? Company cannot cancel 100% of equity shares. But for simplicity, let's ignore that fact. There is some buyback limit also, which we will discuss in a bit. Just going back, let's say company wants, for a minute, forget about the limits. Let's say 1 lakh of equity share capital is getting cancelled. Meaning from 1 lakh, this will become 0. Practically, it is the Companies Act does not allow this. I'll get to the limits, but for now, just be with me for 2 minutes. Okay. Equity share capital is 1 lakh. So the company bought back or cancelled equity shares. So equity share capital became 0. Okay. Now the problem here is, see, equity shareholders are the owners of the company. Yes or no? Equity shareholders are the owners of the company. Now, and this bank loan people and all are outsiders. Correct? Outside liability holders. Equity shareholders are owners of the company. So normally, who should get their money first? Owners or outsiders? Who should get their money first? Owners or outsiders? Outsiders. Yes or no? First, outsiders should be paid, and then only the owners will have to take back their money. But check what is happening here. Bank loan liability is still at 2 lakh. That is not settled or that is not paid. But equity share capital, from 1 lakh it became 0. That means owners have got back their money. Yes. But outsiders have still not got back their money. Yes, there's a big problem. Yes or no? Because since owners have got back their money, if some reckless decision is taken, if the decisions are taken carelessly, okay, and if company goes into bad position, then what will happen to these guys? They'll be in serious trouble. Because these guys cannot go back to equity shareholders and say, give me your house, give me your car, give me your jewelry. Like that, can they go and recover the money? No. Why? Because company has limited liability. How much ever shares the equity shareholders have taken, to that extent only they are liable to pay. Personal assets of equity shareholders are never liable. Yes or no? That's how it works, the company. It works on a limited liability concept. Yes. So if something happens, means these guys will be in serious trouble. Yes. But owners, because I've already taken back their money. to protect the interest of these outsiders, they introduced a concept known as CRR, that is Capital Reduction Reserve. Capital Redemption Reserve, that CRR, Capital Redemption Reserve. Whenever a capital is getting redeemed, whether preference shares is getting redeemed or cancelled, or equity share capital is getting cancelled, doesn't matter. The concept is same. Whether you are cancelling preference shares or equity shares, the CRR concept is same. Our topic is restricted only to equity shares, so let's concentrate only on that. Okay, whenever you buy back equity shares, your company has to create a reserve known as CRR, that is Capital Redemption Reserve. This is created with an intention to protect the outside holders. To what extent you will create? Check. What was the capital before? Before buyback, the capital was 1 lakh. After buyback, how much is capital? 0. So what is the gap in capital? Meaning after buyback, how much has capital got reduced? 1 lakh. That means there is a gap in capital to the extent of 1 lakh, right? That gap has to be filled up by creating a reserve known as CRR account. So how much ever extent gap in capital is there, that gap has to be filled up. You fill that gap by creating a reserve known as CRR. Alright? So how does it protect bank loan ka people? So CRR is created from free reserves like general reserve, P&L and all. Okay, whenever you create free reserve, right, or a CRR, right, your free reserve balance will reduce. It will not be 3 lakh. How much CRR did you create? 1 lakh. That means P&L balance from 3 lakh will become 2 lakh. Why did it reduce? Because from 1 lakh you have transferred from P&L to CRR. Hence CRR balance increased and your free reserve, as in free reserve means general reserve or P&L, their balance will reduce. Now, how does it still protect? See, earlier P&L balance was 3 lakh. That means it was possible for a company to give a dividend to shareholders to the extent of 3 lakh. Why 3 lakh? Because there is 3 lakh balance in P&L account. Now there is, after you created CRR, does your P&L have 3 lakh balance? No, it only has a 2 lakh balance. That means at best, how much dividend can the company give to the shareholders? Only 2 lakh. That means this 1 lakh worth of funds is getting blocked. That way, outsiders' interest gets protected by creating a reserve known as CRR. Are we fine? Alright, so that is a concept. This is what will be asked you in the examination. How much CRR needs to be created? Okay, one easy way to remember is how much ever extent capital gap is there. To fill that gap, we have to create CRR. Like, are we okay? Alright, just to make you understand, let me take the same example but under second case. Okay, same values we're going to assume. Equity share capital was 1 lakh. Your P&L balance is 3 lakh. Your bank loan balance is, let's say, 2 lakh. Okay, you're buying back equity shares. That means from 1 lakh this will become 0. Alright, now second method is, first method is you are utilizing profits and you're doing the buyback. You utilized the profits and or reserves in surplus and you did the buyback. Second method is shares and securities. Here what will happen is, new shares will be issued to buy back the existing equity shares. I'll repeat that. New shares will be issued. Generally, it will be new preference shares. The company will issue new preference shares, okay, and they will buy back equity shares. How much equity shares are being bought back? 1 lakh. So they will issue new preference shares or new face value of preference shares. They will issue to the extent of 1 lakh rupees. All right. Why? Sir, anyway, to do the buyback, company needs money, no? Because equity shareholders, the company has to pay equity shareholders. Yes. To raise the money, company is probably wanting to issue new preference shares. That's one way of they raising the money. Alright. Hence the method name is shares and securities. The company is issuing new preference shares to raise the money, and that money will be utilized to pay off the equity shareholders because you're buying back equity shares. Like that. Are we okay? Now check this scenario, what is happening. Equity share capital from 1 lakh became 0. But how did you redeem these equity shares, or how did you buy back those equity shares? By issuing new preference shares. Whenever company issues new preference share capital will come into picture. Whenever company issues new preference shares, preference share capital will come in. To what extent the preference shares was issued? 1 lakh. That means preference share capital will come into the extent of 1 lakh. Now can you tell me how much CRR will you create? CRR you create, what is the thing I told? CRR is created to fill capital gap. How much is the equity share capital before? 1 lakh. From 1 lakh it became 0. So what is the gap in capital or reduction in capital at this stage? At this stage the gap in capital is 1 lakh rupees. Yes. But did the company did they not issue new preference shares? Worth how much? 1 lakh. That means what? Are they not compensating? Yes, they are getting compensated. That means what? You will create CRR to the extent of 0. Why? Check. Earlier, what was your total capital? You had only equity share capital worth 1 lakh. Yes. After buyback, what is your total paid up capital? Equity share capital may be 0. Preference share capital is 1 lakh. That means what is your total paid up capital? 1 lakh. Earlier it was 1. Now also it is 1. So that means, is there any reduction or gap in capital? No. That means CRR created is 0. Okay, this is what, or these sort of questions they will ask you in the examination. How much CRR needs to be created, and what is the journal entry you will pass for this CRR creation. Okay. Third method is combination, meaning partly profits, partly reserves in surplus, and partly shares. Let's say we used profits to the extent of 70,000. We are issuing new preference shares to the extent of 30,000. Same component. If you take equity share capital is 1 lakh, P&L balance is 3 lakh, loan balance let's say is 2 lakh rupees. You bought back equity shares. So that means from 1 lakh it will become 0. Okay. Now, what mode of buyback are you doing? Partly shares, partly combination. How much new preference shares worth have you issued? 30,000. So if you are issuing preference shares, means preference share capital will come to the extent of 30,000. Yes or no? Correct. After doing this, is there any still gap in capital? A reduction in capital? Yes. Earlier capital was 1 lakh. After buyback, the capital is only 30,000. So how much is the gap in capital still? 70,000. To that 70,000 extent, you have to create CRR. Okay. And CRR is created from free reserve, meaning from P&L or general reserve. So due to CRR, your P&L balance or general reserve balance will reduce by 70,000 and your CRR balance will increase by 70,000. So your P&L balance will not be 3 lakh, it will become 2 lakh 30,000. 70,000 reduction basically. Okay, that's all right. This is one way you can remember. So how much ever capital gap is there, that extent you need to create CRR. Or another way to remember that is, okay, in first case, how much profits you utilize to create to buy back equity shares? 1 lakh. That means how much CRR did you create? 1 lakh. In second case, you redeemed entirely by issuing preference shares. That means how much profits did you utilize for the purpose of buyback? 0. So how much CRR are you creating? 0. In third case, how much profits you utilize for the purpose of buyback? 70. That means how much CRR are you creating? 70. To whatever extent you are using your reserves in surplus, okay, or your profits, to that extent you need to create CRR. All right. That is about that, and that is another way to remember this particular CRR concept. CRR means capital redemption reserve. Okay. This all is the background relating to this. Based on this only, all of your questions are based. Okay. Now, once you are, if you are through with this, I think we can take up and read up the other components and work out maybe one problem. Buyback of meaning now I think you are already clear. Buyback of equity shares means cancellation of equity share capital. That's all. All right. Another one is there are certain provisions relating to buyback because all these are backed by Companies Act. Left, right, center you cannot do. Okay. One, if you want to do buyback, there must be a provisions in Articles of Association. Your Articles of Association must authorize the company to do the buyback. That is one. All right. Another one is only fully paid up equity shares can be bought back. Meaning, when we say fully paid up, let's say face value of the equity shares is 10 rupees. All the shareholders should have paid this 10 rupees. Only if the shares have reached face value mark, meaning if the company has recovered entire face value of that shares, only those shares can be cancelled or bought back. If there is any partly paid up share, let's say there is some share where the shareholders are paid only 8 rupees, then you cannot do the buyback on this unless you collect full money from them. This is one of the Companies Act of condition. Only fully paid up equity shares can be bought back. Okay, that's one. And Articles of Association must authorize your buyback. And once you pass resolution, no? For buyback there is a resolution required. Up to 10% of buyback, board resolution is good enough. Beyond that, up to 25%, you need special resolution. Up to 10%, board resolution is good enough. Beyond 10, up to 25, you require special resolution. From the day you pass resolution, the buyback should be completed within 12 months of that. Okay, those are some provisions relating to Companies Act. Now, as I discussed previously with you, 100% of buyback is not possible. There are certain limits. These limits are prescribed by Companies Act of 2013. Okay, so what is the maximum buyback? There are 3 limits which the Companies Act has specified. One, there are 3 tests also you can call it. 3 tests you need to do. Whichever test gives you the lowest number, that is the maximum amount of buyback which the company can do. Okay. First limit is 25% of number of equity shares. Like, let's say company has 1 lakh equity shares. The company has 1 lakh equity shares, not the value. 1 lakh equity shares, number. In a year, company can cancel only 25% of that. Entire 1 lakh cannot be cancelled. How many ever shares the company has, only that 25% you can cancel. That means only 25,000 shares can be cancelled as per the first limit. 25% of the number of equity shares. Okay. Second limit is 25% of paid up capital, free reserves and security premium. Calculate paid up capital, free reserve. Free reserve means general reserve and P&L. Free reserve means any reserve from which the company can give dividend. Any reserve which is available for dividend declaration, we call it as free reserve. That generally in all our problems it is general reserve or P&L. Okay, but otherwise also, if they give you any reserve in the problem, and in bracket may if they say this reserve is available for dividend declaration, then automatically that reserve becomes a free reserve. Okay, but commonly in our problems we see only general reserve and P&L. Only that constitutes your free reserve for our problems. So second limit is 25% of paid up capital plus free reserve plus security premium. You add this, whatever value you get. Okay, let's say that value, 25% of that value, if you multiply, you're going to get to be 10 lakh. That is the maximum value of buyback you can do in a year. Okay, your equity share capital could be 1 crore, 20 crore, 5 crore, doesn't matter. This value, this 25% of this number you multiplied, no, whatever value you get, that is the maximum value of the shares that you can buy back, not beyond that in a year. Okay, that's the second limit. Third limit is debt equity ratio after buyback. After you do the buyback, debt equity ratio should not exceed 2. Debt equity ratio means you have to compare the debt versus equity. Debt here stands for short term and long term loan. Debt means basically loan. Short term bank borrowing, long term bank borrowing, debentures, all these are debts. Compare debt with equity. Okay, if you have 1 rupee of, or let's say if you have 100 rupees of equity, then maximum debt is allowed is 2 times of that, that is 200. For 1 rupee of equity, maximum debt you can have is twice, that is 200. Like this, if 100 rupees is equity means maximum debt should be 200, it should not go beyond 200. Okay, that is what is one of the condition. Debt equity ratio after buyback should be lesser than or equal to 2. Maximum it can be up to 2, it cannot go beyond 2. So check all these 3 limits, whichever is the lower number among all this, that is the maximum value of buyback that you can do in a particular year. Okay, all right. Next, capital redemption reserve. This I've already covered. So CRR is created to fill the capital gap, or another way is create CRR to the extent of free reserve utilized. How much of a profits or free reserve you utilize, to that extent you can create CRR. Alright, for the purpose of CRR, no, ignore the premium on buyback and premium on new issue for CRR purpose. Sometimes what happens is, let's say you have 1 lakh equity shares, okay, or let's say 10,000 equity shares of 10 each. So that means totally 1 lakh. Alright, this is the number of equity shares, and this is the face value of equity shares, and this is the total face value. This 10,000 is the number of equity shares which the company wants to buy back. They've already tested the limits. This 10,000 is well within the limits, let's assume. So 10,000 shares the company wants to buy back. Let's say company has 1 lakh shares. Entire 1 lakh they don't want to cancel. Now they want to cancel only 10,000. So it is well within the limits. So 10,000 shares they want to cancel. Okay. Whose face value, total face value is 1 lakh. So if the company wants to cancel means shareholders have to surrender their share certificate. Correct? No. Shareholders have to also agree for it, and they have to surrender their share certificate, because once they surrender their share certificate, company will tear off that certificate and give the equity shareholders their money. That's how buyback will work. Shareholders will give the share certificate to the company. Company will relinquish or will tear off that share certificate, and it will give the money back to equity shareholders. That's the process of buyback. Yes. Alright. Shareholders are telling, we are okay with buyback. This 10,000 shares you want to buy back, no? We are okay with it. But I don't want you to pay me 1 lakh rupees. I want you to pay me, on 1 share, I want you to pay me 30 rupees. Okay. I'm fine. 10,000 shares you cancel. Alright. But I don't want 1 lakh. Totally, I want 3 lakh rupees. Face value of the share may be 1 lakh. They are saying, they're demanding, there's a negotiation, right? So they are saying, give me extra. Okay, because equity shares does not have any expiry date. See, if you take a bank loan will have a term, right? Maybe 5 years, 10 years, etc., etc. But equity shares does not have any term. It goes on forever. Unless the company is there or company wants to cancel, equity shares will always be there. Okay. Hence, equity shareholders are demanding, you want to cancel my shares, but I really don't want to. But since you are so hesitant, or since you are desperately want to cancel my shares, I don't mind. but you have to give me something extra. Totally, you have to give me 3 lakh. That they are hell bent on that. If you don't give, we will not give the share certificate. Company told no problem. I accept it. I will give you 3 lakh rupees. You give me your share certificate. Now you tell me what is happening here. Face value of the equity shares is only 1 lakh. But how much is the company paying to buy back those equity shares? 3 lakh. So how much extra the company is paying for the purpose of buyback? 2 lakh. Yes or no? This only we call it as premium on buyback. Premium on buyback. The extra price that you paid. Okay, because face value of the share is only 10 rupees, but you paid 30 rupees. That means on one share you paid 20 rupees extra. So 10,000 into 20 if you do, you're going to get same 2 lakh rupees. Yes, that extra is premium on buyback. This premium on buyback should be ignored for CRR purpose. I'm not asking you to ignore it for journal entry sake. Ignore it for CRR purpose. Why? So CRR is created to fill capital gap. Okay, alright. So premium on buyback. This premium is a loss, right? Whatever you pay, it's a loss. Loss will be transferred off where? P&L account, or you can adjust off with security premium, which I'll tell you in a bit. Are you okay? So premium on buyback will not be your capital. No? Is this your share capital? No. So premium neither creates gap nor it will fill the gap. Hence, the premium on buyback should be ignored for CRR purpose because it neither creates the gap nor fills the gap. Gap means only the face value of capital, share capital. So it does not affect the face value of share capital, hence premium is ignored for CRR purpose. Similarly, if there is any premium on new shares or debentures, because we already discussed over here, no? There is another method, second method of buyback is what, sir? New preference shares. Okay, company can issue new preference shares and buy back equity shares. If new preference shares are issued, they can be issued at par or at premium. Yes. Alright, let's say this new preference shares ka face value is 1 lakh, but it was issued at 1,50,000, meaning they issued at a premium of 50. They issued this new preference shares at a premium of 50,000. Alright, whenever premium is collected on new shares or debentures, where will this premium go to, sir? You pass the journal entry if you remember. What is that? Share allotment account debit to equity share capital to securities premium. Yes or no? If you allot preference shares also same entry. Yes or no? Whether you collect the premium on equity shares or preference shares or debentures, this premium collected will go to securities premium account. Is security premium your capital? No. Hence what? Premium paid or premium collected, it neither creates the gap nor it fills the gap. Hence both the premium are ignored for CRR purpose. For CRR, you only take the face value of share capital. Okay? Check how much has the face value of the share capital reduced by. To that extent, you have to create CRR. Is that okay? Alright. That's about this provision. Buyback methods I've already discussed with you here. That is alright. Next, buyback ka entries. Entries of buyback is very straightforward if you ask me. One, first you are cancelling equity shares. No sir. Equity share capital you are cancelling. Share capital has what balance? Credit balance. How do you cancel that? By debiting. So first journal entry will be equity share capital account debit. Let's say face value of the equity share capital is 100. We just now learned. Buyback means it's a negotiation. Okay. The shareholders may not be asking for 100. They may say give me more. They may say give me 120 rupees. Possible. For instead of 100, they may say give me 20 rupees extra. What does that take? How much extra? 200. That extra only we said what, sir? Is the premium on buyback, right? So the journal entry is equity share capital account debit 100. Okay. Sometimes what happens, we may have to pay extra money to the equity shareholders due to this buyback. So it's a loss for the company. As per nominal account rule, loss to be debited. That loss only we call it as premium on buyback. Here loss I've assumed it to be 20 rupees. That means totally how much you need to pay to equity shareholders? 120. That you credit in a separate account known as to equity share buyback. Some books also will, instead of using equity share buyback, some books straight away write to equity share holders account. Because this 120 is payable to equity share holders. But our study material is using equity share buyback, hence I've brought in the same component. Is that okay? That is good. Next, this premium on buyback is a loss. Where do you think we'll transfer this loss to? P&L. But there is one section 52 of Companies Act 2013. What it says is, if there is any premium on buyback, instead of transferring that loss first with P&L, you can set it off with security premium account. Okay, and this 20 rupees I've assumed that is loss, right? Okay, that loss first, instead of transferring directly to P&L, first check if there is any balance in security premium. Let's say security premium has a balance of 50 rupees. Okay, how much is premium on buyback or that loss? 20. That means, can you set off this 20 with this 50? Yes, because security premium has enough balance. If security premium has enough balance, then this premium on buyback, you can set it off with security premium. So the journal entry will be, you have debited this premium. To transfer, what you will do? Credit. So you will credit premium on buyback. Debit, either you will give it to securities premium. If security premium is not there, you will transfer, you will set it off either with general reserve or PN. Check. If security premium is there, utilize that first, because security premium has only 5 utilization as per section 52 of Companies Act. Okay. One of the utilization is this. Since it's a restricted reserve, first try to set off this loss with securities premium. If security premium does not have balance, you can adjust it either with general reserve or P&L. That's a transfer entry. So the journal entry, security premium or general reserve or P&L account debit to premium on buyback account. Okay. Then I already discussed, whenever there is a buyback, you have to create one reserve to fill capital gap. What is that? CRR. CRR is created from what reserve I told? Free reserve. So when you create CRR, your free reserve, as in your general reserve or P&L, balance will reduce and your CRR balance will increase. So the journal entry will be general reserve or P&L account debit to CRR account. These balances will reduce, CRR balance will increase. So that is your journal entry to create CRR. Lastly, you may have to pay money to equity shareholders. No? So you are not called out equity shareholders here. You have used the term equity share buyback. So when you pay the money, the journal entry will be equity share buyback account debit to bank. These are the 4 entries which will normally come in almost all of your questions of buyback. Other than this, there could be some extra adjustments like for the purpose of buyback, company sold some assets. Because due to buyback, you need some money to pay equity shareholders. No? So if company may choose to sell some of their assets or some of their investment, so sale of asset, sale of investment, etc., could also be some extra fittings that could come. But these are some of your basic entries that will come in almost all of your buyback related problems. Okay, don't worry, we'll also see one of the questions just to see that, but I'm just discussing the whole thing first, then everything we will apply it. Okay, all right. Another one is equity shares with the differential rights. Okay, what does this mean? Let's say there is a company B Limited. They have, let's say, 3 shareholders. Okay, shareholder 1, shareholder 2, shareholder 3. Okay. Now, can company give, normally sir, what sir? One share means, one equity share means 1 vote. Yes, no, that's how it is normally works. If you own 1 equity shares, normally you get 1 vote. Okay. And one more thing is, all the shareholders get the same rate of dividend. Let's say a company wants to declare 5% dividend. Okay. Alright. That means all the shareholders will get based on how many ever shares they are holding. Yes or no? Based on the value of the shares they are holding, they will get the shares. Now, the question is, let's say same company, B Limited, I'll make another example here. Okay. To one type of shareholders, can the company give dividend at the rate of 10%, and to another type of shareholders, can they give dividend at the rate of 20%? Okay. To one set of equity shareholders, can the company give 10% dividend, only 10% dividend, and to another set of equity shareholders, can the company give 20% dividend? Or can the company say, type 1 shareholders will get for 1 share 1 vote. If they are holding 1 share means they get 1 vote. Type 2 shareholders, if they own 1 shares, they get 2 votes. Like this, can the company differentiate? What's the question? Alright. I am not looking for an answer from you. Answer is given here. That's what we mean by equity shares with the differential rights. As per the Companies Act, the company is eligible, or the company, if they want, they can issue these sort of shares. Meaning, to one set of shareholders, they may give different dividend. To another shareholders, they may give different percentage of dividend. 1% of shareholders can have one set of voting rights. Another set of shareholders can have another type of voting rights. So they could have a differential rights depending on the shares that they are holding. Both are equity shareholders. But in equity shares, you can further categorize. That we refer it to as equity shares with the differential rights. It is possible for the companies to issue it. Okay, that Companies Act right now makes it available. Okay, many companies these days, or not many companies, some of the companies, if you observe, they have these equity shares they have issued. Okay, especially with respect to dividend rights, they have issued. But there are certain Companies Act of provision that you need to maintain, or you should have complied. Like one, it should be authorized by articles of association. And 2, you should not have defaulted in filing your financial statements with ROC. You should have not have defaulted in paying dividend. You should have not have defaulted in paying the loan of a banking loan or any other financial institution loan. Like there are certain provisions of Companies Act. If you have complied with that, then the company can issue shares with the differential rights. This is one question. Sometimes they ask it as theory. Okay, there could be some theory questions coming from this particular concept. Okay, but do remember, only equity shares with the differential rights can be issued. The company cannot issue preferential shares with the differential rights. That is also once it has come in the previous year paper. Can company issue preferential shares with differential rights? Okay, like this they had a question. The answer is no. Companies cannot issue preferential shares with differential rights. The company can issue shares with differential rights only for equity shares. Those are some of the provisions. Okay. Alright. So let's do a thing. Let's apply the buyback related provisions in one of the questions. This question is also from study material only. D Limited, they have a balance sheet as on 31st March 20x1 and all the numbers they are saying is 1000. So they've given this balance sheet, share capital, reserves and surplus, trade payable, all these are usual, nothing much. Note stock accounts, they're saying the company has 2,50,000 equity shares of 10 each fully paid up. We know one of the provisions, right? If the company wants to do buyback, then all such shares must be fully paid up. Here is it fully paid up? Yes. That means company, if they want, they can do the buyback. Then the company has 2,000 preference shares of 100 each, they're saying. Alright, this is important. Issued 2 months back for the purpose of buyback. The company has issued this preference shares only for the purpose of buying back equity shares. To buy back equity shares only, they've issued preference shares. Otherwise, this preference shares would not have been issued, is what they are trying to say. Let's keep this in mind. I'll discuss this later. They've given various reserve. Capital reserve is not a free reserve. Revenue reserve is a free reserve. Security premium is not a free reserve. P&L is a free reserve. Revenue reserve means your general reserve. Free reserve means those reserve which is available for dividend declaration. Security premium and capital reserve is not available for dividend declaration. That means only revenue reserve and P&L account is your free reserve component. Why it's very important to categorize? You create CRR only by using free reserve. That is the reason it's important to identify what is a free reserve in the problems. Okay. Alright. The company has passed a resolution to buy back 20% of its equity share capital at 50 per share. Okay. So how many shares does the company have? Equity shares. They have 2,50,000 shares. Entire shares they are cancelling. No. The company is cancelling only 20%. So 2,50,000 cut 20% will be what? How much will be that amount? That will be what? 2,50,000 into 20% will be 50,000 shares the company is cancelling. Okay. What is the face value? 50,000 shares they are cancelling. Each equity share ka face value is 10 rupees. So the face value is 5 lakh rupees. Okay. But what is the buyback price? What is the buyback price? They're cancelling 50,000 shares, alright. But on one share, are they paying 10 rupees? Face value of the share is 10 rupees. But is the company paying 10 rupees for the purpose of buyback? No, they are paying 50 rupees. That means what is the buyback price? 50,000 into 50, that is 25 lakh. Yes. For 5 lakh worth of share, the company is paying 25 lakh. How much extra is the company paying? 20 lakh. At extra only we call it as what? Premium on buyback. Yes. So premium on buyback is 20 lakh. You can also get it like this. 50,000 shares. 10 is the face value. Buyback price is 50. That means how much is the extra being paid out on one share? 40 rupees. So 50,000 into 40 if you do, same 20 lakh you're going to get. And this is the thing. For this purpose, it sold all the investment for 22 lakh rupees. Entire investment it sold off. You need to pass the journal entry and they are asking you to prepare balance sheet. First journal entry. You sold investment for 22 lakh. What is the journal entry? Bank account debit 22 lakhs. They're showing all the numbers in thousands. If you want, you can write it in full number also. What is the investment ka value, sir? Investment ka value is 3,000. They've expressed it in lakhs. So this is 30 lakh. 30 lakh of investment, they sold it for 22 lakh. That means they made a loss of 8 lakh. Which if you want to express in 1,000, it will become 800. Loss will go off to P&L. No? So bank account debit, P&L account debit. There's nothing but loss on sale of investment. To investment account. 30 lakh rupees. This is the first journal entry for investment being sold. Then the usual buyback entries. What is the first journal entry for buyback? Equity share capital you're cancelling means equity share capital as credit balance. How do you cancel that? By debiting. You already wrote that. What is the face value of equity share capital? 5 lakh. So you'll write the entry equity share capital account debit 5 lakh. Premium on buyback account debit 20 lakh. to equity share buyback 25 lakh. Okay. This premium and buyback is a loss. That loss, first you will let it off with security premium. However, security premium should have a balance. Premium is 20 lakh rather. Check, do you have 20 lakh balance in security premium? Yes, we have 22 lakhs. So that means enough balance is there. Okay. So which you can net off then. So the entry will be what? Security premium account debit 20 lakh to premium and buyback 20 lakh. Okay. That's the entry. Then whenever you buy back, you need to create one reserve known as CRR. Okay. To the extent of capital gap. Check. How much is the face value of for CRR purpose? You should only take the face value because capital is always shown at face value. How much of equity shares face value you are cancelling or buying back? 5 lakh. That means your capital is reduced by 5 lakh rupees due to buyback. Yes or no? No matter what, you need to fill up this gap because capital is reduced by 5 lakh. No, it will be unfair for the outside liability holders. So this capital gap has to be filled up. Two ways to fill it up. One by creating CRR or by issuing new shares. There are two ways to create or to fill out this particular gap. Check, did the company issue any new shares? They have not given an adjustment. But go back to the question. The company issued preference shares when 2 months back before 2 months before buyback only they have issued. But for what purpose did they issue this preference shares? Only for the purpose of buyback. If buyback was not done, means this preference shares would have not been issued. Yes, so you can consider this also. It's not necessary the preference shares has to be issued after buyback only. If preference shares are issued for the purpose of buyback, whether before or after, it is fine. Alright. So how much preference shares was issued? All these numbers are in thousands. That means this will be 2 lakh. So out of 5 lakh, 2 lakh gap is already filled up by issuing by preference shares. How much gap is still remaining? 3 lakh. That you have to fill it up by creating CRR. So the journal entry is what? Either you will use free reserve. You have two free reserve here. One is revenue reserve, that is nothing but general reserve, or P&L. Choice is yours, you can use anything. Here they've used revenue reserve as in general reserve. If you want, you can also use P&L, there will be not a column there. So revenue reserve account debit to CRR account, 3 lakh rupees the entry. Okay. Lastly, after doing all this drama, you need to pay money back to the equity shareholders. So the journal entry for that is equity share buyback account debit 25 lakh to bank account 25 lakh rupees. That's your entry. Okay. So that's all. This is your journal entry. At best, after this, they may also ask you to prepare balance sheet. Balance sheet after buyback. Due to buyback, various values will change. That's all. Now, if you want, you can just check. What was equity share capital before? Before it was 25 lakh. How much equity share capital face value got reduced? 5 lakh. That means equity share capital will only become 20 lakh. Preference share capital is still 2 lakh only. That means what is your total capital, sir? Total paid up capital is 20 lakh of equity share capital, 2 lakh of preference share capital. So in your balance sheet, total paid up capital will be 22 lakh rupees. Reserves in surplus balance will change. So it's better to prepare a note for that and accordingly check. Okay. Or maybe we can work it out from the question only. Capital reserve, anything changed? No, it is 1000 only. This is same. Revenue reserve? Yes, it changed. You created CRR. No? How much CRR did you create? You created CRR to the extent of 3 lakh. 3 lakh if you have to present in 1000, that will be 300. So revenue reserve will reduce by 300, meaning it will become 2700. Why did it reduce by 300? Because you created CRR from revenue reserve. So, okay. How about securities premium? Yes, there was a premium on buyback of 20 lakh, or if you have to express in 1000, that will be 2000. That you adjusted from securities premium. I mean, security premium will only be 200. P&L account. I think you sold some investment at a loss. How much investment loss you made? 800 or 8 lakh. Okay, so minus 800 if you do, this will be what? 2000, 3500 minus 800 will be 2700. Yeah. Along with this, no, there will be one extra reserve also. If you just check there, the company does not have CRR. After buyback, we need to create one CRR also. So one CRR also will come to the extent of 300. That means total if you do all of this, okay, then that will be the value. Okay. So your capital reserve is 1000. Revenue reserve is 2700 plus your security premium is 200, your P&L is 2700 plus your CRR is 300. So total if you do, my calculator is showing 6900. That should be your value of reserves in surplus in the new balance sheet after buyback. Okay. Alright. Anything else? Trade payable, nothing changed to 1400 only. Property, plant and equipment also nothing changed. So 9300 only. So those two values will be same only. Okay. This is the total liability side. Then in the question they had given this one, non-current investment. This will not come in the balance sheet because it's already sold. So that will not come. Inventory, no change, it will be 500. Trade receivable also no change, 200 only. So this will be 500, 200 only. Next they have shown is cash and cash equivalent. This balance will not be 800, it would have changed. Because one, you sold investment. Yes, when you sell investment, you got some money. How much money you got by selling investment? You got 22 lakh or 2200. Then for the when you did buyback, you had to pay money to equity shareholders. How much you paid? 2500. Yeah, 2500 you have to pay to for buyback portion. That means how much will be, sir? 800 plus 2200 minus 2500 if you do. The bank closing balance or cash and bank closing balance is 500. That should come in your new balance sheet. Has it come? Yes. That is your total of balance sheet. That's all. Okay. Check based on the time you take a call preparing the notes documents. Ideally, you should also, one note you need to prepare for share capital, one note you need to prepare for reserves and surplus, because there will be a lot of things there. Okay. If you have time, prepare this. If you don't have time, show all the components inside balance sheet itself. It's always again time versus marks wala concept in CA. Take a call based on that. Okay. So with this, yes, buyback related portion also we have completed. Thank you. Hello guys. The next topic is accounting for Esop or employee stock option. So as the name itself is saying, Esop as an employee stock option. These are nothing but some shares given to the employees of the company, but at concessional price. So Esop means some extra shares given to the employees of the company at concessional price. Now, why do you think company has to give them shares to the employees? As such, anyway, the employees get salary, no? Yes, they get 101 things. So why shares? Basically, shares or Esop is one of the means to retain the employees. Okay, it's one of the main intention to, or it's given basically to retain the employees, because once you own shares of a particular company, no, you are an owner of the company or part owner of the company. Yes. So to retain the employees, or employees feel more connected with the company because he feels now he's the owner of that organization, or at least part owner of that organization by having shares. So he'll be more motivated to stay in the organization, work better and stay longer in the organization. So to motivate and retain the employees, Esop is Esop is usually given by the companies. Okay. Now, what is the scope of Esop for us? Alright. So Esop, again, they will give you a small scenario where the company would have given Esops to the employees. All we have to do is pass the journal entries whenever Esops has been given to employees. That's all. Okay. Journal entry is the scope of this particular topic. Okay. Alright. One, we know that Esop has to be given at concessional price, meaning let's say the market price, let's say there is one company, maybe X Limited, they want to give Esop to their employees. The market price of the share is 100 rupees. The market price of one share of X Limited is 100 rupees. X Limited, do you think if they give Esop to these employees at 100 rupees only, do you think employees will be motivated to buy that? No. If X Limited gives Esop to the employees by charging 100 only, see, Esop is not given at free of cost. Esop means the shares are given to the employees by the company at a discounted price or at a concessional price. If the company gives the shares to employees at market price, then nobody will buy. Because what do you think employees will tell? I have my own Demat account, okay, Zerodha or whatever. Okay, I'll buy the shares using my Demat account only. Why should you give me that? What's in it for me? Okay. So if the company issues these shares at market price, then nobody may be interested to buy them. Yes. Let's say X Limited told, okay, I know that at 100 rupees you are not interested. X Limited is giving the option to the employees now. If you want, you can buy my company shares at 70 rupees. Now do you think some of the employees may be interested? Now they may be interested. Why? Because the market price of the share is 100, but the employee has a chance or has an offer to buy these shares only at 70. Yes, this 70 we call it as exercise price. Okay, that exercise price means the price the employee has to pay to the company to buy this Esop shares. The money given by the employee to the company to buy these Esop shares, we call it as exercise price. Okay. Generally, it will be lower than market price. So, how much is the discount over here? 30 rupees. This is the discount that we are referring to. Alright. So, you don't have to bring in Companies Act ka funda over here. So, Companies Act prohibits share to be given at discount. No. What Companies Act says is, let's say face value of the share is at 10 rupees. What Companies Act says is, no company shall issue the shares at a price below face value. The company cannot issue any shares below this face value, below 10 rupees. That is what they mean by the shares cannot be issued at discount. If company is issuing the shares at below the face value, that is called as discount as per Companies Act. Here when we use the term discount, we don't compare face value with to get the discount. Here we are ascertaining the discount by comparing market value and exercise price. Okay, this is what is a discount as far as the ESOP is concerned. For this, there is no prohibition in the Companies Act. Companies Act prohibits only issuing the shares below the face value. Okay, this is okay. That's one. Okay, so we got to know why it's issued. Basically, to retain the employees. One, and another one is it is issued at a concessional price. Now, there will be certain terminologies that will be used in our problem. So let's get acquainted with that. One is grant date. They say grant date means, see, there's an offer between whom the company and the employees, right? So company is offering something. So it is basically an agreement. Agreement means both the parties should agree to the terms and condition. The day the terms and conditions have been agreed upon is what we refer to as grant date. Grant date is a date on which the terms and conditions of this ESOP agreement has been agreed by the company as well as the employees. And if by chance this particular ESOP scheme, if it requires shareholders approval, okay, then the day on which the shareholders approval has been received, that we refer to as grant date. So basically grant date means the day on which all the terms have been agreed by company and employees, and this particular ESOP scheme is also approved by the shareholders. That particular day becomes your grant date. Okay, again it will just come in the problem, not that important for examination, just that you should know this terminology. That's all. Vesting period means waiting period in simple terms. See, normally even companies are not this thing. Companies are also smart, yes or no? Because they know. They will also think, okay, I want to give ESOP to the employees. Meaning I want to give my company shares to the employees. After that, if they buy my shares and if they leave the company, like here, market price of the share is 100. The company is willing to offer the shares to the employees at just 70. What will the employees do? He will nicely buy the shares. Okay, quit the company and sell the shares and make money. Yes or no? Quite possible. So hence what normally an ESOP and all, no, they will not give ESOP in one installment. Normally what the employees company will tell is, they'll put some conditions. You know, now for everything there will be terms and conditions these days. Even for ESOP there will be terms and conditions. Normally what do you think the employees will say is, okay, companies will say the employees, I will give you 100 shares. I'm just giving you a small example. The company is telling one employee, I will give you 100 ESOP, provided you stay in my company for 2 years. The company is telling one of the employees, he is a key employee, good employee, which the company wants to retain. So it is telling him, boss, hey employee, I will give you 100 ESOP or employee stock option, meaning 100 shares I will give you, provided you stay in my company for a minimum period of 2 years. So if this employee wants to buy this 100 shares, not at a concessional price, he has to stay in the company for a minimum period of 2 years. If he quits within 2 years, he will not get any shares. Okay, minimum he has to stay. That we refer it to as waiting period or vesting period, or that waiting period we call it as vesting period here, meaning the period for which employees have to wait before he is eligible to buy the shares. That period we call it as vesting period. Okay. Alright, fair value of the option. You know the discount here we refer it to as fair value of the option. We don't call it as discount, we call it as fair value of the option. So how do you get the discount? Basically market price minus exercise price. From market price and exercise price, if you compare, you will get the discount element. That discount element only, instead of discount, we call it as fair value of the option. That's all. Okay, that's what I've written it over here. Market price minus exercise price. Right? Exercise price we already discussed. Exercise price means the price the employee has to pay to purchase these ESOP shares. Alright? There could be 3 types of employee stock option plan. Okay, only one is there in our syllabus. One is equity settled plan. Equity settled plan means the company will give shares to the employees, or employee gets shares from the company, like that. There is another thing known as cash settled plan. Cash settled plan means here the company will not give shares to the employee. The company will give money to the employee. How much money the company will give to the employee is based on the share price. The employee will receive cash based on the share price of the company. That we call it as cash settled plan. Another one is equity settled plan with cash alternative. This is like this. Okay. Either here under equity settled plan with cash alternative, company will either give cash to the employees based on share price, or it will directly give shares to the employees. And this choice of taking the shares or cash maybe with the company or maybe with the employee. Only this is there in our syllabus. These two plan you will not learn here in CA Inter, you will learn in CA Final. There is a standard known as Ind AS 102, share based pay. About these two, you will learn it in CA Final. So you need not worry too much about those two components for the time being. It is just there, so that I'll quickly discuss. Okay, this is what equity settled plan, wherein employee gets shares. That is the plan for which we need to pass journal entry and in our CA as per as our CA Inter syllabus is concerned. Alright, so vesting period is very important as far as the journal entry ka treatment goes. Before you start journalizing, one of the first observation you need to do is, or you need to check is, what is the vesting period? Okay, you need to basically check whether the vesting period is less than 1 year or more than 1 year, because the accounting treatment or the journal entry is different for different thing. If it is less than 1 year, there is one sort of journal entry. If it is more than 1 year, then we need to do some slightly different treatment. So this is first thing you need to check. You don't need the exact vesting period. All you need to find out is whether the vesting period is less than 1 year or more than 1 year. That's all. Meaning the waiting period is less than 1 year or more than 1 year. Okay. If it is less than 1 year, then the simple journal entry is, okay, let's say, I'll give you some data over here. Market price of the share is 150. Face value of the share is 10 rupee. Okay. Exercise price is, let's say 110. Okay, this is the thing, right? So now let's say vesting period is less than 1 year, meaning within 1 year only employees will be eligible to buy the shares. Let's pass the journal entry for one share or what for one Esop. Okay, so vesting period came, so that means the employee wants to buy the share, and Esop is an option. It is employee stock option, so it's not an obligation, it's an option, meaning it's an option given to the employees. If employees want, they can utilize this offer and buy the shares, or if you want, they can reject this offer. All right, it's not an obligation, it is just a choice or an option. Let's say here employee want to buy the share. Only one Esop he's been given for simplicity we're taking. He wants to buy the share. That means what do you think has to do? Think you need to pass the journal entry from company's perspective. The company, if employees has to buy, means employee has to pay money to the company. Alright, that means company will receive money. So the journal entry will be bank account debit. Yes or no? How much money employee has to give? The exercise price. Yes, which is what? 110. Alright. So in Badle what will the company do? They will issue equity shares. Whenever company issues equity shares, they will credit equity share capital. Equity share capital always shown at face value. What is the face value? 10 rupees. To what? If shares are issued at premium, it will be issued at, or the premium element will go off to securities premium. Yes, no? Check. What is the market price of the share? 150. What is the face value of the share? 10 rupees. If these shares, if it was not issued to employees, if it was not issued to employees, then company would have issued the share at 150 only. If it was issued to third party, then obviously if the market price of the share is 150, means company would have issued it for 150 only. Yes, that means what would have been the premium? 10 rupees worth of share, if it is issued at 150, means the premium element will be 140. Basically 150 minus 10. Yes, is the journal entry matching? This side is 150, that side is 10. What is that 40? 40 is missing, right? What is that 40? Check. How much discount did the employee get? Since the shares was issued to employee, the company gave these shares at a discount. What discount? 150 worth of share, they gave it just by collecting 110. So how much is the discount of which the company gave it to employees? 40 rupees. Because it was an employee, company is taking this loss. Yes or no? Because it is our own company, our own employee, company is ready to bear this loss. So this 40 is the balancing figure which you need to debit. Why? As per nominal account rule, all loss to be debited. This we call it as employee compensation expense account debit. It's all written over here in the chart. That is your journal entry you need to pass when you have, or when the vesting period is less than 1 year. Basically, that's what I've given over here. Bank account debit, employee compensation expense account debit to equity share capital to securities premium. That's all. Okay. This is the journal entry. And employee compensation expense is a loss. Loss will be transferred off to P&L. So that entry will be P&L account debit to employee compensation expense. These are the two journal entries that will come if the vesting period is less than 1 year. Very chota problem. Chotu, chintu this is. Okay. Small scenario, two journal entries, problem over. This also, the things have been asked for, I think 3 to 4 marks previously. It's come. Only these are the two types of problems that we have mostly. Then what, sir? If there is any option lapsed, you need to ignore that here. What does it mean? Let's say company gave 1000 ESOP option to employees. There are many employees to which company told those employees, okay, 1000 ESOP has been given to employees, okay. But company has put a one condition saying only those employees who will stay or will get the, or let's say vesting period is less than 1 year only, it's okay. Let's say vesting period is 6 months. Vesting period is 6 months, meaning all the employees who wants to buy this 1000 shares, they have to first stay in the organization for the next 6 months. Only those people who stay will be eligible to buy the shares. Okay, company means many employees will quit, many employees will join. Okay, let us say, okay, there are few employees who quit within the 6 months. They didn't say, they lost patience, they got a better offer, so they quit the organization. Okay, let's say they had about 200 ESOPs with them. They were eligible to buy 200. Totally to all of the employees, company had given 1000 ESOPs. To some employees have already quit. Let's say they were eligible to buy 200 ESOPs. But since they have already quit within 6 months, can they buy? No. That means how many ESOPs can be bought by the employees now? Only 800. Yes or no? What happened to this 200? Can it be bought? No. That we call it as lapsed. So those ESOPs which the employees don't buy, we call it as lapsed. Okay, in this case, since these some employees who quit the organization within 2 months, so they had option to buy 200 shares, that cannot be bought. So those we call it as lapsed. So if there is any lapsed option, no journal entry needs to be passed for them. Meaning journal entry, you will only pass it for this 800 shares. Because all this activity is happening within the same year, no? Okay, so hence you pass the journal entry only for 800. Because employees have bought only 800 shares. So pass this journal entry, the two journal entry we discussed. Pass these two journal entry only for 800 shares. Only for the options exercised. For those options which got lapsed, you need not do anything under the first option. What is the first option? When the vesting period is less than 1 year. This term. Alright. When the vesting period is more than 1 year, there is a slightly few things we need to do. I'll quickly discuss this and we'll also apply it in one other problem to understand this a little better. One I'll read through. The journal entry will pass is employee compensation expense to employee stock option outstanding account, and this employee compensation expense will be transferred off to P&L. Okay, if let's say vesting period is 4 years, then these two journal entries are called out. For all the 4 years, you need to pass this journal entry. Meaning every year, these two journal entries will keep coming. So if the vesting period is 4 years, means 8 journal entries will come. Yearly 2 entries, these two. So 4 years, so 8 entries. At the end of 4th years, employee will be eligible to buy the shares. Then this banking entry will come. That I will show you in the one particular problem itself. So it's better to understand this with the help of numerical. Okay. And if any option gets lapsed, okay, then you need to pass one reversal entry. For the previous scenario, there was no journal entry required. If the vesting period is more than 1 year, and if any option gets lapsed, you need to pass one reversal entry, that is employee stock option outstanding account debit to general reserve account. This is the journal entry you need to pass for options lapsed. Okay. Alright, so these are the only few things you need to remember. So let's do a thing. This we will understand it better with the help of one problem. It's a lot easier to connect with numericals there. Okay. Let's take up question number 2. The same question is there as illustration number 2 in our study material. Same thing I've taken. ABC grants 1000 employee stock options. So total ESOPs given is 1000 on 1st April 20x0. This we call it as a GD, as in grant date. So on 1st April 20x0, the company has given ESOPs to the employees at 40. At 40 means employees have to pay 40 rupees to the company to buy these. That means this 40 is only we call it as EP, as in exercise price. The market price of the share is 160. So 160 is the market price of the share, but employee can buy it at only 40 rupees. That means they're getting a heavy discount. How much is that? 160 minus 40, which is 120. That discount only we call it as fair value of the option. So fair value of the option is calculated at 120 per option. That's the discount element which they've told. Great. The vesting period is 2.5 years. Meaning, if employees wants to buy the shares, they need to wait first for 2.5 years. They have to stay in the company for 2.5 years first. Then only they are eligible to buy this 1000 options. If some of the employees quit within 2.5 years, then those employees will not be eligible to buy ESOPs because they are failing to meet those terms and conditions. Like that. Okay. The maximum exercise period is 1 year. Exercise period is, so waiting period is 2.5 years. Okay, 2.5 years. Okay. After 2.5 years, employees is eligible. See, some companies like Reliance, Tata and all, they have many employees. So that means after 2.5 years, can all the employee buy all the ESOPs in single day? No. What the companies will say is, so minimum of waiting period is 2.5 years. Company will say, minimum 2.5 years you have to stay in my company to be eligible to buy. After this exercise period, certain extra time period will be given to the employees, because there will be many employees. Okay, they will be given some extra breathing time or extra cushion, extra window. Let's say they have been given a window of 1 year. Okay, meaning company is saying, I will give you after 2.5 years you are eligible to buy. Any day you want, you apply, I will give you my company ka shares. Okay, but I will give you a further 1 year period to decide. Okay, if you need more than after 2.5 years, you are right away eligible to buy. But company will give generally extra period of time. That extra period of time we call it as exercise period. Exercise period. Exercise period means after the vesting period, how many extra days or months or years is being given for the employees. Okay. Generally, it's a practice for many of the companies to give this exercise period. Okay, it could be 6 months, 8 months, 1 year, whatever. In this case, it is 1 year. Meaning after 2.5 years, 1 year extra time is given to the employees to decide. Okay. Some employees, if they want, they can buy the share after 2.5 years immediately. Some of them, they can also buy it within 3.5 years. Okay, 1 year extra. But after 3.5 years, nobody will, if they don't decide, the options will get lapsed. That's how things are, right? Okay. 300 unvested option. Unvested option means those shares which the employees are not buying due to whatever reason, maybe they quit or whatever. 300 unvested option lapsed on 1st May 20x2. 600 options exercised on 30th June 20x3. 100 vested option lapsed at the end of the exercise period. You need to pass the journal entry giving suitable narrations. Okay, journal entry means narration. So narration you can write it in your own words. No, it's not a problem, but narration is a must. Okay. Alright. To solve all these questions, you must be comfortable. Our regular students must be comfortable. We used to prepare a small table. And almost all our problem, I think we have done some 15, 16 problem in the ESOP almost, or maybe more than that. All the problem we are trying to fit into that particular table. Okay. And this particular, I'll again draw it for you. This particular table will be helpful for your CA final also, because in CA final also more or less the concept is similar. So we need to calculate something over here. Okay, so we'll have to put up a working note. So I'll call it as particulars, or you can simply call it as employee compensation expense. Working note number 1, employee compensation expense. Okay, so what the funda or see for ESOPs and all, no, we don't have any accounting standard. We have some guidance note given by our mother body, ICAI, Institute of Chartered Accountants of India. ICAI has given some guidance note, and we are doing the journal entry or accounting treatment for ESOP based on that guidance note. What that guidance note says is the employee stock option expense, or that loss is there, no? Whatever loss the company bears due to that ESOP. Okay, that ESOP expense, it has to be recognized over vesting period. It has to be recognized over vesting period. Okay, let's say in the previous case, if you remember, I give you a small example. The loss was how much? Loss was 40. Yes. This loss, that only we call it a loss, right? This loss has to be recognized, or it has to be amortized over the vesting period. Hence, vesting period is very important. Okay. If the vesting period is less than 1 year, then this total loss will be accounted in the first year itself. If the vesting period, let's say, is 4 years, then this 40 loss will not be transferred to 1 year P&L. This 40 will be amortized over 4 years. Why 4 years? Because vesting period is 4 years. If vesting period is 2 years, then this 40 will be distributed over 2 years ka P&L. Okay, in this particular problem that we solved, vesting period is 2.5 years. That means whatever loss the company faces due to this ESOP. What is the loss that the company faces due to ESOP? They're issuing the shares at discount, no? I mean, that discount element is a loss for the company. That discount element or that loss, which we refer to as employee compensation expense, that has to be recognized over vesting period. In this case, the vesting period is 2.5 years. You have to amortize it like that. Okay, hence we need to recognize that to know how much is the expense recognized each year. I'm putting up this particular table. Okay, so year one will end on. So what is your grant date? 1st April 20x1. So on the first day of the year only you have given. So that means first year will end on 31st March 20x1. Yes. 1st April 20x1, x0 is starting means 31st March 20x1 is your ending date. X is something which they normally use. Instead of 20, 21, 22 and all, no, they've started bringing variable as X. Okay. So simple. If year starts on 1st April 20x0, it will end on 31st March 20x1. Like that. Okay. The next year will be 1st April 20x1 and it will end on 31st March 20x2. Like this, it will just go on. Okay. Here, what is the vesting period? Vesting period is 2.5 years. That means expense should be recognized over 2.5 years. So year 2 will end on 31st March 20x2. Then some expense has to be booked in third year also, because 2.5 years, no? That half year element will come in the third year component. So third year will end on 31st March 20x3. So I want to know how much is the expense being recognized each year. That's the reason I'm putting up this table. Okay. This table is quite common. You can solve many questions using this table only. First, expected, or you can write like this, number of options expected to vest. Number of options expected to vest out. Okay. So this employee compensation expense, since vesting period is 2.5 years, alright, we don't know how many of them really will buy it and how many of them will leave the company or stay, or how many of them will buy, we don't know. Yes, hence the choice has been given to the company. What the guidance note says is, every year, at the end of every year, company has to do an estimate. How many shares the employees may buy? How many options employees may buy? Based on that, expense will be recognized. So it is based on the expected accounting. Alright. And later, if the expectation is higher or lower, accordingly you can change. You can revise your treatment, accounting treatment. It's okay. But every year you do the accounting based on your expectations. At the end, when they finally buy, you just check whether your expectation was it met, was it higher, was it lower, and accordingly you make the changes, which I'm going to show you. Okay. Now, how do you do? That's what I've written. For number of options expected to vest first. How many options did the company give to the employees? 1000. It gave on which date? 1st April 20x0. Now we are come to the end of first year. End of first year means 31st March 20x1. Does the company know any extra data that 50 shares got lapsed, 100 shares got lapsed, anything like that they know? Yes sir, given sir. 300 options got lapsed. Yeah, 300 options got lapsed. When? When did the company know about this? The company knows this information only on 1st May 20x2. Correct? So about this 300 option getting lapsed, company knows only on 1st May 20x2. We are on which date now? 31st March 20x1. As on 31st March 20x1, did they say anywhere there this many options got lapsed? No. That means company still feels the 1000 options which they gave to the employee, all of them will still get exercised because they don't have any extra information at the year end. No employee have quit. So that's the reason they're thinking still 1000 shares will get exercised, meaning employees will buy 1000 Esops. Now let's do the same thing here. 31st March 20x2. On 31st March 20x2, second year end, did the company get any extra information? Yes sir. No. This 300 option information company knows only on 1st May 20x2. We are in the second year and second year ends on when? 31st March. The 300 option you got to know only on 1st May. That is 2 months later. That means on 31st March also company feels 1000 options are going to get vested. Okay. On this particular day, this is the information company has. Now next year, 31st March 20x3. Now what do you think? 1000 only? No. On 1st May 20x2. So you know this year, 31st March 20x3 means the year will be 1st April 20x2 to 31st March 20x3. This is the financial year. So in this financial year, did the company get to know any extra data? Yes, on 1st May 20x2, okay, in the current year only, they got to know that 300 options got lapsed. Okay, so even 100 options got lapsed. Yeah, that got lapsed on 30th June 20x3. We are on what? 31st March 20x3. Further information you're getting on 31st June 20x3. Till 31st March 20x3, how much information you know? We know that only 300 options have got lapsed. So company issued 1000. In that 300 have got lapsed means company feels 700 options will be purchased. Okay. On 30th June, we have got extra information that we will take care of it later. So as of 31st March, company feels 700 will be left. 700 shares the employees will buy. Okay. Alright. Second one we need to take is fair value of the option. This is given to you in the problem. If at all it is not given also, you simply do market price minus exercise price. Generally it will be given to you in the problem. Check the fair value of the option is 120 per option. That will not change. That is a discount element. That is same 120 only. Okay. Next, the third point you need to have is, maybe I'll write off the other columns and then figure it out maybe. Third point, total employee compensation expense. Total employee compensation expense to be recognized. That is given by the column 1 multiplied by 2. Maybe I'll write off the other one as well. Expense recognized previously. And then point number 5. Employee compensation expense for the year. Employee compensation expense for the year. Our regular students must be okay with this. We have solved many questions in that. Somebody who's new, who has not followed us, we follow this format only for all our questions, so that it'll obviously get triggered. And this format will be helpful, as I told you, for CA final also. What is it? We will learn. Okay. So on one share, how much is the loss the company is expecting, sir? On one share, the loss is 120. How many shares the company feels the employees will buy? 1000. That means what is the total loss? On one share 120, on 1000 shares it will be 1000 into 120. That is what? 1,20,000. Yes or no? This is the total employee compensation expense or total loss due to ESOP. Okay. Entire 1,20,000 loss, can you book it in first year only? No. Can the entire 1000 shares employee can buy now only, or he has to wait? He has to wait. He has to wait for how many years? Here the vesting period is 2.5 years. Since employees have to wait for 2.5 years, this is not the loss. This one, if you multiply this, you're getting 1,20,000. 1,20,000 loss is not for 1 year. Employees have to work for 2.5 years. That means this is the loss for how many years? 2.5 years. This loss has to be amortized over 2.5 years. It has to be distributed over 2.5 years. You are in which year now? First year. What is your grant date check? 1st April 2080. Count from that day. From the grant day, you have to check the year ending date. Grant date here, for your reference, you can write it in Bajumi here also. Grant date is 1st April 2080. From grant date to year 1 ending date, you just check. That will be 1 year. So you are in first year. So how much expense will you recognize in first year? That will be, maybe I'll draw off a line over here. 1 second. Okay, how much will be this now? 1000 into 120 is your total employee compensation of 1,20,000. That has to be recognized over 2.5 years. So into 1 divided by 2.5 if you do, 48,000 is the expense, employee compensation expense for the first year. We are in first year, so previously means previous year. So we are in the first year of scheme, so that means no expense has been recognized previously, that is 0. So employee compensation expense for the year 5 is equal to 3 minus 4. This significance you will not find it now, it will be important for the next year. So 48,000 minus 0 is 48,000 only. Okay? This is how a table will look like. Don't worry about this for the time being. When you come to year 2, you will know the importance of this. Now come to the second year. Number of options expected to vest is still 1000. Employee compensation expense for 1 share is still 100, or rather 120. On 1 share the loss is 120. On 1000 shares if you do, you're going to get totally 1,20,000. This 1,20,000 is a loss for 1 year. No, it is a loss for 2.5 years. Yes. We are in which year now? Second year. This column, what it is trying to say is up to second year. You are in second year now. No? Up to second year, what is the total expense you should have recognized? I'll repeat that. What does this means is up to second year. You are in second year now. What this one signifies is up to second year, what is the total expense you need to recognize? Total expense means first year and second year put together. Okay. So count from grant date till the second year ending date, you count from 1st April 2080 to 31st March 2082. How many years you going to get? 2 years, right? So here you have to write into 2 divided by 2.5. Because 2 years is over. No? I mean 2 years ka total expense you should have recognized. That will be how much? 1000 into 120 into 2 divided by 2.5 if you do. That is going to get 96,000. Is 96,000 expense for the second year? No. 96,000 is a total expense you should have recognized by the end of second year. By the end of second year, totally you should have recognized 96. In this 96, how much is already recognized previously? In the previous year, you have already recognized 48,000. Yes or no? Total expense to be recognized up till second year is 96. In that 48 is already recognized in the year 1 itself. So how much more will you recognize? That is what I have written here. 5 is equal to 3 minus 4. So 96 minus 48 is 48,000. Like that. Okay. Alright. So first year you recognize 48. Second year again you will recognize 48. So that means the total will become 96. Like this. Done? Okay, third year you feel only 700 options are going to get lapsed because some employees maybe have quit. So you feel only 700 is going to get bought out. So what is the loss? The loss is 120 per share and the total number of shares expected to get vested is 700. So if you do this, you're going to get total. We are in third year. That means vesting period is over. Once vesting period is over, total expense should be recognized. So you need not do anything, any multiplication here. Even if you want to multiply, don't multiply 3 divided by 2.5. Into 2.5 divided by 2.5 because total expense has to be recognized. No? Expense for one share is 120. For 700, how much? 84,000. So by the end of third year, total expense of 84,000 you should have recognized. So this is optional. If you want, you can write, or if you want, you can cut it off. Okay, like that. All right, but check. What is the total expense you should have recognized by the end of year 3? When you have approached by the end of year 3, 84,000 you should have recognized. But how much have you recognized previously? How much have you recognized previously? 48,000 you recognized in year 1, 48,000 you recognized in year 2. That means totally how much have you recognized previously, sir? 96,000. Only 84,000 is the total expense to be recognized, but you have recognized 96 because you did the accounting based on estimates, no? Based on your expectation. Expectations could go wrong, or it could be higher or it could be lower. Here you have done a higher estimate. You have booked the expense for 96, but expense to be booked is only 84. That means whatever excess you have booked, no? Employee compensation expense, here if you want you can write employee compensation expense. You can write like this, employee compensation expense recognized / in bracket you can write reversed. Okay, more expense you will recognize, or if you have recognized excess you will reverse. Employee compensation expense recognized or reversed for the year. And then I will write 5 is equal to 3 minus 4. You can bring in like this. For the first 2 years, you have to recognize the expense. For the last year, 84 total you have to recognize, but 96 you have already recognized. So 84 minus 96 is 12,000 negative, meaning you have already recognized 12,000 more, which you need to reverse. Okay. So based on this particular table only, entries will be derived. How to pass journal entry is this. Unless you have got this table ka values right, your journal entry will not be right. Okay. Based on this only, journal entry will come. Okay. Now we can look through the journal entry. Now first journal entry, what is this basically? This table gives you how much expense, employee compensation expense needs to be booked every year. First year you will book 48,000 expense, second year again you will book 48, third year you will not book, rather you will reverse. Okay. So what is the journal entry? You can't write bank account debit because bank account only will come in the third or fourth year. Okay, on the yes, first year, since employees have to work to get the Esop, you have to amortize this expense over vesting period. So the journal entry you passes, that's what I've called out in the chart here. What is the chart I told? Employee compensation expense account debit to Esop outstanding. Check, is that the entry they passed? Employee compensation expense account debit to employee stock option outstanding. This is as per our working note. Check our working note. What is the first year amount? 48,000. That is what they passed the entry for. And employee compensation expense is a loss that will be transferred off to P&L. So the entry will be P&L account debit to employee compensation expense 48,000, 48,000. This is the journal entry for first year. Okay. Now for the second year, how much expense you need to recognize? 48,000. So that means the same journal entry will come for the same amount. Employee comp, this is for the second year, year 2. Okay, previously was for year 1, next year it is year 2. Employee compensation expense to Esop outstanding account 48,000, 48,000. And this employee compensation expense you transfer it off to P&L. This is for your year 2. Alright, year 3. Year 3 ends on 31st March, but is the vesting happening on 31st March? No, vesting happening on 30th June. That means rather buying is not happening in the third year. Buying is happening in the fourth year. Okay. So third year, what do you have to do? You have to recognize the expense, or you have to do ulta. You have to do the ulta of it. So that means what is the journal entry you need to pass? You have recognized extra expense. No? So the journal entry you need to pass, I've called out over here. Employee stock option outstanding account debit to general reserve. Fair enough? Why is that entry? Okay, if you want, you just check over here. Okay, maybe I'll show through this. When you recognize the journal entry, what is the entry you pass, sir? Employee compensation expense account debit to Esop outstanding account. That is the entry you're passing. Yes, here. Employee compensation expense account debit to Esop outstanding 48,000. Okay. Then this employee compensation expense is an expense which you're transferring off to P&L. So the entry you're passing is P&L account debit to employee compensation expense 48,000. This is the journal entry you passed previously, first year, second year, same you passed. Now you do the math, add up two entries for me. Employee compensation debit, employee compensation credit. So that is getting nullified. So effectively what entry you're passing? P&L account debit to Esop outstanding account 48,000. Yes or no? This is the entry effectively you're passing. To recognize the expense, this journal entry means. To reverse the expense, what will be the journal entry? This is the journal entry to recognize. To reverse, it will be ulta entry. Yes or no? That is what they're doing. Employee stock option outstanding account debit. This is for the lapsed portion. Okay? Because they are recognized extra. No? 12,000 extra we have recognized. So we need to reverse. So the journal entry will be employee stock option ulta of this. Employee stock option outstanding account debit 12,000. You will not credit P&L. You have to credit general reserve account. Okay, because all this entry has to be shown in reserves and surplus. You'll learn more about this particular adjustment. I had explained you the logic a little more in the regular class. You'll learn more about this in your CA final. This adjustment has to be done in statement of changes in equity. Just like you have balance sheet, P&L, cash flow statement, notes to accounts. These are all you call it as financial statement. In CA final, you'll learn one more known as statement of changes in equity. Okay, all this adjustment, reversal has to be done not through P&L, it has to come through reserves and surplus. That reserve and surplus only we call it as sourcing. Hence, we don't credit P&L account, rather we'll credit general reserve account 1,000. So reversal entry actually should have been Esop outstanding to P&L. Instead of Esop outstanding to P&L, here we write Esop outstanding to general reserve account, because all this adjustment has to be shown in reserves and surplus. Again, more information as I told you learn in your CA final. I had given you a little background about this in your regular class, but right now it's not important, so it's fine. Just remember the reversal, that's good. Okay, that's for the third year. Then what is happening? Check. After that, what happened? 600 options exercised on 30th June. 30th June 20x3 means when it will come? 30th June 20x3 will not come in year 3. It will come in year 4. So in year 4, 30th, this is your year 4, 600 options got purchased. It got purchased means employee had to pay money. Yes. So now the bank entry will come. If employee is paying money means company will receive it. So the journal entry will be bank account debit. Company expected how many shares will be bought? 700. But eventually 700 bought, only 600 of them bought they told. To buy the share, how much they need to pay? What is the exercise price? They have only given in the question. The exercise price is 40 rupees. 600 shares they bought by paying 40 per share. The amount is 24,000. What will you credit? To equity share capital account, 600 shares, always equity share capital at face value. They have given it to be 10. So this is 6,000. To security premium. So the market price of the share, they have only given. How much is that? Market price of the share is 160 they told over here. And the face value of the share is at 10 rupees. That means what is the security premium? 150. For one share, the security premium limit is 150. On 600 shares, it will be 90,000. Journal entry is not matching. There is a balancing figure. If the vesting period is less than 1 year, you could have written the balancing figure as employee compensation expense. Yes. But here, employee compensation expense, everything is recognized, because employee compensation expense has to be recognized over vesting period. That is over 3 years or 2.5 years. That is already over. Which account has a balance? Employee stock option outstanding account has a balance. Yes or no? This is a dummy account, guys. Employee stock option outstanding account is a dummy account. Till the Esop transactions are routed, this account will have a balance. Okay. Once Esop transactions are done, this account also will get nullified. Okay. To route this Esop entries, we open an account known as employee stock option outstanding. Okay. Check. This account has how much balance now? Okay. This account has a balance of how much? 48,000. Check here only. For 48,000 first year, again 48,000. You pass the journal entry. If you want, you can just check the balance over here as well. First year, you credited employee stock option outstanding to the extent of 48. Yes. First year, year 1, you credited that account by 48,000. Again, year 2, you credited employee stock option outstanding for 48,000. Okay. What is this basically? Basically, employee compensation expense, you are routing in that account. Yes or no? In year 3, you reverse this account by debiting. You debited this account for 12,000. That means how much is the balance? This account has a balance of only 84,000. Why 84,000? Because company thought, okay, 700 options will get lapsed. and the loss on one share is 120. So hence 700 into 120 is your 84,000. Yes or no? Basically this account has what? The loss element. Alright. But here the 700 shares got bought. No. Only how many shares got bought? Only 600. And what is the loss per share? This account you are passing only for to book that employee compensation expense. No? Meaning the loss. What is the loss element per share? 120. How many shares got bought? Only 600. So into 72,000. Either you can calculate this or get this as a balancing figure. Calculate this, this and this and get this as a balancing figure. It is good. Alright. Or it's very straightforward also. Employee stock option outstanding account is a dummy account. It will only have the how much is the loss due to this ESOP scheme. The loss on one share due to ESOP scheme is 120. And how many options got bought? 600. So 600 into 120 if you do, you're going to get obviously 72,000. That's how they arrived at this number. Are we fine? Alright. Now if we just check year 4 mein, alright. If you want to do again, year 1 mein I credited this account by 48,000. Year 2 again I credited. Year 3 I debited by 12,000. So what is the balance in this account? 84,000. In year 4 what happened? The shares got bought. So I debited this account by how much? 72,000. So I again debited by this account by 72,000 debit. This account has a 84,000 credit balance. I have debited only 72. I mean still this account has a balance. How much balance it has? 12,000 balance. That the options got lapsed, meaning you have to transfer that to general reserve. So how can you say option got lapsed? Check here in the question they have given. The company thought employees will buy 700 shares. But eventually how many shares got bought? Only 600. So in 700 only 600 got means 100 options got lapsed. Yes, 100 options got lapsed. And what is the employee compensation expense for one share? One share the loss was 120. On 100 shares how much is it? 12,000. Yes or no? To the extent of loss only you're opening employee stock option account or employee stock option outstanding account, the dummy. Yes. On 100 options lapsed. Lapse entry you already know by now. What is the lapsed entry? Reversal you need to pass. Employee stock option outstanding account debit to general reserve 12,000, 12,000. Either you can calculate all this or by looking at journal entry also you can get it. By the end of once the ESOP scheme is over, this employee stock option outstanding account balance has to be nullified. It has to become zero. Check how much balance is there. Count from the beginning. Where and what and all you have debited. Here you told no. Year 1 you credited, year 2 you credited, year 3 you debited. Like this you do the debit credit ka mismatch. Matlab you keep calculating. The employee stock option outstanding account will still have 12,000 balance. That you nullify. Close. It will have a credit balance. To close you have to debit it. So employee stock option outstanding account debit to general reserve 12,000, 12,000 you need to do. Or you can straight away calculate also. 100 options more got lapsed and the loss employee compensation expense per share is or the loss per share is 120. On 100 shares how much? So that's how you're going to get 12,000 as well. So these are the entries you need to pass when the employee or when the vesting period is more than 1 year. It's same. Okay, if the vesting period is 6 years, you need to pass the same journal entry over 6 years. That's all. It all depends. The entries are same, but the number of times you have to pass the journal entry will go on increasing. So just have a quick recap. What is the entry when you pass when you have vesting period is more than 1 year? First of all, why is vesting period important? Because employee compensation expense will be accounted or will be recognized over the vesting period. If vesting period is 3 years, then the expense will be recognized over 3 years. Yes, that means if the vesting period is 3 years or 2.5 years in this case means employees cannot buy the share till 2.5 years. Till 2.5 years he needs to wait. Okay, but expense you have to recognize. So the entry will be employee compensation expense debit to what? You can't credit cash or bank because this is all what? You're not paying any cash, right? So employee compensation expense will be debited. Credit will go to a dummy account known as employee stock option outstanding account. Okay, till that ESOP scheme runs, this employee stock option outstanding account will have a balance. Once the scheme is over, this employee stock option outstanding account balance also will be nullified. So go on passing the entry. Here vesting period is 2.5 years. So for 3 years, you have to go on passing the same entry. Alright. If any option get lapsed, then a balance in employee stock option outstanding account has to be transferred to general reserve. And the entry for that is employee stock option outstanding account debit to general reserve account. Why do we debit employee stock option outstanding account? Because that particular account has a credit balance. To close out, we have to debit it. That's all. Alright. So those are the things you need to remember as far as the ESOP questions are concerned. Alright. So that's all about the ESOP people. Thank you. Now let's get to the next topic, that is amalgamation of companies. Amalgamation of companies. Sir, amalgamation ka treatment, whatever we are about to study, that is given under Accounting Standard 14. So whatever treatment we are seeing now is prescribed under Accounting Standard 14. First of all, what does amalgamation mean? Amalgamation means one company buying other company. Let's say X Limited is there, Y Limited is there. X Limited purchased of Y Limited. X Limited bought of Y Limited. That is also an amalgamation, meaning one company purchasing another company is also, or taking over another company is also amalgamation. Or let's say A Limited is there, B Limited is there. These two companies came together and they formed a new company, C Limited. Okay, these two companies came together to form a new company. That is also amalgamation as far as AS 14 is concerned. One company taking over another company, or two or more companies coming together and starting a new company. That is also amalgamation. Alright. So both all the scenarios are covered under our AS 14 ka ambit. Okay. So before you start amalgamation ka question, there are two methods of amalgamation. First, you need to identify that, because the treatment of amalgamation depends on the method. Okay. So one, amalgamation could be in the nature of purchase, or we can call it as purchase method. There is another method known as merger method, or also known as pooling of interest method. Okay. So have to first figure out whether the amalgamation is of purchase method or merger method, because accounting treatments are different for both of them. Okay. So how to identify? So for merger method, they have given 5 conditions. Okay. And if all the 5 conditions are satisfied, for merger method, they have given 5 conditions they have specified. If all the 5 conditions are satisfied, then it becomes merger method or pooling of interest method. If any of the one condition fails, if any one condition among this 5 fails, then it automatically becomes purchase method. That's how to identify. Generally in our problems, they will only mention whether it is purchase method or merger method. If they mention, don't worry about the condition. No need to worry about testing the condition. If they don't mention which method of amalgamation it is, then you need to remember those 5 conditions, test it, conclude which method, and then start solving your problem. Okay. So what are those conditions? First condition is all the assets and liabilities of the selling company, purchasing company should take over. All the assets and liabilities of the selling company, the purchasing company should take over. Like let's say purchasing company or selling company has 100 assets and they have some 20 liabilities. All this has to be taken over by the new company or purchasing company. Not even one should be left out. Okay. This is first condition. And all the assets and liabilities should be taken over at book value. At how much ever value the selling company is showing, at the same value it should be taken over. There should not be any alteration or any modification made to the value of the asset. How much ever it is shown, and that value only it is taken over. That's the second condition. All the assets and liability to be taken over at book value. Third one, the shareholders who are owning 90% of the shares, equity shares in selling company, should become shareholders of new company. The shareholders who are owning 90% equity shares in the selling company, they should become shareholders of the new company. It's not necessary that they should, in the new company also they should own 90%. No. Whoever guys who are owning 90% equity shares of selling company, they should just become shareholders in new company. They may own 90% in new company, or only 10%, or only 9%, or 100%, whatever, it doesn't matter. But they should just become shareholders of new company. How will they become shareholders? Basically, they should be given shares of new company. That is what they're trying to say. Okay. So the shareholders who are owning 90% equity shares of the selling company should become shareholders of the new company. Okay. So if company is selling means the owners of that company will expect compensation. Yes or no? That compensation only we call it as PC. The compensation that is paid to the owners of the selling company, we call it as purchase consideration, PC. Okay. That PC to equity shareholders has to be given in the form of equity shares only. To the owners, owners of selling company will have owners, right? Owners means what? Owners could be equity shareholders and preference shareholders. Yes. To the owners, the purchasing company has to pay some compensation. The compensation paid to the equity shareholders, one owner, that is equity shareholder, has to be in the form of equity shares only. Meaning these owners of selling company should get only equity shares of new company. They should not get anything else. If they are getting anything else, it is not merger method, it is purchase method, like that. Okay. So that's what they mean by PC to the equity shareholders has to be discharged in the form of equity shares only. The last condition is selling company ka business to be continued. The selling company ka business, the new company which is taken over should continue. How long and all they have not mentioned. So if all these 5 conditions are satisfied, then it becomes merger method. Even if one fails, then it automatically becomes purchase method. That's how you can test and identify. Okay. So yes, check whether they have given the method or not, and then take a call whether you need to verify these conditions. All right, that's one. Or now I think by now you know purchase and merger method. Suppose it is a purchase method, what to do? Right? If it's a purchase method, first thing you need to do is find out the net assets of the company, net assets of selling company. Okay, you have to find out something known as net assets of selling company. So what does net asset mean? So name itself is saying net asset. Net asset means total assets taken over by the new company, meaning purchasing company, at agreed value. All the selling company ka whichever assets the purchasing company has taken over and at whatever value, that is your this component. From assets, if you deduct if you deduct liabilities, you're going to get net assets. Okay, but here careful you need to be. What you need to be careful is net asset means asset taken over. Whichever assets has been taken over, from that you need to reduce outside liabilities taken over at agreed value by the new company. All right. Okay, if you do that, you're going to get a component known as net assets. Fair enough, easy. All right, simple. Just to retrace it, if selling company has only 10 assets. And if only 8 assets has been taken over by the new company at let's say 10 lakh rupees, then let's say the selling company has 3 liabilities. In that, let's say only 1 liability has been taken over by the new company, let's say at 1 lakh rupees. Okay, can you tell me how much will be net assets? What is net assets? Net asset mean, because it's not necessary all the assets and liability of selling company, purchasing company needs to take over. No, it's a negotiation. Some they choose to take over, some they may choose I don't want it. Yes, so you only told all the assets and liabilities should be taken over. If for it to be a merger method, entire thing needs to be taken over. All the assets, all the liabilities needs to be taken over. If any asset is left over, then it will not be purchase, it will not be merger method, it automatically becomes purchase method. Okay, that is what. Since some of the assets are not being taken over here, it automatically becomes purchase method. Okay. Under purchase method, the first step you need to calculate is net assets. Net asset means the total assets taken over at agreed value. How many assets was taken over? 8. At what value? 10 lakh. First you need to take this. Minus outside liabilities taken over at agreed value. What is the outside liability? We may have 3, but only how much was taken over? 1 liability. At what value? 1 lakh. From this 10 lakh, if you deduct 1 lakh, you will going to get 9 lakh. And this is the net assets of selling company. Alright, so all these values also belong to the selling company only. That is the first step we need to calculate. Net assets of selling company. Second one, find out the purchase consideration. Purchase consideration means the compensation given to the owners of the selling company. The amount payable by the new company to the owners of selling company, we call it as purchase consideration. And who are the owners of selling company? The shareholders. What are the types of shareholders? Equity shareholders and preference shareholders. That only we call it as owners. Whatever you pay to the owners becomes your purchase consideration. You can pay them equity shares, preference shares, debentures, fixed assets, cash, whatever. Doesn't matter. Whatever you pay to the owners will be called as purchase consideration. This is the second thing you need to find out. First is net asset, second one is PC. Third step, okay, and one more thing. If nothing is mentioned in the problem about PC, they give you data, they say amalgamation. If they don't mention how much is PC given, if they don't give the PC value, then we assume that PC is equal to or net asset only itself is purchase consideration. If they don't mention anything about purchase consideration, then net assets only becomes your purchase consideration. Because net asset is the net worth of the company. From assets, if you deduct liability, you're going to get the worth of the company. Alright. So I have discussed the logic of all this in detail. For now, we're quickly revising, so I'll not go into everything. Right. So if PC is not mentioned in the problem, then net asset itself will become your purchase consideration component. Okay. That's one more you need to remember. Third step is compare PC with net assets. If PC is greater than net assets, let's say purchase consideration is 1 lakh. Purchase consideration means how much money the purchasing company has paid to the owners of selling company. Let's say they paid 1 lakh rupees. But net assets, meaning the net worth of that company is only 80,000. Net asset means net worth of the company. Net worth of the selling company is only 80. But how much did the buying company pay for it? 1 lakh, meaning net asset is greater than purchase consideration. How much is it greater than by? 20,000. That means here purchasing company made a profit or they made loss. Selling company ka worth was only 80. But how much did purchasing company pay to buy off this company? 1 lakh. So how much extra they paid? 20,000. That loss only we call it as goodwill. If PC is greater than net asset, then purchasing company has made a loss. That loss, as per AS 14, we call it as goodwill. Alright? If it's the other way around, let's say PC paid is only 50,000. Amount paid to buy the company is only 50, but the worth of the company is 80. Worth is 80, but the amount paid is only 50. That means purchasing company. You should always think loss or profit from purchasing company's angle. Purchasing company made a profit over here. How much profit they made? 30,000. This is a revenue profit or a capital profit. This is a capital profit. All this one don't happen on a recurring basis, right? This is a non-recurring component. So it's a capital profit. All capital profit will be transferred off to capital reserve. So if it is other way around, then you have a capital profit which will be transferred off to capital reserve. This is the next step. Okay, that's what you need to work on. All right. Then, and under purchase method, only assets and liabilities of the selling company will be taken over. Meaning reserves and surplus, share capital and all will not be taken over. Only assets and outside liabilities will be taken over by the new company. Reserves and surplus and all will be left out. This is about purchase method. Once we will discuss all the methods, then we will apply it in the problem as well. Okay. Alright, this is about the purchase method ka drama. Purchase method ka what do you have to do simply? First you have to calculate net asset. Net asset means the net worth of the company. How do you get that? From assets deduct liabilities. But be careful, net asset means assets taken over by the purchasing company at agreed value minus outside liabilities taken over at agreed value. That if you do, you're going to get net assets. PC they would have given to you in the problem. PC means the amount paid by the purchasing company to the owners of the selling company. If they don't mention anything about PC, then PC will be equal to net assets itself, because net asset is the worth of the company. No? If nothing is mentioned, the purchasing company would have paid to the extent of the worth of the company and bought it, is what the assumption is all about. Okay. Then compare PC with net asset. If PC is greater than net assets, then the purchasing company made a loss. That loss we call it as goodwill. Why goodwill? Because of the goodwill of the selling company, they are able to sell it at higher price. Their worth may be only 80. But because of the goodwill that they have generated over the years, they are able to sell the company at a higher price. Hence that loss we call it as goodwill. If it's the other way around, if PC is lesser than net assets, it's a capital profit to be transferred off to capital reserve. Okay. Then if it's a merger method, what to do? If it's merger method, first step, find out PC. PC is same. PC is the amount paid by the purchasing company to the owners of selling company. So PC does not depend on method, whether it is purchase method or merger method. PC ka calculation is very same. Okay. Second step is find out paid up capital. They would have given the balance sheet in the problem to you. Find out paid up capital. Paid up capital means equity share capital plus preference share capital put together. Okay. Find out paid up capital. Let's say PC is 1 lakh rupees assumption. Paid up capital is just 80,000 rupees. Paid up capital. Here paid up capital constitutes the worth of the company. Why sir? Because under merger method, even the reserves and surplus of the selling company is taken over. That's the reason we say merger method. Other name is pooling of interest method, meaning all the components will be added line by line. All the assets will be taken over at book value. All the liabilities will be taken over at book value. Even reserves and surplus of the selling company will be taken over at book value. Only component that the new company will not take over is the paid up capital. Hence you compare PC with paid up capital and find out the difference. If PC is greater than the paid up capital, if PC is greater than the paid up capital, here paid up capital is only 80, but they paid how much? 1 lakh. That means it made a loss. Yes, if PC is greater than paid up capital, it's a loss, but here loss we don't call it as goodwill. The loss will be adjusted in the reserves. The loss will be adjusted in reserves. Here how much is the loss? 80,000 is the paid up capital, PC is 1 lakh. That means how much excess the new company has paid? 20,000. This will be adjusted in the reserves. This will be adjusted in the reserves of the selling company. Why sir? Because under merger method, even the reserves and surplus of the selling company is taken over. Since under merger method, even the reserves are taken over, this loss can be adjusted with reserves only. First you adjust with the reserves and surplus of selling company. So if selling company does not have reserve, adjust it with the reserves of the purchasing company. So if purchasing company also does not have reserve, adjust it with P&L, because P&L could have a debit balance or credit balance. Is that okay? Basically this loss you have to adjust it in reserves. So what if it's other way around? Let's say purchase consideration is only 50,000, but paid up capital is 80,000. That means here 80,000 is the worth, but the company is only paid. This is paid up capital. Paid up capital is 80, but PC is only 50. That means purchasing company has made a profit, capital profit only. That will be transferred off to capital reserve. In terms of profit, the same adjustment. Okay, profit means that will be transferred off to capital reserve. So this is the difference between purchase method and merger method. Okay, here we compare PC with paid up capital, right? Not with net assets, because here under reserve, even the reserves and surplus are taken over, right? Okay, so hence only thing that didn't get taken over is the paid up capital. So compare PC with paid up capital, then you will find out whether it is purchasing company made a profit or whether they made a loss. If PC is greater than paid up capital, it's a loss scenario. Here under loss scenario, we don't call it as goodwill, we adjust it in the reserves. If PC is lesser than paid up capital, then the purchasing company made a profit, capital profit transferred off to capital reserve. So this is about the merger method ka drama. Alright, in amalgamation, again the scope of amalgamation is pretty much the same. They may ask you some journal entry and they may ask you some balance sheet. Sometimes instead of journal entry, they may also ask you to prepare ledger accounts, we'll see. But they'll give you many adjustments. So purchase and merger method, these things what I've called out is a base. Okay, then there'll be certain adjustments. So let's go over those adjustments one by one. One is the mutual owings. Sir, if any transaction is happening between purchasing company and selling company, that we call it as mutual owings. Like let's say purchasing company has given loan to selling company. Purchasing company has given a loan to selling company. That means for purchasing company it is a loan given. Let's say 1 lakh. Loan given means it's an asset for one company. For selling company it is loan taken. Loan taken same amount 1 lakh. But this 1 lakh for the selling company is a liability. Before amalgamation happened, purchasing company had given some loan to the selling company. Okay, so for the purchasing company, it is loan given, which is an asset. For the other company, it's a loan taken, which is a liability. Now, what happened due to amalgamation? Purchasing company, selling company have acquired selling company, right? So before the amalgamation, there were two companies. So one company could pay the other. Before amalgamation, purchasing company was also there, selling company was also there. Okay, so it was possible for selling company to repay this loan because both the company was in existence. But due to what happened in amalgamation, purchasing company took off selling company. That means, are there two companies now or are there only one companies? Only one, because selling company is no more there, it's gone now. Yes, that means what should we do for this asset and liability? Who will pay whom now? As long as there were two companies, one company could pay the other or one company could receive from the other. But when amalgamation happened, both of them have been treated as one, meaning there are only one company. Yes. So can one company pay money to itself or collect money from itself? No. Right? So hence these sort of transaction, first of all, we call it as mutual owings, meaning transaction happening between purchasing company and selling company. Okay. Since selling company is not there, there exists only one company. You know, such a transaction you need to cancel. If there is mutual owings, you need to cancel mutual owings in the books of new company. How do you cancel, sir? So asset has a debit balance, liability has credit balance. To cancel asset which has debit balance, what do you do? It has debit balance. To cancel you will credit. That means you will credit asset account. Liability has credit balance. To cancel you have to do ulta, which is debit. So that means the journal entry to cancel mutual owings is what, sir? Liability account debit to asset account. This liability or these transaction could come in the form of bill receivable, bills payable, loan given, loan taken, debtors, creditor, etc. etc. There could be various forms of mutual owings. Debtor, creditor, bill receivable, bills payable, loan given, loan taken. So in the books of new company, you need to cancel such transaction. Okay, so that means cancellation entry will be all the liability will be debited. Creditors or bills payable or loan taken account will be debited / debtors, bill receivable, loan given. Basically liability account debit to asset account. If you have three mutual owings, you don't pass like this. Separately, you need to show the cancellation entry. There's a chart book, so I've just shown it for easy reference. That's all. Okay. So I made it as a combined and show you if there are three mutual transaction or mutual owings, show all the three cancellations separately in examination. So this is about mutual owings. Okay. All right. Another point of view is stock reserve. What is a stock reserve is? Let's say there is A Limited, there is B Limited. A is the purchasing company, B is the selling company. Okay. Alright. So let's say A Limited has sold goods to B Limited. A Limited has sold some goods to B Limited. Let's say cost of the goods is 1 lakh. Alright. A Limited did not sell this goods at cost price. They made a profit of 20,000. That means their sale value was 1,20,000. A Limited sold some goods to B Limited. The cost of that goods was 1 lakh, but it was sold for 1,20,000. So due to this transaction, A Limited has made a profit of 20,000. Okay. Now you tell me who has the goods now. Initially, before this purchase sale transaction, the goods was with A Limited. It was there in A Limited ka factory. Now where is the goods? The goods is there in the B Limited ka factory. Yes or no? Alright. Okay. What is the funda over here is? Alright. See, selling price of one company. Selling price of one. If A Limited has sold for 1,20,000 means B Limited has purchased for 1,20,000. Yes, no. Selling price for one company is purchase price for another company. That means what is the cost price for B Limited? They purchase these goods by paying 1,20,000. Correct. Let's say B Limited year end has come, meaning 31st March 2023. Let's say is our year ending date. On this date, B Limited purchased the goods, but they have not sold these goods yet. They have all these goods as stock in their godown. That means these goods it will be shown in the balance sheet of B Limited as a closing stock. Yes. So since they purchased these goods for 1,20,000, so closing stock will be shown at 1,20,000 in B Limited ka balance sheet. Okay. Alright. Now A Limited purchased B Limited. A Limited acquired B Limited. When A Limited acquires B Limited, all the assets and all the liabilities of B Limited belongs to A. Yes or no? If A Limited has acquired B Limited means B Limited ka all the assets, all the liabilities now belongs to A Limited. Okay. Alright. Other assets and liability, there is no drama. Check about this closing stock. B Limited is showing this closing stock at 1,20,000. That means this again will come back to A Limited because all their assets now belong, all B Limited assets now belongs to A Limited. Can A Limited also show in their balance sheet this closing stock at 1,20,000? Can they show? That would be wrong. Why? Check, sir. Goods went from A to B. And then it again came back from B to A. Yes, no. A, B are in the same group now. Yes, no. They are the same group company. Yes. So we know closing stock should always be shown at cost price. But this 1,20,000 includes some profit element because when A sold this goods to B Limited, he made a profit of 20,000. Okay. Alright. This 20,000 is it realized profit or unrealized profit? It's unrealized profit. Why? Sir, A and B Limited are not two different companies now. A and B Limited are one company. If you show this profit in this closing stock, then it becomes what? Alright, it's like saying 20,000 profit I made from myself. Okay, I made 20,000 profit from myself because this is not realized profit. Yes, because both A Limited and B Limited are one company. Hence, what we have to do is whatever profit is there in this closing stock, we need to eliminate because it is unrealized. Because from left hand, now the goods are in right hand. Left hand is A Limited, right hand is B Limited. Just from left hand, the goods has come to right hand. Okay, so this profit which you have made, it is not realized profit, it is unrealized profit. That we need to eliminate. This unrealized profit only we call it as stock reserve. That is what I have called out over here. Okay. So basically, if you have these sort of purchase sale transaction and if the goods are lying with selling company, find out how much is the profit element included in the closing stock. And since that profit is not realized profit, rather it is unrealized profit, you need to eliminate that. That unrealized profit, there are various names. Some books calls it as unrealized profit, some call it as stock reserve, some also call it as loading element. All are same. Okay. Basically, this needs to be eliminated. That means the closing stock will be shown at not at 1,20,000. After eliminating unrealized profit, closing stock will be shown at 1 lakh only. Why 1 lakh? Because cost of that goods, honestly, the cost of the goods is only 1 lakh. So it has to be shown at 1 lakh only. That is what I have written it over here. Okay. So what is the journal entry for stock reserve? That is what I have called out over here. The journal entry of stock reserve depends on the method of amalgamation, whether it is purchase method or merger method, and also under scenario, whether it is profit or loss. If it is purchase method and if it is profit scenario, under purchase method, the profit we call it as what? We call it as capital reserve. So the journal entry will be capital reserve account debit to closing stock. So why closing stock? Because currently the closing stock is shown at 1,20,000. But from 1,20,000, you have to reduce it by 20,000 because profit element is included. So closing stock is an asset. Assets will have what balance? Debit balance. Something which has debit, if you have to reduce it, what you will do? Credit it. Yes. So closing stock or stock reserve, you can either directly credit closing stock or you can credit stock reserve. And the stock reserve in balance sheet, you can reduce from closing stock. That approach is also okay. Alright. So directly you can credit closing stock or stock reserve. Credit portion is clear. Debit will depend on the method and the profit. Which scenario? If it's profit scenario, you will debit capital reserve. If it's loss scenario, under purchase method, loss scenario, we call it as goodwill. So the journal entry will be goodwill account debit to closing stock or stock reserve. So what if it is merger method? Under merger method, if you get profit scenario, same you call it as capital reserve only. So same entry will come. However, if it is a merger method and loss scenario, under merger method, loss scenario, will we call it as goodwill or will be adjusted in reserves? Reserves, right? So you debit reserves, whichever reserve you're going to use. Generally, our study material, you use P&L. Okay. You can also use general reserve, P&L to closing stock or stock reserve. That will be permissible. This is the entry for stock reserve. All these adjustments you will encounter in your problems. That's all. That's the reason amalgamation questions will be lengthy. Conceptually, they're not that tough. Just that the number of adjustments may be more. Okay. So this is about the stock reserve. So stock reserve means just unrealized profit ka elimination. Next is amalgamation expense. Amalgamation, see, one company is merging or buying out another company means there will be some expense also in that regard. No? First you have to research about that company, you may have to hire some consultants. Yes, so there could be some amalgamation expenses. So what is the journal entry for amalgamation expense in the books of purchasing company or new company is what we are trying to give. That again depends on whether it is a purchase method or merger method and whether it is a profit or loss scenario. Okay, so what is the journal entry for expense paid, sir? Expense paid, the journal entry is expense account debit to bank account. Yes. So yes, due to expense, your bank balance will reduce. So you will credit bank. What you will debit depends on the method and scenario. If it is purchase method and profit scenario, okay, the journal entry you will pass is capital reserve account debit to bank account. Expense here, no, you don't transfer it off to P&L. Check the scenario and accordingly pass. Because normally the journal entry expense is what? If you're paid salary. The journal entry is, let's say salary paid is 10,000. So the journal entry you pass is salary account debit to bank account 10,000. Alright. Salary is an expense. All the expense you will transfer it off to P&L. So the next entry will be P&L account debit to salary 10,000, 10,000. Yes. If you have add this entry, effectively what will happen? Salary debit, salary credit. Effectively what is the entry, sir? P&L account debit 10,000 to bank account 10,000. This is a journal entry for all expense. But you will not use P&L for if there is any expense in related to amalgamation. What will you debit depends on the method and the case. If it is purchase method and profit method, and the purchase method profit scenario we call it as what? Capital reserve. So the entry will be capital reserve to bank. If it is loss scenario, loss we call it as what? Goodwill. Hence instead of P&L it will be goodwill to bank, like that. Okay. If it is merger method, the entry will be same for profit, that is capital reserve to bank. If it is merger method and if it's a loss, that loss will we call it as goodwill or will adjust it with reserves, right? So the journal entry will be reserve account debit. Reserve could be either general reserve or P&L to bank account. Generally, study material will use P&L to bank for this particular entry. That's the journal entry for amalgamation expense. Alright, okay. Next is statutory reserve. They will give you in one of the adjustments that statutory reserves of the selling company should be taken over by the purchasing company. I'll repeat that. They will give you in one of the adjustments. Statutory reserves of the selling company should be taken over by the purchasing company. If you find this scenario, you need to pass one journal entry. Again, the journal entry depends on the method, purchase method or merger method. Under purchase method, if statutory reserves has to be taken over by the new company means, normally under purchase method, what will the new company take over? New company will only take over assets and outside liabilities of the selling company. Will they take over reserves and surplus? No. But here one specific reserve, that is statutory reserve, needs to be taken over. Statutory reserve means some reserve which has to be maintained as per the legally you have to maintain one reserve. Okay, due to Income Tax Act or Gratuity Act or whatever, due to some legal act, you need to maintain that reserve. Normally, under purchase method, the purchasing company will not take over any reserves of selling company. But one specific reserve they are expected to take over, that is statutory reserve. For this, you need to pass one journal entry. Okay, since we have to take it over. Reserve means it will have credit balance. So statutory reserve you will credit. You will debit something known as amalgamation adjustment reserve account debit to statutory reserve. Amalgamation adjustment reserve account debit to statutory reserve. This amalgamation adjustment reserve also will come in balance sheet under reserves and surplus only, but as a negative because you have debited it, no? So you will show it as a negative balance. That's all. So the entry recommended. Fine. Again, all this treatment are recommended by AS14. Under merger method, if statutory reserve are to be taken over, then no journal entry is required. Why? Because under merger method, anyway purchasing company will take over all the reserves and surplus of selling company. Since all the reserves and surplus are taken over already, statutory reserve also would have been taken over. So hence for this statutory reserve, extra entry need not be passed because anyway it is all taken over. Okay, so that's about the statutory reserve wala adjustment. Okay, so let's do one thing. Let's learn or let's apply what we learned in one of the problems. I think that will be a little better. Okay. There's some journal entries also in amalgamation that you need to pass. That journal entry, we'll learn it with the help of problem itself. Following are the balance sheets of P Limited and V Limited as on 31st March 20X1. And all the numbers they're saying in lakhs. Okay, they've given the usual balance sheet, share capital, reserves and surplus, blah, 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 blah. They've given notes to accounts. We have foreign project reserves. Okay. Long-term borrowings and PP and all they've given. It's fine. All the bill receivable held by V Limited, whereof P Limited ka acceptance. For V Limited, they're having all the bill receivable held by V Limited. Here they've given bill receivable ka data. All the bill receivable of V Limited. What is the bill receivable of V Limited? 80,000. Are having P Limited ka acceptance. That means for V Limited, it is bill receivable of 80 lakhs. For the other company, what is the other company? For P Limited. For one company, if it is bill receivable means, since the acceptance was received from P Limited, for this company, if it is bill receivable means, for the other company, it will be bills payable. This is only we call it as what, sir? MO, as in mutual owings. What can we do for this mutual owing? See, as long as there are two different companies, yes, you can show asset also, you can show liability also, no problem there. But when they get amalgamated, they will give you the data. When they get amalgamated, both the company will become one. So hence, these sort of mutual owings you need to cancel. Meaning bill receivable also you need to cancel, bills payable also you need to cancel. Bills payable is a liability. To cancel that we will debit. So the journal entry will be bills payable account debit 80 lakhs. Bill receivable is an asset. To cancel we have to credit it. So BP account debit to liability account debit to asset account basically is a journal entry. This is a journal entry we need to pass to cancel it. We will see that they will pass this entry. We'll see it later. On 1st April 20X1, so balance sheet was given as on 31st March 20X1. Immediately the next day they have told P Limited took over V Limited. P Limited took over. That means P Limited is the purchasing company and V Limited is the selling company. This is very important. Always check. Okay. So P Limited is purchasing V Limited means the purchasing company has to compensate the selling company. So purchasing company has to give PC to the owners of selling company. Agreed? Yes. In amalgamation in the nature of merger, okay, they have only clearly told in the problem that it is a merger method. When they only told the method, you need not test those 5 conditions. Aram se you can go on. If they don't test, then check. Okay. It was agreed. Merger method means one. You remember what does a merger method come? First 2 conditions that is important for our journal entry. 1. All the assets and liabilities should be taken over by the purchasing company, and all these assets and liabilities should be taken over at book value. Okay, all the assets, all the liabilities should be taken over. Nothing should be left out. And in the merger method, even the reserves and surplus of the selling company is to be taken over. Okay, so this, if you remember for our problem, I mean, if this comes to your mind, that should be sufficient. I mean, that is good enough for you to solve it. It was agreed that the discharge of consideration for business of P Limited would allot 3 fully paid up equity shares of 10 each at par for every 2 shares held in V Limited. So you have to give compensation to the owners of selling company. They are saying we'll give compensation in the form of equity shares. Which is the purchasing company? P Limited. P Limited is saying the owners of the selling company, we will compensate by giving you, not by giving you cash, but by giving you equity shares. That is being arranged in some ratio. That only we call it as PC, right? They have agreed some ratio, old and new. What they are trying to say is, check, I'll read that data again. It was agreed to discharge of consideration. Consideration here means PC. P Limited would allot 3 fully paid up equity shares of 10 each for every 2 shares held in V Limited. If you have 2 shares in the old company, that is V Limited, you will get 3 shares of the new company. That's what they're saying. For every 2 shares held, 3 would be allotted, is what they have agreed. Check. Old means V Limited. Check, V Limited has only 2 shares. You would have given a note stock accounts. Check. They have given share capital 6 lakh. Oh, they have given total. Alright. So that means we can get in total. For 2 it is 3 means for 6 lakh, because what is the share capital of V Limited? 6 lakh. For 6 lakh, how much will be the value? This is not the number, this is the value. Okay, directly we can get the value, it's fine. Alright, so what will be the value? So the PC will be what? The purchase consideration value will be 6 lakh, if you have to do it into 3 by 2, that will be what here? 9 lakh rupees. That's your first step, finding out the PC. Alright, so purchase consideration is 9 lakh rupees. And again, all the numbers are in thousands. In fact, not 9 lakh, actually this 6,000 they told. Again, all the numbers are in lakhs. 1 minute. I'll write it as 6,000 here. 6,000 is the one the balance sheet value is given. So you'll get 9,000. All these numbers are in lakhs. That's what they're for. Okay. Second step, what did I told? What did I tell? First step, you have to find out PC. Second step, you need to find out paid up capital. Paid up capital, we already know. 6,000 only of selling company, which is 6,000. Yes. Check. Third step is what? Compare PC with paid up capital to get to know whether it is a profit or whether it is a loss. Paid up capital constitutes the worth of the company under merger method. It is under merger method, okay? Okay. 6,000 is the worth of the company, but the purchasing company paid 9,000. That means they have paid 3,000 extra. That means it's a loss. Loss means what you have to do, sir? You have to adjust it in the reserves. Okay, check which company V Limited has what reserves. Generally, adjustment will be made in the general reserve first, just as a convention. Okay, so since V Limited has 3,200 in general reserve, we can adjust it in general reserves because selling company all the reserves in surplus will be taken over under merger method. No? So this 3,000 loss will adjust there. So what if general reserve balance is not there? I already told, right? If general reserve does not have balance, then you can use P&L. Or if selling company does not have any reserve, means you can use purchasing company ka reserve. If no company has reserves, you can use P&L. Okay, like that. So adjust in general reserve 3,000. This is the adjustment that we need to do. Alright, this is our working. Alright. Also, it was agreed that 12% debentures in V Limited would be converted into 13% debentures in P Limited. Yeah. Selling company, no, they have 12% debentures to the extent of 1,000. Now, what do you think debenture holders will tell? These debentures, this is of P Limited, this is of V Limited. These debenture holders are holding debentures of V Limited and V Limited is sold, What do you think debenture holders will tell? Either give my money back first or give me new company ka debentures. Yes or no? Because old company is not there, no? It is shut down. Since old company is shut down, the debenture holders will tell either give me my money back, this 1,000 you refund or you give it back to me, or you give me new company ka debentures. Here they are saying the old debentures in V Limited would be converted into 13% debentures in P Limited of the same amount and denomination. So the new company told, we will give you our company ka debentures, don't worry. But debenture holders are telling, no, I don't want 12% interest now, I want 13% interest rate. It's a negotiation. Why, sir, and all, we can't question. Okay, it's a negotiation. So they have told, the new company told, we will give you 13% debentures, don't worry. Debenture holders, that's what they have agreed upon. Trade receivable, trade payable ka breakup they have given. Okay, that is fine. It's alright. Amalgamation expense amounted to 1 lakh to be borne by P Limited. So journal entry for amalgamation expense we already decided. We just now discussed. One, it depends on the method. Method we already know here, which is what here? Method is merger method. And we need to know whether it is a profit or a loss. We already know that since we are adjusting in reserve. This is a which scenario? This is a loss scenario. Loss scenario means the journal entry for amalgamation expense will be either general reserve account debit or you can also use P&L. Study material uses P&L for amalgamation expense. So you can pass the journal entry P&L expense account or P&L account debit 1 lakh to bank account 1 lakh. That's the journal entry for amalgamation expense. You are required to pass the journal entries in the books of P Limited. P Limited is your purchasing company and prepare P Limited ka balance sheet after the merger. That's all. So entries aram se we can discuss. First journal entry that P Limited has to pass is, what did P Limited do? They purchased the business of V Limited. And the first journal entry is business. This is a routing entry only or dummy entry only. First journal entry is business purchase account debit to what happened to V Limited now. Is the company there or it is shutting down? It is shutting down. Whenever a company shuts down, no, to oversee this affairs, we appoint liquidator. So that means P Limited has to pay this purchase consideration or pay the value to the liquidator. Hence the journal entry will be business purchase account debit to liquidator of selling company. Your selling company is V Limited. So this is the entry. And they purchase this PC by paying how much PC? We already calculated. PC is 9,000. So business purchase account debit 9,000 to liquidator of the selling company V Limited is 9,000. Okay. Alright. This is the first entry. Second entry. When you purchase business, what are you going to get, sir? When you purchase someone else's business, selling company ka, what will purchasing company get? They will get all the assets, they will get all the liabilities. It's a merger method, so you'll also have to take over all the reserves and surplus. So we can go through the balance sheet. So all the assets you need to debit, all the liabilities you need to credit, also you need to credit all the reserves and surplus. Okay, asset value and all you can figure it out one by one. Here only they have given a, where is it? Maybe this one we have to check. Alright, all the assets will start maybe from balance sheet. Property, plant and equipment, they've given note. Only for V Limited you need to check, so you need to be a little careful there. What is this? Is Pika, this is Vika. V Limited ka plant and machinery is 5,000 and fixture is 1750. Have they debited 5,000 and 1750? Okay. Then any other asset is there? This is a notes to accounts. Come back to balance sheet. So this is over. Then they have inventory 4041. Trade receivable ka breakup also they give it on the next page. First maybe we'll debit inventory. Inventory 4041 have they debited? Yes. Trade receivable, no? Total trade receivable of V Limited is 1100. They have given the breakups. That check. 1100 ka breakup is this. 1020 is debtor, bill receivable is 80. You have to take the components individually. So debtor is 1080, bill receivable 1080. So bill receivable is a mutual owing you need to cancel. No? To cancel, first you need to take over. First take over the assets of the selling company and liabilities and then do the cancellation entry. Okay. After taking over only you can cancel, no? Like that. Then any other asset is there, you just check. So this is over. Then we have cash and cash equivalents of 609. Have they debited that? Yes. So this is all your assets debit. Assets account debit. Okay. You will credit what? Next is all the what and all will go balance sheet only. Share capital will not be taken. All the reserves. Foreign project reserve 310. Okay. Check have they taken credited foreign project reserve 310. Yes. Next, general reserve 3200 is there, but did you do any adjustment? Yes, there was a loss, and how much you adjusted in general reserve? 3000. Since you adjusted 3000 loss in general reserve, your general reserve balance will not be 3300, 200. From 3200, you have adjusted 3000. So the balance will only be 200. Check have they taken over 200? Yes, that's what they've written it over here. This 3000 is nothing but the loss adjusted, which we just now calculated. Okay, that's what we mean by adjustment in general reserve. Okay, then what and all is there? Check. After this, P&L 825. Okay, then anything else is there? No. So that means P&L debit 825. So this is all your reserves and surplus. Then other outside liabilities, is it there? Check. Long-term borrowings, that is debentures 1000. Then trade payable 463, short-term provision 702. So these three also have the credited. Check 1463 and 702. Okay. 12% debentures. So they are giving 13%. No? Yeah. First you have to take over 12% debentures and then you will convert this 12% debentures into 13% debentures of the same value. Okay. If you need not write like this, you can also write just simply 12% debentures. In bracket mein you can write V Limited. V Limited ka debentures first take over, then convert that debentures by giving your company ka debentures. So you can also write like this. Just 12% debentures in bracket mein V Limited. Here also you can present the same thing. 12% debentures, V Limited account debit 1000 to 13% debentures. Here you need not write P Limited because in P Limited books we don't say P Limited. Or you can also present like the way study material has done. Both the presentation they have shown. That is about the conversion aspect. Okay. This is all about the assets. I told you first entry is only routing entry, business purchase. That's a routing entry, dummy account. Okay. That you have debited. Second entry made gets nullified by crediting 9000. Okay, this way the journal entry will get matched out. That's all. Okay. So basically the journal entry is, first journal entry is business purchase account debit to liquidator or selling company. Second journal entry is under merger method assets account debit to liability account to all the reserves and surplus account debit to business purchase account. This is your journal entry under the second journal entry under merger method. Effectively you need to pass. Don't write like this. If you have taken over 10 assets, all the 10 assets you need to list out individually. You can't just directly write sundry assets or assets and move on. You need to call out all the assets. The shortcut method is not accepted. Okay. Alright. So when you buy a business, you have to pay some money. Here whom you have to pay the money to? Liquidator. If you pay cash to the liquidator, the journal entry will be. If you pay cash to creditor, the journal entry is creditors to cash. If you pay cash to liquidator, the journal entry is liquidator to cash. But in this problem, was cash paid to liquidator or how was this PC given? PC was given in the form of shares. So the journal entry will be liquidator of the selling company V Limited 9,000 to what? You can't write equity shares because whenever P Limited is the company issuing equity shares, no? Whenever company issues equity shares, for that company it is equity share capital. So to equity share capital 9,000 you will write. This is about discharge. First 3 entries will come in every amalgamation problem. Doesn't matter whether it is purchase method or merger method. There afterwards it is adjustment. Adjustment could be stock reserve, amalgamation expense, like the statutory reserve, etc. etc. Number of adjustments they may go on increasing. Alright. So this is for all this. Then there was one mutual owings in the form of what? Bill receivable, bills payable. We already wrote that entry also somewhere here. So maybe that only we'll just check. Bills payable account debit to bill receivable account 80 lakh, 80 lakh. Have they passed that? Bills payable account debit to bill receivable 80. All the numbers are anyway in lakhs. 80, 80 over. Okay, that is done. Next, what was there? I think there was one amalgamation expense. Yes, amalgamation expense was 1 lakh. I told amalgamation expense either you can use general reserve or P&L. Here they use P&L, so the journal entry will be P&L to bank. They would have shown. They have done 2 entries. You just write P&L to bank because if you club this entry, they have done to goodwill. Goodwill to bank, P&L to goodwill. So goodwill will get nullified. So effectively the journal entry will be P&L account debit to bank account. You show like this only, it is okay. P&L account debit to bank. This is the journal entry for your amalgamation expense. Okay. So every entry we have passed now then. That's all. Simple question. Yes, this is the journal entry. 3 basic journal entries. One, business purchase account debit to liquidator. Second, journal entry is to take over all the assets, liability, reserves and surplus and to close out business purchase. Third is for settlement. After that, based on adjustments, extra entries will come. Mutual owings, cancellation, stock reserve, adjustment, amalgamation expense, etc. etc. Okay. They also asked the balance sheet after the merger. Balance sheet, merger method balance sheet is very, very simple. It's a straightforward addition of balance sheet. That's all, nothing. Okay. P Limited ka share capital you take. V Limited ka, when you bought V Limited ka business, how much of equity shares you gave? 9,000 worth of equity shares you gave. So equity share capital will become 15 plus 9, which is 24. Check, have they shown 24? 24,000. Okay. Reserves and surplus is also line by line addition. That's all. Here anyway, note account, they've given reserves and surplus. So 3,000 plus 0. So 3,000 plus 0 if you do, you're going to get 3,000 only. Entire reserves, all the assets, liability, reserves and surplus, line by line you need to add. Because you have to take over all of them at book value only. So 0 plus 310. So foreign project reserve will be 310. Okay. General reserve 9,500. You will not take 3,200 because 3,000 we have already adjusted. So the balance is only 200. So 9,500 plus 200 will be 9,700. Then 2870 plus 825. I think some amalgamation expense entry was also there. Plus of 1 lakh I believe that was. So add that 1 lakh to this particular entry. We pass the journal entry, no? Amalgamation expense. P&L account debit to bank account. That's the reason. Alright. In fact, this should be minus 1. P&L you have debited, no? So that means this should be minus 1. So add up 2870 plus 825 minus 1 if you do. My calculator is showing 3694. Any other reserves is there? No. Add up all this. 3694 plus 9700 plus 310 plus 3000, that will be 16,704. That should come in your balance sheet, final balance sheet. 16,704. That is what they have done in note to account also. Okay. I'm quickly showing it to you over here because balance sheet, I believe most of you are comfortable with that. Alright. So this is the reserves and surplus wala funda. I'll go back. So reserves and surplus is done. Long term borrowing, no change. So 0 plus 1000 will be 1000 only. Check, have they shown 1000? But the debenture will not be 12% now, it will be 13%. Yeah, because new company ka debenture is very sure at 13%. That's the reason. Okay, so this is 1000. So that's all right. Then coming back to question, what else is there? Trade payable, add it up. So 1200 plus 463. If you have any mutual owings, you need to cancel. There was one bill receivable, bills payable, mutual owing. Both from bill receivable also, one asset also you need to eliminate, one liability also you need to eliminate. That bills payable is included in this 463 because trade payable means creditors plus bills payable put together, we call it as bills payable. They gave the breakup also. So how much was that mutual owing? We already discussed 80. So 1200 plus 463 minus mutual owing of 80. So this should be 1583. How much have they shown in the main balance sheet? 1583 after eliminating mutual owings. Okay. Alright. Next is short-term provisions. This straightforward addition, 1830 plus 702. That will be 2532 is what my calculator is showing, and they also showed 2532. So liability side of balance sheet done. Asset side of balance sheet also same thing. Line by line you add. If there is any mutual owings, eliminate. That's all. Okay. The asset side, these two you add, 22304 plus 6750. So the balance sheet value will become 29054. Okay, how much have they shown? 29054. Then inventory, add. There is no stock reserve adjustment. If at all there is stock reserve adjustment, you would have reduced. Minus 0 L, right? The 0 is for stock reserve. In this problem, they have not given. If at all there is stock reserve adjustment, reduce it. So 7862 plus 4041. So it will be 11,903. How much have they shown? 11,903. Okay. Then trade receivable. Trade receivable means debtors plus bill receivable. Put together become, we call it as trade receivables. Add these two mutual owings. From bills payable you have reduced 80. Even bill receivable has to be eliminated. No? So that is 80 you have to reduce from here also. So it will be 2120 plus 1100 minus 80 if you do. You're going to, my calculator is showing 3140. How much have they showed? 3140 after eliminating mutual owings. Then cash and cash equivalents, add it up. Did you pay any money? Yeah, amalgamation expense you paid 1 lakh. No? So cash balance will reduce by 1. So 1114 plus 609 minus 1 if you do. You're going to, my calculator is showing 1722. What did they take? 1722. Okay, so that's your balance sheet got tallied over there. Okay, that's how you present the balance sheet. Okay, this is about your merger method and purchase method, or purchase method ka overview. Alright, now coming back. So far what and all we discussed, all this treatment we have done in the books of purchasing company. All this treatment, all in the books of purchasing company. Selling company is also there, no? What to do in the books of selling company is the next one. Okay, in the books of selling company, since selling company is shut down, you've already done it in your 11th standard or 12th standard and all. Partnership firm, whenever the firm got dissolved, we used to prepare one account known as realization account. Here also same thing. Selling company is shutting down, so they have to prepare realization account to close down all their assets. Okay, so alright, first step in realization account is transfer all the assets to realization account, because you have to close down all the assets. All the assets have debit balance. To close them you have to credit it. So the entry is realization account debit to sundry assets account. One by one you have to call out all the assets. And these assets will be transferred at book value. Because assets are shown at book value, you need to also cancel it by crediting at book value only. So the journal entry is realization account debit to sundry assets. All the assets you need to list out one by one. Okay. Similarly, you need to close out all the liabilities also. Liabilities have credit balance. So to close it, we have to debit. So the journal entry will be all the liabilities account debit to realization account. Hence it will come on this side. And this will also be credited at book value only, because those components are shown in the books at book value only. So, okay. If there is any realization expense, so we already did amalgamation expense. No. If amalgamation expense is incurred by the purchasing company, what to do? Entry we have already seen. If amalgamation expense or realization expense, if it is incurred by selling company, then the journal entry will be, we know the entry for expense, I have already proved it to you just now. The entry is P&L account debit to bank. Yes. For one expense, you want to prepare whole P&L. Hence, for all the expenses and all, no, we route it through realization account only. So instead of writing P&L account debit to bank, if there is any realization expense or amalgamation expense, the journal entry will be realization account debit to bank account only. Okay, that is the whatever is the amount. Okay, they could also give sometimes realization expense. Let's say is 1 lakh rupees. Realization expense is 1 lakh rupees. Let's say selling company incurs this and later they get 80,000 reimbursed. Later they get 80,000 reimbursed by purchase or from purchasing company. What am I trying to say is, the realization expense or amalgamation expense is 1 lakh rupees. First, selling company will incur that expense, meaning they will pay for that expense. Later, the purchasing company will reimburse it, but they will reimburse only to the extent of 80,000 is what I am saying. Later they will get reimbursed from purchasing company. Let's make it as 80,000, not fully. Okay, partial will take. That's a better scenario. In that case, what journal entry you need to pass? First, selling company has to pay for that expense. So when they pay for it, the journal entry will be realization account debit to bank account 1 lakh 1. Okay. Later, 80,000 they will receive. So that means what is the entry? So when you paid the amalgamation expense, the journal entry was realization account debit to bank. When you get it reimbursed, ulta entry. So it will be bank to realization account. Okay, that is what I have written here. Liquidation expense reimbursed. The reimbursement I have taken it as 80,000. It could be 1 lakh also, it could be 40,000 also, whatever. How much ever reimbursement you are getting. So can I net off these two? Because here you are showing 1 lakh, here I am showing 80,000. Can I net off and show only 20? Ideally, expense will be incurred on one date. Reimbursement will happen at a later date. So showing it separately on these two is much better criteria according to me. Okay, than netting off. Okay. Alright. Now selling company, they are not selling the assets one by one. If you remember in your 11th standard and all, first you used to transfer the assets. Then you used to sell the assets one by one. When you sold the asset, the journal entry used to pass as bank account debit to realization account. You can't write a bank account debit to, let's say you sold fixed asset. You can't write bank to fixed asset because fixed asset ledger is already closed. And instead of writing bank to fixed asset, you used to write bank account debit to realization account. When you sold the assets one by one in your partnership form and all, you have done this. But here, the selling company has not sold their assets one by one. They sold their whole business. Okay, and they have to receive money from the purchasing company. Hence, purchasing company is their debtor. So this money is not received. So instead of bank, they will write purchasing company ka name. So we will write here by purchasing company account. So instead of bank, we will write purchasing company account debit to realization account because we had to receive that money. Okay, how much you will receive from purchasing company? The purchase consideration PC. That is the value we need to write. So this is the journal entry. That journal entry, when you post it into realization account, you will write by purchasing company account. This is another component. Okay. All right. Okay. Next one is to preference shareholders account. This is for any amount paid in excess of preference share capital. Let's say preference share capital was 1 lakh, but preference shareholders were paid 1 lakh 5,000. That means how much excess was paid? 5,000. So it's a loss, right? That excess loss paid will also come off over there. That's all. Okay. Alright, then finally when you prepare realization account, you will get realization profit or loss that will be transferred off to equity shareholders account. If it is realization profit, it will come on this side. If it is realization loss, on the credit side. This is just arrived as a balancing figure. That's all. Okay. Alright. Next, last the checkpoint is you need to prepare something known as equity shareholders account. That is the checkpoint. This account should get balanced, meaning debit side total should be equal to credit side total. There should not be any balancing figure. If this debit side total if it is equal to credit side total, then what you have done is correct, is the indication. Okay. So now you tell me what and all will the equity shareholders get? What and all will you show on the share capital, equity shareholders funds or shareholders funds, share capital and reserves in surplus, right? So all the equity share capital and all the reserves in surplus has credit balance that will be transferred off to equity shareholders account. So all this has credit balance. To transfer we need to debit. So the journal entry will be equity share capital account, all the reserves and surplus account debit to equity shareholders account. Similarly, if you have any preliminary expense, deferred revenue expenditure, that also you will transfer it off to equity shareholders account. All these will have debit balance. To transfer we need to credit. So the journal entry will be equity shareholders account debit to miscellaneous expense, preliminary expense, deferred revenue expenditure, etc. etc. Okay. Then equity shareholders will get their share of realization profit or realization loss depending on when you prepare realization account, check what it is and accordingly post. Okay. Basically equity shareholders will get their share of equity share capital, all the reserves in surplus, preliminary expense, deferred revenue expenditure, realization profit or realization loss, and then any purchase consideration. Okay, and any balance cash remaining if there is anything. All this you have to post it into the respective account, and this account ka total should get matched out. Meaning if this side is 1 lakh, that side also should be 1 lakh. There should not be any balancing figure. If it gets matched out, then what you have done is correct is one of your checkpoint that you can utilize. Okay. Again, in our regular class, we have done 5-6 problems on this only we have done. So this I've just given a quick snapshot summary. This also they could ask. These are all the treatments that you need to do in the books of selling company. Basically in the books of selling company, every single ledger you need to close down. Okay. Assets, liability and all will you get, it will get closed down when you prepare realization account itself. The only thing that will be pending is equity share capital, preference share capital, reserves and surplus, preliminary expense, etc. etc. Equity share capital, reserves and surplus, preliminary expense and all, you transfer it off to equity share capital. Okay, and accordingly post this, plug in all these components, whatever I've called out here as 5 pointers, right? Plug in all this, okay, under the respective sites, and the total should get matched up. If it gets matched, what you have done is seems to be correct. Okay, so yes, so that was all with respect to amalgamation of company. Thank you. Hello guys, the next topic we'll be starting with is partnership accounts, or dissolution of partnership accounts, or sale of partnership firm into to a particular company. That's the topic. Okay. So the first aspect is the dissolution of partnership firm. Dissolution means the firm is coming to an end. Yes, the reason the firm is being put to an end could be anything. It may be the partners decided to stop the business, or all the partners have become insolvent, or they have become of unsound mind. Okay, or it is the liquidation order is passed by the court. It could be anything. The reason could be anything. As far as our accounting goes, the treatment is pretty much the similar. All right. So whenever a firm shuts down, we know that we prepare realization account and partners capital account and all that, right? So all that is your regular dissolution problems which you have done in your golden days, in your 11th grade, 12th grade, etc., etc. Here specifically they're going to ask, there is a dissolution of partnership firm, and the firm is getting dissolved because one of the partner has become insolvent. Due to insolvency of a partner, the firm is getting dissolved. Okay, in case of insolvency of a partner, there is a particular case law called Garner versus Murray rule. Those rules, they have given certain provisions. That provisions we need to apply in our problems. Okay, that we will run through or quickly revise that. First, before you start this, first prepare realization account. When you prepare realization account, you will get the realization profit or loss, the normal realization account which we have done, and also take you through one of the problem just to be sure. So first step is to get that, prepare realization account and get realization profit or realization loss. In these sort of problem, mostly it will be a realization loss. And then they say transfer that realization loss to partner's capital account or partner's current account, depending on what the how the partner's capital account is being maintained. Okay. Then the third step is solvent partners, the guys who have not become bankrupt. Okay, though they are not called as solvent partners, right? Solvent partners will bring their share of realization profit or realization loss in cash or check. The solvent partners will bring their share of realization loss in cash or check. That's one next step that happens. All this we will apply it in the problems also once we are running through. Then loss of the insolvent partner. We know that partnership firm has unlimited liability. So if any partner is insolvent and if he is not able to take up the liability, then the insolvent partner ka loss will be taken up by other solvent partners in the capital ratio. As per Garner versus Murray rule, insolvent partner ka loss will be taken up by other solvent partners in capital ratio. So what is this capital? Sir, what is this capital ratio? Depends on how the capital accounts are maintained. If capital account is maintained under fixed capital method, then this insolvent partner ka loss will be distributed in fixed capital ratio. So how do we know that partner's capital account is fixed? We know that partner's capital account can be maintained under two methods. One is fixed capital method, another one is a fluctuating capital method. Okay, how to identify is in fixed capital method, each partner will have two accounts. There will be partner's capital account plus there will also be partner's current account. Each partner will have his partner's capital account plus partner's current account. Both will be available. Okay, in case of fixed capital method. In case of fluctuating capital method, partner will have only one account, that is partner's capital account. This current account will not be there. So by looking at the balance sheet, you will be able to figure out whether the capital is being maintained under fixed method or fluctuating capital method. Is that okay? Alright. So if capital accounts are maintained under fixed capital method, then insolvent partner ka loss will be taken up by the solvent partners in fixed capital ratio. So what if it is fluctuating capital method? If partner's capital account is maintained under fluctuating capital method, then we have to insolvent partner ka loss will be taken up by solvent partners in adjusted capital ratio, or you can call it as revised capital ratio. So how do we get this revised capital or adjusted capital ratio? You have to do certain adjustments. What are those? First, take the capital as given in the balance sheet. In the question, they would have given balance sheet. Take that. To that, we have to do certain adjustments. First adjustment is, if there is any accumulated reserves and surplus, add or less. If it is accumulated profit, partner's capital account will increase. So add. If it is accumulated loss, then partner's capital balance will reduce. Hence, I've written plus minus there. That was one. And if there is any interest on capital, drawings, interest on drawings, any errors, due to error, partner's capital could increase or it could reduce. Due to drawings, partner's capital will reduce. Due to interest on drawings, partner's capital will reduce. And due to interest on capital, partner's capital will increase. That's what I've written the signs of there. All right. Basically, all adjustments up to the date of dissolution. Before you start the dissolution proceeds, no, what is the capital you need to find out? Okay. Before you start the dissolution process, what is the capital you need to find out? That only we call it as a revised capital, or also you can call it as adjusted capital ratio. Each partner ka you have to find out this revised capital, and in this adjusted capital ratio or revised capital ratio, insolvent partner ka loss will be taken up by solvent partners. So what about realization profit or loss? You should not add or minus realization profit or loss, because realization profit or loss comes as part of dissolution. Only when you start the dissolution proceeds, then only you will prepare realization account and get realization profit or loss. Hence, realization profit or loss should be ignored for this particular adjusted capital ratio wala calculation. Okay, that is one particular. These are all the things that we need to keep in mind when we solve insolvency of a partner by applying Garner versus Murray wala rule. And one more point you need to probably remember is, if any partner's capital account has a debit balance. So just because a partner's capital account has debit balance does not mean he is insolvent. Like, let's say they give you in the problem, there are 4 partners, A, B, C, D. C is insolvent. C is insolvent. A's partner's capital is having a balance of 1 lakh credit. B's is having 2 lakh credit. D's is having 10,000 debit. C is insolvent, they only give it. Okay, but D ka capital balance is, it's not credit balance, it is having a debit balance. It does not mean D is insolvent. Okay, if it is insolvent, they will clearly mention in the problem. So why can't we take it as insolvent? So insolvent means even the partners don't have their personal assets. Capital account may be having debit balance, but it is quite possible that D could have some private assets. He could own a building, he may have some car, jewelry, whatever. All right. That is the reason, just because partner's capital account is having debit balance, don't assume D is insolvent. In the problem, clearly they will mention who is insolvent and only take that partner to be insolvent and go ahead and solve. All right. Now, what do we need to remember about this is, if any partner's capital account is having debit balance other than insolvent partner, there is in this case C, if any other partner's capital account is having debit balance, then such partner, as per Garner versus Murray rule, will not take up insolvent partner's loss. I'll repeat that. If any partner's capital account is having a debit balance, then such solvent partner will not take up the loss of the insolvent partner. Since D's capital account is having a debit balance over here, loss of insolvent partner, which is C, these loss will be only taken up by A and B. That is another case point given in Garner versus Murray. All right. These are the pointers relating to Garner versus Murray. So let's do a thing. Let's quickly go ahead and apply it in one of the questions. So that will be a quick revision for us. This question is asked quite a few times in examination. PQR are partners sharing the profits in the ratio of 3:2:1. No partner's salary or interest and capital is being allowed. Okay, that's great. Balance sheet as on 30th June 20x1 is as follows. They have given, you're able to see the word here, fixed capital. So they only given fixed capital. That means partnership account is capital accounts of partners are maintained under fixed capital method. So each partner will also have, other than capital account, he will also have some current account. We will see. They have given fixed assets this side. Next page, they have given current account of P and Q. R the current account is coming on the asset side, meaning it is having a debit balance. Okay. Then a loan from P. The partnership firm has taken a loan from the partner. So partnership firm has to pay the partner towards a loan of 8,000 rupees. All right. All other assets they have given. Debtors ka 2,000 balance. Then we have some provision for doubtful debts of 200 rupees and net debtors is 1,900. So P&L is also coming on the asset side, meaning P&L account is also having debit balance. On 1st July 20x1, the partnership firm was dissolved. Motor vehicle was taken over by Q. One of the partners has taken over one of the asset at a value of 500, but no cash specifically or no cash passed specifically in respect of this transaction. One of the partner has taken one of the assets and he is not giving any cash for this assets. Normally in dissolution, what happens? All the assets of partnership firm will be sold one by one and we will recover the money. Here, one of the assets partner took over and he's not paying any cash because even the partnership firm has to pay the partner. No? So all this adjustment will happen through partner's capital. Okay. Alright. Some of the other sale of other assets realize the following amount. They've given the realization value of all the assets. Okay, we'll see that later. Trade creditors were paid this much in full settlement. Dissolution expense amounts to 1,500. Loan from P was repaid. Okay. P and Q were both solvent and able to bring any cash required, but R was forced into bankruptcy. So R has become insolvent over here and was able to bring only 1/3 of the amount to due. How much ever money he had to bring, entire money they're saying he cannot bring, he can bring only 1/3. Suppose R has to bring 3,000 rupees, let's say. R's share of loss, let's say, is 3,000. Then entire 3,000 he'll not be able to bring. He'll be able to bring, they're saying, only 1/3 of his loss. So 3,000 ka 1/3 if you do, that will be 1,000. So how much ever is his loss, 1/3 of that he will bring. Balance 2/3 is Tirupati loss. Okay, that is the loss of insolvent partner, which other solvent partners have to bear. In what ratio? Since capital account is maintained under fixed capital method, the loss will be shared in fixed capital ratio. This I just assumed with this 3,000. We need to find out that. Okay, you are required to show cash and bank account, realization account, and partner's fixed capital account after transferring current account balance. Okay, they are saying no need to prepare partner's current account. Whatever balance is there in partner's current account, directly you transfer it off to partner's capital account. Okay, first thing, let's quickly prepare realization account. What is the first step in realization account? We prepare realization account to close down all the assets and the liability. First step is to transfer all the assets to realization account at book value. All the assets have debit balance. To transfer, we have to credit all the assets at book value. So the journal entry is realization account debit to all the assets. Check as per the book value. What is the trademark 40, freehold property 8,000. This is 12,800. Are you able to see the same number? Yes. Then what are the other assets we have? Motor vehicle 700, stock 3,900. Check have they taken? Motor vehicle 700, stock 3,900. Then debtors 2,000 as the gross debtors. Provision separately they have deducted. So I'll show that separately on the credit side. So to debtors we will take 2,000 and provision for doubtful debts we can take it on the other side. Or you can net off and do it also and take it instead of 2,000, you can take 2,900. But showing debtors at gross amount and provision on the other side is much better approach because even provision for doubtful debts is a separate ledger account. So that has a balance. It has credit balance. To close out, we have to debit. So the entry will be provision for doubtful debts to realization. So showing this approach is much better according to me. Any other asset is there? Cash and bank balance is there. Cash is already, you are transferring the assets to realization account because we will be able to realize the money from them. Cash is already realized. What more can you realize? Okay, you can't give Gandhi note and recover dollars. All right, so it's already there in Gandhi note. So it's already realized. So hence cash at the bank and all, we need not transfer to realization account. This is the first step, transferring all the assets to realization account at book value. Same step you have to do for liabilities also, outside liabilities. Partner's capital, partner's current account, will do it separately. Loan from P. Partner's loan, you have multiple option, people. Okay, either you can transfer to realization account, okay, or you can adjust it through partner's capital account, or you can directly show in cash and bank account. Whichever way you want to show, you can do it. Absolutely not a problem. Here they have shown it in cash and bank account. If you want, you can also write in realization account itself. One more component you can write here, by P's loan. How much is partner's loan? 8,000. So you can write 8,000 here. You can transfer it to realization account also. Absolutely not a problem. It will not impact that and solution even one bit. Okay. All right. Any other liability, outside liability is there? Yes. Trade creditors 12,400. That will be transferred to the credit side. Why? Liabilities have credit balance. So to close them, we have to debit. So the journal entry will be all the liabilities account debit to realization account. Again, the transfer will be made at book value itself. B. Okay. As in book value itself. Okay. So all this over. Next. What is the next step after transferring all the assets? You realize the assets one by one. So these the realization value they have given over here. What is the journal entry for assets sold? The journal entry for assets sold is bank account debit to assets account. But since asset ka ledger is already closed over here, you can't write bank to assets. Rather, here we'll write a bank account debit to realization account. Hence, you'll write by bank for all the assets realized. What are the assets realized? 7,000, 5,000, 3,000, 1,600. Have they taken the same number? Yes. So totally, by selling the assets, you have recovered 16,600. This is your assets realized. Okay. Since asset ka ledger is already closed, we don't write bank account debit to asset account. Rather, we will write bank account debit to realization account. Like that. Similarly, was there any asset taken over by partner? Yes. Q took over one of the motor vehicle at 500 rupees. So if you have realized the asset, the journal entry will be bank to realization account. Yes. If one of the partner has taken over that asset and you are not getting any money, then it will not be bank account. Which partner took that over? Q, right? So that means you will write Q's capital account debit to realization account. Q's capital account debit to realization account. So in realization account, you will write by Q. He took it over at 500 rupees. That's the value he is assigned for it. So we'll update that. This is about assets. What about liabilities? They told P's loan was repaid, no? Okay, either directly you can show it in bank, or you can also write here a to bank account. This is for P's loan. P's loan was repaid, no? When you repay the loan, the journal entry is P's loan account debit to bank account. But since P's loan account I have already transferred to a realization account, since the ledger is closed, so instead of that, I will write realization account debit to bank, 8,000. Check here, 8,000 I showed it on the credit side, 8,000 on the debit side. In a way, its effect will get nullified. So it's okay. You can either show that partner's loan in realization account, or in partner's capital account, or in cash account. Multiple approaches are there. You can follow any of them. Everything will give you the same final answer. Okay. Oh, what about creditors? Creditors were paid at 11,700. So the journal entry is realization to bank 11,700. There was one dissolution expense also saying 1,500. If any expense is there, dissolution expense, the journal entry for that is, or for that matter, any expense, the journal entry is realization to bank, that is 1,500. Okay. Remaining thing is what? When you prepare realization account, you're going to get profit or loss, realization profit or realization loss as a balancing figure. Here it's a case of realization loss. If the balancing figure is on the credit side, then it is a realization loss. If the balancing figure is on the debit side, it's realization profit. Here the balancing figure is 51,000 on the credit side, so it's realization loss. In case of partnership firm, all the profit or loss will be transferred to partners' capital account. So let's transfer to partners' capital account in their profit sharing ratio. What is their profit sharing ratio? 3:2:1. So in about 3:2:1 ratio, they have transferred this 51,000. So 51,000 into 3/6 if you do, P ka share will be 25,500, Q ka 17 and R ka 8,500. That's the share of all the partners. This is the first step, getting the realization account. Then is preparing partners' capital account. Partners' capital account, what will you show now? First thing you write opening balance, by balance brought down, given to you in the problem. Then check the balance sheet. Do we have any accumulated profits or accumulated losses? Yes, we have P&L over here. This accumulated losses that you have to transfer it to partners' capital account. Where is that? 12,000. Or they have actually transferred first P&L balance to partners' current account, and then they have done. You can show this working mode. You can cut off directly. You can show that loss here. Okay. So directly you can write here to P&L. How much of that loss? 12,000. 12,000 you distribute in 3:2:1 ratio. So 12,000 in 3:2:1 only, no? Partners capital account, PSR is 3:2:1 as a profit sharing ratio. 12,000, if you do, it will be 2,000, or rather, no, 12,000 divided by 6. So it is what? 6,000, 4,000 and 2,000. These are the loss, accumulated loss which you have transferred to partners capital account. Okay, and then check what is their partners current account the same. Then they told the problem, you need not prepare partners capital account or partners current account. Partners current account balance directly you can transfer to partners capital account itself. Okay, check. P and Q, they are having current account balance on the credit side, meaning on there, this is the liability side of balance sheet. This is the asset side of balance sheet. Okay. Since current account of P and Q is coming on the liability side, P and Q ka current account is having a credit balance. So when you have to transfer, you have to debit it. So the journal entry will be P's current account debit to P's capital account. That means here you'll write what? By current account of P. Okay. How much is that? P ka current account is 500. Okay. You can take it as 500 over here. P ka rather one. What is the entry there by the way? P's current account debit to P's capital account. Okay. All right. So how much is that amount? They've done all in the working note. You don't have to worry about that. So we'll do it directly over here. You can directly bring in. They've shown that the loss, the P&L account, the debit balance, they've adjusted here. I'm not adjusting directly. I'm showing. Okay. So I directly show this as 500 over here. Okay. Either you can prepare a working note like that or bring it in here only. Answer if anyway will not change. Similarly, Q ka is 9,000. That will bring it as 9,000. R ka current account is having on the debit side. So on the debit side, what is R ka current account? 400. You will write it off over here. Okay. So if you just do 2,000 plus 400 will be 2,400. Like that they have written. Okay. 6,000 minus 500 if you do, you're going to get 5,500. That's what they have done. 2,000 or 9 that's how they have ascertained for each of the components. That's it. Hope that is clear for you. Okay. Alright. Yes. So that's what. If you want it here also, 9,000 minus 4,000 will give you 5,000. That's how they have ascertained. But no need to prepare separate working note. Bring it in here only. It will save you time. Okay. This is one. This from the balance sheet. After balance sheet, you already prepared realization account. When you prepared realization account, you got realization loss. Transfer realization loss 25,500, 17,000 and 8,500. This is your realization loss. Okay. Now you have to start applying Garner versus Murray. First step of Garner versus Murray is to find out realization loss, which we did. Second step, transferred realization loss to partners capital account or current account, which we did again. Third one, solvent partners. Who are solvent partners here? P and Q will bring their share of realization loss in cash or check, whatever. So who are the solvent partners? P and Q. What is their share of realization loss? 25,500 and 17,000. This much cash the solvent partners will bring. So when the partners bring in cash, the journal entry is what? Cash account debit to partners, capital account. Yes. So if written here, you can either the adjustment can be done through cash or what do we have here? Cash account or we have bank account. We have cash at the bank, so we can route all the transaction through partners through bank account itself. So the journal entry will be bank account debit to P's capital 25,500. Why 25,500? Because P's share of realization loss is 25,500. Similarly, bank account debit to Q's capital 17,000. That is Q ka realization loss. R is insolvent, so he will not be able to get any money. That's the third step. Okay. Then we say loss of insolvent partner, which is R. Okay. R's realization loss will be taken up by other solvent partners. First of all, check how much is R ka insolvent loss. If you add all of this, these two numbers, you're getting 10,900. That side is only 10,000. That means R's realization loss is what? The side total is 10,900. Here we have only 10,000. That means R's losses or R ka total loss is how much? 900. Will R bring any money out of the total loss? This is your total loss. Can R bring any money? Yes, they told how much ever is R ka loss, he can only contribute 1/3 of that. So what is 1/3 of 900? 900 ka 1/3 will be 300. Yes, that means R will be able to bring in the amount only to the extent of 300. So the journal entry will be bank account debit to R's capital 300. Total loss is 900. In that he is able to bring in only 300 means the remaining loss of insolvent partner is 600. This has to be taken up by other solvent partners, that is P and Q. In fixed capital ratio, because here capital is maintained under fixed capital method. What is fixed capital of P and Q? 20,000 and 20,000. That means 1:1. So P and Q will take up this loss, R's loss equally. So here you write Y and P's capital and Q's capital 600. In P's capital column, you'll write 2 R's capital 300, 300. The journal entry is basically R's loss has to be taken up by these guys. That's all. Okay. So by balancing figure, you are about to write it here. So the journal entry is P's capital account debit, Q's capital account debit to R's capital account. Because something should come on the credit side of R's capital account. No? That much cash is not able to bring. So P will bear that loss. Okay. So this is the component. This is the posting you have to do. In R's capital account, you'll write by P and Q's capital 600. In P's capital column, you'll write 2 R's capital 300. In Q's capital column, you'll write 2 R's capital 300. Okay. Then P and Q are still solvent. If still any extra money if they have to bring means they will bring. But if the firm has extra cash means they will withdraw. Here they're saying this is bank. To bank is arrived as a balancing figure. Okay. They're saying company has extra cash balance over here which the partners will withdraw. Initially they will get some cash to the extent of their realization loss. After that, after doing all the proceedings, if money is left in the organization means they will take up. So this to bank or it could be by bank, it is ascertained as a balancing figure, nothing else. Okay. This should match. Last step is you need to prepare bank account. Whatever postings we have done in realization account and your partner's capital account, you have to post it into the bank account. Or banking related entries you should post, and compulsorily banking ledger or total should match. There should not be any balancing figure. If there is balancing figure, that's somewhere you have done some mistake. If it tallies, you have done everything right. That's all. So this is the step relating to, or this is what we need to do in case of insolvency of a partner under Garner versus Murray wala fund. Okay. Quickly we have done. The intention was just to give you a quick overview of that. If you do it full everything in calculate, it will take half an hour, 45 minutes and all. Okay. So we try to do it quickly. Fine. Okay. So this is one type of problem that can get asked in our examination. That is Garner versus Murray application. Next, there is something known as maximum loss method. Or before this, I'll give you a little background. Sir, when a firm dissolves, what will happen? All the assets of the firm will be sold and money will be realized. And out of that money realized from assets, you will start paying off the liability holders. Yes or no? First, you will sell all the assets and try to recover the money. And how much ever money you have recovered, from that, you will start paying all the liability holders like creditors, outstanding expense, bank loan, etc. etc. Yes. After paying all the outsiders, then you will start paying the partners. Yes, no? Once all outsiders' liability is settled, then only money will be paid to partners. Okay. Let us say, okay, a firm has 3 partners, P, Q, R. P's capital balance is 1 lakh, Q ka is 2 lakh, R ka is 50,000. Okay. That means the total capital of all these partners are 3,50,000. Yes. Suppose only 2 lakh cash is available. Totally, all the partners' capital account is 3,50,000. Okay. After paying all outside liability holders, only 2 lakh cash is remaining. This much only cash is remaining. The question will arise now is, this 2 lakh rupees, who will you pay to? Will you pay to all the partners, or first you will pay to P, first you will pay to Q, first you will pay to R? To whom will it be paid? If at all you say you will pay to all the partners, in what ratio will you distribute this 2 lakh? Whether you will distribute it in profit sharing ratio, in capital ratio, or equally, or some other ratio like this, there are some headaches. Yes or no? How much money should be distributed to partners? Because sometimes there may not be so much money left. Okay. How much ever money is available, how will you distribute? To sort out this distribution wala headache, there are 2 methods that are available or that are discussed in our syllabus. One is maximum possible loss method and other one is higher relative capital method. These are the 2 methods which is suggested. Okay. So let's run through this method and understand how these methods work. Okay. First, maximum loss method. One second. And then carry forward. One of the first assumption in this method makes is whatever amount you realize. Normally, okay, this cash available, I've given it as 2 lakh, right? This cash available, I've given it as 2 lakh. When will you receive this cash? Only when you sell the assets. Now, if the partnership firm has about 15 or 20 assets, all the assets will be sold on one day. Do you think all the assets will be sold on one day? No, quite possible that you may sell on the day 1, you may sell 4 assets. On day 10, you may sell another 5 assets. Like this, you could sell the assets gradually in installment. That means this 2 lakh also, you will not receive in one go. You will receive it in installments. Yes, possible, maybe 3 installments, 4 installments, 5 or whatever. That they will give it to you in the project. Now, this method, how it works is, this method assumes that the particular installment realized would be the last realization possible. How much ever you have realized in this particular installment, that would be the last installment possible. That would be the last realization possible. After that, you will not be able to recover any money. Okay, let's say we have recovered installment number 1 ka money now. We sold some assets and we recovered, let's say, 1 lakh rupees now in first installment. Some assets are sold and we recovered 1 lakh. What this method assumes is this 1 lakh would be the last realization possible. After this, the company the partnership firm will not be able to sell any assets and recover any money. That's the assumption this particular method makes. Okay. And using this assumption, it tries to find out something known as maximum possible loss. Okay. How do you find out maximum possible loss? The capital balance which the partnership firm has to pay to the partners. Basically, partners' capital balance it takes. From that, it deducts the installment money. Okay, like here, what is the partner's capital account? Capital account balance I've written it as 3,50,000. In this installment, how much money did we realize? 1 lakh. Okay, it assumes that only 1 lakh is the last or the last amount of realization possible. Other than this, we cannot realize anything. We have to pay 3,50,000 to the partners, and if only 1 lakh is realized, means what is the maximum possible loss which partners may face? If this is the last realization possible, means the partners will have to take up a loss of 2,50,000. Yes, that's how we get maximum possible loss. And what this method does is, normally what do? How much ever money is available, that is 1 lakh, that to be distributed to partners, yes or no? This method does ulta. It distributes maximum possible loss in profit sharing ratio. Instead of distributing installment realized in profit sharing ratio, it distributes maximum possible loss in profit sharing ratio. Okay, and after this distribution of maximum possible loss, if any partner's balance is becoming negative, then such negative balance will be taken up by other partners in their capital ratio, like Garner versus Murray. Okay, so we didn't understand. No, I've given a small example over here. We can work it out with this also once. Let's say there are 3 partners A, B, C, and their profit sharing ratio is 2:2:1. Okay. Okay. Installment money realized is only 900 rupees. You sold some assets, okay, and you have recovered 900 rupees. This is one of the study material question only. I've just taken it as a glimpse. Again, if you solve the whole question, it will take half an hour, 45 minutes. But I'll explain it to you through the small example. It's the same step. One step, if you understand, then other things will be same thing you have to do. Installment money realized is, let's say, 900 rupees. To part A has to get his capital back of 15,000. B's capital is 18. C is 9,000. The total capital of all the partners put together is 42,000. Okay. Now, what this method assumes, how much ever installment money you have realized, which in this case is 900, is the last realization possible. Meaning, after this 900, the partnership firm will not be able to sell any assets and recover any money. That's the assumption this method makes. If that is the case, means each partner will have to take how much maximum possible loss. So, what is the total maximum possible loss? 42,000 the partners have to get. But how much money installment, when you sold the assets, how much money you realized? Only 900. That means what is the maximum possible loss? 41,100. That 41,100 will be distributed to all the partners in profit sharing ratio. So 41,100, you do it in 2:2:1 ratio. So this will be what? 16,440. Okay, you're distributing loss. Loss means profit means partner's capital balance will increase. Loss means it will reduce. So I've given it as negative proportion. So here also it will be 16,440. Sika it will be 8,220. Okay. Okay. Do this and give me the total. So what will be the total here? 42,000 minus 41,900. You're going to get 900. Here 15,000 minus 16,440. If you do, you are getting a negative of 1,440. 18,000 minus 6,440. If you do, you're going to get 1,560 positive. 9,000 minus 8,220. You're going to get 780 positive. Okay. This is the distribution. Instead of distributing money available, or instead of distributing the money available to partners, it distributes maximum possible loss in profit sharing ratio. That's the first step. Okay. And after this distribution, if any partner's capital account goes negative, then this negative balance will be absorbed by other partners. Other partners here are B and C in their capital ratio. Okay. That capital ratio, let's assume it as, I'm not given it, let's assume it as 2:2. Let's say all the partners' capital account is 20,000, 20,000 and 20,000. Okay, all the partners having equal capital. So this is P, A ka, B ka, C ka, A, B, C. So A you leave out because A's share is negative. A ka share has to be absorbed by B and C in their capital ratio. The capital ratio is 20,000 is to 20,000. That is 1:1. So this 1,440 will be absorbed by B and C equally. So if you do that, B will take up 720, C will take up 720. If you do that, you're going to get the actual distribution. Okay. Actual distribution. Okay, this will be nil. So if you do that, 900, if you do this, A is getting nothing. 1,560 minus 720, if you do, that will be 840. 780 minus 720, if you do, you're going to get 60. So if you add these two, how much are you getting? 900. So indirectly they say amount available of 900 will be distributed to B and C in this particular proportion. That's how this particular method works. Simple thing, first find out maximum possible loss and distribute that maximum possible loss in profit sharing ratio. After such distribution, if any partner's capital account goes negative, then this negative share will be absorbed by other partners in their capital ratio. That's how this. If there are 4 installment means this step you have to repeat it 4 times. If there are 3 installments, do this step 3 times. That's all is the funda of this particular method. One step if you know, go on repeating the same thing. That's about your maximum possible method ka working, how it works. Okay. Next one, there is another one known as higher relative capital method. Higher relative capital method. What this particular method tries to calculate is, it is trying to check whether the capital has been maintained by the partners in their profit sharing ratio. Whether the capital is maintained as per profit sharing ratio. Because partners will get profits or loss from by doing business, right? So we are trying to check whether even capital is maintained as per profit sharing ratio. If capital is not maintained as per profit sharing ratio, meaning if any partner has some excess capital, then he will be repaid the money first. So this is just trying to say whether the capital is maintained as per profit sharing ratio. How it works, I've given a small example. Let's go through that. Let's say A's capital balance is 18, B's capital is 15,000. And A and B are 2 partners and their profit sharing ratio as in PSR is 3:2. What this higher relative capital method is trying to calculate is, first step you have to do into this method is find out the unit capital. Meaning, 18,000 is the capital A. Okay, 18,000 A is having a capital of 18,000 for how many units of profit? A's profit sharing ratio is what? 3, right? So for 3 units of profits, A is having a capital of 18,000. For 1 unit, how much? For 3 units of profit, A is having a capital of 18,000. For 1 unit, how much? That's what we need to find out here. How do you find X over here? X is nothing but 18,000 divided by 3, which is what? 6,000 rupees. Similarly, you find out the unit capital for B also. 15,000 is the capital for 2 units of profit. For 1 unit of profit, how much is the capital? So 15,000 divided by 2, which is 7,500. That is the first step. Find out the unit capital. Now, for 1 unit of profit, all the partners should have same capital. Yes or no? Because they have different units. We are trying to get everything to the common platform. We are trying to get the capital to 1 unit ka platform. For 1 unit of profit, how much is the capital? For 1 unit of profit, A is having a capital of 6,000, and for 1 unit of profit, B is having a capital of 7,500. What next you need to do is, among this, check which is the lowest number, because you are trying to find out which partner has excess capital. So you have to choose the lower or the lowest unit capital. Which is the lowest unit capital among these two? 6,000 or 7,500? Which is lower? 6,000. So choose that. Okay. And then using this, you find out the required capital. Meaning, for 1 unit of profit, 6,000 capital is what is required. How many units does A have? 3. That means what is A ka required capital? 18,000. For 1 unit, the required capital is 6,000. For 3 units, how much? That is 18,000. Similarly, for 1 unit, what is the required capital? Only 6,000. How many units does B have? 2. That means the required capital is 12,000. This is the required capital as compared to their profit sharing ratio, as compared to their unit profit sharing ratio. Compare this with actual capital balance to find out if anybody has some excess. See, check how do you find out excess? Required capital of A is 18,000. How much is he having? 18,000. That means is he having any excess? This I'll write it as 1. This is 2. So 3. Okay. 3 is nothing but 1 minus 2. 18,000 minus 18,000. The excess is 0. B ka required capital is only 12. But he is having a capital of 15. That means how much excess he is having? 3,000 rupees. Okay, so compared to his profit sharing ratio, he has excess capital of 3,000. So what this method says is, whichever partner has excess capital, first he should be paid. So first, how much ever money the partnership firm has, of that first 3,000 will be paid to B. Okay. First, 3,000 will be paid to B. Once you pay 3,000 to B, no, okay, all the partners will have the profit sharing ratio, or all the partners will have their capital as per profit sharing ratio. If you want, you can confirm that also. See, once you repay 3,000 to B, what will be the capital of A and B? Can you tell me? What will become the capital balance? A did not pay anything, so that means his capital balance is still 18,000. Okay. B ka initial capital was 15,000. In that you have repaid 3 means how much will be his capital? 12,000. That is 15,000 minus 3,000, which is 12,000. Now, what is the profit sharing ratio? 3:2. Find out the unit capital. Let's see, how do you find out the unit capital? Capital divided by profit sharing ratio. So 18,000 divided by 3, if you do, you're going to get 6,000. B also 12,000 divided by 2, 6,000. This way, what their profit sharing ratio will be exactly, or their capital will be exactly as per the profit sharing ratio. Now onwards, you will distribute the money equally to A and B. Okay. First, you distribute 3,000 to B. Once you distribute 3,000 to B, A and B will have their profits as per profit sharing ratio. From now onwards, let's say company still has 6,000 more to distribute, or let's say they have 20,000 money. Partnership firm has 20,000 for distribution. After distributing 3,000 to B, if any money is remaining, that money will be distributed both to A and B in their profit sharing ratio. So this 20,000 will be distributed among A and B in 3:5 ratio. Okay, that will be what? 12,000 and 8,000. Like this. Okay, that's how this method works. First, see which guy has the excess unit capital or excess capital, distribute that excess capital to him. After that, all the partners will have their capital as per their profit sharing ratio. Then you can distribute all the money to all the partners in their profit sharing ratio. That's how this particular higher relative capital method wala funda is all about. Okay. Alright. There is another set of question which can get asked in the examination, that is getting partnership firm getting converted, or partnership firm selling its business to a company. And the same as the normal dissolution also, because anyway, whether the partnership firm dissolves, okay, or they sell their business to another company, right? It's the same thing. Okay, so in case of normal dissolution, what will happen? All the assets will be sold one by one, and you will recover the money, and all the liabilities will be paid one by one. Okay, like that. Yes. But in case partnership firm whole business, if it is sold to a company, then from that company, if you remember, we discussed, the partnership firm will receive purchase consideration, PC. That's all. Okay, we have done one problem when we did amalgamation also, I showed. Yes. So that whatever we did in amalgamation, same thing will happen. But in case of partnership firm, they pretty much the same drama you'll have to do. Realization account you need to prepare, partners capital you need to prepare, cash and bank balance you need to prepare, etc. etc. Okay. In that case, you may also have to prepare one working note for purchase consideration calculation. And what to do in the books of company books? You know the journal entry already. 3 journal entries. Business purchase account debit to liquidator of partnership firm. Then when you purchase the business, you will get some assets. Also, you will get some liabilities. So assets account debit to liabilities account to business purchase account is the second entry. Third entry is liquidator of partnership firm account debit to however the PC is given. If the PC is given in the form of cash, you'll write to cash. If it is given in the form of equity shares, you'll write to equity share capital, etc. etc. Those concepts are same as amalgamation, that there is no change. Okay. That is another type of question that can get asked from this particular topic. Okay. Yes. Okay. This is about partnership firm. Next, we'll get on with the next topic, that is consolidated financial statements. Consolidated financial statements. Okay. What does the word consolidation mean? In plain layman language, consolidation means to consolidate something means to add up. So you are consolidating financial statement. That means 2 or more financial statements, you're simply adding. If they're giving you 2 companies, if 2 company ka financial statement, if you add 2 company ka financial statement means what? Balance sheet, P&L, cash flow statement, etc. So if 2 company ka balance sheet, if you add P&L, etc. if you add, that added statement is what we refer to as consolidated financial statements. Fine. So any 2 random companies ka financial statement can you add up? Like ArivuPro Academy with let's say Tata Limited. ArivuPro balance sheet and Tata Limited ka balance sheet, can we add up? No. Just 2 random companies ka balance sheet or financial statements you cannot add. If you want to consolidate the financial statement, then there is one key element. That key element is control. Okay, only if control is there, then only you need to prepare CFS. CFS as in consolidated financial statement. If control is there, CFS will come. Otherwise, no CFS. So when can you say control is there? If one company owns more than 50% equity shares of another company, okay, then we say the control is there. Like here example, let's say A Limited owns 90% equity shares of B Limited. A Limited has purchased the 90% equity shares of B Limited. Okay? So now we can say A has control over B Limited. Control will come if one company as if they purchase more than 50% shares of another company, then the control is available. Okay. This company, the purchasing company, we call it as holding company, or we can also call it as parent company. The other company we call it as subsidiary company. Okay. Holding company and subsidiary company. So these two financial statement, if you add, okay, A is a separate company, they are preparing their own balance sheet and financial statement. B Limited is a separate company, they are preparing their own financial statement. Two financial statements, if you add up, that added statement only we refer to as consolidated financial statement. Is it okay? So why do we need to prepare consolidated financial statement? Let's say there is an investor. He wants to invest the money, or he wants to invest the money in A Limited. Now you would tell me, as an investor, he would like to know only A Limited ka performance, or he would also like to know B Limited ka performance. He would like to know both A and B, yes or no? Because A is only controlling B Limited, no? Yes. So B Limited ka performance will affect A Limited because A only is controlling. Legally there may be two companies, but at heart they'll say there are only one company because the same management is controlling A Limited also, they're controlling B Limited also. That's the reason investor wants to know A and B Limited ka performance. Hence they do, you add up these two company ka financial statements, that added statement becomes CFS. So the investor can refer to this CFS and he can take whatever decision that he wants to take. That is the necessity of preparing consolidated financial statement. Okay. Alright. A part of consolidated financial statement, a glimpse, a little bit of it is there in our inter syllabus. A lot more is there in your CA final syllabus. We'll learn a lot more about this. Okay. For now, we're targeting the basics of consolidation over here. Okay. Interesting topic. But actually, by the way I said, it looks like a simple activity. No, sir. Two company ka balance sheet you need to take added. Two company ka P&L you need to take added. Just addition, that is calculator work. No, chindi, small work. Yes, no, chintu work. Yes. For that, why do you think some portion they have to keep it here, some portion to see a final and all? What is so big deal in adding? Sir, it's not plain and simple addition. There will be certain issues which will arise as part of consolidation. One of the issue, if you want, I can just point it out over here. Now, A Limited, I told, has purchased 90% equity shares of B Limited. Yes. So, if A Limited has purchased 90% shares of B Limited that means A Limited has made an investment. Yes, for A Limited, if they are purchasing shares of another company, so for A Limited is an investment. Investment is an asset, or investment is an asset. Asset of what balance? Debit balance. Yes or no? Alright. But you think the same transaction from B Limited perspective now. For A Limited, it's an investment because they invested in B Limited. What did they buy? A Limited bought 90% equity shares of B Limited. That means, can I say B Limited has issued equity shares to A Limited? B Limited has issued equity shares to A Limited. If B Limited has issued equity shares, means for them it is equity share capital. Yes or no? If company issues equity, if a particular company issues equity shares, means they will show that as equity share capital. Equity share capital will come on the asset side or it will come on the liability side. It will come on the liability side and it will have what balance? Credit balance. Now, how will you add this? One component. There is one component, one company, that component is an asset. The same component for another company, it's a liability. So what will happen? So you can say you can knock off also. No, what happens is investment is shown at cost price. Because whenever you have to buy investment, you have to pay the money. How much ever is the cost of the investment, you will show. So investment will be shown at cost price. But equity share capital is always shown at face value. It is quite possible that the face value of the share may be 10 lakh. But the cost of the investment may be 30 lakh rupees. Yes, possible. Because the share price currently, many years ago, the share value could have been 10 lakh. But when the day A Limited bought 90% of equity shares, the value of that 90% equity shares could be 30 lakh, quite possible. So straight away they won't get knocked off also. Though they have debit and credit balance, they don't get straight away knocked off. You need to do some working notes relating to that. So there will be a lot of issues that will arise due to consolidation. Like, what if A Limited is an Indian company, B Limited is a foreign subsidiary, okay? Like this, there are many components of that. Like, first A Limited purchased only 50%, then they purchased 30%, or first they had only 40%, then they purchased 50%, first they had 90%, then they sold off 20%. Like this, there are many issues, okay? Some issues are being discussed at CA Intel level, okay? Yes, so if I just keep telling you about this, you may not understand fully. So let's do a thing. Let's revise what needs to be done in consolidation with the help of problem directly. Whatever steps you need to do directly, I will tell you in the particular problem itself. Okay. Let's take up one question. This question is also from study material only. So let's take it up. H Limited and S Limited provides the following information on 31st March 20X2. So H Limited ka and S Limited ka, they have given certain information at the end of the year. Property, plant and equipment, that is fixed asset, they have given investment, they have given check for whom it is an investment. 8,000 equity shares of S Limited. H Limited is showing this investment. That means H Limited has purchased the equity shares of S Limited. So H is the holding company and S Limited is the subsidiary company. We'll see what is the shareholding percentage, we'll find it out. Then they have given current assets 7470, share capital they have given, and each share of face value they have given. Okay. P&L account balance they have given, a trade payable they have given. So these are some data given. Alright. Additional information. H Limited acquired the shares on 1st July 20X1. So they have given the information on 1st March 20X2. That means the current year will start from 1st April 20X1 and it will end on 31st March 20X2. This is our current year. So H bought shares of S Limited. Did they buy it on the first day of the year only? No. And the year beginning is 1st April 20X1. But they are saying H bought the shares on 1st July 20X1, meaning after 3 months. April, May, June. 3 months in the current year had already passed. And then H Limited bought the shares, equity shares of S Limited, they are saying. Balance in P&L account of S Limited on 1st April 20X1. So 1st April 20X1 balance is nothing but opening balance. Yes. On 1st April 20X1, any ledger if you have balance, that only we refer to as opening balance. So P&L account of S Limited, opening balance they have given it to be 30,000. You need to prepare consolidated balance sheet of H Limited and its subsidiary. Okay, that's all. Or if you just check on consolidation, we have done in our regular class more than 20 problems. Okay, and I've given you all the problems. I've solved it in a particular steps, our regular students. Okay, so now also we try to work out this problem in that particular steps only. So first, we have to prepare some working notes in consolidation. Working notes are the most important ones. Once you prepare working notes, other things, preparing consolidated balance sheet and all is very easy. First working note is knowing shareholding percentage. Shareholding percentage. Checks. S ka share capital is how much? 1 lakh. And each share ka face value is 10. That means how many shares does S Limited have? 10,000 shares. Yes, no, 10,000 into 10 will give you 1 lakh rupees. S Limited totally has 10,000 shares. Entire 10,000 H Limited has purchased, or how many shares has H Limited purchased? Out of this 10, they only purchased 8. So what is H Limited ka ownership percentage? 8,000 they have purchased out of 10,000. That means if you find out the shareholding percentage, it is 80%. Yes. So H Limited has purchased 80% shares of S Limited. That means there are few other people who are holding this 20%. That we refer to as minority interest. The guys who are holding other 20%, we call it as minority interest. Okay, that's the working note number 1. Finding out the shareholding percentage. Working note number 2, generally we used to prepare for general reserve of subsidiary company, that is S Limited. We used to prepare general reserve called ledger. In this problem, it is not required because we read the problem. They have not given any general reserve balance. If at all it is there, you can prepare the working note. In this, it's not there, so I'm just going to move on. Alright, I'm going to keep that working note just for your reference. Working note number 3 is preparing P&L account of subsidiary company, that is S Limited. P&L account of S Limited. Checks. Have they given opening balance of P&L? Yes, on 1st April 20X1, P&L account of S Limited had a balance of 30,000. So opening balance they have given. Buy balance brought down 30,000. Closing balance also, is it available? Check. Yes. If we just check, they have given the data as on 31st March 20X2. 31st March 20X2 means at the end of the year. P&L balance of S Limited on 31st March 20X2 is 40,000. So closing balance is 40,000. So 30,000 became 40,000. How? Opening balance of P&L was 30,000. Closing balance is 40, means it has increased by 10,000. Why it has increased? Because current year, the company, subsidiary company has made some profit. This 10,000 is nothing but current year profit arrived as a balancing figure. To know this current year profit, we prepare working note number 3. That is the intention. Okay, that will not be given to you. We need this data. That is the reason this working note. Okay. Or this is working note number 3. Same step we have done in almost all other problems. Our regular students must be, all this problem should be a cakewalk for you. So those of you doing consolidation for the very first time, so you can follow these steps if you want. Okay. Working note number 4 is analysis of reserves and surplus, or you can write it as profits of subsidiary company, that is S Limited. Okay. Particulars, H Limited and minority interest. H Limited is 80%, minority interest is 20%. Now, if you remember, what you used to show on the shareholders' funds when you used to prepare balance sheet, and the first head you used to give a heading as equity and liabilities. Under that, you used to give point number 1, shareholders' funds. Under shareholders' funds, what you used to show? Share capital and reserves and surplus. Yes, that means, can I say reserves and surplus belongs to the shareholders? Belongs to equity shareholders? So yes. So that means, who are the shareholders of S Limited? Who are the shareholders of S Limited? H Limited and others. Yes or no? In S Limited, H Limited owns 80% and others own 20%. That others only we call it as minority interest. So all the reserves and surplus of S Limited belongs to the shareholders, which is H and minority interest. Distribution of the reserves takes place in this particular working. Okay. First component is this profits. No, first we have to categorize them as pre-acquisition profit, and then post-acquisition profits. Pre-acquisition profits and post-acquisition profits. Pre-acquisition profits and post-acquisition profits. So what does this pre-acquisition profit mean? All right, checks. Current year started from 1st April 20x1. On the first day of the current year only did H Limited buy the shares of S Limited? No, they purchased on 1st July. That means how many months had already passed? April, May, June. On 1st July they bought. That means April, May, June has already passed. That 3 months we call it as pre-acquisition. Pre-acquisition means before acquisition. Before acquisition, how many months have passed? In this problem, it is 3 months. Yes, that is April, May, June. Okay. Alright. So we have to find out among all the components how much is pre-acquisition profit, how much is post-acquisition profit. I'll tell you in a bit why we do that. Okay. First is check. P&L account. Opening balance of P&L is how much? 30,000. Opening balance means this balance is as on 1st April. On 1st April was H the shareholder? No, he became shareholder only on 1st July. That means this 30,000 is what? This is a pre-acquisition profit. So we'll take opening balance instead of A directly, I'll write opening balance of P&L account. How much is the total? We can also have one total column. Opening balance of P&L is 30,000. Yes. So again, all the reserves and surplus of subsidiary company, we have to distribute to H and the minority interest in 80-20 ratio. So this 30,000 will be distributed in 80-20 ratios. That means it will be 24,000 and 6,000. This is one. Now, after that, what is there? 10,000. 10,000 is current year profit. That means this is 10,000 profit not for 1 month or 2 months. It is for the whole year. This 10,000 is a profit for whole year. But we want only pre-acquisition profit. Pre-acquisition profit means 3 months. So we will write here current year profit. Current year profit is 10,000. 10,000 is for the whole year, meaning 12 months. For pre-acquisition period 3 months, how much is the profit? So you do that 10,000 into 3 by 12. If you do, how much are you going to get? 2,500. So 2,500 is for the 3 months. Okay, that is your pre-acquisition profit. This distribute in H and minority interest. It will be 2,500. Anything else is there? No. If you distribute these two, considering these two only, you got closing balance. No? So automatically closing balance has been ascertained. So you don't have to worry anything about closing balance. Because opening balance also we distributed, current year profit also we distributed. So you only distributed out of this 10 only 2,500. So what happened to 7,500? That will come. Next is there. Okay. So that's all is there over here. So what will be the total pre-acquisition profit? Total pre-acquisition profit if you have 2, if these two calculation is 26,000 and these two it will be 6,500 and the total will be 32,500. This is your pre-acquisition profit. Similarly, we also need post-acquisition profit. Post-acquisition profit means when did H become the shareholder? 1st July, and year is ending on 31st July 20x1 he became the shareholder and year is ending on 31st March. So if you count July, August, September, October, November, December, Jan, Feb, March, meaning The remaining 9 months is post-acquisition profit. Okay. Current year ka profit we already got to know. How much is the total current year ka profit? 10,000. This is for the whole year. For 9 months, how much? So 10,000 into 9 by 12 if you do, that is 7,500. This 7,500 you distribute in 80-20. So it will be 6,000 and 1,500. This is your total post-acquisition profit. To get the pre-acquisition, post-acquisition profit, we prepare this particular working note, and this is quite important as far as consolidation problem is concerned. Okay. Alright, this is your working note number 4. Next, we prepare working note number 5 for minority interest. Minority interest. And minority interest owns 20%, right? Minority interest is a shareholder. You only told me what do you show on the shareholders funds. You only show share capital and reserves and surplus. That means minority interest being shareholder only asks for 2 things. Here's the share of share capital. Here's the share of profits. One you have to give him. Here's the share of capital. So capital, share capital you can write. What is the total share capital of S Limited? Total share capital of S Limited is 1 lakh. That is the total. Minority interest owns only 20%. So 1 lakh at 20% is 20,000. And he will ask his share of reserves and surplus. That reserves and surplus of subsidiary company only, you have split it as pre and post. That only you have split it as pre and post. So minority interest will ask for his share of pre-acquisition profit. Okay, and also he will ask his share of post-acquisition profits. You got this, or you have this number from working note number 4. Minority interest share, MI. His share of pre-acquisition profit is 6,500. His share of post-acquisition profit is 1,500. So 6,500 and 1,500. That means the total of minority interest will be 20,000 plus 8,000, which will be 28,000. Okay. This will come in consolidated balance sheet. Okay. So we need to know that. Hence this particular component. So working note number 5 is to get minority interest. Next, working note number 6, we prepare cost of control. Either you can call it as cost of control or you can also call it as goodwill. Okay. Slash capital reserve. Slash capital reserve. Okay. When I told you the example, I told you over here, right? Okay. Investment will be shown at cost price, whereas capital will be shown at face value. They will not get nullified. There will be some difference among this. That difference only we call it as goodwill or capital reserve. Okay. The difference between these two only is nothing but goodwill or capital reserve. That only you will get it in working note number 6. That's what we are trying to calculate. Working note number 6. Okay. For this, what you have to do is first you have to take cost of investment. From this, you have to deduct pre-acquisition profits. And if you have any pre-acquisition dividend, you need to reduce that as well. Then reduce face value of share capital. Face value of share capital. First of all, cost of investment have they given? Yes, H Limited bought these shares by paying 1,26,000. Okay. H Limited share of pre-acquisition profit, do you know? H Limited share of pre-acquisition profit is 26,000. That we need to reduce. So why we need to reduce this? Logically, you think so. H Limited paid how much to buy the shares of S Limited? To buy the shares of S Limited, H Limited has paid 1,26,000. Yes? Okay. And when did H Limited become the shareholder? Only on 1st July. Yes or no? That means logically, if you think from 1st July onwards, how much ever S Limited earns profit, H Limited should get a share in that. Since H Limited became a shareholder on 1st July, from that day onwards, how much ever profit subsidiary company makes, H Limited should get their share, which is 80% of that. Yes. But company does not work like that. Company works on all or nothing basis. Like let's say you purchased Wipro ka share today morning at 10 o'clock. 10 a.m. you purchased Wipro ka share. Some 100 shares you purchased. At let's say at 3 p.m. Okay, you sold the shares. You are a trader. Morning you buy, evening you sell. That's your business. Okay, so you held the share for hardly about 5 hours or 6 hours or whatever. Okay. Alright, can Wipro company call you up and saying, oh, you held the share for 5 hours? No, hey, 5 hours ka share of profit is 50 paisa. Okay, hey, your share of profit is 50 paisa. Like this, can company do? Okay, can they do this holding? It is impracticable, yes or no? Because people hold the share for 1 minute, 1 day, 1 year, 10 years. Yes, possible. So hence company does not work on this time basis. They work on all or nothing basis. So what does that mean? Once you become the shareholder, no? Once anybody becomes a shareholder, whatever the company has, whatever that company has, everything belongs to you. When H Limited becomes the shareholder of S Limited on 1st July, whatever S Limited has on 1st July will belong to H Limited. It does not matter whether the balance was created on that day, before that, or whatever. On that day, whatever is there, H Limited will get a share. And if H Limited sells the share, means nothing you will get. If you are a shareholder, you will get everything. If you are not a shareholder, you will get nothing. That's how all or nothing basis it works. I'd explain you in detail when we're done regular class. Now it's revision. I'm quickly trying to explain or recap. Okay. So now this pre-acquisition profit means what? Name itself is saying pre-acquisition profit. Pre-acquisition profit means this is the profit of subsidiary. Okay. That is S Limited. This is the profit which S Limited had made before H Limited had become a shareholder. This is the profit of S Limited. Okay. Before H Limited had become the shareholder. So ideally or logically, should H Limited get any share in this? No, because this was created much before H came into picture. But just now we proved it is not possible for us to do this time allocation. Hence, H Limited will get this. On the day they become the shareholder, whatever is there, they will get this. So H Limited will still practically get this number. So that's the reason standard says pre-acquisition profit should be reduced from cost of investment. You only think. On one hand, H Limited is paying 1,26,000 to buy the investment. On another hand, they are getting a pre-acquisition profit of 26,000. So effectively, what is their cost of investment? Effectively, their cost of investment is only 1 lakh. Because on one hand, they paid 126. On another hand, they are receiving 26. So net their cost is only 1 lakh. Hence, pre-acquisition profit you should reduce from the cost of investment. That is the fund. Okay. Same goes for pre-acquisition dividend also. Pre-acquisition dividend means using pre-acquisition profit. Using pre-acquisition profit, if any dividend is declared, because based on profits only you will declare dividend, right? Using pre-acquisition profit, if any dividend is declared, that we call it as pre-acquisition dividend. First of all, you think logically, should the company H Limited get pre-acquisition profit? No. So dividend declared out of that profit, should H Limited get? No. But we know once he becomes the shareholder, after that the dividend is declared, H Limited will receive that dividend. Even though it is pre-acquisition dividend, H Limited will still receive that. So that you need to reduce. In this problem, it is not there. If it comes, you will reduce. Okay. All right. This thing. This is your cost of investment. Compare it with the face value of share capital. What is the share capital of H Limited? 1 lakh. 1 lakh is the total share capital. H Limited owns everything? No, they own only 80%. So 1 lakh 80% you do, which will be 80,000. So do this number. If you are getting a positive number, it's goodwill. Negative number means capital reserve. So calculate. How much is this now? You are getting a positive number. That means it's a goodwill. So why goodwill? Check. You paid 1 lakh rupees for your cost of investment. That is 126 minus 26 if you do, you're going to get 1 lakh. You're paying 1 lakh rupees for cost of the investment. But the worth of the investment is only 80. Value of the investment, no? Okay. And the worth of that investment is only 80. But H Limited paid 1 lakh to buy those investments. That means they paid extra. Amalgamation concept, do you remember? Yes. The extra only is a loss. That loss we call it as what? Goodwill. That is what I said. If it is a positive number, goodwill. If it comes as a negative number, it's a profit. Capital profit. So transfer of the capital reserve. Okay. To get this goodwill or capital reserve, we do working note number 6. Okay. Last step is your consolidated reserves. Working note number 7. Consolidated P&L. Or you can write it as consolidated reserves in surplus. Either you can prepare it as a ledger or in the statement format, both I have showed you. Since there is only P&L over here, we can prepare it as the ledger format. Okay, you can also write it as consolidated P&L as a heading. Okay, what happens here is due to consolidation, H Limited ka P&L balance will not be. H Limited ka P&L balance is 50,000 that they have given. Due to consolidation, this number will change. So we are trying to find out what in consolidated balance sheet, what should be the P&L that should appear. So we take the balance given and do some adjustment. So this is P&L account of H Limited. Okay. First of all, have they given the balance? Yes. How much is the balance given of H Limited? 50,000. So we'll write here by balance brought down 50,000. So this is not opening balance. Why are you writing by balance brought down? That's what I said. No. Due to consolidation, this balance will not be. Actually, this is the closing balance. Yes. Because all this information is as on 31st March. But due to consolidation, this balance will not be 50. It will change. So I will take the balance given, do consolidation adjustment and get the revised closing balance. Hence, whatever balance they have given, I am writing it as the opening balance. If you don't like this ledger format, you can also present it as a statement. Okay. This is one. All right. Now if you just check, there was pre-acquisition profit that we have already considered, but H Limited also had post-acquisition profit. Yes, how much is H Limited ka share of post-acquisition profit? 6,000. That is regular profit. No? That post-acquisition profit will come here. So post-acquisition profit of subsidiary. If you are presenting this as a statement, take this 50,000, you add. Okay. Suppose H Limited post-acquisition profit share is 6,000 rupees. You do this. All right. This is 56,000. All right. Okay. Next is next there is no adjustment. There is no stock reserve. Nothing adjustment. So that means this only will become your closing balance. To balance carried down 56,000 rupees. These are the working notes that is necessary for you to prepare consolidated balance sheet. Consolidated balance sheet is the easiest. We'll see this now. But these are the things which are important for the as far as the problem goes. Okay. Now I think consolidated balance sheet quickly we'll run through. That's not a problem. So how consolidated balance sheet works? Consolidated balance sheet preparation works. The heading is consolidated balance sheet of H Limited and its subsidiary as on 31st March 2020. Balance sheet का format you put Roman letter 1 equity and liabilities. Under that shareholders funds. Okay. Under shareholders funds you also share capital. First thing you will show on the share capital is only H Limited ka share capital will come in consolidated balance sheet. Only holding company ka share capital will come in consolidated balance sheet. Check, have they shown? Yes. So why not subsidiary come? So H Limited is able to control. Yes. H Limited is able to control H Limited. Only those components which you can control, you will show on consolidated balance sheet. H Limited can control only assets and some liabilities. Share capital and reserves and surplus and all can you control? No. Hence, share capital and reserves and surplus of subsidiary company will not come in consolidated balance sheet. Rather, in consolidated balance sheet, only H Limited ka share capital and H Limited ka reserves and surplus will come. Hence, share capital is 1,50,000. Then what is there? Reserves and surplus, you will show P&L. You will not show P&L 50,000. You already done a working note. So as per your P&L account here, you got the revised balance how much? 56. Check, have they shown 56? So reserves and surplus they have shown 56,000 like this. Okay. Then you have to also show minority interest. Minority interest. Have you got minority interest? Yes. Check our working note. Minority interest is 28,000. How much did they get? 28,000 is minority interest. Okay. This is your under separate category. Then current liabilities. What is the current liability? Only few data has been given over here. Current liability means trade payable. All the assets and outside liabilities, no, it is 100% addition. Consolidated balance sheet is very simple. All the assets and liability you add 100%. Okay. Share capital only H Limited ka share capital will come, and reserves and surplus may only H Limited ka reserves and surplus will come. Along with this, even minority interest one extra component will come. Okay. So trade payable add these two. 1 lakh plus 60 is 1,60,000. That's the liability side ka balance sheet over. Then on the asset side, heading is assets, under that non-current assets. So they have given only two assets, PP investment and rather three assets, PP investment and current assets. PP is line by line addition. 1 lakh plus 1,30,000 if you do, you're going to get 2,30,000. How about investment? Investment will not come. Just now I explained to you. For H Limited, it is an investment, but for the other company, S Limited, it is a share capital. Both components, same component, you cannot show both as an asset as well as a liability. Okay. Hence, the share capital of S Limited also will not come. Investment of H Limited also will come. They will get nullified. That's another way or other logic why S Limited ka share capital will not come. Because for H Limited, it is an investment, which is an asset. For S Limited, it is share capital, which is liability. So hence, both will not come. Because same component, you cannot show both as an asset as well as a liability. Hence, both will get knocked off. But instead of that, goodwill or capital reserve will come. That we did a working note. No? What is goodwill or capital reserve we got? We got a goodwill of 20,000. Check, have they shown goodwill? Under non-current assets or intangible assets, they should have showed a goodwill of 20,000, which we got. Yes, same 20 also we also got, right? Yeah, 20,000. So investment will not come. Current assets, line by line addition. 74 plus 70 is 1,44,000. Current assets have they shown 144? Yes, balance sheet got matched. Okay, this is a simple balance sheet or simple consolidation problem just to explain. Okay. More or less all of the adjustments will come. Along with this, they'll give you another 3-4 adjustments, which we will discuss. Okay, once you know base of this, it's easier to discuss the other adjustments. Okay, that we will do it as per our chart. So I wanted you to have a basic understanding as to how consolidation is done. Then it is easy to run through the other adjustments. All right. Okay. Now coming back, there are a few consolidation adjustments. So let's go over them one by one. First, we got to know what is consolidation, right? Consolidation is simply adding up two company financial statements. All right. Any random company you cannot consolidate. To prepare consolidated financial statement, there has to be control. Control only if you own more than 50% shares of. If one company owns more than 50% shares of another company. Okay. Now, certain extra adjustments that will come in consolidation. One such adjustment is unrealized profit. Unrealized profit. We have already done this in our amalgamation topic. Let's say H Limited has sold some goods to S Limited. H Limited, that is a parent company or holding company, has sold goods to subsidiary company. Okay. The cost of the goods is 1 lakh. Okay. Let's say it was sold at 1,20,000. That means holding company made a profit of 20,000 when they sold these goods. Cost of the goods was 1 lakh, I assume. The sale was made at 1,20,000. So H Limited, when they did this transaction, they made a profit of 20,000. So H Limited is showing this stock, this particular component as closing stock because all these goods they have it in their inventory. So this is the transaction. We have done this in our amalgamation. Amalgamation, we also passed journal entry for this. Yes. Okay, goodwill to stock reserve or capital reserve to stock reserve, like this. It's based on the scenario and the method. We have done this. In consolidation, how these sort of transaction will work is what we are trying to say. Okay. All right. Now what you have to do is, like here, if this is the transaction, this we call it as downstream wala sale. Downstream means H Limited has sold the goods to subsidiary company. Holding company has sold the goods to subsidiary company. Means holding company is the father. Okay. Subsidiary company is children. So dad is always above. Yes. So if holding company sells the goods to subsidiary company, we call it as a downstream wala sales. In that case, what you have to do is, now you check who made the profit. This 20,000, who made profit? H Limited, right? If H Limited makes the profit, we have already done consolidation here. One problem we have done. You remember we prepared H Limited ka P&L. Just 1 minute, I'll show you. That is working note number, this one, working note number 7. Since H Limited made the profit, is that realized profit or unrealized profit? It's unrealized profit. Why, sir? Sir, H Limited sold the goods to S Limited. Legally, there may be two companies. H Limited is a separate company, S Limited is a separate company. But for consolidation purpose, you are treating them as two companies or you are treating them as one company. You are consolidating them, meaning you are adding them. So it means you are treating them as one company. So if H Limited sells the goods to S Limited and makes some profit, means is it really a realized profit or unrealized profit? Unrealized profit, yes or no? Because H and S are one company now. They are within the same group. So by selling goods to each other, they will not be able to make the profit. Hence, all the unrealized profit you need to eliminate. Okay, you need to eliminate. But since H Limited made this profit, their profit balance will be increased. So here we have to write one more adjustment known as to stock reserve. To stock reserve. How much is my example? How much is that stock reserve? Unrealized profit is 20,000. That you have to write it down here. Okay. If at all it is there, it will come here. Okay. In this problem, it is not. In the previous problem which we did, it was not there. But if at all there is profit, means it will come here. The stock reserve adjustment will come here. Okay, because H Limited made the profit, you will put it up over here. There's one impact. And anyway, from closing stock also you have to eliminate that stock reserve because S Limited is showing that closing stock not at cost price now. Because if S Limited has sold at 1,40,000 means S Limited has purchased it by paying 1,20,000. So this 1,20,000 closing stock of S Limited will include unrealized profits. That also you need to eliminate. And in consolidated balance sheet, you will show the closing stock of S as 1 lakh rupees only. Meaning when you add, consolidation is simply adding. So these two company ka closing stock you need to add. Let's say H Limited ka closing stock was 2 lakh. S ka is 120. So you will not add 20 plus 2 lakh plus 120. This 120 includes unrealized profit. No? You also need to eliminate unrealized profit of 20. Like this you need to add. That means 3 lakh of closing stock will come in consolidated balance sheet. Is that okay? Basically, the unrealized profit should be eliminated is what I'm trying to say. That is the adjustment you need to do. When holding company has sold the goods to subsidiary company. Is it always necessary only Bob, the dad should sell the goods to son? It could be other way around also. Subsidiary sells the goods to holding company. That we call it as upstream sales. Subsidiary selling the goods to holding company. Same transaction, change the arrow mark. Subsidiary is sold the goods. Cost is 1 lakh, it's sold for 20,000. Meaning subsidiary made a profit of 20,000 in that case. Yes. If that is the case means, if you remember, we do working note. We do working note number 4, analyzing the profits of subsidiary. That for unrealized profit, no, you have to bring it in here. Okay, and that stock reserve is there, no? Unrealized profit, that you need to bring in here. Okay, if S Limited has made a profit of 20,000 means that 20,000 you have to bring it as negative over here. You need to reduce that profit and give the apportionment here. Alright, That is the stock reserve adjustment. That's what I've written in the chart over here. Okay. If subsidiary is sold the goods to holding company and if they had made some profit, means in analysis of working out of subsidiary company, that is working on number 4 bit period, under post acquisition profits, you need to put that as a negative number because this is unrealized profit. So you are eliminating that profit. So as a negative sign, you put it and eliminate. This is the adjustment. And also when you're preparing consolidated balance sheet, okay, H limited ka closing stock, holding company ka closing stock will include profit now. That unrealized profit also you should eliminate. Same thing what we did. Okay, those are the impacts. All right. This is about one adjustment of relating to unrealized profit and its effect in consolidation. Let's say we'll take the same example. H limited had purchased in our example 80% equity shares of S limited. Yes. Okay. Suppose S limited wants to sell some asset, or suppose you want to sell the asset. Let's take it like that. You have an asset in the books. You are showing the asset at 1 lakh rupees. Let's say you have a plant and machinery. You are having a plant and machinery in your books. You are showing a plant and machinery as 1 lakh rupees. It is valued at 1 lakh as per your books. You want to sell it. If you want to sell it, means will you sell it at book value or you will sell it at fair value? Fair value means market value. If you want to sell any asset, means will you sell as per the books? Land, you may show it at 10 lakh rupees because you bought it at 10 lakh. 10 years ago, you bought a land by paying 10 lakh rupees. Today, its value is 1 crore rupees. Today, the value of the land is 1 crore rupees. But in your books, you are showing it at 10 lakh rupees. Will you sell that land at 10 lakh rupees or at market value? You'll always sell the asset at its fair value or market value. Yes or no? Let's say the fair value of that asset is 1,50,000. 1,50,000. Yes or no? So you will always sell this fair value. Same goes for consolidations. See, if H Limited wants to buy 80% shares of S Limited, means 80% of assets of S Limited now belongs to H Limited. And whatever belongs to S Limited, 80% of that belongs to H Limited. Yes or no? So when they are buying the shares, H Limited needs to pay the money. For this 80%, H Limited has to pay some money. Let's say that is the 10 lakh rupees or whatever, how much ever it is. Okay, 10 lakh rupees. How this 10 lakh will be arrived? This 10 lakh will be arrived by keeping fair value in mind. Yes or no? By keeping the fair value of S Limited, you will calculate. Let's say the fair value of S, or maybe we'll calculate it. This fair value of S Limited is, the whole company is at 10 lakh rupees. That means to buy 80% shares of S Limited, H Limited has to pay how much? 10 lakh ka 80%, which will be 8 lakh. Yes or no? By keeping fair value in mind, this particular investment value, cost of investment depends. Correct? Okay. Now, what is the adjustment? What is its effect on consolidation? Taking the same example, let's say S Limited has a plant and machinery in their books. S Limited has a plant and machinery in their books. Book value is 1 lakh. But the fair value of that plant and machinery is 1,50,000. Now you tell me, for consolidation purpose, we should take book value or we should take fair value? We should always take fair value because all this value, 80% is acquired keeping fair value in mind. Yes or no? Book value is irrelevant because in the books, you always follow historical cost accounting. So that is outdated information. You always take in the market value and accordingly decide the value. Yes. So for our consolidation purpose, we need to take fair value. But S Limited is showing the asset at what value? 1 lakh. So that means this, due to this fair value, okay, there is a fair value increase. Due to this adjustment, there is a fair value increase of how much? 50,000. This 50,000 ka adjustment, you need to bring it in consolidation. Okay. What you need to do over here is take this increase. Increase is how much here? 50,000 rupees. Now, all right. That you have to take in pre-acquisition profit. Okay. Here I've done working note number 4, if you remember. Analysis of profits of subsidiary company. If you have any fair value adjustment, okay, fair value adjustments, okay, that you have to bring it in over here. Because whenever you have to increase, I've already discussed an accounting standard 10 also. If you want to increase the asset and bring it up to fair value, you need to pass one journal entry. Asset account debit. Asset account debit to revaluation reserve, or revaluation surplus or revaluation reserve. Plant and machinery, you are showing at 1 lakh, but its fair value is 1.5 lakh. If you want to increase it, you need to pass the journal entry, plant and machinery account debit to revaluation reserve 50,000. Yes. Now all the reserves and surplus of subsidiary company belongs to whom? The shareholders. Who are the shareholders of subsidiary company? H Limited and minority interest. Hence, if there is any fair value increase, that fair value increase will come under pre-acquisition profits column because all this adjustment is happening on the date of acquisition. So fair value adjustment, here there is a fair value increase. So hence, plus 50,000 you do. This 50,000 will be distributed to H Limited and minority interest in 80-20 ratio. So it will be 40,000, 10,000. So if you have any fair value increase, you will put that increase in this particular column. So what if it is fair value decrease? If it is decrease of let's say 20,000, asset ka fair value is reduced. Books may are showing 1 lakh, but its fair value is only 80,000. If that is the case, then you will write it as minus 20,000, and here it will be 16,000 and minus 4,000. Like this. Same. There is also fair value adjustment, but this is a decrease. So that fair value increase or decrease will come in here. Are we fine? Also, it will have one more adjustment. If you just check over here, we are taking the plant and machinery value as how much for our consolidation purpose? 1 lakh. But S Limited is showing plant and machinery in their books at what value? 1 lakh. That means S Limited has calculated depreciation on 1 lakh. But for consolidation, we need to calculate depreciation on 1,50,000. Because for consolidation, we are taking the value as fair value, which is 1.5. But S Limited has taken the depreciation on 1 lakh and calculated. So due to this fair value depreciation, you will also get some excess depreciation. Because they have calculated depreciation on 1 lakh. We need depreciation on 1,50,000. On what value depreciation is not calculated? 50,000. Let's say depreciation rate is 10% assumption. So 50,000 into 10% you do, which will be 5,000. That excess depreciation will come under post-acquisition profit over here. Excess depreciation due to fair value adjustment. Due to fair value adjustment, how much extra depreciation you are getting? 5,000. That depreciation is an expense. No? An expense will reduce the profit, hence negative a portion. That will be distributed to H and minority interest in 80-20 ratio. So this will be 4,000 and 1,000. That will be the distribution. Fair enough? Okay, so if the fair value of the asset increases, then you will also get some excess depreciation. Suppose the fair value of the asset has reduced means the company would have charged more depreciation. That means you have to reverse this depreciation. In that case, it will not be excess depreciation, it will be reversal of depreciation. So the sign will not be negative, it will be adding back. That is what I've written in the chart over here. Right? If you have revaluation or fair value increase, then that increase amount you have to take it in pre-acquisition profit. Because of this increase, you will get some excess depreciation, and that excess depreciation you have to show it under the post-acquisition profit side. All right, that's one. If you have revaluation decrease, meaning fair value decrease, then take that decrease under pre-acquisition profit as a negative sign. All right, and then you will not get excess depreciation. Rather, you will get reversal of excess depreciation under post-acquisition profit. That's all. This is another adjustment which often gets asked in our examination. In our regular class, we have done more than 4 or 5 problems relating to this adjustment. Revision session, so I can't do a whole problem. So that's the reason I'm quickly running you through one. Okay. So there's about revaluation adjustment wala drum. Okay. Dividend, pre-acquisition dividend, already I've explained it to you. If there is pre-acquisition dividend means you have to reduce, or maybe once again I'll just put it up here and tell you. If you have any pre-acquisition dividend means you have to reduce it from working note number 3. Because if subsidiary company has declared dividend means their profit will reduce. Out of profit only you will declare dividend. So pre-acquisition dividend has to be reduced 1 at this place. Working note number 3. If at all it is there. In the problem, this problem which we did, it was not there. If it is there, you have to reduce. Why? If subsidiary company has declared the pre-acquisition dividend means the dividend they will declare out of profits. So profit will reduce. This is 1. Then pre-acquisition dividend you have to reduce from working note number 4 also over here. Okay, that is working note number 4. And then you have to reduce from working note number 6, which I have already explained it to you. And you also need to reduce from working note number 7. If you have any pre-acquisition dividend, you have to reduce it from here also. Why? So pre-acquisition dividend, no? Or if you want to explain it over here, pre-acquisition dividend, logically, should H Limited get this? No. Why? Pre-acquisition dividend means that dividend paid out of pre-acquisition profit. First of all, holding company should not get pre-acquisition profits only. So pre-acquisition dividend also they should not get. As per accounting standard 13, investment accounting, AS 13, no? What AS 13 says is, if you have received any pre-acquisition dividend, then dividend is an income, yes? Yes. If you are receiving any dividend means, for you it's an income, yes? Income you will transfer to P&L. But pre-acquisition dividend is not your regular income, because ideally you should not be getting that. So hence what AS 13 investment accounting says is, if the company has received any pre-acquisition dividend, then that pre-acquisition dividend has to be reduced from cost of investment. I'll repeat that. If you have received any pre-acquisition dividend, then as per AS 13, you have to reduce it from the cost of investment, because this is not your regular income. Ideally, you should not be, logically if you think you should not be receiving it. But due to practical difficulty, the companies will pay and you will receive it. That's the reason. Okay. That's the reason this should not be transferred to P&L. But in your problems, they will say, in all this consolidation problem, there will be a note and they will say, pre-acquisition dividend of 10,000 received by holding company, they have credited to P&L account. Meaning, instead of reducing it from the cost of the investment, they have transferred it to P&L account. That is what is adjustment they would have told. Okay. Instead of reducing from the cost of the investment, if you treat it as a regular income means you will transfer to P&L. So P&L balance of H Limited would have increased. Hence, to reduce that, we have to bring in pre-acquisition dividend column here. Okay, that's the reason. If you have pre-acquisition dividend and 4 working notes, you need to reduce. That's about pre-acquisition dividend wala fund. Okay, alright. Like other usual concepts relating to amalgamation, like mutual owings, if you remember. Mutual owings could come in the form of debtor, creditor, bill receivable, bills payable, loan given, loan taken. If holding company, if they have given some loan to subsidiary company. For holding company, it's a loan given, meaning an asset. For subsidiary company, it is loan taken, which is a liability. All these mutual owings you will eliminate in consolidated balance sheet. Okay, whatever mutual owings is there, you have to eliminate. That concept is same. Okay, that same drama will follow. And one more, not so popular. If they ask you to prepare consolidated P&L, not balance sheet, consolidated P&L. Same like balance sheet, it is line by line addition. All the income, all the expense, you go on adding. 100% go on adding, no change. 100% of expense of holding company and 100% expense of subsidiary company, you add. Similarly, 100% income of holding and 100% income of subsidiary, you add. Line by line, you add the addition. If at all there is any mutual owings, eliminate that. From balance sheet also, consolidated balance sheet also, you need to eliminate mutual owings. From consolidated P&L also, you need to eliminate mutual owings. So what could be mutual owings for P&L? If holding company has sold the goods to subsidiary company, and for holding company it's a sale. For subsidiary company it is a purchase. So one company it is a sale, for another company it's a purchase. These are mutual owings. So from sales also you eliminate that amount. From purchase also you eliminate. If holding company has given some service to subsidiary company, for which they have charged. Holding company has given some service to subsidiary company and they have charged some money. That means for holding company, it will be an income. Let's say commission income. Okay. But for subsidiary company, it's an expense. These two belong to same group now. So there's a mutual owing transaction. So eliminate that. So if you have those sort of transaction, eliminate that in consolidated SPL. Okay. Those are the kinds of problems which gets asked in our examination. So this is about consolidation wala topic. So next we will get started with liquidation of companies. That's the next topic. Okay. So here liquidation of company means the company is shutting down. The company is closing down. So whenever company closes down, what do you think will happen to company ka assets? All the assets relating to the company will be sold off and the money will be recovered. And using that money, all the liabilities will be paid off. Yes. So to do all these activities, normally company appoints a person known as liquidator. To do this liquidation process or winding up or close down process, a person is appointed known as liquidator. Okay. His job is to sell the assets, receive the money and distribute that money received among the various people. How much to give it to the bank loan, how much to give it to debenture holders, how much should we pay creditors, how much to the preference shareholders, how much to equity shareholders. And obviously he'll do all this activity to get some remuneration on his own. So liquidator's remuneration also will be there. So to calculate all this drama, to distribute or to do this apportionment activity, liquidator is appointed. Okay. This particular topic may hardly there are 3 to 4 types of problems that we'll encounter. Okay. The first type of problem that can generally get asked in this particular question is liquidator's statement of account. Okay. Let's learn that particular concept or that particular thing, how it's done with a numerical problem itself. Liquidator statement of account, they'll ask you to prepare. Okay. Let's understand that with the help of this question. Again, question is from study material only. Prakash Processors Limited went into voluntary liquidation on 31st December 20x1. It gives you the following ledger balance. They are given share capital. Company has 5,000 cumulative preference shares of 100 each fully paid up. So preference share capital is 5 lakh. And these are 10% the preference shares they're saying. We have 2,500 equity shares of 100 each, 75 paid up, 187,500. Okay, we have 7,500 equity shares of 100 each, 60 paid up. So that means we have multiple class of equity shares. This is one class, this is another class. Both the face value is same, but one ka paid up value is 75, another ka paid up value is 60. Alright, and we have already learned that company can issue shares with the differential rights. So it's possible. So here we have multiple class of equity shares. We'll see what to do with that. Debentures are secured by floating charge. These are 15% debentures. They've given the value. Interest outstanding on debenture is this much. Creditors, they've given land and building machinery, all the assets they've given, and P&L account is having a debit balance, meaning it's a loss-making company. Maybe that's the reason they are shutting it down. Could be one reason. We don't know. Preference dividend is in arrears for the last 2 years. Since last 2 years, we have not paid that preference dividend. So what is preference share capital? 5 lakh. And what percentage preference shares are these? 10%. So 5 lakh at 10% if you do, you're going to get 50,000. That is the preference dividend for 1 year. How many years arrears dividend we have? 2 years. That means this will be what? 1 lakh. So totally, company has not paid preference dividend to the preference shareholders to the extent of 1 lakh. Creditors included preferential creditors of 38,000. So what does this preferential creditor mean? See, the funda is whenever company is liquidating, you need to pay the money to various people, and almost everybody will say, give me money, my money first, yes or no? So I mean, there should be an order of payment, right? Or normally what happens in this order of payment, I'll discuss this and then we'll apply. Normally what happens is, okay, first, liquidator is doing this activity. So if there is any liquidation expense out of the money that he has realized, liquidation expense first he will set aside. Okay, to do this activity there will be various liquidation expenses, no? That he will set aside. Then next payment will be made for liquidator ka remuneration. Okay, next payment will be paid for preferential creditors. So preferential creditors means those creditors who have a preference, like tax payable to the government. If you have to pay some tax to payable to the government, that is an example of preferential creditors. Salary and wages to the employees up to 4 months. Salary and wages of employees up to 4 months is considered as a preferential creditor. Meaning all these payments will be paid next. After paying preferential creditors, then the debenture holders will be paid. Those debentures who have a floating charge. Floating charge means general charge. Any specific asset is not being given to them as guarantee. Specific asset is not pledged. We have given a general guarantee. That we call it as floating charge. So after preferential creditors, debenture holders will be paid. After debenture holders, unsecured creditors will be paid. Unsecured creditors means your normal creditors, outstanding expense, etc., etc. All this will be paid, for which we have not given any guarantee. And we call it as unsecured creditors. Then the payment will be made to them. After this, all these guys are outsiders. After all these guys have been paid, next the payment will be made to preference shareholders, including dividend. Whatever needs to be paid to them, we need to pay. After paying preference shareholders, if still any money remains, then the money will be paid out to lastly to equity shareholders. So that is the order of payment. That's what we're going to follow in this question as well. Alright, that is what they're given as preferential creditors. They're not given what is the type of preferential creditors, but that's fine with me. Preferential creditors is 38,000. So total creditors is 318,750. In that 318,750, 38,000 they are saying is preferential creditor. That means how much will be your unsecured creditors? Unsecured creditors will be 318,750 minus 38,000. If you do, you're going to get 280,750. That's your unsecured creditors. Okay. Assets realized as follows. Obviously, liquidator will sell all the assets. All the assets ka realization value they have given. Okay. Then liquidation expense they have given it to be 27,250. Liquidator gets a commission of 3% on the asset realized except cash. Whatever assets you have sold, on that he will get a commission of 3% except cash. Because cash there is no need to sell. No, it's already realized. So on that cash balance we will not give any commission. On other than that, if he has sold any asset like building, plant and machinery, etc., etc., on that they're saying he'll get a commission of 3%. Great. Assuming that the final payment including the debentures are made on 30th June 20x2. So final payment you're making on 30th June. If you check this data is as on 31st December 20x1. The data they have given in the question, the balances that they have given in the question is as on 31st December 20x1. But the payment to debentures was made on 30th June 20x2. Okay, that means what? Between the data given and the payment made, there is a delay of 6 months. That means even for this 6 months, you have to pay interest to the debenture holders. So the interest on debentures is already given. Yeah. Interest outstanding in debentures, this is the interest up to 31st December because they only told no. All this data is up to 31st December 20x1. For the next 6 months also, you need to calculate interest. We will do that. Okay. Using this data, you need to prepare liquidator's statement of account. It's very simple. Liquidator statement of account, it's like your cash account. If you remember, all of you have done cash account. In cash account, how do you show it? All the receipts you will show it on the debit side. All the payments you will show on the credit side. So liquidator statement of account is similar to that. The format is receipts amount, payments amount. Okay. All the receipts you will show it on the left hand side, all the payments you will show it under the payment side, that is the right hand side. That's simple as that. Okay. Well, we'll get started. First, do we have any cash balance? Yes. Currently, liquidator already has a company already has a cash balance of 75,000. So first is asset realized. First we will write bank balance 75,000. You can write to bank 75,000. Then asset realized, other assets. Other assets, what and all liquidator sold? Building he sold for 3 lakh, machinery for 5 lakh, patent for 75. 3, 5 and 75 show 3 lakh, 5 lakh, 75,000. Other than that, stock for 150, trade receivable for 2 lakh, 150 and 2 lakh. So totally he has sold asset to the extent of 12 lakh 25,000. By selling all these assets, he has realized 12 lakh 25,000. Okay. So this is the money right now the liquidator has. With this money, what do you think he will do first? First, he will set aside the money for the liquidation expense. Do we have any liquidation expense? Yes, 27,250. That's the first payment. Liquidation expense 27,250. Then liquidator ka remuneration. He will get his remuneration. They told how much ever assets he has realized, that is 12 lakh 25,000 ka, except bank balance, whatever other assets he has sold. On that 3% he will get. So if you calculate 12 lakh 25,000 ka 3% if you do, it is 36,750. That one. Okay. So liquidation expense over, liquidator's remuneration over. Next the payment will be made to preferential creditors. Do we have any preferential creditors? Yes, 38,000 they do. So next payment will be made to preferential creditors 38,000. We still have a lot of money. Yes, we have almost 13 lakh. We have only made these 3 payments. I think we are still good to go. We can carry forward. Yes. Then after that we will pay debenture holders who have floating charges. 2 debenture holders, what and all you need to pay. One, you need to pay their debentures. What is the value of debentures? You need to pay them 50,000. And interest up to 31st December 20x1 is outstanding to the extent of 37,500. These 2 you need to pay, 250 and 37,500. That's all? No. Interest they have calculated only up till 31st December 20x1, but the final payment was made on 30th June 20x2. That means extra 6 months interest also you need to calculate. How much will be that? Debenture value is 2,50,000 and these are 15% debentures. So next you will calculate 2,50,000 into 15% for 6 months. If you calculate this, 2,50,000 into 15% into 6 divided by 12, my calculator is showing 18,750. That is your extra 6 months interest. So totally you need to pay them 3,06,250. Okay. This is a payment made to debenture holders. After debenture holders, if any money remains, still you can pay off to unsecured creditors. How much unsecured creditors we already wrote here? 280,750. So that is your 280,750 unsecured creditors over here. After satisfying or paying unsecured creditors, if there is still money, you can pay preference shareholders. Okay, I think we still have money. To preference shareholders, what and all you need to pay? One, you need to pay their capital back to the extent of 5 lakh, plus some dividend also was in arrears for 1 lakh. 5 lakh towards preferential capital, 1 lakh towards dividend. So totally 6 lakh you have paid. Check if you want to do the total. Okay. 75,000 is these 2. Total receipt is 75,000 cash we already had. 12 lakh 25,000 is asset realized. From this we made series of payment. So total receipt is 1 lakh 30,000. I'll write these 2 addition is 13 lakh rather. Okay, this is your total receipts. These 2 addition. Then total payment made so far. Till here how much? I'm just trying to find out how much cash is available. Till this I'm adding 27,250 plus 38,000 liquid this one plus 36,750 plus 306,250 plus 280,750 plus 6 lakh. So totally we have made the payment up till preference shareholders. We have cleared a payment to the extent of 12 lakh 89,000. Totally liquidator had 13 lakh rupees. The preference shareholders he has settled and that settlement value is 12 lakh 89,000. Still some surplus is remaining. Okay. If you calculate the surplus, 13 lakh minus 12 lakh 89,000. So that will be what? 11,000 is the money still remaining. Yes or no? Yes. After paying preference shareholders, if any money remains, next whom you should pay? You should pay the equity shareholders. Yes or no? But the problem here is, do we have only one type of equity shareholders or we have 2 types of equity shareholders? We have multiple class of equity shareholders. If you have multiple class of equity shareholders, how you need to pay them or whom will this? Now, right now, check see. We have only 11,000 surplus. Okay. To one class of equity shareholders, we have to pay 187,500. These 2 numbers. Yes. To one class, we need to pay 187,500. To another class of equity shareholder, we need to pay 4,50,000. That means we have to pay a lot more, but we don't have that much money. We have only 11,000. So this 11,000 will be given to whom? Is the question. Okay. For this, to sort out this, there is a small approach known as notional call approach. Okay, that is what I've given in the chart over here, notional call approach. That is what I'm about to discuss. So how to solve this, or who will get the money? There's a small component known as notional call approach. How we do that? So this is nothing but working note number 1. Okay. Anyway, in our regular class also 5-6 problems we have done just on this notional call approach. Same format we will stick here. Now also we try to do this. Working note number 1, we can call it as call money from contributory, or you can also call it as equity shareholders distribution, whatever you want, that's okay. Call money from contributory. Okay, first of all, what is your total receipts? Total receipts, we already calculated that. Total receipt with the liquidator is 13 lakh. Okay. Alright, 1. Total payments. Total payments is how much? Total payments, when we added all this, we got these things which I boxed. Up till preference shareholders, the liquidator has already paid 12,89,000. Okay. I mean, do we have any surplus or deficit? Surplus or a deficit. I'll call it as 1 minus 2. If you do that, you're going to get 11,000. That is your surplus. 13 lakh minus 12,89,000, which is 11,000 surplus. Okay. Now, how this approach, notional call approach works? Just concentrate here for 2 minutes. Check here, sir. One equity shareholders, both the face value is same, not a problem. But one guy has, one class of equity shareholders have paid 75, another guy has paid 60. That means, are they on the same platform? No, one guy ka platform, one guy has paid 75, another guy has paid 60. So one is on 75 ka platform, another one is on 60 ka platform. Okay, since they are on a different platform or different basis, before you distribute the money, you have to get them on the same basis. Because if you want to compare, no, you can't do apple to orange comparison. Yes, no. If you want to compare something, it has to be on the same things. Yes, but these guys' paid value is different. So if you want to distribute, first you have to get them on the same platform. That is what we are trying to do with the help of notional call approach. So what happens here is, check. This guy has paid 60 rupees. If he pays another 15 rupees, if this guy, these guys, 7,500 equity shareholders or on these shares, if we recover 15 per share more, how much the paid value will become? 75. This paid value is already 75. That means both of them will become at par now. Yes. If these guys pay another 15 rupees more on their share, per share basis, all of them will become equal partners. Yes or no? That is what we are about to do over here. Notional call money. Notional call money per total notional call money. Okay. On one share, what is the notional call money, sir? 75 minus 60. So on one share, the notional call money is 15. Okay. On one share, they have to pay 15 rupees. How many such shares they own? 7,500. So what will be a notional call money? This is notion, meaning this is not happening. Okay. Just to work out, we want to get them on the same platform. So hence we call it as notional or notional call money. Notional call money per share is 15. 7,500 shares we have. So 7,500 into 15 will be 1,12,500. So what will be your surplus? If you recover this 1,12,500, then liquidator will have more money. So we will write here surplus after notional call. After notional call money, what will be the surplus? That we will call it as 3 plus 4. Money will increase. No? From 11,000, it will increase by 1,12,500. That means the surplus will become 1,23,500. This much money liquidator will have if the other guys pay 15 rupees per share extra. Yes. Or can you tell me what is the total number of equity shares we have? Total number of equity shares we have. First, one guy ka, how many shares we have? Type 1 we have 2,500 shares. Type 2 we have 7,500 shares. So 2,500 plus 7,500 if you do. Totally we have 10,000 shares. So if liquidator has 1,23,500, totally he has this much surplus. That surplus whom? Can he keep it with himself? No, he has to distribute to equity shareholders. So this 123,500 will be distributed among 10,000 shares. This 1,23,500 will be distributed among 10,000 shares. On one share, how much is the refund? So what is your refund per share? Equity shareholders will get how much money? That's what we mean by refund. So refund per share will be how much? That can I call it as 7 is equal to 5 divided by 6. 1,23,500 divided by 10,000 if you do, you're going to get 12.35. So on one share, the company will refund 12.35 rupees. One share, a company will refund 12.35. That means what will be the total refund? Total refund on 75 paid up shares. On 75 paid up shares. Okay. How many of them? How many shares be there? How many shares on which 75 is being paid up? 2,500 shares, because those guys don't have to pay anything more. No? So to these guys, we will issue a refund. We will issue a refund of 12.35 because they have paid 75. Everything we are getting to 75 platform now, because that's what we made it as. That's a platform we took. Yes. So these 2,500 shareholders or on these shares, 75 is already paid up. So hence they will get a refund of 12.35. 2,500 into 12.35 if you do, they will get a refund of 30,875. Okay. But what about the other guys? 7,500. Now these guys, no, check. They will also get a refund of 12.35. They will also get a refund of 12.05, provided they have paid the company totally 75. If they have totally paid the company 75, then they will also get a refund of 12.35. Yes, that's a refund on 75 paid up shares. Have they paid 75? No, they have paid only what? 60 rupees. That means what? If they pay the company, if these 7,500 shareholders, if they pay the company 15 rupees, if they pay the company 15 rupees, then they will also come to which platform? 75 paid up platform. Yes. If these shareholders, 7,500 shareholders, okay, if they pay another 15 rupees per share, okay, then they will also come on 75 platform. Then the company will issue them the refund, meaning they will be able to collect how much? They will be able to get, the company will refund them 12.35, meaning they will be able to collect 12.35. Now you think two transaction will happen now. First, they will pay 15 rupees to the company. Then the company will give them back 12.35. Do you think that will happen? Rather than that, we will net off now. Instead of they paying 15 to the company and collecting 12.35 from the company, net off. So that only we call it as call money from contributories. Okay. From these guys, company will collect them. Yes, or these guys only will pay the balance. 15 minus 12.35 you do. They will only pay off the company 2.65 per share. Instead of paying the company 15 rupees, these shareholders, instead of paying the company 15 rupees and collecting 12.35 back from the company, they will pay the difference amount to the company, 12.65. So shareholders will give 2.65 rupees per share to the company. Right? So for the shareholders, it's a payment. For company, it's a receipt. Yes. So hence that only we calling it as call money from contributories. All right. How much? Well, the call money per contributory is 12.65. How much? How did you get 12.65? That is nothing but 15 minus 12.35. This is the call money per share. 2.65 is on per share. How many such shares are there? We have 7,500 shares. So if you calculate 2.65 into 7,500, that will be 19,875. So from one class of shareholder, company is collecting the money. On another class of equity shareholder, company is paying the money. That's how it works. That's how your notional call approach works. Right? They them on the same platform only. Okay. So this is the refund, meaning the liquidator has or the company has to pay these guys. So this 3875 will come on the payment side. Right? How about this call money from contributory 19,875? Company is collecting. So company is collecting means it will be collected by liquidator only. So it's a receipt for it. So this 19,875 is a call money from contributory. That's what we worked out. Okay. This approach we call it as notional call money. There are multiple approaches to work out these sort of problem, but our study material, ICA study material uses notional call approach. Hence I suggest you present this, this in the same format as I've showed you over here. All right. Simple notional call money. How? Try to get them on the same platform just to make sure you have got it. Let's say face value of the share is 100, but the paid up value of this is only 50. Instead of 75, let's make it as only 50. This also, face value is 100, but paid up value is only 40. Instead of 75, 60, I made it as 50, 40. In that case, what will be notional call money? The notional call money per share will be what? This guy ka paid up value is 50, other guy ka paid up value is 40. That means if these guys pay another 10 rupees more, on these guys, if you collect another 10 rupees more, that means everyone will come to 50 ka platform. So the notional call money in that case will be 10 per share. Like that you have to do the working. Same numbers they will not give you. This you can use it as a reference and keep doing the question. Alright. So this is one type of question. Okay. If you just check here, all the payments has been made and liquidator's final statement of effect. Account ka both the side is matching. There is no balancing figure. After plugging in these numbers, if these final total, if it is not matching this total, then you have done some working wrong. Both the side ka total, receipt side ka and payment side ka total should match up. Okay, then you have done the calculations correctly. That is your checkpoint. Okay, this is one type of problem that they can ask in your examination. Liquidator statement of account. Using the same data, they can ask the same data in a different format that we call it as liquidator statement of effects. which I've called it out over here. Liquidated statement of affairs. That is just no calculation, taking the data and dumping it. Okay, you have to prepare them in certain list. List A, already you must have gone, you must have been aware of that. It's a plain format driven exercise. List A is for those assets which are not pledged, meaning those assets which you have not given it as guarantee to anybody, freehold assets. It's there with you, you have not pledged or not given that assets as security or guarantee to anyone. That comes under list A. Some assets you could have pledged to take bank loan or to give debentures, etc. etc. So assets specifically pledged will come under list B. List C is for preferential creditors. D is for debenture holders having floating charge. D is for debenture holders having a floating charge. Okay. Then E is for unsecured creditors. F is for preferential creditors, preferential shareholders. G is for equity shareholders. H is for deficiency. Deficiency means, let's say equity shareholders, share capital is 1 lakh, but the money available is only 70,000. To equity shareholders, we have to pay 1 lakh rupees. But the money available with the liquidator is only 70. That means there is a shortage, right? 30. That shortage only we refer it as deficiency. So we present the same data in the list format. We presented liquidator statement of account in receipts amount, payment amount format. Now we have to present it in a statement format, the same component. This is another type of question that you can expect from this particular topic. All right. Next, another type of question that could come from this particular question is known as list B contributories. Contribution from list B contributories, or you can simply call it as list B contributories. So what is this? So list A contributories means the present members of the company. The present shareholders or members of the company, we call it as list A contributories. Yes. List B contributory means past shareholders of the company, previous shareholders of the company who have sold their shares, who have sold, more importantly, the partly paid up shares 1 year prior to liquidation date. Okay. Now, what is this funda? Maybe I'll give you a little background. Let's say face value of the share is 10 rupees. Okay. Paid up value of the share is only 8 rupees. Paid up value is only 8. You know, once you take up, company has, or shareholders of the company have limited liability. To the extent of face value of the share, they are liable to pay the company. Yes. Let's say face value of the share is 10. Company had asked the shareholders to pay 8 rupees and all of them had paid 8 rupees. Company had asked the shareholders to pay 8 rupees and shareholders had paid 8 rupees, meaning called up capital and paid up capital is 8 per share. Okay. So what about the balance 2? Company told, if required later on, I'll ask you. If required later on, I will ask you. Okay. Then company went into liquidation. Now, do you think can the company ask this 2 rupees from the shareholders? Yes, because the liability of the shareholders is up to 10 rupees per share, but they had paid the company only 8 rupees. So, company has a right to collect this 2 rupees from the shareholders. Okay. So, first this 2 rupees, they are like to collect it from the present members, who and all are existing equity shareholders. No, the company will try to collect the money from them first. That is the listing. Suppose certain members from list A, if they are bankrupt or they cannot pay, if they are untraceable, okay, if you are not able to collect the money from list A, then company has a right to approach list B contributories and ask them to pay this 2 rupees. Because previously list B means the past members of the company who have already sold the company shares. Okay, that past members of the company, we call it as list B. So, past members means somebody would have bought the share 50 years back also. How will we go and approach them? They may not be there at this dunya also. They might have gone to heavenly place. Yes. So, how will you follow up them? That's the reason they've kept a ceiling limit, or they've kept a limit for list B. List B means the past members of the company who have sold partly paid up shares. It has to be partly paid up shares. If it is fully paid up, then shareholder will not even pay 1 single penny extra. Yes. If it is fully paid up, that's it. Done tomorrow. You can't even ask anything more from them. So, list B means those previous members of the company who have sold partly paid up shares within 1 year prior to liquidation date. So, if your liquidation date is, let's say, 10th August 2023, then go 1 year prior to this. That will be what? 11th August 2022. Yes, no? Okay, somebody who has sold the share within 1 year from the date of liquidation. From the date of liquidation, go 1 year back. So, in this particular window or in this particular time period, who and all have sold their share, that members we call it as list B contributories. If before this, if anybody has sold the share, they are not list B contributories. Company cannot reach out to them. Okay. Only those guys who have sold the share within 1 year prior to liquidation date are known as list B contributories. And if they were holding only partly paid up shares, then the company has a right to approach this list B members and collect the money. Okay, that is one type of problem that could get asked in the examination, for which I have given you a small example. Let's work it out with the help of example to understand it. Okay, so liquidation date, I have taken it as 1st July 2023. Face value of the share is 10 rupees. Paid up value of the share is 6 rupees. That means this is fully paid up shares or partly paid up shares. 6 rupees is the face value. Paid up value is only 10 rupees is the face value. Paid up value is only 6. That means every shareholder is liable to pay the company 4 rupees more, because 10 minus 6 is your 4. But if they will give you in the problem that the current company is not able to pay the creditors because money is not sufficient we are not able to collect the money from list A contributors. They will ask you to calculate from list B guys, how much money you can collect. Okay, that's what we are trying to work out. So I have given you 4 guys, the date of sales. A, B, C, 3 shareholders have given. A is, I have assumed 500 shares they are owning. B is 300 shares. C is owning 200 shares. A has sold the shares on 1st Jan 2023 itself. Okay. First of all, what is liquidation date? 1st July 2023. Go 1 year before this. So 1 year before this, if you calculate from 1st July 2023, if you calculate, okay, that will be what? 2nd July 2022. Yes, from 1st April to 31st March is your year, right? So from 2nd July 2022, if you count 1 year, it will be 1st July 2023. Yes. So those guys who have sold the share within this window becomes your list B contributories. A has sold the shares within 1 minute. I should have 1st January 2023. Is 1st January 2023 fitting within this window? Yes. So A is a list B contributory because he is already sold. Only present members we call it as list A. A is already sold, but since he has sold the share within this window, he is a list B guy. B is sold within 1st April. 1st April 2023 will come within this window. It's 2023 year. So 1st April 2023 will fall within this window. 1st May 2023, C has sold. So all of them have sold with the shares within this window. So all of them are liable to pay. Okay. Now how this works? Let's say on 1st January 2023, company had to pay the creditors 10,000 more. Company does not have money to pay this creditor 10,000 rupees. They have to pay 10,000, but money is not available. Okay. All right. Okay. Now what happens is incremental creditors write the same thing, 10,000. Now company has a right to collect the money from list B members. We'll see how this works. Is this liability of 10,000? A sold the shares on this. On the day A sold the shares, the liability or the creditor we had to pay how much? 10,000. This will be shared by A, B, C because on this particular day all these guys were shareholders. Yes, because B sold it much later, C sold it much later. A sold on 1st January only. So on this day, liability of the company, the outsider's liability was 10,000. This 10,000 the shareholders will share in the ratio. Normally, liability of the shareholders will be limited to the shares taken up by them. How much ever shares the shareholders have taken up, based on that only they are liable to pay. Yes. Hence, this 10,000 liability will be shared by ABC in the shareholding ratio, which is 500 is to 300 is to 200, or you can simply call it as 5 is to 3 is to 2. So this 10,000 will be shared by them in 5 is to 3 is to 2 ratio. So 10,000 into, that means amount will be what? 5,000. A 5,000, B 3,000, C 2,000 rupees. So company has a right to collect this much money from them. We'll work out at the end. First we will finish off all this. There is one ceiling limit of maximum liability also. First we will open. Okay. On this day A went off. Okay. After A goes off, do you think the liability is his headache? No. No. On 1st April, few months later, on 1st April 2023, B sold his share. On that day, creditor ka balance was 15,000. On 1st January, it was 10. On 1st April, it has become 15. That means it has increased. That only I am calling it as incremental creditor. So 15,000. This 10,000 portion is already settled. Yes. Only now you have to settle extra 5,000. Again, don't say 15,000 we have to settle. Because in this 15,000, 10,000, we have already calculated over here. So how much is the incremental portion? 5,000. This will be shared only by B and C in 3:2 ratio. A will not even contribute single rupee towards this. Why? Sir, A has already sold his shares on 1st January. If you ask him, what do you think he will say? Boss, I sold my share on 1st January. So whatever is the liability on that day, I will bear that. After that, if extra liability comes, how am I liable for it? That is not my headache. Like some of you have done your BCom, Okay, let's say you have already finished your BCom, 1 year over. Okay, or let's say 8 months over. You completed your BCom and 8 months is over. Now your college is coming and called you up and saying, hey, we revised the fees down. Okay, we have increased the fees retrospectively. Okay, from the beginning. Okay, we have increased the fees. Because of that, you have to pay us 1 lakh rupees more. Okay, we have increased the fees, but we charge less fees from you because you are the old batch students. Current fee structure is 1 lakh more. Please give 1 lakh more. Your college has called you up and asking you the money. What do you think you will say? You will say wrong number and cut the call only. Yes or no? Same thing they will do over here. Okay, since this extra liability of 5,000 has come after A has sold, he will say, why did you transact? He will ask the company, why did you transact? Why did you buy extra goods? Okay, he will say, I am not liable towards. So on this particular day, who are the shareholders? Only B is remaining and C is remaining because C is selling much later. So hence this extra liability of 5,000, B and C will share in the ratio of 3:2. A will not contribute anything. So B ka share is 3 and C ka share is 5,000. If you do it in 3:2 ratio, you're going to get 3,000 and 2,000 like that. Okay. Now on 1st April 2023, B is gone. Alright. Now you think you can approach B again? No. On 1 month later, 1st May, C has sold the share. On that day, creditors balance is 50. Okay. Or that day, creditors balance has become 70. So how much is the incremental amount? Up to 15, it's already settled. So the incremental amount is 17 minus 15, which is 2,000. Who do you think will bear this? Only C, because A and B have already sold their share. So this 2,000 rupees, only C will share. So that means what is that total A is expected to do? If you have total all this, A ka share is 5,000, B ka is 6,000 and C ka is 6,000. So that means this is the total you are getting. Correct? Alright? But you know what they will say? This is what you are asking from them. But you can ask the stars, you can ask moon, you can ask how much ever you want. But shareholders will only use one language. Boss, my face value of the share is 10 rupees. So that means on every share, I am liable to pay you 10 rupees. I have already paid you 6 rupees. 6 rupees is already paid up. So unpaid amount is only what? 4 per share. You can ask how much ever, but the maximum liability is only 4 per share. Why 4? Because in 10, 6 is already paid up. So the balance remaining is only 4. And 1 share maximum liability of the shareholder is 4. How many shares does A have? 500. So 500 into 4, if you do, 2,000 rupees. So you are asking him to pay 5,000, but you know what he'll say? Sorry, boss, my maximum liability is only 2,000. That means he will only pay how much? He'll only pay the lower of the two. A and B you can calculate. He'll only pay lower of A and B. If you are asking less, he will pay less. But if you are asking more, he'll only pay his maximum liability. Like that. Similarly, what is B ka? B is holding 300 shares. Into 4 if you do, 1,200. C is holding 200 share and the maximum liability on 1 share is 400. So that means his maximum liability is 800. B, you are asking him to pay 6,000, but his maximum liability is only 1,200. That means he'll only pay 1,200. C ka? You are asking him to pay 6,000, but he can only afford maximum liability is only 800. So he'll pay lower among these two. So that means this much only you will be able to collect the money from the list B contributories. If you add it, it's going to be 4,000. So only this much you can receive the contribution from list B. Okay? This is another type of problem which they can ask. In fact, they have asked also. That's another problem. Okay. Yes, these are the types of questions that can come from this particular topic, that is liquidation of companies. Thank you. All right. So the next topic is banking companies. Banking companies, so let's go through them. First, every bank, every bank, how much ever profit they have earned in the current year, 25% of current year profit they have to transfer compulsorily to the reserve fund. Whether they mention this in the problem or they don't mention, you have to compulsorily do it. Every bank, how much ever profit they have earned in the current year, 25% of that profit they have to transfer it to the reserve fund. Watch out when they ask you to prepare balance sheet or P&L, this one you need to be careful. Okay. Sometimes they'll only mention how much percentage. Even if they don't mention, take 25%. 25% is minimum. It could be more also, but minimum is 25%. The rate was 20% till last year, that they have increased it to 25 now. And these could keep changing. You watch out latest RTP, you just check whenever you're writing the attempt, check your latest RTP to get all the revised rates. Okay. All right. Next is capital adequacy ratio. This is another type of problem that could come. Excuse me. Capital adequacy ratio. So what is the funda behind this is, if you just check, the primary function of bank is what? The primary function of any banks is to accept deposits and to give loans. Yes, no? The main purpose or function of any bank is to accept the deposit from public and give the money as loans. Let's say they accept a deposit of 1 lakh rupees from the public. This 1 lakh they may distribute as loan. Yes, correct? Because they have 1 lakh means they may distribute 1 lakh as loan. The problem here is, one of the problems that started facing is, see, bank, no? Think from bank angle. They will accept money from the public. That money only, they will give it off as loan to another company, whoever requires it. On one hand, they will receive the money from public, and on the other hand, whoever receives the loan, they will give away the loan. Okay. So what was happening is, if bank started becoming reckless because there is no risk for them. On one hand, collect the money. On deposits, let's say they give an interest rate of 7%. Because if customers are depositing money in bank means bank will give interest to them. Let's say that is 7%. On let's say loan, bank is collecting an interest of 10%. Okay. That means by doing this activity, bank is able to net earn how much extra? 3%. They are giving 7% interest on deposit. On loan, they are collecting 10% interest income. So 3% extra income they are getting. That's the activity of bank. You just check, there is hardly any risk in this affair. Accept the money from the public and give the loan, say money, you give it off to another set of guys. So if the banks start doing reckless lending because they want to increase this income as much as possible, because even they are doing a business, so they want to increase their net income as much as possible. So banks wants to give as much loan as possible. So banks started giving reckless loans, carelessly giving loan. Any Tom, Dick and Harry wants, they started giving loan. All right. Now check, sir. If you give it to any Tom, Dick and Harry, and if the person defaults, one of the customer took the loan, he's not repaying the money. Okay, then what will happen? The bank will stop getting this interest from him. Yes or no? Because they're not getting the money back. Then what do you think bank will tell to the deposit holders? He will say, that guy defaulted on the loan. I also can't pay you interest on your deposits. Yes, that's what they will say. Bank risk is hardly anything over here. If these guys stop paying the loan ka EMIs, then on the deposit holders also, bank will start defaulting because they don't have money. Yes. So this started issues having, because bank wanted to increase this net income, so they started recklessly lending. Hence they brought in, no, this is very serious matter because bank is playing with public money over here. Yes, that's a serious issue. Hence they brought in a small concept known as capital adequacy ratio. Okay, they said, bank, you not only can give money, loan from the deposit, along with this, RBI is instructing the bank, you also need to maintain adequate capital. Bank also need to maintain adequate capital. So that way what happens, recklessly banks will not give loans because even their money is involved. Yes, okay. When their money is involved, people will be a little more cautious. Yes or no? Hence, with that background, this particular concept was introduced, capital adequacy ratio. Okay. Through this, we are trying to find out whether the banks have adequate capital compared to their operation. That's given by a simple formula, capital funds divided by risk-weighted assets plus off-balance sheet item. So how do you find out capital funds? Capital funds are of two types, Tier 1 capital and Tier 2 capital. Tier 1 capital consists of your core capital, like your paid up capital, your free reserves, your securities premium, capital reserve, okay, these and the statutory reserve. If you have any intangible assets, you reduce it. If you have any deferred tax asset, you reduce it. Profit means you will add. Free reserve means if you have profit means you add. If you have any accumulated losses or current year losses, that you reduce. If you do this, you're going to get Tier 1 capital funds. Okay. Tier 2 capital funds is simply revaluation reserve minus 55%. If you have revaluation reserve of 1 lakh, deduct 55% of this. So 1 lakh of 55% if you calculate, that will be 55,000. So take 45,000 only. That 45,000 becomes your Tier 2 capital. From revaluation reserve, reduce 55% to get the Tier 2 capital. If you add Tier 1 and Tier 2, you will get the total numerator, that is your capital fund. Divided by what? Risk-weighted assets. Each asset will carry some risk, so it will have some risk percentage. So asset multiplied by risk percentage will give you risk-weighted assets. So what is that percentage? Simple way to remember, I had already told you. Anything to do with RBI and government, 0% risk. Because these rules are formed by the government and RBI only. Okay. So if you give some money to RBI and if you say it carries 5% risk, 10% risk and all, that will be a shameful thing, yes or no? Hence, they said anything to do with government or RBI, the risk percentage is 0. Anything to do with other banks, the risk percentage is 20%. Okay. Real estate sector, it is 150%. All others, it is 100%. This is a simple way to remember 0, 20, 150, and 100. Anything to do with RBI and bank, RBI and government, 0%. Anything to do with other banks, 20%. Real estate sector, if you have given any loans, okay, that is 150%. All other assets will carry an item of a risk of 100%. Okay. You may have some off-balance sheet items also. Off-balance sheet item means some bank guarantee given, letter of credit. Normally, banks will give guarantees on behalf of the customers. So, if you have given, banks have given some guarantees, that we refer to as off-balance sheet items. Even they carry a risk of 100%. Okay, so that's what we mean by that. Take the asset value multiplied by the risk percentage, you will get the risk-weighted assets fund. So, this if you do, you're going to get capital adequacy ratio. Okay, so this is how you calculate capital adequacy ratio. Okay, all right, and as of now, the minimum required capital adequacy ratio is 9%. CAR should be 9%. You can always check, these rates keeps getting revised. That is one type of problem that you could get. Another one is non-performing assets. So assets could be of two types, performing and non-performing. Right. Let's say bank has given a loan to another customer. If bank has given a loan to the customer, means bank will expect two things from that customer. What? Periodically he should pay the principal back and periodically he should give the interest back. This only we call it as EMI. That customer should pay the interest to the bank as well as principal back. If he is paying means, then we say that is a performing assets. Performing assets are those assets on which the banks are earning. Because if customer pays the interest and principal, bank is able to generate the income, because on loan, bank will get interest income. Yes. So if they are able to recover these components, then we call such assets as performing assets. If suppose they defaulted, if suppose one of the customer defaulted for a continuous period of 90 days, you did not receive principal or interest for a continuous period of 90 days. If the default is 90 days or more, then we call such assets as non-performing assets. Non-performing assets are on those where there is some default for a continuous period of 90 days. Okay. And NPA classification should be made not on borrower wise, based on facility wise. It should be done based on borrower wise and not facility wise. Meaning, let's say there is one customer A Limited. There is one customer A Limited. He has taken two loans from SBI, State Bank of India. One loan, term loan, one he has taken, term loan two loans he has taken. Okay. One loan ka value is a 10 lakh, another ka loan value is, let's say, 1 crore. Two term loans he has taken. Okay. One ka value is 10, other ka is 1 crore. Alright. On this 10 lakh, no problem. Everything is paying. Interest, principal, everything is paying to State Bank of India. Things are going smooth. On this, he has defaulted. He has not paid interest and principal for a continuous period of 90 days. That means what? This looks like NPA, yes or no? But what the RBI regulation says is NPA classification should not be done loan wise or facility wise. You should do it borrower wise. Meaning, if particular borrower, if he has taken two loans, even if he defaults on one loan, then both of them will be classified as NPA. Even if he defaults on one loan, then how much ever loan he has taken, if he has taken 10 loans and on one if he defaults, then all the 10 loans will be classified as non-performing assets. These are some strict regulations RBI has imposed, so that's that. Because bank plays with public money, so they need to be careful as to whom they are giving the loans to. So hence some strict regulations are put in place. That's what I mean by NPA classification borrower wise and not facility wise. So why is this important? One, on NPA you have to make some separate provisions. Like if you have if your debtors are not paying, means you make provision for doubtful debts, right? Similarly on NPA we have to make a provision. Okay, and another funda of difference is if you have performing assets, income on performing assets will be recognized on accrual basis. Meaning if there is no default, if everything is going rosy, smooth, okay, then the interest income on performing assets, that only we call it as performing assets, right? So interest income on performing assets we recognize on accrual basis. However, if it is a non-performing asset, interest income will only be recognized or income will be recognized on receipt basis or cash basis. Meaning you will not recognize. Accrual means what? Whether the customer has paid or not, you recognize it. Okay. If this month has passed, means this month ka income, you can recognize it as an income. Because customers will not pay exactly at month end, Okay. Right? Whatever is the due date, on that day he will pay. So accrual basis means irrespective of whether he has paid or not, you can go and recognize the income. Receipt basis means only after the customer has paid, you can recognize the income. This is the difference. On NPA, income recognition happens on a receipt basis. Alright. On non-performing asset or on performing asset, it happens on an accrual basis, like that. Another part which is important for our examination is provisions. Okay. First on standard advance. Even standard advance, you need to make provision. If you have given standard advance means performing assets. Right? Meaning everything going smooth on these assets. On these assets, you have to make a provisions. One is if you have given loan to agriculture sector, you have to make provision of 0.25% on the loan outstanding amount. If the loan outstanding amount is 1 lakh means on that 1 lakh calculate 0.25%. That is the provision required. If it's an agri loan. If you have given a loan to real estate sector, then you need to make provision at the rate of 1%. For all other loan, it is 0.4%. All these provisions percentage you need to remember. They will not give you to in the examination. You need to remember and put it up there. So on agri it is 0.25. On real estate sector it is 1. On all others it is 0.4%. This is for the performing assets or standard assets. If you have non-performing assets, then non-performing assets has various categories. In fact, under non-performing assets there are 3 categories. One is substandard, another one is doubtful, and last one is loss assets. Okay. So when does it become substandard? So from the date of NPA up to 1 year. From the day you classified an asset as NPA, from the day you classified a loan as NPA, from that day till 1 year, the loan we call it a substandard. It will remain in substandard category. All these are NPA only. Under NPA, we have 3 more categories: substandard, doubtful, and loss assets. So up to 1 year from NPA date, it will be under substandard category. After that, it will move up to doubtful category. Okay. Loss assets means 100% Tirupati toss. You are not able to recover the money. Bank also gave up the efforts. They all will not recover the money. So loss assets means the bank, whether the bank or internal auditors, external auditors, RBI, anyone, even if they feel that on this loan we will not be able to recover any money, that becomes a loss assets. Okay. Why this is important? Provisioning percentage are different. If it is substandard asset, for secured portion the provisioning is 15%. For unsecured element it is 25%. If it is in doubtful category, check. Doubtful up to 1 year, it is the provisioning percentage is 25% of the loan amount. And for unsecured, if it is in doubtful category, for unsecured portion, it is 100%. So what do we mean by secured and unsecured? Sir, if the bank gives loan means, they will obviously take something from the customer as guarantee or surety. Let's say bank has given a loan to the customer worth 1 lakh rupees. Okay. They have guarantee. They have taken something from guarantee. Let's say they have given an agricultural loan. Okay. Alright. And they have taken tractor as guarantee. Tractor value is 80,000. Okay. So of this 1 lakh, 80,000 is secured by 80,000 becomes your secured loan, and the balance 20,000 becomes your unsecured loan. Meaning on the unsecured means on those loans which you don't have any guarantees. Alright. So banks always take guarantee. No, so yeah, banks take guarantee, but with time the guaranteed value may reduce. Yes, so that's the reason. So 1 lakh is the loan amount given, but the guarantee value is only 80,000. So if it is secured loan, the provisioning percentage is different. If it is unsecured loan, provisioning percentage is different. For secured again, it is 15 and 25. For doubtful assets, up to 1 year, it is 25%. More than 1 year, but up to 3 years, it is 40%. More than 3 years, 100%. If it is in doubtful category and if it is unsecured asset, then the provisioning percentage is 100%. For loss assets, whether it is secured or unsecured, does not matter. Provisioning percentage is 100% only. Alright? Alright. If no provision is required to the extent of guarantee given by ECGC and DICGC. ECGC and DICGC are agencies of government, Export Credit Guarantee Corporation and Deposit Insurance Credit Guarantee Corporation. These are agencies to promote few activities. Okay, like ECGC, Export Credit Guarantee Corporation, is an agency, government body, which will help the companies. The main function of that is to promote the exports. Okay, so they will help the company. They say. So normally, to do exports and all, people will be little hesitant. Why? One company is in India, but they are exporting, let's say, to Japan. They don't know about the other customer, whether they will pay or not. So there will be little skepticism. Okay. So hence these corporations will tell A Limited, don't worry much. Okay, if something bad happens, dude, I will cover for you. Right? And what is the activity? They will give you some grant or they will help the companies. That is the main objective. So if the loan is backed by any ECGC or DICGC guarantee, to that extent, you need not make provision. That is what is the rule. Okay. Alright, so let's do a thing. Let's quickly run through this particular thing in form of problem. From the following information of AY Limited, compute the provisions to be made. They have given you standard assets. Okay. Sir, have they given you agricultural advance, real estate advance? No. They've just told standard. That means the provisioning percentage is what? 0.4%. For standard advance, 0.4%. For others. If it's agri and all, 0.25. Real estate, 1. They have not mentioned, so I'll take 0.4. For substandard, it depends again on secured or unsecured. If it is secured, it is 15%. If it is unsecured, it will be 25%. They have not given anything. I think they have assumed it as secured, so we will take it as 15%. You can also assume it as unsecured and take 25 also. Doubtful, up to 1 year, secured. Secured assets in doubtful category is 25%. For 2 years, up to 3 and 3 years, meaning it is less than 3 years. So the provisioning percentage is 40%. For more than 3 years, secured by mortgage of plant and machinery, 600 lakhs. So they're saying in this 2000, 600 is secured and 1400 is unsecured. Sir, if it is in D3 category, meaning doubtful for more than 3 years, does not matter whether secured or unsecured, provisioning percentage is 100%. For loss assets also 100% provision. That's what they've done. You need to take the loan amount here, multiplied by the respective provisioning percentage. You'll get the amount of provision. Okay. So 2000 multiplied by 20,000 multiplied by 0.4, the provisioning percentage will give you a provision amount of 80 lakh rupees. Okay, all the numbers are in lakhs. Like this, you will get the total provisioning amount. There's nothing but your provision for doubtful debts which you have done. So banks also have to create on their advances, especially if it's an NPA. This is the provisioning percentage. Okay. This also they will ask either as a standalone question or they may club this aspect in balance sheet preparation and P&L preparation also. There's one flexible question which can be plugged in anywhere. Okay. It is that sort of question. Okay. Now coming back. Okay. Another one is aspect that they could test is a rebate on bill discount. Rebate on bill discount. So what is this rebate on bill discounted? See, one of the activities of bank is discounting the bill. Okay. Let's say A Limited has sold some goods to B Limited. A Limited has sold some goods to B Limited worth, let's say, 1 lakh rupees. Okay. Let's say with 3 months credit. With 3 months credit. But he wants the money right now. Right? But B Limited, since he is given a credit of 3 months, he'll only pay after 3 months only. Alright. So what A Limited and B Limited do is they can enter into this bill receivable, bills payable transaction, Now A Limited will put draft one document which saying this contents. I've sold the goods worth so and so lakh rupees, 1 lakh rupees with 3 months credit. And then B Limited will put a signature on the document. He'll verify the contents and put the signature. Once B Limited puts a signature, for A, it becomes a negotiable instrument. Meaning for A Limited, it will become bill receivable. For B Limited, it will become a bills payable. Okay. What is the importance of this is, this bill receivable document, that letter, okay, that A Limited can take to a particular bank. Let's say they took it to ICICI Bank. Okay. A Limited can give this letter to ICICI Bank. Using this letter, A Limited or ICICI Bank will give money to A Limited. What is the bill value? 1 lakh. Entire money ICICI Bank may not give. Then let's say they gave only 90,000. They gave only 90,000. Right? Meaning bank also should earn commission. No? Okay. This we call it as bill discounting. Meaning bank will purchase the bill from another vendor and based on that bill, they will give the money. Okay. To the A Limited. After this, what will happen? After this, what will happen? ICICI Bank will wait for 3 months. They have this bill, no? They'll wait for 3 months, approach B Limited. After 3 months, they will go to B Limited and collect the money. Okay, and B Limited after 3 months will pay to ICICI Bank. This is one of the activities which the bank do. This we refer to as bill discounting. Okay. Alright, what happens here is, if you just check, the bill value was 1 lakh, but ICICI Bank only gave how much? 90,000. Okay, let's maybe do it with the dates. Let's say bill discounting date is 1st February 2023. This is the date on bill discount. So what is the term of so bills will have term. What is the term here? 3 months. Okay. That means what will be your due date? When will ICICI Bank? They paid the money. When they discounted the bill, they gave the money. Okay. But when will they recover the money? They will recover the money only after 3 months. Okay. Alright. So that means let's say the due date is February, March, April. So 30th April 2023. There will be some grace days also for all this. For simplicity's sake, I'm ignoring the grace days. Okay. So leave that. So this is your due date. Plus actually 3 days you need to add. For simplicity, I'm leaving that. Okay. Now check what is happening here is bank did some process over here. They purchased the bill. But the bill value is 1 lakh. But how much did they pay? They paid only 90,000. That means did they earn some interest? Did they earn some interest income or commission income? Yes. 1 lakh was the worth of the bill. They gave only 90,000 means they earned a commission or a discount income of 10,000 rupees. Yes, that's an income for the bank. Okay. Now the question is, this income relates to February or it relates to February, March and April. This 10,000 is an income. You might have discounted the bill in February, but does not mean that this 10,000 is an income relating to February. Why? because the bill cut term is how much? 3 months. That means this 10,000 is an income for, or rather, I think I'll get an odd number. Let's make it maybe as 91,000 instead of the 90. No, let's make it as 91,000. Okay, so that we land up with around solid figures. So let's say ICICI Bank gave 91,000. So 1 lakh minus 91,000 will give you 9,000. Okay. Okay. So this 9,000 is an income not for 1 month, for 3 months. What is that? Okay. March and April. So Feb income will be how much? 9,000 is an income for 3 months. That means every year or every month the income is how much? 3,000. Yes. You know what the journal entry bank will pass? And they purchase the bill. That is an asset for them, because after 3 months they'll be able to recover the money. It's a loan given for the bank. Yes. No? Right now they have given 91,000. After 3 months they will collect 1 lakh. So with interest they will collect 1 lakh. So it's a asset for them. So they will pass the journal entry bill discounted account debit. What is the bill value? 1 lakh. To client account or to customer account. To customer entire 1 lakh they gave up. No, they gave only 91,000. To discount on bills. How much is the discount on bill the bank earned? 9,000 rupees. This is the journal entry they will pass. Okay. Discount on bill is an income for the bank. Yes. No? Alright. But the question is, can you transfer entire 9,000 to your P&L? See, current year ends on, I'll also give you right here. Current year ends on 31st March 2023. Current year starts on 1st April 2022 and it will end on 31st March 2023. Okay, this is a data point. For this year, which is ending on 31st March 2023, can the bank book entire, or can they transfer entire 9,000 to P&L? No, that would be wrong. Why? So this 9,000 is an income for 3 months, February, March and April. So does April fall under current year or it comes in the next year? April comes in the next year. But bank has already received this 3,000. Yes, no? They have already received this 9,000 totally. Okay. Out of this 9,000, 3,000 does not belong to current year. It belongs to the next year. That next year income only we call it as a rebate on bill discounted. It's nothing but in golden days you used to call it as income received in advance. If you receive any income in advance, that we used to call it as income received in advance. That only here we call it as, in bank terminology, rebate on bill discount. That is nothing but it is an income relating to next year, but it is already received in the current year. It might be received in the current year, but can you transfer that to P&L? Can you transfer entire 9,000 to P&L? No. This year income should be transferred to P&L. Next year income you should transfer to next year P&L. Yes or no? That means you have already credited bill discount on bill of 9,000. In this 3,000 belongs to next year. So means you need to pass one journal entry. Discount on bill account debit. In this 9,000, how much belongs to next year? The April income, which is 3,000. This 3,000 we park it in a separate account. Previously used to call it as income received in advance. Here we call it as rebate on bill discounted. To rebate on bill discounted 3,000. Okay. Current year we have to pass this particular journal entry. And then how much ever? 9. If you just check what is the balance on discount on bill, you credited it by 9, you debited it by 3. So how much is the balance remaining? 6,000. Yes. That 6,000 is an income for the current year. Yes. March and February is the income for the current year. That you will transfer it off to P&L. So the journal entry will be discount on bill account debit to P&L account 6,000. This way what happens, that income account will get closed. Okay. Fair enough. This is what the banks have to do. Alright. That is what I called out here as journal entry. Okay. For the current year, they need to pass the journal entry discount on bill account debit to rebate on bill discount. Okay. This is one. Okay. And discount income will transfer it off to P&L. That entry also again. Suppose the same transaction was there in last year also. Then what will happen? Or maybe giving the same example only. This 3,000 you did not recognize it in the income in the current year. Why? It belongs to next year. So when you come to next year, what will happen? Next year, what will happen? See, this 3,000 rupees you parked it on rebate on bill discounted. Why? It belongs to next year. When you come to next year, is it still income received in advance? No. So in next year, what do you have to do? Next year, it becomes your normal income. So you have to pass reversal entry. From rebate on bill discounted, you have to transfer it to discount on bill account. So the entry will be what? That is what I have given here. Rebate on bill discounted account debit to discount on bill. This is what last year ka rebate, that which last year ka rebate income. Last year it was income received in advance. That's the reason we did not recognize. But in the current year, it becomes normal income. So from rebate account, you have to transfer it to normal income account. Fair enough? Alright. And whatever discount income finally remains, that you transfer it off to P&L. That is another set of problem which they can ask. I think there's one more question similar on this concept. Let's maybe cover off this also. Calculate rebate on bill discounted as on 31st December 20x1 from the following data and show the journal entry. They have given the date of the bill, they have given the amount of the bill, period of the bill, 5 months, and the rate of discount. Okay. Alright. First is calculating the rebate on bill discount. For each component, you need to calculate the rebate income. And they're saying year is ending on 31st December. That's what they're trying to say. Okay. For this, what you have to do is, first you have to get the due date of the bill. So they've already given, no, this is the date of the bill. Just the date. They have given the period also. Period means they have given here 5 months. The date of bill discounting is 15th October. The period is 5 months. So what is the due date? Add 15th October for plus 5 months you do here. How much is that? November, December, January, February, March. So 15th March. These are negotiable instruments. So you'll also have 3 grace days. Okay. So it will not be 15th March. It will become 18th March is the due date. Adding the 3 grace days. Similarly, from 10th November, the period is 4 months. So add 4 months. It will be what? November, 10th November, if you add 4 months, it will be December, January, February, March. 10th March plus 3 grace days. So it will become 13th March. Similarly, this will become 28th March and last due date will become 23 March. This you need to find out, due date of the bill. Okay. Now, your year is ending when? 31st December. 31st December 20x1. Is the due date of the bill also getting over on 31st December 20x1? No. The due date of the first bill is on 18th March 20x2. Current year ends on 31st December, but this bill date is 18th March. That means how many days is going beyond the current year? Current year ends on 31st December. This bill date is having a due date of 18th March. How many days is going beyond current year? After 31st December, count from till 18th March. That means January full 31 days, February 28 days, March ka 18 days. So how many days is going beyond 31st December? Why 31st December? Because in this problem, our year is ending on 31st December. If the year is ending on 31st March, accordingly, we could have taken it. Okay, but here it is 31st December, so we have to calculate. So 77 days. What is the meaning of this? How much ever discount income bank has earned on this bill amount. Now, of that, 77 days is the income relating to next year. Why? Because 77 days is not falling in the current year, it is falling in the next year. Okay. How much is the discount income the bank earned on this? 8%. What is the bill amount? They have only given 25,000. So on this 25,000, bank is earning a discount income of 8% totally. Yes. But how many days is going beyond the current year? Or how many days comes in the current year? 77 days. So for 77 days, you calculate. Because we have to calculate rebate on bill discount. No? Into 77 divided by 365. 25,000 into 8% into 77 divided by 365 if you do. My calculator is showing 421.917. That they will written it as 421.92. This is nothing but your rebate amount. Rebate on bill discounted amount. For each component, we need to calculate. Same, 15,000 is the second bill amount. Discount rate is 7%. So 15,000 is the bill amount. 7% is the discount income which the bank will earn. How many days is going beyond the current year? Our year ends on 31st December. This due date is 13th March. So if you count January full month, February full month, March ka 13 days. January 31, February 28 and March ka 13. That is 72 days. So for 72 days, how much is the income you need to calculate? So it will be 15,000 into 7% into 72 divided by 365 if you do. You're going to get 207.1. Okay. Similarly, for other bills, you need to discount, rebate on bill discount will be income for 87 and 82 days respectively. This is the total rebate on bill discount. Meaning this is the total next year income which the bank has received in the current year only, because all this bill they have discounted in the current year. They have discounted all this bill in the current year, but all their due dates is falling in the next year. So how many days is falling within the next year also we have calculated and we got the rebate. For rebate on bill discounted, what is the journal entry? Currently this is already included in discount income. So what do you have to do? You have to pass one journal entry. That is what? Discount on bill account debit to rebate on, you can write it as discount on bill, it's fine. Discount on bills account debit to rebate on bill discounted 1569.3. Okay, that's all. How much is the discount income and all they have not given. They only ask the journal entry only for this rebate amount. So that is your journal entry, or this is another type of problem which could get tested in the examination. Okay. All right. Next is bills sent for collection. Banks, so they need not just buy the bill, or they may not purchase the bill, or they may not just discount the bill. They can also act as a collecting agent. Like in my example here, no? Okay. A Limited has bill receivable. A need not discount or give up this bill to ICICI Bank. Okay. What A Limited can do, or maybe I'll just redo that example here. A Limited, B Limited. A Limited has bill receivable For B Limited, it is bills payable. The term of the bill is 3 months. Okay. What A Limited can do is, if he wants, he can he can get it discounted with a particular bank, or he can keep this bill with himself. He has an option. That is his choice. Another activity which bank can do is, let's say HDFC Bank. A Limited, after 3 months, okay, it went to a HDFC Bank and told, I have a bill. It has reached the due date now. You take this bill and approach B Limited and collect the money on my behalf. So meaning HDFC can act as a collecting agent on behalf of A Limited. Because see, if A directly presents the bill to B Limited, A presents this bill receivable to B Limited. B Limited may not pay, quite possible. So if an external agency, HDFC Bank, goes and asks B Limited, and if B Limited rejects the payment, it becomes a proof of rejection. So A Limited can easily file a case against a bank, against B Limited, and recover the money sooner because they have a clear acknowledgement. Yes, because bank is an external party in this case. So what A Limited can do is they can give this bill to HDFC Bank, not discounting. On the due date, they can give this bill to HDFC Bank, or a few days before the bill, they can give this bill to HDFC Bank, and HDFC Bank will approach B Limited and collect the money. Okay, from B Limited. Let's say the bill value is 1 lakh. So in this case, what will happen? B Limited will pay HDFC Bank 1 lakh rupees. Does this 1 lakh belong to HDFC Bank? No. They are just acting as collecting agents. So this 1 lakh rupees, again, HDFC Bank will give it to A Limited Bank. They will not pay entire money, because even if HDFC Bank is doing this activity, means they have to earn some commission. Let's say HDFC Bank pays only 99,500, meaning 500 rupees is their discount or commission for doing this activity. Okay, that is the thing. This process we call it as bills sent for collection. Banks not only can discount the bill or purchase the bill, they can also do this collecting activity or collecting the money as an agent. If they are doing that activity, then 2 accounts they need to maintain: bills for collection asset account, bills for collection liability account. These 2 are mirror accounts, mirror image, opposite of each other. Okay. All right. Why 2 accounts? See here, think from HDFC Bank. Okay. One, they have a right to collect the money from B Limited. Because they are holding this bill, they have a right to collect the money from B Limited. So that means HDFC has the right to collect the money, means it becomes asset. And at the same time, once the money is collected, they have to give the money back to A Limited. That means they have an obligation to pay as well. That means they have a liability also. That is the reason this bills for collection we maintain both as a mirror image, both asset as well as liability. Asset opening balance will come on the debit side to balance brought down. If this is 1 lakh, means even liability opening balance also will be 1 lakh, because mirror image, same component. This 1 lakh is opening balance. Current year also, bank may do some activities relating to collection. So if the current year, if they have accepted some more bills for collection, that will come here. Let's say they have accepted a bill for 2 lakh rupees. Same thing comes in the liability also, because bank has an right to collect 2 lakh. At the same time, they have an obligation to pay 2 lakh as well. So something which you write on the debit side, you'll write it on the credit side for liability. Okay. If bill is collected, then asset balance also will reduce, liability balance also will reduce. If the customer dishonors the bill, in this case, if B Limited rejects the payment, then what will HDFC do? HDFC will come back to A Limited and say, I didn't get any money. That means what? The liability also will get squashed, asset also will get squashed. Whether the customer pays or it gets dishonored, bank has no obligation over here. Yes, if they collect the money, they will pay. If they don't collect the money, they will convey the same information and get on with it. Then you will get the closing balance of that asset and the liability. These are just memorandum accounts. Okay. This also you can expect. Not that often asked, but sometimes it could be asked. All right. Another one is preparation of balance sheet of banks. This could be asked. Okay. This is very, again, a format driven question, quite easy. I have given an acronym to remember that. One, you can remember it as CRDBO. C for capital, R for reserves, D for deposits, B for borrowings, O for other liabilities and provisions. CRDBO will come on the liability side. On the asset side, it is CBI AFO. CBI AFO. C for cash and balance with RBI. B for balance with other banks, and money at call and short notice. Money at call and short notice means one bank will give the loan to the other banks for a short period of time, 10 days, 14 days, etc., etc. That we refer to as money at call and short notice. Loan given by one bank to another. That is money at call and short notice. That is your B element. Then I for investment, A for advances given. Okay. Then F for your fixed assets, O for other assets. So CRDBO and CBI AFO is one way to remember it. It's a very format driven exercise. All the data they will give you in the question. You just have to take the data and dump it. One working they may ask you to do is, here is the provisions. Okay, provisions or NPA which we did, that one working can be asked over here. Contingent liability like bank guarantees given, letter of credit, all that will come outside the balance sheet. Okay, this is the balance sheet wala format. In the same line we have P&L format as well. P&L means it will have income and expenses. Major income for any bank is what? Interest income. On the loans given, they will earn interest. Okay, and other income. Other income could be commission incomes, profit on sale of asset, etc., etc. Could be your other income. So if you add the two, you're going to get the total income. Expenses. The first major expense for any bank is the interest expended or interest paid. Interest that they have to pay on the deposits taken. So interest on deposits, we call it as interest expended. Then could be your other operating expense like your salary, rent, electricity, etc., etc. All those are operating expenses. Then you could have some provisions and contingencies like provision for NPA, etc., etc. If you have, it will come in there. So this is your total. Okay. From income, if you deduct the expenses, you're going to get profit or loss for the year. Okay. Then you also have in previous year ka profit if you have, if they give the data, that you will write it previous year brought forward loss. If you add this, you're going to get the total profit. Using the total profit only, you will do your appropriations. Appropriation could be transferred to statutory reserve. Minimum you have to transfer 25% currently. There could be some transfer to other reserves. This 25%, watch out. Sometimes they will give you the data in the problem. If they don't give, take it as 25%. Minimum should be 25%. And using that only, they will pay some dividend. If at all dividend is there, that it's there. In the balance, if anything remains, any profit still remains after transferring the amount to statutory reserve after paying dividend, and the balance will be transferred off to balance sheet. And this is the total. This is the P&L format of a particular bank. This is also often asked in examination. This they will club it with NPA, and that's how they are testing these sort of questions. Yes, all the questions and concepts relating to the banks also we have completed. Thank you. Hello guys. The next topic that we'll be starting is NBFC, that is non-banking financial companies. Okay. First of all, NBFC means one, it should be a company registered under Companies Act 2013 or Old Companies Act of 1956. Okay, this is one. NBFC means it should have two features. One, it should be a company, and two, its main business should be to give out loans and advances and acquisition of shares, debentures, etc., etc. So one, it should be a company. Second one, its main business should be in the lending business, to give away loans and advances and to make some and to purchase shares or debentures of an other company. So that's the components of NBFC. If NBFC has to commence its operation, means it has to get certificate of registration from RBI. To commence NBFC to start its operation, they have to get certificate from RBI, and RBI will give that certificate of registration only if the net owned fund, or NOF as we used to call in class, that should be greater than, it should be 200 lakhs or more, meaning it should be 2 crores or more. Only those NBFC which has a net owned funds of 2 crores or more, they will be given the license to operate this NBFC business. Okay. Alright. So this calculation of net owned fund is a popular question that can come from your NBFC topic. So how to calculate that? Let's see. Net owned fund, for a class purpose we can call it as NOF. So before you calculate net owned fund, first we need to calculate owned fund or OF. How do you get owned fund? It is similar to the capital adequacy ratio which you have calculated for bank. Okay. So owned fund is given by paid up equity share capital plus compulsorily convertible preference share capital. If you have preference shares, that's going to get converted into equity shares. So that is compulsorily convertible preference share capital. If you have, you add it. All the reserves in surplus like free reserves, share premium, capital reserve, you add, excluding revaluation reserve. So if revaluation reserve component is included in capital reserve, that you need to exclude that. Okay. Then if you have any accumulated losses or intangible assets, deduct it. If you have any deferred revenue expenditure, deduct it. If you do this, what are you going to get is OF, as in owned fund. Alright. From owned fund, we'll be able to calculate the net owned fund. So net owned fund, if you want to present it as an equation, net owned fund is nothing but owned fund plus investment in group company shares or debentures or other NBFCs minus the 10% of owned fund. This, if you do, what you're going to get is what we refer to as net owned fund. This is a popular question. We have done enough number of questions in our regular batch. Now also let's do a thing. Let's apply this in one of the questions and see how it works. Alright. Alright, this is our from our class notes. It's there in the study material. Or no, this question came in December 2021 paper for about 5 marker. GEM Limited is an NBFC providing hire purchase solutions. The following information is extracted from the books for the year ended 31st March 2021. They've given you various information. All the numbers are in lakhs, they are saying. So what you need to do is you need to calculate owned fund as an OF, also net owned fund. So how do you calculate owned fund? Paid up equity share capital plus compulsorily convertible preference share capital plus free reserve plus security premium plus capital reserve but excluding revaluation reserve minus any intangible asset minus accumulated losses minus deferred revenue expenditure if any. Okay, that's the first thing. Okay, so first we will do OF calculation. Will you take paid up equity capital? Yes. Compulsory convertible preference share capital? Yes, you will add. Free reserve? Yes. Security premium? Yes. Capital reserve is 319. In that they are saying 220 lakhs is arising out of sale of building. So out of this 319, only 220 is from sale of asset. So we will add only 220. Other is probably due to revaluation component, revaluation reserve component, that is excluded. Only those which come as part of the sale of assets, that component is considered as a capital reserve for owned fund calculation. So you will add capital reserve but only to the extent of 220. That's what they have done. Check here. First they've added a paid up equity share capital, then they've added compulsorily convertible preference share capital, free reserves they've added, security premium they've added, capital reserve they've only considered 220. This is your addition. Then check, do you have any intangible asset? No. Accumulated losses? No. Deferred revenue expenditure? Yes, we have. Reduce that. Minus 54 you do. This if you do, you're going to get owned fund. That is the first kind of calculation. Owned fund is 4020. Alright. That's the first component. Second is net owned fund. How do you get net owned fund or NOFS? If you want to present it as an equation, that is nothing but owned fund plus, okay, then you can say plus investment in group companies, meaning if NBFC has other group companies which it owns, which it controls, that investment in group companies slash other NBFCs. If they have invested in other NBFCs, okay, take that. From this, reduce 10% of owned fund. This is what you need to do. Owned fund you already know. How much is owned fund? Owned fund is 4020 plus investment in group companies and other NBFC. Has this NBFC made any investment? Yes, they've invested in debentures of subsidiary company of 171. They've invested in other NBFC of 945. So total investment will be how much? If you add these two, 171 plus 945 will give you 1116. What they say is, see, normally owned fund means the company the money which the company has, NBFC has raised for their operation. So that means you should, if you have raised the money for your operation, you should invest in your own operation. Yes. But using these funds, if you invest in some other company, right? If you buy some other, if you invest in your subsidiary company or if you invest in other NBFC, that is considered as a dilution of capital. Okay. They say up to 10% of owned funds if you invest, that is acceptable level. Beyond that, we will not consider it as owned, or beyond that, we will exclude it, is what they are trying to say. That is what this equation represents. Total investment they have made is 1116. 10% of owned funds, up to 10% of investment is allowed for this calculation. How much is owned fund? 4020. Calculate 10% of that, it will be how much? This is 116 minus 10% of 4020 is 402. That means investment in other group NBFCs and other group companies up to 402 is allowed. Beyond that, it is considered as a dilution of capital. Okay. So do this 4020 plus 1116 minus 402. If you do minus 402, if you do, my calculator is showing 714. So if you do that, it will be 47, or rather this is owned fund minus. I have written equation slightly different. 1 minute. Yeah, this one. Sorry. This is not plus, this should have been minus. Okay. Up to that much percent is dilution is allowed. Beyond that, it is not allowed. So beyond that, you need to reduce the funds from your own fund. So 4020 minus 714 you need to do. That will give you a number of 3306. This is your net owned fund. That's what they have calculated over here. This is a popular question. It's a format driven. You need to remember this and put it up in the examination. Okay. If you want, you can present it like the way they have done in statement, or you can also present this as an equation. Net owned fund is nothing but owned fund minus total investment that the NBFC has made in other NBFC and in their own group companies minus 10% of owned fund. Okay. Up to 10% of investment is allowed. Beyond that, it is considered as dilution of capital. Hence, we reduce it from the owned fund to get the net owned fund. That's how the calculation will look like. Okay. That's the first level of problem, or first type of problem that could come from this particular topic. Another one is income recognition. On non-performing, if you remember on banks, we had non-performing assets. Even NBFC ka one of the main operation is giving out loans and advances, right? So when they give loans and advances, chances that that loan may become NPA. So if it is an NPA, the interest income on that non-performing asset, NBFC will recognize only on the receipt basis, same like banks. On the performing asset, you can recognize it on accrual basis. On non-performing asset, on the receipt basis only. And since NBFC ka main investment or another main objective is to make the investment. When they make investment, either they will receive some interest income. So interest income you will recognize it on accrual basis. If NBFC has purchased debentures of another company, then they will get interest on this investment. That you can recognize it on accrual basis. If they have purchased equity shares of another company, that means they will get dividend income of this. That you will recognize when the dividend income is declared by the investing company. Suppose, obviously, you will get the dividend. Suppose NBFC company, one NBFC, and they have purchased the shares of Infosys. Okay, equity shares of Infosys. All right. So that means obviously Infosys may declare dividend on a regular basis. Okay, if this company declares dividend, NBFC will receive a portion of the dividend. Yes or no? So when should you recognize this dividend income? This dividend income NBFC can recognize only when the dividend is declared by Infosys. Only when that company, other company, that is Infosys in this case, declares the dividend, NBFC has a right to receive this dividend. So on that day, you can go ahead and recognize that particular income. Okay. Then is non-performing assets. If you remember, for banks, what was the non-performing assets ka limits? If the overdue amount went for more than 3 months. Yes, if the EMI was outstanding for more than 3 months, you would have classified as non-performing asset in case of bank. In case of NBFC, there are 3 limits, or rather 2 limits. One is 3 months, another one is 6 months. For this NPA purpose, there are 2 types of, or NBFC can be broadly classified into 2 types. One is systematically important non-deposit taking company and deposit taking company. Another one is non-systematically non-deposit taking company. So what does this systematically important mean? Systematically important non-deposit taking company means those NBFC which are too big. Like the biggest banks in India is what? HDFC Bank, ICICI Bank, all SBI, all these are big banks, right? If they collapse or if they liquidate, then the whole economy of India will collapse. Yes or no? So like that, if you have too big an NBFC, that we refer to as systematically important NBFCs. For that, for you to call an NBFC a systemically important NBFC, their assets, that NBFC ka asset should be greater than 500 crores. Those NBFCs whose asset base is 500 crores or more, that we refer to as systemically important. Okay, for systemically important, if those NBFCs, if they have given loan, and on that loan, if the installment is outstanding for period of more than 3 months, then it becomes NBFC. For other NBFC, the overdue period is 6 months. For systematically important, it is 3 months. For other NBFCs, it is 6 months. Okay. Alright. You can think for practical purpose, systemically important NBFCs and banks are on the same lines. Alright. Alright. Non-systematically important means smaller NBFCs. Alright. Similarly, if the NBFCs has given some higher purchase loan, then for higher purchase, there is a different limit specified. Those limits are 3 months and 12 months. Meaning, if let's say systemically important NBFC is given some higher purchase loan on loan for the leasing arrangement, then if that loan is outstanding for a period of more than 3 months, then it becomes a non-performing asset. However, if it is non-systemically important non-deposit taking company, then in their books, if they have given loan for this higher purchase transaction, it will get classified as an NPA only if the overdue amount is greater than 12 months. Okay. For systemically important, it is 3 months. For others, non-systemically important, it is 12 months. Hence, there are 2 limits over here, 3 and 6, 3 and 12. For higher purchase and leasing, one is the limits is 3 and 12. For other loans, it is 3 and 6. Like that. Again, this is something which you need to remember for your classification purpose. Now, why do we need for classification of NPA? Because NPAs have, if there is NPA means you need to make provision. Provision we not only make for NPAs, we also make for standard advances also, right? For standard advance, if it is systemically important non-deposit taking company NBFC or deposit taking NBFC, then the rate is, for bank what was the rate? For standard advance, if it was agricultural advance, it was 0.25. For real estate, it was 1. All others, it was 0.4, right? I told systemically important and banks are on same par. So you can remember like this. For standard advance, here the rate is 0.4%, same like banks. For non-systematically important, you should take the lower rate. Which is the lower rate for banking? 0.25. That is the rate of provision for this particular NBFC. Okay, this is on standard advance. If it is NPA, we know that under NPA we have three categories: substandard, doubtful, and loss asset. If it is substandard, the provisioning is 10%. For here onwards, the rate is same. Okay, only for standard advance, the rate between systemically important and non-systemically important, the rates are different. Afterwards, once it becomes NPA, the provisioning requirements for both the types of NBFC is same. Okay, for substandard it is 10 and 10. For doubtful, if it is doubtful and if it is unsecured category, you will make 100% provision. If it is doubtful and if it comes under secured category, then doubtful up to 1 year is 20%. More than 1 but up to 3 years is 30%. More than 3 years it is 50%. Same rate goes here also. For loss assets, it is 100%. These are the provisions. Again, you need to remember. They will not give you all this provisioning rate. You need to remember this. Hence, these are some topics which are totally format driven. You just have to remember the percentages and you are good to go. You'll get full marks. The chances of going wrong is very, very limited. Okay. Alright. In case the NBFC is given some higher purchase loans or leased asset wala loans, then you need to make some additional provision. Other than the normal, you need to make some additional provision also, which I've called out over here. If the higher charges or lease rental, if it is overdue up to 12 months, then the additional provision required is 0%. Then you have 12 to 24, 24 to 36, 36 to 48, more than 48 months. The rate is 0%, then it is 10%, and then go on adding 30%. Then it will be what? 10, 40, 70% and 100%, like that. Okay, what is all this? This 10%, 1%, you will multiply it on the net book value, which they would have given it to you in the question itself. Okay, they will give you this overdue amount and they will give you the net book value in the question. You will be asked to calculate the additional provisioning requirement in case of higher purchase and lease assets wala loan. Okay, these are additional. Okay, up to 12 months no, to up 0%, 12 to 24, 24 to 36, 36 to 48, more than 48 months. 1 year gap you go on building. The rate is first category to 0%, then 10, and then go on adding 30%. So 10 will become 40, 40 will become 70, 70 will become 100, like that. Okay, so that you multiply, you're going to get the additional provisioning requirement. Again, this is a popular question from this particular topic. Alright, moving on. Now we'll move on to the accounting standards. Okay, accounting standards. Accounting standards are nothing but certain extra guidance for accounting. That's all. It's just an accounting guidance, extra guidance given. Alright. So we already have golden rules of accounting. No, is it not sufficient? No. These days things have become so complex. Okay, and things are so dynamic, ever evolving and ever changing, that all your old rules, right, are not sufficient. There are many areas for which the guidance was needed because we didn't have a proper clarity. Hence, a concept of AS was introduced, accounting standard was introduced. For those areas where there is a lack of clarity, our Chartered Accountants of India, our mother body has taken the lead in forming this AS. Okay, they will roll out the clarifications relating to those areas. Okay, one by one we will look into it. First AS is accounting standard, is accounting standard 4, which talks about contingencies and events occurring after the balance sheet date. AS4 only talks about those events which is coming after the balance sheet date. Something which is coming within the current year, meaning within the balance sheet date, that is not the scope of this standard. The scope of this standard is a transaction has happened after the year has ended, meaning after the balance sheet date. For that, what you have to do? So for those events, should you account it in the current year, or should we disclose it in the current year, or what we should do, or should it be done only in the next year? That is the scope of this particular standard. Okay. As far as this particular standard is concerned, only 3 things you need to know, guys. 1, you need to know whether it is an event. First, you need to know whether it is an event. Alright, if at all you conclude that it is an event, next you need to know whether that event is an adjusting event or a non-adjusting event. If it is an adjusting event, you do one sort of treatment. If it is non-adjusting event, there is another set of treatment. That's all. That's all is the scope of this particular topic. Only 3 things: event, adjusting event, non-adjusting event. What is event now? Event means both. Events are those which are both favorable and non-favorable events that occur between a certain window. That window is that occur between the balance sheet date and the date on which financial statements are approved by the board of directors in case of company and other competent authorities in case of other companies. Okay, event means both favorable and unfavorable. It's a favorable and unfavorable transaction occurring between a certain window. Let's say current year is 1st April 2022 to 31st March 2023. Alright. So for you to call, after this balance sheet you will prepare on 31st March 2023. After this balance sheet date, there is a certain event, there is a particular transaction that has happened. For that transaction to come under the scope of AS4, no, that event should be within a particular window. That window is the balance sheet date. What is the balance sheet date? 31st March 2023. Company means once the year is over, the auditor will come and audit the books of accounts. Then the board of directors will have a meeting and they will approve the accounts, saying everything is fine now, we can close this year. So they will approve this accounts. So financial statements, let's say, has got approved. Financial statement has got approved by the board of directors, let's say on 1st July 2023. Okay. Only those events which occur between this window, between 31st March and 1st July, that will be called as an event for AS4 purpose. Something which fits within this period only is an event. So let's say one event has occurred on, let's say, 1st August 2023. That means will you apply AS4? No, you will not apply AS4 because it's not fitting within this window. It's going beyond. Alright, that's the first step, event. Okay, and this event could be both favorable as well as unfavorable. Got it? Now, if it is an event, yes, since if it is an event, now the next question is, you will categorize that event to be adjusting event or non-adjusting event. So what is adjusting event? Adjusting event means, or maybe let me give you a small example here and take it. Okay, let's say there is an earthquake. There was an earthquake, and due to this earthquake, one of your plant and machinery has got destroyed. Due to this earthquake, the plant and machinery which you had in your factory, or your factory has got destroyed. Let's say this event has happened on 1st June 2023. Okay, this is a particular transaction which has happened. My year has ended on 31st March. My financial statement approval date is 1st July. This earthquake has destroyed my plant and machinery on 1st June. First of all, is it an event? Yes. Is it happening within that particular window? Yes. That means it will be considered as an event. Only if it is an event. Now you will classify that event to be adjusting or non-adjusting event. Sir, adjusting event means on balance sheet date or before. On balance sheet date or before, you knew that an event is going to happen in future. On balance sheet date itself, you had an idea. There were condition. Condition was existing on balance sheet date. Further evidence, you got it later. On balance sheet date only, you knew that an event is going to happen in future. If that is the case, means we call it to be adjusting event. Okay. Non-adjusting event means like our classes, full bouncer. You had no idea. Meaning on 31st March 2023, we had no idea about this particular event. A particular thing is going to happen in future. Full surprise. If it is full surprise, it is non-adjusting event. Okay. Now this earthquake, just check. On 31st March 2023 itself, the company knew that due to earthquake, our plant and machinery is going to get destroyed. No. That means what sort of event is this earthquake? It is a non-adjusting event. Okay. So give us an example of adjusting event. Okay. Let's say we had sold goods to our debtor. During the current year, we have sold goods to our debtor. Okay. The debtor is not paying us the money. The money is already due. The debtor is not paying us the money. Let's say if the debtor doesn't pay the money, with follow-up, we first make provision for doubtful debts. Let's say on 1st March 2023, that means within our current year only, I have made provision. Company has already made the provision for doubtful debts to the extent of 10%. They have already made the provision because the debtor is not paying. That's the reason auditor may be suggested 10% provision. So the company has made the provision already. Within the current year only, they made the provision. Let's say on 1st May 2023, that debtor, he filed for bankruptcy. Meaning he became bankrupt. So he told, I don't have money. So on 1st May, he filed for bankruptcy. 1st May 2023. Check, is 1st May 2023 is within the current year? No. That means that bankruptcy event is happening within the current year or it is happening after balance sheet date? It is happening after balance sheet date. That only becomes an event for AS4 purpose. But for it to be an event, it must fit within this window. Is it happening within the window? Yes, financial statements are approved on 1st July. But this particular event has happened on 1st May. So is it an event? Yes, it is an event because it is happening within that window. Now check, is this an adjusting event or non-adjusting event? It's an adjusting event. Why? On balance sheet date itself, you already have made the provision. That means condition was existing because debtor, you were following up with the debtor. He was not paying you the money. That is the reason you made a provision. You already made a provision means condition was existing on balance sheet date. Further evidence. What is further evidence? He becoming bankrupt. That you got it after balance sheet date. So condition was existing on balance sheet date. That means this is an adjusting event. So what to do if it is adjusting event? If it is an adjusting event, even though this bankruptcy or this event has occurred next year, you will adjust it or you will account it in the current year itself. Even though the event has occurred in next year, you will account it in the current year itself. That is the adjusting event, meaning you have to adjust your financial statement. So what if it is non-adjusting event? If it is non-adjusting event, you need not pass any journal entry. Just give a disclosure. If it's a major event, give a disclosure. What is the nature of the event? How it affects your financial statement. Like that, you give a disclosure in the current year. Accounting treatment, the journal, blah, 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 and all, you can do it in the next year only. That in the case of non-adjusting event. That is all is the scope of this particular standard, AS4. Event means it should occur between the balance sheet date and the date on which financial statements are approved by what? The board of directors in case of company and other competent authority in case of other company. In case of partnership firm, the competent authorities are partners. In case of sole proprietor, the competent authority is the sole proprietor. Like that. Something which occurs within that window is an event. And that event you have to find out whether it is an adjusting event or non-adjusting event. Adjusting event means on the balance sheet date itself, the conditions were existing. So condition was existing on the balance sheet date. Further evidence you got it later on. So if it is adjusting event, though the event has happened next year, you have to account it in the current year itself. Next one, if it is non-adjusting event means complete bouncer, meaning we had no idea, full surprise. Condition was not existing on the balance sheet date. For such a non-adjusting events, you need not adjust your balance sheet. You just need to give a disclosure. What is the event, how it affects a financial statement. Like that, if you give a disclosure in the current year, that is sufficient. That's all about AS4. Okay, moving on. Next is Accounting Standard 5, which talks about net profit or loss for the period, prior period item, and changes in accounting policies. This is again a theoretical standard which only targets 5 things: extraordinary item, exceptional item, prior period item, changes in accounting policy, changes in accounting estimate. Only these are the 5 areas that it talks about. That's all. Alright. So we will just go through them quickly one by one. First there is something known as ordinary activities. Ordinary activities means, or when can you say an income or expense relates to ordinary activity? What is ordinary activity? Like if you have to take us as an example. Now ArivuPro Academy. Alright. So we are providing coaching. So that means what? When we provide coaching, we will collect fees from the student. So that is our income. That is our main income. And to conduct this coaching, we have to pay salary to our teachers. Okay. Teachers' fees we have to pay. Okay. Teacher's salary or teacher's fees or remuneration. That is our expense. Yes or no? Correct. So for a coaching academy, these two are expense are what? Necessary. Yes or no? So those expense and those income which are necessary for you to conduct the operation, that we call it as ordinary activities. The income and expenses which are necessary for you to run your business, that we refer to as ordinary activities. Okay. Alright. Okay. There is something known as extraordinary activities. Extraordinary activities means those income and expenses which are clearly different from ordinary activities. Extraordinary activities means those income and expenses which are clearly different from ordinary activities. Example could be, one of the example could be loss due to flood or earthquake. See, we are doing coaching business. Suppose due to fire, flood or earthquake or short circuit, if our asset gets destroyed, is it part of our operation or completely different from our operation? Completely different. Yes or no? So loss of assets due to earthquake, flood or any other natural calamity is an example of extraordinary event. Property being attached, meaning let's say the one company did not pay tax to the government. Okay. If they don't pay tax, what will the tax authorities do? They will come and take away company's property in order to recover the tax. Yes, and we call it as property attached. So all these are, is it related to our business activity or ordinary activity? No. So hence these are extraordinary activities because they are completely different from the ordinary activities. And if it is extraordinary activity, you have to show that expense, whether it is an extraordinary income or extraordinary expense, does not matter. They have to be shown separately in P&L. This standard only talks about that. Okay, whether should we give a separate disclosure in P&L or not? That's all is the scope of this particular topic. Normally we prepare P&L as per the Schedule 3 of Companies Act 2013. There is a format. Yes. Should we do it in that format or should we give a separate disclosure of it for a particular event is what is this particular standard. And if you check Schedule 3 ka format, there is a separate category for extraordinary items also. Okay, there you need to show these components if it is extraordinary. Okay. Then exceptional item. Exceptional item means they are those income and expenses which are from ordinary activities only. Exceptional item means they are income and expenses from ordinary activities only, but their nature and size is such that if you disclose them separately, then the readers of financial statement, whoever is using that financial statement, will understand your financial statement better. That is what we mean by exceptional item. Exceptional item means those income and expenses which are from ordinary activities only, but their nature and amount is such that if you show them separately, user will understand the financial statement much better. The examples of exceptional items could be write down of inventory. Normally, inventory is valued at cost or net realizable value, whichever is lower. Okay. Normally, majority of the cases, inventory will be valued at cost. Very rarely, inventory will get valued at net realizable value. So, if inventory has been written down to net realizable value, that could be taken as an exceptional item. Okay. So, write down of inventory to net realizable value is one of the examples of exceptional item, meaning you need to show it separately in P&L. Then, if you have any long-term assets, if you are, let's say you are having a machinery since about 4 or 5 years, you want to use a machinery, but suddenly you sold off. You bought a machinery with an intention to use it for next 5 to 10 years, but you suddenly sold it off. So, sale of those long-term investments or property, plant and equipment constitutes one of the examples of exceptional item. Litigation settlements. Suppose we have a case going on with our creditor. Okay, we are fighting the case with our creditor in the court of there's a court battle going on. Okay, so these are part of your operations. Yes, because if you're doing business means and if you're dealing with many people, so these sort of court kacheri activities and all is quite common for a business. But if you show them separately, if you have done any settlement, if you have paid anybody as a settlement due to court order, then showing it separately, showing that expense separately in P&L will make the users understand your financial statement better. That is also an example of exceptional item. Basically, if you have exceptional item like extraordinary item, you need to disclose it separately in P&L. Again, if you check P&L ka format of schedule 3, there is a separate category for extraordinary item and there is a separate category for exceptional item also. Both of them, there is a separate category. Alright. Next is prior period item. Prior period item means those income and expenses which relates to the previous year. Prior period item means those income and expenses. They don't relate to current year. They relate to the previous year or previous year. But they are coming in current year. They relate to previous periods, but they appear in current year because you have done some error or omission in preparing financial statements to the previous year. You committed some error while preparing previous year or previous year's financial statement. Hence, that one particular expense or one particular income is coming in. That to be referred to as prior period item. They relate to previous period, but it is coming in the current year because of some mistake that you have done. Let's say we are in 2020-2023 year. This is our current year. Let's say when you prepared financial statement of 2020-21, one of the expense you forgot to account. One expense you missed out. Alright, or let's make it as maybe 21, the previous year only we take it. Okay. Previous year, that is 2020-21 to 2022. The previous year when you prepared financial statement, one expense you forgot to record. You got omitted by mistake. That you detected in the current year. If you detect a mistake, means will you keep it or will you ignore that mistake or will you correct it? You'll obviously correct it. So now you can't go ahead and change previous year financial statement because it's already audited, signed and all. Nothing can be done with that. So that expense, now what you will do? You will account it in the current year. Meaning that expense is coming in the current year. But does it relate to the current year? No, it relates to the previous year. That only we call it as prior period item. Okay. And if it is again prior period item, you need to disclose it separately in P&L. You can't club it with other income. You need to show it separately. That's all is the scope of this particular component. Okay. They will give you various case studies from this problem. All you need to identify it is what sort of an activity is it. Is it a extraordinary activity, exceptional item, prior period item, changes in accounting estimate, changes in accounting policy. One, you need to identify what is it and accordingly tell whether should we disclose them separately in P&L or can we prepare our P&L in the usual format that we were doing. Okay, that's all is the scope of this particular standard or this particular AS5. Okay. Next one is changes in accounting policies. So what do we mean by accounting policies? So accounting policies mean certain rules, regulations, principles used in preparing financial statement. Some rules and principles used in preparing financial statement that we refer to as accounting policies. To give you an example, we know no, to value the inventory closing stock, yes, we can either use FIFO method or we can use weighted average cost method. Either you can go for first in first out method, that is FIFO, or you can value it under weighted average method. Can you do both? Can you choose both? First week I will do it under FIFO method. Next week I will do it under weighted average method. Like this I will keep on hopping. Is that allowed? No. Among these two methods you have to select one. You have to select one. Yes, no? That selected one only we refer it as accounting policies. Among the various methods of accounting you have to select one, right? That selected one we refer it as accounting policies. Now you tell me, accounting policies and all, can you change it quite regularly? Weekly basis, hourly basis, monthly basis, can you change? No. These are rules, right? Rules have to be consistently followed. Yes. So accounting policies, as much as possible, you should follow it consistently. Meaning year on year, you should follow the same methodologies or same accounting policies. Does that mean accounting policies can never be changed? Nothing like that. If you want to change accounting policies, then there are three parameters, three conditions they have given. Any one of it is getting satisfied means you can change your accounting policies. One, you can change accounting policies if it is required by law of the country. Let's say you are following FIFO method now. Alright, Government of India told FIFO method is banned. FIFO method is banned. You cannot follow it. They said. That means compulsorily you need to go for what method now? Weighted average method. Meaning you have to change from FIFO to weighted average. Yes. So that is your change in accounting policies due to the requirement of statute or law. Next one, required by accounting standard. Let's say accounting standard 2. Accounting standard 2 normally deals with, or normally accounting standard 2 deals with inventory valuation. So accounting standard 2 told FIFO method is banned. Inventory should not be valued under FIFO method. You are following FIFO method. What you have to do now? You have to move over to the other method known as weighted average cost. Yes. So that is the second requirement. Required by accounting standard. Third is better presentation. If board of directors or if the company feels, let's say company is following FIFO method, if the board of directors or if the company feel by shifting over from FIFO to weighted average, financial statements will be presented in a much better way. If the board of directors of the company, if they feel by changing the methodology, the financial statements would reflect a better picture, meaning a better presentation, then you can change. So under these three circumstances, accounting policies can be changed. Okay, fair enough. Last one is what we popularly see in practical case study, but you'll also have to convince the auditors how is it better presentation. You need to give a reasonable justification for it. Okay. Alright, if you want to change the accounting policy, sir, then you have to do it retrospectively. Any changes in accounting policy is to be done retrospectively. What does that mean? Let's say for year 1 and year 2, the company was following FIFO method. In year 3, they want to go for weighted average cost method. For the first 2 years, company was following FIFO method. For the third year, company wants to change over to weighted average cost method because they feel that leads to better presentation. Then if it leads to better presentation, you can change, but this particular change has to be done retrospectively. Retrospectively means from the beginning. So what you have to do is from the beginning you need to rework your inventory under weighted average cost method. From the beginning you need to work out, meaning for year 1 and year 2 you followed a weighted average FIFO method, right? You work out your inventory under weighted average cost method for the first 2 years also and see if there is any difference. Let's say under FIFO method the inventory was 1 lakh. Weighted average cost method you got 1,20,000. That means you got extra 20,000. Here let's say we got extra 30,000. For third year anyway inventory valuation is let's say 1 lakh. Okay. That means totally how much is it? 1,50,000. Your inventory value is increasing. That change, okay, that's what we mean by changes retrospectively. Meaning from the beginning you need to work out, and if there is any differential amount, that differential amount you have to record it in the current year. Here the differential amount is 1.5 lakh, which you have to record in the current year, which is year 3. Retrospectively does not mean go to first year financial statement, erase the value and substitute with new value. No. Once the financial statement is audited and signed, it is done. You cannot change those financial statements. Retrospective application means from the beginning you rework, you recalculate And if you are getting any extra or if you're getting any less, okay, if you're getting anything extra if you're getting or anything less if you're getting, that adjustment you do it in the current year. You rework from the beginning, but its effect you give it in the current year. That is what we mean by retrospective application. Okay. All right. Then if you are adopting a new accounting policies, okay, then it is not considered as a change in accounting policy. Like, let's say earlier the company had no policies to give any gratuity. The company had no policy to give any gratuity. It was done on an informal basis. Whichever employee management led, to them they gave gratuity. Okay, there was no formal structure. Now they brought in the formal gratuity structure. Now you must have studied in Income Tax Act. There is a formal way to calculate gratuity plans. That structure company has adopted in this year. Okay, is that a change in accounting policy? No, sir. So adopting a new accounting policy is not considered as a change in accounting policy. So change means something should be there. That you should revise. That is referred to as change in accounting policy. Hence, if you are adopting a new accounting policy, then it is not considered as a change in accounting policies. Okay. So what sort of disclosure should we give for accounting policy? That is same as accounting estimate change, which we will discuss in a bit here. Okay. I've drawn a chart for this, so I'll just show you. This is about accounting policy. Next, we have something known as changes in accounting estimates. So what is an accounting estimate? So accounting estimates means judgments used in finding out certain components ka value. Judgment used to find out value of some components of financial statements. So what do you mean? So to calculate a depreciation, okay, you require what? You require original cost. How do you calculate depreciation under straight line method? Original cost minus salvage value divided by useful life. Yes or no? Okay. Salvage value means what? Let's say the useful life of the asset is 10 years. Salvage value is 10,000 rupees. Okay. Original cost is, let's say, 1 lakh rupees. Now, original cost means the price you have paid to buy this asset. This, there is no problem. How about these two numbers? Is it a short number or is it just an estimated number? Company feels they will use this asset for 10 years. Is it pakka or is it 100% sure that they will use this asset for 10 years? No. After 8th year, they may stop using this asset. Yes, they may feel the asset is no more usable. Yes, meaning that number could be greater than 10 or it could be lesser than 10. At this point of time, we feel the company will use it for 10 years. Yes. So yes, to find out depreciation and all, you need to find out the useful life and salvage value. Yes. To find out these, we need to use our judgment. That we call it as accounting estimates. Because certain components of financial statements like depreciation and all, no, you cannot find out with, you cannot estimate with 100% certainty. You need to have certain judgments. Because to find out depreciation, you require salvage value, useful life and all. To find out useful life and salvage value and all, you need to use your better judgment and get it. That we call it, or that judgment used is what we refer to as accounting estimates. Okay. Alright. So accounting estimate is necessary because many items in financial statements, value you cannot find out with precision. I already gave you the example. One is the useful life of property, plant and equipment, that is fixed asset or intangible asset, salvage value, etc. etc. For that you need accounting estimates. Okay. And accounting estimates, sir, is based on circumstance. Yes or no? Accounting estimates. See here, if you are saying useful life is 10 years means based on certain criteria, you would have determined this 10 years. Yes or no? So it's based on certain criteria or certain circumstance. Okay. It's based on circumstance existing when the financial statements are prepared. Sir, will the circumstance be constant or stagnant, or that could change? It could change, right? So if those circumstances changes, or if you get any new information or new development, then the previous estimates used or earlier accounting estimates can also be changed. These are judgment based on a particular scenario. If scenario changes, your estimates can also be revised. So accounting policies and accounting estimates are a little different that way. Accounting policies you should follow as consistently as possible because they are the rules. Accounting estimate is based on circumstance. Circumstance will obviously change. Like before COVID, no. In fact, our own example, right? You know, we used to use our for some subjects and all. No, we used to do it under. We used to use marker, the marker, whiteboard, and all. We used to use. After COVID happened, we have digitalized everything. Now we use iPad, camera, and all. So that means our whiteboard has become redundant. When we bought it, we thought we will use it for at least 3 to 4 years more. But once COVID happened and every class shifted to online mode of things, my estimate of three years has become outdated now. Yes, that means we have stopped using those whiteboards and all. So hence accounting estimates are based on circumstance. If those circumstances change, you can revise your earlier estimates also. Okay, or if you are getting any new developments or new information, then also accounting estimates can be reversed. So will you do it retrospectively like accounting policy? No, that will be penalizing, yes or no? Because these are based on circumstance. Circumstance is based on the economy. Things are dynamic in the economy, right? Hence they have given that change in accounting estimate is applied prospectively, meaning from that day onwards. Prospectively means from that day onwards. Previous figures or previous year ka figures you need not change. That's what we mean by prospective application, meaning from that day onwards only. Meaning today, let's say for year 1 and year 2, let's say company was following straight line method of depreciation. Okay, change in the method of depreciation is a change in accounting estimate. Okay, let's say from year 3 onwards, company wants to shift over to WDV method. For the first 2 years, they were following straight line method. Third year onwards, the company wants to move over to WDV method. Any change for depreciation and all, no, to estimate we need require components, right? So they're based on circumstance. So change in depreciation method is an example of change in accounting estimates. So if you change your depreciation method in year 3, only from year 3 onwards, you need to work out depreciation under WDV method. For the first 2 years, you need not do anything. Okay, let it go still under straight line method itself. You need not do any change. That's what we mean by prospective application. Okay. Now disclosure. Disclosure for accounting policies and accounting estimates are same. That's what I wrote it previously also over here. Okay. So what do you need to disclose? First check, sir, due to the changes in accounting estimate, like here you have changed from straight line method to WDV, no? That is a change in accounting estimate. Due to that change, see if there is any material effect in the current year or future year. Due to that change, check if your financial statements are getting affected, either for the current year or for future year. If the answer to that is yes means, then you need to disclose the fact. Fact means you have changed accounting estimate, no? That fact you need to disclose and how much effect this particular change has caused on your financial statement, that you need to give out the effect. Like here you could say, due to this change, no, depreciation in the current year has increased by 10,000. Due to change from straight line to WDV method, our depreciation has increased by 10,000. Depreciation is an expense, yes. Due to this expense, your profit would have reduced by 10,000. Like that, its effect on financial statement you will call out. Okay. If you feel due to this accounting estimate change, there is no impact, there is no material effect in the current year or future year. Meaning material impact means the important change. Okay, material you have already studied in auditing. That if you want to say something as material means that which affects the decision making or which affects the decision of the users of financial statement. Okay, meaning you can consider it as an important change or a big change. All right. So if the change in accounting estimate has no material impact either in the current year or in future year, then no disclosure is necessary. You need not do anything. You can just ignore and move on. Okay. Or you feel no, the change in accounting estimate has an effect on financial statement, but not in the current year financial statement, but in the future year financial statement. And how much it affects, you are not able to find out or you cannot quantify. You have done some changes in accounting estimate. You feel due to this change, your future year financial statements will get affected. How much it will get affected, you are not able to quantify. If that is the case, means just disclose the fact that you have changed the accounting estimate. That fact you disclose, that should be good enough. Okay. So these are some of the things relating to the accounting estimates. AS5. One is what? Simple one, you need to find out whether it is an extraordinary activities. Extraordinary activity means something which is clearly different from ordinary activities. You need to give a separate disclosure for it. Then exceptional item. Exceptional item means they are income and expense which relates to ordinary activities only, but their nature and their size is such that if you disclose them separately, users will understand financial statement better. So for exceptional item, you need to give a separate disclosure. Then prior period item. Prior period item means they are items relating to the previous years or previous year or years, but they are coming in the current year because you did some error or you did some omission while preparing financial statement of the previous period. So if it is a prior period item, again you need to disclose separately. Accounting policy. Accounting policy means it's a rule. Okay, rule has to be consistently followed. You can change the rule only if the law of the country says or accounting standard says or for better presentation. But if you change accounting policy, you have to do it. There is a retrospective application. Next we saw accounting estimates. Accounting estimates means they are the judgment used while preparing financial statement. And any changes in accounting estimate, since accounting estimate is based on a certain circumstance, So accounting estimate change is done prospectively. Okay, so that was your quick recap on AS5. Alright, moving on to the next standard, which is Accounting Standard 7, Construction Contracts. Now, why is this standard necessary? Or this particular standard AS7 is applicable for all constructed assets by contractors, architects, engineers, civil engineers, all these guys. What do? Like if you want to build a house, okay, you will take the help of what? Architect or civil engineers or contractors. So they will help you build that house. Okay, they will build that house, but not for their use. They will build it. If I need a house means I'll approach architect. Architect will build the house, not for his business, but for my usage. Yes or no? So for those guys, for those architects, civil engineers and all, this particular accounting standard, that is AS7, is applicable. So why is this standard necessary? Majority of the construction contracts, like if you are constructing, let's say, an apartment, let's say one builder is there, he's constructing an apartment, not for his use. He'll construct this apartment, then let's say there is an engineer who's constructing an apartment. Okay, then he'll construct it not for his business use, but for somebody else's purpose. Yes, no? Alright. Let's say this particular society or apartment has a lot of apartments. Let's say it's 100 apartment wala society. Okay, it's 100 apartment wala complex that he's building. Do you think this will be completed within 1 year only? No. Let's say it takes about 18 months, or let's say it takes about 2 years for the architect to build this apartment or to build this society. To build this whole complex, it takes about 2 years. Now the question is, let's say he's constructing, let's say I want to construct this apartment, so I have appointed an architect, okay, and he is doing this construction on my behalf. So obviously he'll not do it at free of cost. He will charge some money. Let's say he told, to construct this I will charge 3 crore rupees from you. He told, give me 3 crore rupees, I will construct this 100 apartment wala complex for you. I don't know worries. Okay. Now think from his perspective. Okay, this 3 crores is a revenue for him. Yes or no? Is the income for him? When should he record this 3 crore rupees? Should he record it in year 1 or should he record it in year 2? Okay, see, because this particular apartment is getting completed within 2 years. It's not getting completed within 1 year. It's getting completed over 3 years. This 3 crore rupees, should he account it in the first year itself? Entire 3 crore should he account it in the first year itself? Or should he wait for this apartment to get completed and book the entire 3 crore in year 2? Or should he book it equally in both the years or in different proportion? What he should do? So that there was some guidance required, because everyone were used to do their own thing. Yes. So to give guidance in these areas, a standard was formed, that is Accounting Standard 7, Construction Contracts. Alright. Okay. First we'll run through the little basics. There are two types of construction contracts. One could be fixed price contract. Fixed price contract means the one I told over here. Architect told me what? He told me give 3 crore rupees, I will construct this apartment. So that is what? The 3 crore price is fixed. Those kind of contracts we call it as fixed price contracts, meaning the contract value is fixed. Next is cost plus contract. How does cost plus contract work? Here the architect may say, how much ever cost I incur now, to that he will add his profit margin and he will bill me. Let's say cost is 2 crore rupees. Cost to construct a particular asset is 2 crore rupees. Then we may have an agreement saying, the architect or someone may say, on the cost I will add 20%. 20% is my margin, he may tell me. To the cost he will add 20% margin. So that will become what? The 2.4 crores. Yes. So that could be with a contract value. Okay, like this you could also have an arrangement. This arrangement we call it as cost plus contract. Cost plus contract. Meaning to the cost he will add profit margin and he will bill it. That's another type. Okay. Third one is segmenting. Segmenting. To segment something means to show different. Okay. So what do we want? What are we talking about segmenting here? Contracts are accounted separately. To give you an example, let's say government has called for a tender of 2 flyovers. Government wants to construct a flyover. 2 flyovers they want to construct. Flyover 1 and flyover 2. Okay, they bid. They asked for the tender. So I also applied for it. My firm, let's say I am an engineer, a civil engineer. I also applied. I bid for this particular flyover. Both the contract I only won. Because normally whoever bids the lowest gets that contract. That's how at least books may it happens. Yes, no? Practically what happens, let's not worry about that now. Okay, let's say both the contracts I only won. Okay, these are construction contracts for me. Yes, because flyover I am not constructing for my use. I am constructing on behalf of government. Yes or no? Alright. Now, should I treat both of this contract as one contract? This both the contracts, flyover 1 ka contract, flyover 2 ka contract, both of them, should I treat it as one contract or should I treat it separately? Okay, that is the question. Should we merge, if you have a couple of contracts, should we merge them and treat it as one contract or should we account those contracts separately is the question. Okay, now you can, if you want to treat the contracts as separate contracts, if you want to treat the contracts as separate contracts, there are certain conditions. One is you should have negotiated a separate proposal, you should have submitted for both the contracts. Okay, like here I should have sent a separate proposal for flyover 1, separate tender for flyover 1, separate tender for flyover 2. Separate proposal I should have sent for both the contracts, not one proposal, different proposal. One is that. And the second condition is I should have subjected that to separate negotiation. I should have negotiated flyover 1 ka amount separately, flyover 2 ka amount separately. It should not be like I'll tell the government, if you award me, let's say flyover 1 ka contract is for 10 crore. I should not be telling the government, if you give me flyover 1 contract, no, on flyover 2, I will give you 25% discount. Okay, what have you told the government is, if you are telling the government, if you award, hey government, if you give me flyover 1 ka contract, then on flyover 2, I will give you 25% discount. This should not be the case because here you have negotiated as a package. If you want to treat it as a separate contract, means both of them you should have negotiated independently or separately. That's the second criteria. 1 separate negotiation and 2 separate proposal. And 3, cost and revenue of each contract you should be able to allocate or recognize it separately. Meaning if you want to account these separately means, then you should be able to clearly tell how much is the cost and how much is the revenue associated with flyover 1. Similarly, how much is the cost and how much is the revenue associated with flyover 2, you should be able to clearly track them. You should be able to maintain the records. If all these conditions are satisfied, okay, you can go ahead and separate the contract. Okay, else the contracts will be combined. Okay, segmenting means to show it separately. It should be a separate proposal, separate negotiation, and cost and revenue you should be able to identify for you to separate it. Otherwise, it will get combined. Alright. Now coming back to the accounting part of things. So how should we account this construction contracts? There are 2 methods permissible for accounting of construction contracts. One is percentage of completion method. Another one is completed contract method. Percentage of completion method and completed contract method. So what does this percentage of completion contract method means? Let's say you started the work this year. I'm an engineer or I'm an architect. I started doing some construction in this year. Let's say this year 40% of my construction is complete. 40% of my work is complete. Then 40% of the revenue you can recognize. If that is the case, means we call it as percentage of completion method. Meaning how much ever percentage the work is over, that much percentage of revenue you can recognize. That's how percentage of completion method works. Okay, I'll tell you how to find out that percentage now. You got the broad idea, right? Okay, so revenue recognition will be done based on the percentage of work completed. So when can you adopt percentage completion method? If you want to adopt percentage of completion method, no, one outcome of the contract you should be able to measure it reliably. The outcome of the contract you should be able to measure it reliably. And when can you say outcome can be measured reliably? One, how much revenue you are getting from this contract, you should be able to tell clearly. How much money you will get, the architect will get by doing this contract, you should be able to tell that clearly. You should be able to measure that clearly. Cost related to this contract, you should be able to measure it reliably. And then percentage of completion, you should be able to measure it clearly. Because you want to do percentage of completion method means how much percentage work you have completed. That you should be able to measure it reliably. And benefits should flow to the entity. Meaning architect should have a reasonable certainty that the other customer will pay me. If architect is obviously doing the work on behalf of customer, right? So there should be a reasonable assurance that customer will pay the architect. Architect should have that reasonable assurance. If all of this is satisfied, we say outcome can be measured reliably. And if outcome is measured reliably, you can go for percentage of completion method. Generally, most of the construction contracts, we do go for percentage completion method because outcome will be able to measure it reliably. If outcome cannot be measured reliably, then you will go for completed contract method. All this is fine, sir. Tell me, how do you find out percentage of completion? So to find out percentage of completion, there are various methods, okay? But the one which we will use for our examination is cost input. Cost metrics we will use. To find out percentage of completion, we simply take cost incurred till date divided by total estimated cost into 100. for our examination purpose. To find out this percentage of completion, there are various methods, sir. But for our examination purpose, we'll use cost method. So how do we get percentage of completion? It's simply cost incurred till date divided by total estimated cost into 100. Let's say architect feels to construct this contract, it takes totally about 1 lakh rupees. The total cost the architect is estimating to be 10 lakh rupees. Okay. Let's say cost he has already spent is 2 lakh rupees. Totally he feels to construct this contract it will take 10 lakh. In this 2 lakh he has already spent. This much cost he has already spent. Can you tell me how much percentage work is completed? Cost incurred till date, which is 2 lakh, divided by total estimated cost, which is 10 lakh into 100. This will be what? 20%. This is how you find out percentage of completion. And why do we need to find out percentage of completion? Because the revenue recognition is based on percentage of completion. If 20% work is completed, now in this example 20% work is completed, no? Okay, let's say the revenue of this contract is, let's say, 20 lakh rupees. By doing this job, architect will get 20 lakh rupees. Since 20% work is complete, he can recognize the revenue. In the current year, he can recognize the revenue to the extent of 20%. 20% of the contract value. Total contract revenue or total contract value or total contract price is 20 lakh. Of that, if you multiply 20%, you will get 4 lakh. This much of revenue contractor or this much of revenue can be recognized in the current year. Okay, this is how it works. And what about cost? Cost also you can recognize based on percentage of completion, or you can also write cost incurred till date. How much ever he has spent in the current year, that much will be recognized as cost. So revenue minus cost will give you profit or loss for the contractor for that particular year. Let's say revenue is in the previous sake, how much was the revenue? Revenue is 4 lakh. How much is cost spent? 2 lakh. So revenue recognized is 4 lakh, cost recognized is 2 lakh. That means revenue minus cost will give you profit in the current year for the on this contract, which is 2 lakh rupees. That's how accounting will run. Okay. Every year you will just check how much percentage is complete. Based on that, you go on recognizing the revenue. Alright. So what about the completed contract method? So don't be misled by the term completed contract method. Name itself is saying completed contract method. That means what? So once the work is over or work is 100% over, then only we'll recognize the revenue. No. In completed contract method, what we do is revenue is recognized to the extent of cost incurred. How much ever cost you have incurred, to that extent we will recognize the revenue. Meaning no profit will be recognized. Profit will be recognized only when the contract is fully over. Okay, you will recognize the revenue to the extent of cost incurred. Meaning if the outcome is not measured reliably, then you will go for completed contract method. Okay, if this was completed contract method, what you would have done, how much cost you have already spent? 2 lakh. So the revenue and cost you will recognize to the extent of 2 lakh. Revenue also will be booked to the extent of 2 lakh. Cost also will be recognized to the extent of 2 lakh. That means what is your profit? The profit is 0. No profit or loss should be recognized unless the contract is completed. That's what we mean by completed contract method over here. Okay, this is the fundamental. Easy, sir? Alright. So what if there is a loss? So if there is a loss, expected loss on the contract should be recognized immediately. It does not matter whether you have started the work or you have just signed the work or no work is started, whatever. If the day you find out that if there is any loss associated with this contract, then the day you come to know, that day itself you need to book the loss. Conservatism or prudence wala concept. So how, sir? Check here. Let's say we enter into a contract. We have not yet started the contract. We just signed a contract. So the contract price, let's say, is 10 lakh rupees. We have entered into a contract. So once I finish this contract, totally I will be able to get 10 lakh rupees. Okay. Let's say I feel to do this contract, totally I will incur a cost of 11 lakh rupees. What is my total contract price? How much is my total revenue or total income? 10 lakh rupees. But I feel to do this contract, I require a cost of 11 lakh rupees. That means this is a profit making contract or loss making? This is a loss making. I have not yet started the work. That means this is expected loss. How much is this? 1 lakh rupees. That you have to recognize it immediately. Doesn't matter whether you have signed it, you have signed it just now, the work is only 5% complete, all that is irrelevant. The moment you come to know that the contract has some loss associated with it, that loss should be recognized immediately as per conservatism contract. So why will the company take up this? Maybe company wants to do for the marketing purpose, especially if you are a new guy, for marketing purpose, initially you may have to take certain loss making contracts to build your reputation. So because of that, they may enter into such loss making contracts also, quite possible. Alright. But that is irrelevant for us. As far as our examination goes, if there is any loss on contract, it should be recognized immediately. Okay, that's about this particular component. Then there will be another things known as, see, we know this construction contract is necessary because the period will be more than 1 year. Okay. See, if architect is constructing some asset on my behalf, means architect has a right to collect money from me. That means I am his debtor, correct or no? So debtors means it should come in balance sheet. That only we are calling it over here. Amount due from customer. Amount due from customer means it's a debtor. Amount due to customer means is a creditor. So this particular component, so till now the revenue and all, revenue cost and all we worked out. That is the P&L impact. In balance sheet, you will have to show since the contractor has a right to receive the money from his customer. That means he'll have to show that customer as a debtor. Yes. So possible that sometimes it could be a creditor also. Why? Sometimes what happens when you immediately ask, let's say you want to construct a house, you told the architect, help me build a house. He told, give me an advance of 10 lakh rupees. Only then I will start. He has not yet even started a single work. Okay, he told, give me advance, then I will start. So in that case, I become his creditor. Yes or no? Because he's already received the money, but the work is not yet started. So that is what we are about to find out here. Amount due from the customer, meaning the debtor element, or amount due to the creditor. If customer has paid more means it will become amount due to the customer. How do you get that? That is nothing but cost incurred till date plus recognized profit minus recognized loss minus progress billing. Cost incurred till date plus recognized profit minus recognized loss minus progress billings. Let me give you a small example. I think same example I had given in the class. Okay, let's say I am a pen dealer. Okay, I buy and sell this pen. Let's say I have purchased this pen for 100 rupees. Okay. Let's say my selling price is 150 rupees. I have purchased this pen for 100 rupees. I sell it for 150 rupees. That means what is my profit, sir? My expected profit is 50 rupees. Correct? No? Alright. Let's say I have already sold it to one of the customer. Customer has already given me an advance of, let's say, 120 rupees. Okay. I've already got an advance. I want to sell this pen to another customer, and that customer has already given an advance of 120 rupees. That means how much more money I need to collect from him. Totally I need to collect 150 by selling this pen. In that 120 he has already paid. That means how much more I need to collect? 30. Yes or no? This only we call it as amount due from / to the customer. Okay. Now you express this in equation. Let's see. What is this? From 100, how did you get 30? If you want to express in an equation, you took cost, you added recognized profit, you got selling price. Yes or no? From that, what did you do? Advance money you reduced. Yes or no? If you want, maybe I'll take up case 2 also. This is, let's say, case 1. Let's say this is case 2. Separate case. Cost is still 100. Conditions are bad. So I feel my selling price is now only 80 rupees. I purchased it for 100 rupees. After that, Corona came, COVID came. There is no demand for my product. If I have to sell this product means I have to sell it only for 80 rupees. That means what, sir? I have to sell this product at a loss of 20 rupees. Yes or no? Alright? Let's say same scenario. Customer has already given me an advance of 70 rupees in this. How much more I need to collect? My selling price is 80. In that, I have already received an advance of 70. So how much more I need to collect, sir? How much more I need to collect? 10 rupees more. Yes or no? So like this. If you want to present this as an equation, and let me not write it as like this, I will write it like the second case loss. Loss is 20. Advance also I'll write it in 1. Just pure numbers, ignoring the signs. Okay. How do you get this Can you express this in equations? Sir? How do you get directly from 100 to 30 or 100 to 10? How do you get that? You take the cost, alright, you add a profit. If it is loss, you will reduce loss. Yes or no? 100 minus 20 you did and you got 80. Yes. From that you reduce the advances. Yes. This only here we call the cost as cost incurred till date. Instead of cost, it becomes cost incurred till date. Instead of adding profit here we call it as a recognized profit. Loss means you will reduce, right? That is nothing but recognized loss. This advance that you receive from customer in construction contract terminology, we call that as progress billing. Progress billing means how much bill have you sent it to the customer. How much have you already sent the bill to the customer? That we refer to as progress billing. So progress billing also, if you want, you can represent an equation. That is nothing but progress payment received minus progress payment yet to be received. Progress billing means how much have I billed it to the customer. Let's say I have sent a bill to the customer for 100 rupees. Okay. In that 100 rupees, 80 rupees is already paid. That means 20 rupees is yet to pay. So if I add these two, I'm going to get my total bill amount, which is what we refer to as progress billing. Progress billing means total bill value sent. Okay, that could be progress payment received plus progress payment to be received. Okay, that is also another way to express this. Okay. Similarly, cost incurred till date, in some problems they refer it to as work certified. Cost incurred till date, there is another way to get that. That is nothing but work certified plus work uncertified. We have seen this also in a couple of problems in our regular class. We have seen this. So work certified plus work uncertified, if you do, what are you going to get is nothing but the cost incurred till date. Sometimes they will not give you cost incurred till date. They will call it as work certified and work uncertified. If you add these two, you're going to get cost incurred till date. So these are some of the concepts relating to our construction contracts. Let's maybe do one question also to understand this a little better. Shankar Limited undertook a contract to build a crane for 10 lakh rupees. So 10 lakh rupees is the total contract value. So Shankar is a contractor. So he has taken a contract to build a particular crane, bulldozer, for 10 lakh rupees. As on 31st March, it has already incurred a cost of 1.5 lakh rupees. So this is cost incurred till date. It expects 9 lakh more will be required to complete the crane. So 1.5 lakh rupees already they have incurred. So that means 1.5 lakh rupees is what, sir? Cost incurred till date. What is this 10 lakh? It is a contract price. Okay. 1.5 lakh is already incurred. What is the further cost that they're planning that they will incur? 9 lakh rupees. So what is the total estimated cost then? Total estimated cost is 9 lakh, 1.5 lakh already spent plus 9 lakh expected to get incurred in future. So total estimated cost is 10 lakh 50,000. Yes or no? 1.5 already spent, 9 lakh more we will be spending. So that means the total estimated cost is 10.5 lakh rupees. Okay. Alright. So with this data we can find, or maybe I'll read off this data once. It has received so far 1.2 lakh rupees as progress payment. So this is nothing but your progress billing. We have billed to the customer 1,20,000 and we have also received the money. Discuss the treatment under AS7. Discuss the treatment means how much will you show it in P&L, what you will show in balance sheet is what they are asking. First, we know, alright, in these sort of things, always assume that the outcome of the contract is measured reliably. Okay, so that means we will go for percentage completion method. To go for percentage of completion method, first we require what? Percentage of completion. How do you get that? Cost incurred till date, which is 1,50,000, divided by total estimated cost, which is 10,50,000. So 1,50,000 divided by 10,50,000 into 100 if you do, the percentage of completion is 14.2857, which they have taken it as 14.29%. If 14.29% of the work is done means that much revenue you can recognize. Yes or no? What is the total contract price? 10 lakh. In 10 lakh, 14.29% of revenue you can recognize. So 10 lakh minus multiplied by 14.29% if you do, you're going to get 1,42,900. That is the revenue you can account it in this year. How much cost will you account it this year? How much cost did you incur? 1,50,000. So cost you will recognize to the extent of 1,50,000. So revenue as an income is 142,900, cost is 159,900. That means it's a profit or loss. So the loss on contract is 7,100. Yes, the difference between these two, which is 7,100 is the loss. Okay. But I told you, always whenever you're doing in construction contract, first always compare, do one quick checkpoint between contract price and total estimated cost. First thing, always check this. The total estimated cost is 10,50,000. The total revenue is only 10 lakh. That means what, sir? Is this a contract a profit making contract or a loss making contract? Estimated cost is 10.5 lakh, revenue is only 10 lakh. That means there is an expected loss on this contract. How much is the total loss you are expecting? 50,000? That is what you have written here. What did I say? The moment you know that there is a loss, you should recognize that. Yes, here there is a total loss of 50,000. How much loss you have already recognized? 7,100. So how much more provision for loss you need to make? 40,900. How did you get 40,900? The difference between these. 7,100 loss you have already recognized. So you need to recognize a loss of 40,900 more so that the total loss will become 50,000. So this is the impact on your P&L. What do you have to do in balance sheet? You have to know whether the customer, you have to still receive money from the customer or has he paid excess. Okay, that is given by what? Cost incurred till date. What is cost incurred till date? 1,50,000 plus recognized profit. Is this a profit making contract? No. Recognized profit is 0. Minus recognized loss. Minus recognized loss. How much is the recognized loss? Don't say 7,100. Total expected loss you need to recognize it immediately, which is what? 50,000. 7,100 loss you have already recognized. You made additional provisional loss of 40 to 900. That means the total loss you are recognizing is 50,000. So you have to take the total expected loss here. Cost incurred till date plus recognized profit minus recognized loss minus progress billing. What is progress billing? 1.2 lakh rupees. If you do this, that's what they've written in equation. Okay, they're saying you're getting a negative number. So you're getting a negative number, 20,000 means customer has paid excess. So this is not due from the customer. This is actually amount due to the customer, meaning this will be shown on the liability side of balance sheet. If this was a positive number, means we had to collect more money from the customer, so it would have been shown on the asset side. Since it is negative, you will show it on the liability side because it is amount due to the customer. So amount due means we will refund to the customer. No, these are all contracts now. Okay, till now you may have received more, but contract is still not over. Only 14% of the work is over. No? Still a lot more work is go. So how much our excess he has paid, we will adjust it for our next installment, like that. There will not be refund issue. This is just for the presentation aspect. So this is about your construction contract AS7. Okay. The next standard is accounting standard 9, which talks about revenue recognition. Okay. So this scope of this particular standard is, it only covers 4 things. How much revenue you should recognize when you sell the goods. If you are dealing with goods, meaning if you are buying and selling goods, meaning when you sell the goods, you'll get some revenue, right? So when you sell the goods, when you should recognize, how much you should recognize. That is the first target area. If you are in service industry, meaning if you are rendering any service, like chartered accountants, okay, they don't sell any product, right? We give what? As chartered accountants, we give auditing service, income tax service, consultancy service, like we are giving you now coaching service. So if you are in service industry, how much and when you should recognize the revenue, that is the second scope. And if you are receiving any dividend income, and then if you are receiving any interest income, and if you are receiving any royalty income, okay, how and when you should recognize the revenue is the scope of this particular standard. Only these 5 it covers. So when we say revenue recognition, it talks about revenue recognition for the goods sold, service rendered, interest, dividend and royalty, wala income. That's all. Okay. One by one we have to target each concepts. That's all. Alright, first is revenue recognition on the sale of goods. Revenue recognition on the sale of goods. So if you sell the goods, okay, when should you recognize the revenue? So when you sell the goods, you can recognize the revenue only when the performance obligation is satisfied. Okay. Normally in your 11th standard and all you used to say, right? Okay. You used to check the invoice date. The day, the date of sales invoice, on that day only you used to pass off the journal entry. Cash account debit to sales, debtors account debit to sales. Okay. That is your bachpan. Bachpan mein all those were okay. Okay. On the date of invoice, you used to pass off sales ka journal entry. Yes. No, but here actually the criteria to recognize the revenue on the goods sold is the day on which performance obligation is satisfied. It is not the invoice date, it is not the delivery date, nothing. Okay, it is not the receipt date. It is the date on which performance obligation is satisfied. That is the date on which you will recognize the revenue. Okay, so when can we say performance obligation is satisfied? You can say performance obligation is satisfied. 1, when the goods is transferred to a buyer for a particular price. When the seller has sold the goods to a buyer for a particular value, let's say for 1 lakh rupees, 10 lakh rupees or whatever. That should be the first criteria. There are various criteria for this. 1, you can say performance obligation is satisfied when the goods is transferred to the buyer for at a particular price. Second one, risk and reward is transferred to the buyer. Okay, see, if, suppose I sell, I'm a, let's say, car dealer, okay, or let's say I'm a mobile dealer. Okay, I buy and I sell mobile. Let's say you have purchased a mobile phone from me. Yes, that means who should have the risk and reward relating to that mobile phone? You have purchased means, meaning I have sold means you have purchased. That means who should have the risk and reward? You. Yes or no? You have purchased the mobile means you should have all the risk and the rewards attached to it. Reward could be, now these days if you have mobile phone, everything you can do. Yes, no? You can attend our classes, okay? you can buy shares, you can make investment, you can do career, you can do every sort of work these days in that small dabba called mobile phone. Yes or no? So everything you can do. That is the benefit. Dunya mutti mein they say. Yes. But what is the risk attached to it? These days, due to mobile, no, people are ready to leave everything. Okay, even if they want to go even 5 minutes out of their place, they cannot leave mobile phone because all of them are addicted. It keeps buzzing on WhatsApp, Instagram, and all. Keeps so much buzzing that we cannot stay away from it. We are so much addicted to it. Yes. So those are the risk attached to that product. So if I have sold the goods means you as a buyer should have the risk and reward associated with that. That is the second criteria. To say performance obligation is satisfied, risk and reward should be with the buyer. Third one, seller has no control over the goods transfer. Okay, now I've sold a mobile phone to you. I call up every day and say, don't use the mobile phone for more than 5 hours. Okay, don't take your mobile phones to college. Don't take your mobile phones to CA office. Like this and all, if I keep calling you, don't do this, don't do that and all. What do you think? Do you think I have the right to do that? No. If I've sold the goods, means I should have completely relinquished my right. Yes, no? Meaning I should have no control over that goods transfer. However you want to use it, how much ever you want to use it, wherever you want to use it, you have a right to do so. Yes, no? As a seller, I should not interfere in it. So if seller has no effective control over the goods, that is one criteria to prove whether the performance obligation is satisfied. And fourth, sale consideration is already fixed, that I brought it here only. And then there should be no uncertainty in collection of sale consideration. Meaning I've sold goods to somebody, let's say on a credit basis. I've given a credit period of 90 days. I've sold goods to one of my customer for 90 days credit. So I should have a reasonable certainty that I will receive that money from him. So there should be no uncertainty in collecting the sale consideration. Okay, I should feel that yes, he will pay. The day that, if that reasonable certainty is there, means you could say performance obligation is satisfied. Okay, when all these criteria are satisfied, then performance obligation gets satisfied. On that day, you can go ahead and recognize the revenue related to the goods sold. So the key criteria is what? For you to recognize the revenue on the goods sold, performance obligation should be satisfied. And when will the performance obligation be satisfied? One, the goods must be transferred to the buyer for a particular price. And two, risk and reward associated with that goods should be with the buyer. And seller should have no control over that goods. He should have relinquished all his rights, meaning he should have no control. Fourth, there should not be any uncertainty which the seller should have in collecting that amount. On that day, performance obligation will be satisfied, and then you can go ahead and recognize the revenue on the goods sold. This is for the goods. Next aspect is, if you are a service guy, if you are renting service, you can recognize the revenue on this service. Same thing here. First criteria is for goods is what? Goods transferred for a particular price. There, in case of service, there will not be any goods. No? Here you will say service should be performed. For you to recognize the revenue relating to service, like here I am giving you teaching service. No? For one, I should have performed. Two. The second one is service consideration is fixed. By giving this service, how much money I will receive, that I should know. Okay, by giving this particular service, how much money I will receive, that you should know. And third, there should not be any uncertainty in collecting the amount. Okay, I am giving the coaching now, yes, on behalf of ArivuPro Academy. So I should have a reasonable certainty that I will receive this money from ArivuPro Academy. Okay, that reasonable certainty should be there. If uncertainty is there, I cannot recognize the revenue. One, I should have rendered my service. Second one, okay, how much consideration I will receive for rendering the service, I should know it. And third one, there should not be any uncertainty in collecting this amount. So that is the criteria for revenue recognition for the service. All right, sir. For service, no, there are a couple of methods. We already saw in construction contracts there were two methods: percentage of completion method and completed method. Same thing here also. In case of service, if you are giving any service, no, there are two ways you can. There are two acceptable methods to recognize the revenue related to service. One is proportionate completion method, or you can also call it as percentage completion method. Another one is completed contract method or completed service method. So when to go for which method, we don't know how to choose. So if a particular contract has many acts, has more than one acts or many acts, you will go for percentage completion method. Like now, excuse me, let's say I provide the coaching for advanced accounting. Yes, let's say advanced accounting has 20 topics. Advanced accounting has 20 topics. Okay, so obviously when I give this coaching of 20 topics, I will receive money from the academy. Correct? I need not wait for all the topics to get over for me to recognize my income. See, by giving this coaching, I will receive money. That means for me, it's revenue. I need not wait for completion of all the 20 topics for me to recognize revenue. Let's say if 2 topics are over, okay, then revenue related to 2 topics I can recognize today itself. Let's say if today 2 topics is over, then today itself I can recognize the revenue related to 2 topics. That is what we mean by percentage completion method. When will you go for it? If contract has more than one act. Here what each topic is an act. There are 20 different acts. Yes or no? As and when each act or each component is getting over, you can go ahead and recognize the revenue. So if the contract has more than one act, you can go for percentage completion method. If the contract has only a single act, now let's say I'm doing marathon session. So no, marathon is a revision session. That is one activity, no? So if by doing this revision, if I'm receiving any money from ArivuPro Academy, that constitutes only single act. There is no topics over here. Okay, if I'm doing any marathon, or if I'm conducting any seminar on accounting standard, if I'm doing any seminar on IFRS, all this is a single act. So once that act is over completely, once that day is completely over, or that act is over completely, then only I can recognize the revenue. That is your completed contract method. So if you have many acts, you will go for percentage method. If you have only one single act, you will go for completed contract method. That's how to find out which to go for. So this is goods we have covered, service we have covered. Next is what? Interest, dividend and royalty. Sir, interest income is always recognized on time basis. If you invest in some other company ka debenture as an investment, let's say A Limited has purchased the debentures of X Limited. They have purchased the debentures of X Limited as investment. On these debenture, X Limited has to pay interest. X Limited has to pay interest to A Limited. Okay. Interest has to be paid on what? On a timely basis. So interest income you will always recognize on a time period basis. Meaning if April month is over, you can go ahead and recognize the revenue for April month ka interest. Like this, if May month is passed, you can recognize interest income for May. So you can recognize it on a timely basis. It's not necessary you have to do it on monthly basis. If you want, you can also do it on a quarterly basis or half yearly or yearly basis also. Based on the time period, you will go ahead and recognize the revenue. That's for the interest. Okay. Next is the dividend. Dividend income you will recognize. We already discussed a little bit on this in NBFC. Dividend income you will recognize when the right to receive the dividend gets established. That's the terminology AS9 use. Dividend income you will recognize when the right to receive the dividend gets established. Let's say A Limited has purchased equity shares of Reliance. They purchased equity shares of Reliance. Okay, that means Reliance, no? Let's say Reliance on 1st August 2023, they have declared the dividend. They have declared equity dividend to their shareholders. Reliance has declared dividend. Okay. So A Limited, for A Limited, they will receive this dividend income because they are also shareholders. So A Limited will receive this dividend income when the right to receive the dividend is established. And when will A Limited have a right to receive the dividend? When the other company, that is Reliance, declares the dividend. The day Reliance declares the dividend, A Limited has a right to receive it. So A Limited can recognize this dividend income on 1st August here. Because on 1st August, that right to receive the dividend is getting established. Okay. But practically, no, the company may own, we may purchase 101 investment. Okay. We can't keep tracking each investment. So practically, when you receive the dividend only, companies will pass the journal entry for dividend income. But theoretically, the day you have a right to receive the dividend, you can go ahead and pass the journal entry. I was saying practically. Practically, when the company A, when A Limited receives the dividend, that day they will go ahead and pass. Okay, because we cannot keep tracking when will Reliance hold their AGM, when will they declare dividend. Like this, people don't track much, right? So yes, if you are able to track, record it on that day. Otherwise, book it on a receipt basis. This is about interest and dividend. Royalty means what? Royalty means, let's say, I have written a book. Okay, I have written a book. Some publisher, he told he liked my book. I wrote one book, and one of the publishing house, they liked my book and told, we will publish your book. Okay, book is mine. So contents are mine. I wrote it, but it is being printed and it is being circulated, marketed by the publisher. Do you think I will give that book that free of cost? No, I will tell the publisher, on every book sold, I have told him, you need to pay me 10 rupees. On each book sold, I told the publisher, you give me 10 rupees. That to be called as a royalty. That's all. Okay. Royalty means they are using my intellectual property or my resources. So in return, I am commanding some payment from them. Okay. So in this case, when they sell my book, on each book sold, I will recollect 10 rupees. That particular component we call it as royalty. Royalty will be recognized on the basis of agreement. Okay. When you will recognize or not, agreement will clearly say that based on agreement, you do the revenue recognition. Okay. This is about the 5 components which AS9 predominantly targets. Then uncertainty. You know, if one of the criteria to recognize revenue is there should not be any uncertainty in collecting the amount. Okay. If at the time of sale, if there is uncertainty, let's say I have sold the goods to one of my customer, but that guy is a cranky customer. Okay. I feel he'll probably put Nama to me. Tuna only he'll put Tirupati toss. But still I took a chance and I sold him the goods on credit basis. To one of the customer, I've sold the goods on credit, 30 days credit, let's say, but I strongly feel he's going to put Tuna, Tirupati toss. Okay. So that means what? At the time of sale, do I have certainty that I will receive the money? No. That means at the time of sale, there is some uncertainty. If at the time of sale, if there is any uncertainty, you cannot recognize the revenue. You have to postpone it. Till the day you get certainty, do not recognize the revenue. Okay. Alright. See, I have sold the goods to customer. This is one case. The next case is I sold the goods to customer. On that day, I was pretty sure I will receive the money. Everything was rosy. Awesome. No problems. I sold the goods to another customer on 30 days credit. There was no issues. Okay. After 10 days, I got to know that his financial position is very bad. He's already put tuna to many customers. Okay. Now in the 10th day, what came? The uncertainty came on the or after 10th day. Meaning after I sold the goods, then uncertainty came. After selling the goods, if uncertainty comes means then you need to make provision. Normally we make no provision for doubtful debts. That is what they are referring over here. At the time of sale, if there is an uncertainty, do not recognize the revenue. Meaning do not pass that sales journal entry. Okay. Till the certainty gets cleared, do not pass the sale entry. Now at the time of sale, there was no uncertainty. After that it came means you make some provision for doubtful debts. Meaning provision you make for that. Okay. Alright, some other cases which I have given, generally you see all this in case study. I have just quickly brought that down. Excuse me. Let's say you have sold one of the major goods for which some major inspection is necessary. You have sold one big machinery. You are a machinery dealer, it's a huge machinery. You have sold it to one of the customer. But the delivery or the machinery is quite complex, that it requires a complex installation or inspection. In that case, on the day I sell the goods, I cannot recognize the revenue. Only when I deliver the goods and once the customer inspects that machinery, then only I can recognize the revenue. Okay. If the goods are quite complex, that it requires a complex installation, okay, or in any inspection, once that inspection or once that installation is completed, then only you can recognize the revenue. That is one of the small practical case study I have just quickly called out here. Then consignment sales. Let's say I have appointed some agent. I have appointed an agent to sell my product. I am not selling on my own. I have appointed some selling agents who will sell my product on my behalf. That means what? Today I gave the product to my agent. Today only can I recognize the revenue? No. I can recognize the revenue only when the goods are sold by my agent. Only when that agent only, we call it as consignee. I will be known as consignor. The owner of the goods, we call it as consignor. The agent, we call it as consignee. Only when that agent or consignee sells the goods, we can recognize the revenue. That's a condition. Goods sold on approval basis, especially if you are dealing with new products, people don't expect or accept the new product that soon. So let's say I'm a manufacturer of this pen. Okay, I already manufactured. Okay, but I was pretty sure that nobody will buy my product because it's new. So I went to some of the guys and told, some of the shopkeepers and told, you use the pen for 10 days. You take my pen, you take the delivery of this pen, use it for 10 days. If you like it, then you buy it. Otherwise, you can return the product to me. No questions asked, I will take it back. So I am giving them a right to use this product for 10 days. If they don't like it, I will take it back. That we call it as goods sold on approval basis. So when can you recognize the revenue on such transactions? One, when the time has lapsed. Here I gave a time period of 10 days. After 10 days, it automatically becomes a sale. That is first criteria. Second is on buyer's acceptance. Let's say on the 7th day only, buyer called me up and told, your product is nice, I would like to buy it. Then on the 7th day, you can go ahead and recognize the revenue because buyer has accepted it. Or buyer does any action amounting to sale. Let's say he broke this pen. Now do you think I'll accept this product back up? No. So if buyer does any action amounting to sale, then you can go ahead and recognize the revenue. This is about the goods sold on approval basis. If you are selling the goods on a cash on delivery COD basis, then you can recognize the revenue on such cash on delivery sale only when you, the company or your agent collects the cash. Only when the company or company's agent, when they collect the cash, only on that day you can go ahead and recognize the revenue. Till then you cannot recognize. If the delivery is delayed at buyer request, okay, I've sold the goods to another customer, invoice is over, okay, alright. I was about to deliver the goods to him. He told, no, you keep it. I will take it later. Right now, I don't have space in my factory. Okay. We have already entered, I've already generated my sales. I was about to dispatch the goods, but the customer told, I don't have space in my factory, you keep it. I will take it later from you. Meaning delivery is being delayed at buyer's request. Then you can go ahead and recognize the revenue on the sale date. On the invoice date itself, you can go ahead and recognize the revenue. You can ignore the delay portion because delay is not from our end. Delay is from the customer's end. Actually, for this, there are some conditions. But AS9 does not talk about that condition. In Ind AS 115, CA final, you will see certain conditions. Okay. Alright. Anyway, just for your reference, I'm saying this is all right. Okay. So you can go ahead and recognize the revenue. If case study comes, you can say revenue can be recognized. Alright. Then, if there is any insurance claims, let's say I buy the goods from a lot of outstation places. Okay. And I sell the goods to outstation customers. Meaning I'm in Bangalore, I purchase the goods, let's say from Jaipur, and I sell the goods to Bombay, Delhi, to various places my goods go. Since my goods I have to transport it to various locations, just to be on the safer side, I may say take some transit insurance policy. I may take some insurance policy just in case if the goods gets destroyed or goods get stolen while traveling. To safeguard my interest, I've taken some policy. Okay. So let's say one goods was destroyed. That means what? I will recover the money from insurance company. Okay. That insurance claim when you can recognize the revenue is what they're saying. Insurance claim you can recognize as revenue when there is certainty in collecting the claim. The day you get this reasonable assurance that you will get this money from the insurance company, that day you can go ahead and recognize the revenue. So when you get certainty in collection, that day you can recognize the revenue. Till then, no. Okay. These are some extra points related to AS9 revenue recognition. Alright. So let's do a thing. Let's take a break for about 15 minutes and then we will resume with the next topics. Thank you. Hello guys, welcome back after the break. So next topic that we'll be taking up is Accounting Standard 17, which talks about segment reporting. Okay. So again, this is a disclosure standard. We don't have to do anything relating to the journal entry or accounting aspect, just giving some disclosure. So what is this standard? Segment reporting means we are giving some additional information about the company. Some additional information about our products, about our location, etc., about our branch, etc. We are giving the information. So first of all, why do we require this? Let's say there is a particular investor. He wants to invest 10 lakh rupees. There is a guy who wants to invest 10 lakh rupees. He has a simple funda. He wants to invest in that company which are producing electric cars. That company which is producing electric cars, he wants to invest. He has narrowed down on two companies. Let's say Tata Motors and Mahindra and Mahindra. So two companies he thought both are producing electric cars, so I'll invest. So he's trying to decide whether to invest in Tata Motors or Mahindra Motors. Okay. Now, let's say Tata Motors ka 20% of Tata Motors ka revenue comes by the sale of electric vehicle and 80% of their sale comes from the other vehicle, that is petrol and diesel. Only 20% of the revenue comes by the sale of electric cars and rest is through petrol and diesel. Let's say for M&M, 60% of the revenue comes from the sale of electric vehicles, 40% comes from other vehicles. Now, if this information or if this breakup is given to this particular investor, what do you think? Which company do you think he will invest his money in? Obviously, he will select Mahindra and Mahindra. Yes or no? Because his main funda is he wants to invest the money in that particular company which are more into electric vehicles. So compared to Tata Motors, Mahindra Limited ka sales from electric vehicles is on the higher side. So that means they are producing more electric vehicles and selling. Yes or no? Alright. This is the intention of segment reporting. So because from your normal P&L balance sheet and all, you will only get what? P&L will give you only total sales. Yes. It will not give you a breakup from electric vehicle how much came, petrol vehicle how much came, diesel vehicle how much sale. This and all you will not be able to get. Yes, from India location how much is a sale made, from China how much, from Japan how much. Like this you will not get to know. So if these information are provided to the investors, investors can make their decisions or take their decisions much betterly or much more efficiently. Yes or no? With that background, AS17, that is segment reporting, was introduced. So segment reporting simply means giving some additional information about company ka products or service or location or geography or division or whatever. That's all. Alright. Okay. As far as AS17 is concerned, there are two types of segment. One is business segment, another one is geography segment. Business segment means if the risk and reward of the company is driven by the product and service that offers. If the risk and reward is driven by the products means we call that as a business segment. If the same in risk and reward is not driven by the product, but if it is driven by the economic environment, meaning the location, then it becomes a geography segment. Like let's say there is one company, they deal with 5 products. All the 5 products they are selling in same location. There is one company, they have 5 different products, they sell it in one location only. That means here the risk and reward is driven by the location or driven by the products. It's driven more from the product, yes or no? So that means we have to give the data, we have to give additional information product wise. That we get, that product wise data, we call it as business segment. So if you give product wise information, that we call it as business segment. Let's take another scenario. There is one company, they have only one product, but they sell it in 5 different locations: India, China, US, Japan, etc. etc. One product, they sell it in multiple locations. Now the risk is not driven by the product, it is driven more by the location, because selling price in India is different from selling price in Japan. Yes, no, because the cost is different, environment is different, the way they operate, the culture, everything is wholly different. Now the risk and reward is driven by the what? The location. That if the risk and reward is driven by the location, then we call it as you have to give the data, you have to give extra information location wise. Now that location wise information, we call it as geography segments. Okay. Alright. Now one of the things that is important for our examination is reportable segments. See, if you imagine or if you think of companies like Reliance, Ambani's, Adani's and all, no, they are into so many products. You name it, they are in there. From pharmaceutical industries to FMCGs to car to steel, software, anything you name, everything they are into it. Yes or no? That means they will have hundreds and thousands of divisions, hundreds and thousands of products. All the product information, all the segment information, if the A17 says give, then do you think it will make sense? An annual report will be like almost 10,000 pages only, because so much data is there. Do you think anybody will read that? No. It will become redundant. It will not help anybody. Yes or no? So that means they had to bring in a certain limits. Okay, which segment ka information or how much information we need to give. There had to be certain limitations or some criteria for it. That only we call it as, there are some tests they have introduced. If you have hundreds of segments and thousands of segments, okay, that does not mean entire data you need to give. They have brought in certain tests. All are 10% test. We call them as 10% threshold test. Okay, 3 tests they have satisfied: revenue test, result test, asset test. Okay, any segment or any division which satisfies at least one of the tests, not necessary it has to satisfy all of them. If any of the segment satisfies at least one of the tests, then it will be a reportable segment, meaning you have to give some additional information about those segments. Additional information meaning how much is the sales of that segment, how much is the cost of that segment, how much asset does that segment own. Like this additional information you need to give relating to that particular segment. Is that okay? So now we'll understand this 10% test with the help of a problem itself. That is much easier. Okay, 10% test we said, that is the revenue, result and asset test. So let's solve it with one other question. There's a study material question again. Chief Accountant of Sports Limited gives you the following information about 6 segments. So there are about 6 he has called out, and all the numbers are in lakhs. They've given you each, these are the 6 segments or 6 division, M, N, O, P, Q, R. Alright. Each segment ka they've given you asset, revenue and result they have given. Okay. They've given the data over here. Some segment, if you just check, are making loss also. Result means profit or loss. Okay. Positive number means profit, negative number means it's a loss. Okay. The chief accountant is of the opinion that only segment M and N alone should be reported. Accountant is saying only M and N I will report, other segments ka data I will not give. So is he justified in his view? Meaning is he right is what they are asking. Okay. Let's test it and see. Alright. 1. So there are 3 10% tests you need to do. First is the 10%, or we'll call it as 10% threshold test. First you can do revenue test. Revenue test. How does this revenue test work is, first find out revenue of all the segments. The revenue could be internal as well as internal. First maybe we'll do revenue. Revenue could be internal or external. Internal means what? See, if M division sells the goods to N division. See sir, all this division is belonging to one company. The main company is Sports Limited. Sports Limited is having 6 divisions. Those division ka name is MNOPQ. That means all these divisions belong to the same company, that is Sports Limited. Okay. It is also possible that M division can sell the goods to N. M can also sell the goods to O. R can sell the goods to P. That means one division, can they sell the goods to other division? Yes. If one division is selling the goods to other division, we call it as internal revenue. Okay. If one division is selling the goods to other division, we call it as internal. If the division is selling the goods to another customer, outside customer, we call it as external revenue. Okay. Right. Now what you have to do for revenue test is first take internal and external revenue, meaning the total revenue, internal and external becomes the total revenue of the segment. No, add up all the revenue of all the segments, all the internal and external revenue of all the segments you add. Here fortunately they only added. If you add all of this, you're going to get 1200. So the total revenue is 1200. That total revenue ka 10% you do. 10% of 1200 is 120. Whichever segment has a revenue of 120 lakhs or more, all these numbers are lakhs, no? So whichever segment has a revenue of 120 lakhs or more is reportable segment. Okay. Basically, simply you have to add up all the revenues of all the segments, whether it is internal revenue, external revenue, doesn't matter, add everything. Here they've not given the breakup, so you don't have to worry about it. Okay. So the total revenue of all the segments you add, you're going to get 1200 here. Of that you calculate 10%. Okay, here we are getting it as 120. Whichever segment has the number has a revenue of 120 lakhs or more is a reportable segment. Which segment has 120 or more? M has 120 or more, N has 120 or more. That means yes. So as per the revenue test, M and N are reportable segments as per the first test. Okay, this is how revenue works. Then if you want, you can do it for asset test. Asset also same thing. Take the revenue of all the segments and add it. All the segments ka asset you take and add it up. We are doing asset test now. So all the segments ka asset you add, here they have already added. When you add, they only told it is 200. Total assets of all the segments you take, that you got it as 200. 200 ka 10% you do, because these are 10% test, right? So 200 ka 10% is 20. Whichever segment has an asset of 20 or more, meaning 20 lakhs or more. Whichever segment has an asset of 20 lakhs or more is a reportable segment. Check which has 20 or more. M has it, N has it, O has it, P has it is 20 or more. So P has 20, so reportable. Q has 20 or more, so it has 20, it's reportable. R not required. 20 or more. So that means what? As per the asset test, what? M, N, O, P and Q are reportable segments. It's not necessary all the test a segment should satisfy all the test. At least one of the test, if it passes, it is a reportable segment, like that. Okay. Alright, last is your result test. Sir, for a student, what is the result? Pass or a fail. For business, what is the result? What does the result mean? Profit or loss. For result test, what you need to do is first find out all those segments which has made profit. Whichever segment has made profit, only profit, not loss. Whichever segment has made profit, total them up. Which segment made profit here? Check. Positive number means profit. So 50 plus 10 plus 10 plus 30. So 50 plus 10, 60, 60 plus 10, 70, 70 plus 10, 100. So when you add all of this, the total profit made by all the segment is 100. First you have to find out all those segments which has made the profit and add them up. Similarly, you also need to find out which all segment made a loss. Total loss reported by all the segments. Total loss making segments ka data you add. Which are the loss making segments? N made a loss of 190. Q made a loss of 100. That means totally P and Q, or rather Q and N and Q have reported a total loss of 200, 190 at 10, 200. For result test, what you have to do is first take the profit of all the segments, take the loss of all segments. For result test, what you have to do is you have to compare profit or loss in absolute number. Absolute number means you need to ignore the sign. Loss means generally you put it as negative, right? Ignoring the sign, you need to compare these numbers and take higher among the two. Which is the higher among the two? Ignore the sign, 100 and 200, leave the signs out and compare which is higher. 200. This 200 ka 10% you calculate, which will be what? 20. Ignoring the signs, compare profit and loss, okay, and take the higher number. Higher number is 200, so 200 ka 10% is 20. Now, whichever segment has either a profit of 20 lakhs or more or a loss of 20 lakhs or more is a reportable segment. I'll repeat that. Whichever segment has a profit of 20 lakhs or more or loss of 20 lakhs or more is a reportable segment as per the result test. So which segment is having a profit or loss of 20 or more? M is having, N is having 20 lakhs profit or 20 lakhs loss. Doesn't matter, any of them. 20 lakhs or more profit, 20 lakhs or more loss. So M is having, N is having, Q, O is not having, P is not having, okay. Q is not having, R is having 30. So that means what? As per this test, M and R are reportable. M and I and R are reportable segments. Now finally, do the comparison. It's not necessary all the 3 tests has to be satisfied. At least if one of the tests is satisfied, then it is good enough. MN came here, OPQ came off here, R came off here. That means what? Every segment is satisfying at least one of the tests. So what is the final conclusion? The final conclusion is all the segments, or rather here you can just check, all the segments are reportable segments because at least one of the tests they are satisfying. Okay. So the conclusion is accountant is saying I'll only report M and N. That is wrong. You have to report all the segments ka data because all of them are satisfying at least one of the 10% threshold test. That's how the 10% threshold test is being designed. Okay. Revenue result and asset wala test. Okay. And one more you need to remember is after you find out the reportable segments, let's say, I'll take you another case study. Let's say A, B, C, D are the 4 segments. There is one company X Limited. They have 4 segments A, B, C, D. You have, after doing 10% test, you have figured out that only A and B are reportable segments. Only A and B are reportable segments because only they are satisfying at least one of the test. C and D is failing all the 10% test. Hence, they are not reportable segments. After doing the 10% test, you also have to do something known as 75% threshold test. There are 2 tests. One is a 10% threshold test, another one is 75% threshold test. What is the 75% threshold test? The external, after doing 10% test, you will get reportable segments. Okay. In this case, I have taken it to be A and B. What you have to do is, you have to take external revenue of reportable segments. Let's external revenue is for A and A is 100. Let's say for this it is, let's say 200. External revenue means goods sold to the outside customer, meaning inter-division sales should be eliminated. Okay, only external revenue of reportable segments you should take and compare it with the total revenue of the whole company. Let's say total revenue of the whole company is 4, or maybe we'll make it as 500. Total revenue of this X Limited, total revenue of X Limited that is appearing in P&L is 500 rupees. What the test says, external revenue of reportable segments, which is these 2 numbers, should at least be 75% of the total revenue of the company. The external revenue of the reportable segments should at least be equal to 75% of the total revenue of the company. Total revenue of the company, I have assumed it as 500. 500 ka 75% if you calculate, it will be 375. External revenue of reportable segment should at least be 375. Here, how much is it? 300. Okay. Okay. If this number is lesser than 375, then the management has to identify one or more segments and report it. Okay. But you have to make sure that what? The reportable segments ka external revenue touches at least, or is at least 75% of the total revenue of the company. Meaning in this example, it should at least be 75. If it is not 75, if it is not 375, then the management has to identify one or more segments. Meaning other than A and B, management can pick either C or D and make that to be reportable so that this 75% threshold also will get satisfied. Okay. Simple funda is external revenue of reportable segments. That's what I've written here. Should at least be 75% of the total revenue of the company. If it fails, then additional segments management should identify and report it. That is their choice now. Okay. So C and D is not failing, is failing 10% test? Yes. Okay. C and D, though if it fails 10% test, to satisfy this external 75% test, management has to pick one among them and report it. If they want, they can pick both also. Even though they are failing 10% test, you still have to report it because to satisfy this 75% wala threshold wala test. Okay. It's about 75%, not much asked, but just sharing with you. If a segment is reportable segment in the current year, normally if you check financial statements, you don't give the data in financial statement. If you just check balance sheet, no, you don't give the balance sheet data only for the current year. You also give previous year data for comparison purpose. Same thing goes for reportable segments also. Reportable segments means you need to give the data in notes to accounts. If a segment is reportable segment in the current year, then that segment ka previous year data also you should give it for comparison purpose. Only then people can compare, right? So if it is reportable in the current year, then previous year data also you need to give. Whether that segment is reportable in the previous or not, year or not, becomes irrelevant. If it is reportable segment in the current year, that segment ka previous year data for comparison purpose has to be given. Similarly, if a segment is a reportable segment in the previous year, last year it satisfied a 10% test, so it was a reportable segment. Then in the current year also it should be taken as a reportable segment only, even though if it fails 10% test. This for safety measure. Okay, because last year if it was a reportable segment means it was meeting those tests. Suddenly, if it fails the test in the current year, means what happened? Did the company drastically curtail its operation? Did they close down this division? What happened? Why it reduced? So as a safety measure, they bought it that if a segment is a reportable segment in the previous year, then current year also it is reportable. Doesn't matter in the current year it has passed a 10% test or failed a 10% test, still you have to report it in the current year. Okay, this is about the segment reporting wala aspects. All right. Now the next topic or the next standard that we'll get is AS18, that is a related party disclosure. Accounting standard 18, which talks about related party disclosure. So what about related party disclosure is, let's say, sir, I'm a, let's say, laptop dealer. I buy and I sell laptop. That's my business. Okay. I deal with one brand of laptop, let's say, for simplicity. Normally, I sell my laptop for, let's say, 50,000 rupees. I'm a laptop dealer and I sell my laptop, a particular brand of laptop, I sell it for 50,000. Okay. Alright, let's say I am A Limited, or maybe I'll just take my example. Okay. Suppose one of my relative came to my office and told, I want to buy a laptop, please give me. Okay. So I told, okay, please take it. He asked me how much. I told, only for you, the price is 30,000 rupees. Normally, I sell the laptop for 50,000 rupees. Because he is my relative, I am not selling it at 50,000. I am selling it at what price? 30,000 rupees. That means I am giving him some discount, 40% discount I am giving him just because he is my relative. Yes or no? That means what? That relative is playing the spoil spot. Yes or no? Because of the relation, I am giving a huge discount. Now imagine somebody who has invested in my company, trusting that I will do the business properly. He has invested money. But I am keeping relationship in mind and giving huge discount, means that is affecting my profitability of the company. Papa, what happens to my investors of my company? Did they do any wrong? No. To satisfy this relative, I am giving it at a lower price. Yes or no? So, hence one standard was introduced saying, if you are doing any transaction with a related party, transaction may not happen at fair price. Here, the fair price of the laptop was 50, but I am transacting that at 30,000. Quite possible. I am not doing it at fair price. So, to cover or to capture these transactions, they brought in something standard known as related party disclosure. So, they did recognize that if there is any relationship involved, then the transaction may not happen at, it may or it may not happen at fair price. So, it's very important that as an investor of the company, you should be aware of such related party transaction. So, AS18 only gives that. Okay, if you are done any transaction with a related party, you should give a disclosure of that particular transaction. So, again, this is not an accounting driven standard. It is just a disclosure driven standard. You just need to disclose. That's all. Okay. Now, sir, who is a related party? For you to call, if you want to call two parties, whether that parties could be individual or company, if you want to call two parties as a related party, then one party should be able to either control or exercise significant influence over another party. Okay, let's say there is A Limited and there is B Limited. If you want to call these two companies as a related party, means one of the party, let's say A Limited, should at least be able to control. When will you control, sir? When will you get control? We have already done consolidation. If you want to get control, you should own more than 50% of the shares. Let's say A owns 70% equity shares of B Limited. That means what? A Limited has control over B Limited. Then these two companies become related party because A is able to control B Limited. Either control should be there. When will you get control? When one party owns more than 50% equity shares. With equity shares only you get voting power, no? So if one person owns more than 50% voting power of another company, then you have control. Either control should be there or significant influence should be there. So what does it mean by significant influence? It is assumed that significant influence you will get if one party owns 20% or more voting power in another company. If one party owns 20% or more voting power in another company, we say there is significant influence. Let's say there is X Limited. They own 25% shares of Y Limited. Does X control Y Limited? No. To get control, you should own more than 50%. If you own 20% or more, then we say X has a significant influence over Y Limited. X cannot control Y Limited, but X can influence Y Limited in their decision because they may not have substantial voting power, but they do have some voting power with which they can influence. To get significant influence, you should have at least 20% or more voting power with other company. 20 to 50%, we say there is significant influence. Beyond 50%, we say there is control. Like that. Okay. So if you want to call two companies or two individuals as a related party, either there should be a control or significant influence. That is the first aspect. Then we say company and key managerial persons. Let's say A Limited. A Limited has a director. A Limited has a director, Mr. X. The directors of the company and the company are related parties. Okay, this directors only we call it as key managerial persons. Okay, the KMPs and the companies are related party. KMP means the persons who are in charge of doing planning, controlling and directing the activities of enterprise. Who is responsible for running the company? Who is responsible for taking the decisions of the company? That we refer to as KMPs. Okay, examples of KMPs are your managing directors, all your directors, CEO, CFO, chief executive officers, chief financial officers. All these we refer to as key managerial persons because they have the decision making powers of the company. So the company and KMP are related parties because one could easily, Mr. X can easily influence A Limited here because he is a director. Okay, so KMPs and the companies are related parties. That is one. Alright, not only this, let's say we'll continue this example. A Limited has a managing director, let's say Mr. S. Okay, Mr. S has a wife. Okay, let's say Mrs. S. Okay, alright. So these two company are anyway related party. We know Mr. S is a managing director in A Limited. That means these two are related party. Not only this, the relatives of key managerial person, and the companies are also related parties. The relatives of KMP and the company, both of them are also related party. Why, sir? Sir, this is what I used to normally tell in class. Mr. S is a boss in the office. In the office, S is the boss. But once he goes home, Mrs. S is the boss. Yes or no? Mrs. S controls Mr. S. Mr. S can influence A Limited. Like that. Okay. Alright. So that's the reason we say, because normally means if you are a family member means information will be freely shared. So whatever happens to the company, Mr. S will share it with his wife, brother and all. So hence relatives of KMP and the companies are also related parties. So who and all are relatives of KMP? Relatives of KMP could be considered as what? Parents, brother, sister, your wife, husband, children, etc. etc. All these are considered as relatives of KMP. So relatives of KMP and the companies are also related parties. Okay. Not only this, enterprise over which KMPs have either control or significant influence are also related parties. Let's say A Limited, they have a director, they have a managing director, Mr. X. Are these two guys related parties? Yes, because KMPs and the companies are related party. Let's say Mr. X has 90% equity shares of another company, Z Limited. Mr. X, he's a managing director in A Limited. Not only that, he owns 90% equity shares of Z Limited. That means he has control over another company. Then these two companies are also will become related parties. The enterprise over which KMPs can exercise either control or significant influence. Those enterprise and the company are also related parties. Okay. So either you should have control or significant influence. Significant influence means, let's say A Limited owns 30%. With 30% you get significant influence. No? We say we have significant influence if you own more than 20% or more shares. If Mr. X owns 20% or more share in Z Limited, then still A Limited and Z Limited will become related parties. That's what we mean by enterprise over which KMP have control or significant influence. They are also related parties. So we saw who is related party. Standard also has given who is not a related party. Two companies having a common directors are not related party. Okay, let's say Mr. X, he's a director. He's a director in A Limited also. He's a director in B Limited also. Mr. X, one guy, is a director in two companies, A Limited as well as B Limited. Then A Limited and B Limited are not related parties. Just because two companies have a common director, they do not become related parties unless you prove it. As a thumb rule, these two companies are not related parties by the virtue of having two common directors or virtue of having common directors. That's the first point. Providers of finance like your banks, okay, and then your major customers, major suppliers, franchisors, agents, distributors, government agencies, all this as a thumb rule are not related parties. As a thumb rule, they are not. Unless you can prove it, they are considered not to be related parties. It does not matter whether you are transacting them in high volumes or low volumes. The volume could be high. Let's say A Limited sells 90% of its goods to B Limited. A Limited sells 90% of its goods to B Limited. Just because the transaction percentage is on the higher side, it does not mean these two companies become related party. Okay, so transaction volume is irrelevant for you to determine related parties. So as a thumb rules, all these guys are not related parties. So suppose there is somebody is a related party. What to do, sir? The standard name is a related party disclosure. So you need to give some disclosure about those transactions. Okay, one is name of the related party. Okay, nature of relationship. How are you related by? Are you related through control aspect, through significant influence aspect, or through KMP? How are you related? That you called out. What is the description? What sort of transaction you are doing with the related party? That you disclose. Okay, and then amount of transaction that you have done with the related party you disclose. Then if you have done any written off or write back of debts related to this related party, that you disclose. Meaning, let's say company has given the loan to related parties. To one of the directors, company has given a loan. That loan they wrote off. They wrote off that loan. Okay, they waived off that loan. If such transactions have been done, you need to kind of disclose that aspect. Okay, these are the disclosure aspects related to AS 18, that is the related party disclosure. Okay, the next standard is accounting standard 19, which talks about leases. Okay, lease. Now, just before that, I'll give you a little background. So, lease accounting and all you have done in your bachpan. Okay, that is what for the guy paying the lease. Okay, first of all, what is lease? Maybe we'll go with that. Lease is what? Lease is a contract between two parties, lessor and lessee. Lease is a contract between two parties, that is lessor and lessee. Lessor is the owner of the asset and lessee is the user of the asset. So lessor and lessee, two parties have entered into a contract, okay, wherein the owner of the asset has given the right to use. The owner of the asset has given the right to use the asset for a certain period of time to the lessee. Let's say that certain period of time we call it as lease term. We can assume it to be 5 years. Okay, for a certain period of time, the owner will let the lessee to use the asset, and in return, lessee will make periodic payments. That we refer to as lease payment. So lease is nothing but it's a contract between the two parties, the lessor and lessee, wherein the lessor, meaning the owner of the asset, will not sell the asset, will give right to use the asset to the other party, that is lessee, for a certain duration. That we call it as lease term. In return, lessee has to make some periodic payments to the lessor, that we call it as lease payments or lease rentals. Okay, we have done all this in our bachpan days. So if you take any asset on lease, for lessee has to pay the money. So for lessee, it's an expense. Lessor will receive the money. So for him, it's an income. So what is the big deal in accounting? For lessee will show it as an expense, lessor will show it as an income. Quite easy, no? Why did they bring in AS 90 this? There was a small practical issue behind this. What is that is? Let's say there is a plant and machinery which lessor and lessee have got into a lease arrangement to on plant and machinery. Let's say the useful life of the plant and machinery is 5 years. This plant and machinery can be used for 5 years. Lease term is also, let's say, 5 years. Lease term is also 5 years. Let's say fair value of the asset is 10 lakh rupees. Lease rental for 5 years, if you put it, let's say lease rental is 3 lakh per 2 lakh. Okay, let's say lease rental is 3 lakh per month. That means for 3 lakh per annum rather. For 1 year it is 3 lakh. For 5 years it will be 15 lakh. This is the total lease rental. Okay, I've just given you some lease ka little gist. That's all. One lease ka. This is the terms. Okay, let's say A Limited, B Limited. A Limited has given. A Limited is the lessor, meaning the owner of that plant and machinery. They have given that plant and machinery on lease to B Limited. That is lessor. The lease term is 5. Useful life is also 5. What is the fundamental problem that was eating our head is? See, who's the owner of that asset? Legally, who's the owner of the asset? A Limited. Okay, but practically you just check. Legally, A Limited may be the owner of the asset, but practically, who's using the asset? Practically, who's using the asset? The other party, which is B Limited. Yes, so that to check. The life of the asset is 5 years, and the lease term is also 5 years. That means the asset is used for its entire life by whom? The asset is used for its entire life by whom? B Limited. Yes or no? That means practically B Limited is using the asset and getting all the benefits. Yes. See, if you are showing any asset in your balance sheet, means you should see fixed asset and all. If you're buying, like academy, for us academy, we show television, this camera, laptop, iPad, and all as fixed asset. Why? Because we use that asset and we generate the benefits, meaning we generate the revenue. Okay. But in this case, A Limited is legally owning that asset. But are they using the asset and getting the benefit? No. Who's using the asset and getting all the benefits? B Limited. A Limited is just the owner. Naam ke vaste he is the owner, but actually who's using and getting all the benefits? B Limited. So radically they shifted their thinking. See, asset, whichever guy uses the asset and gets the benefit, he should only show the asset. Hence they brought in a concept saying, since lessee is using all the assets for its entire life and getting the benefits, lessee only should record that plant and machinery, meaning that fixed asset, lessee only should show in his books, because he's only using the asset and getting all its benefits. Okay, but right now who's the owner of the asset? A Limited. Right now who's showing the asset on in their books? A Limited. So A Limited should cancel showing that fixed asset in his books, because A Limited is not really interested in the asset. He's only interested in what? He's interested in receivable. In receiving what? He's only interested in receiving lease receivable. Okay, let him show that. Whatever he's interested, let him show. No? B Limited is really interested in the asset, so let him show that asset. This is a radical shift in the thinking. This only we call it as substance over legal form wala accounting. Substance means reality. So this AS 19 runs over substance over legal form, meaning reality is more important than legality. In reality, B Limited is using the asset and getting all the benefits. So B Limited only should show this asset in his books. But legally, A Limited is the owner of the asset. That's what we mean by substance over legal form. With this background, they brought in the whole standard. Now the whole things have changed. If this was not there, this standard would have been very straightforward standard. Okay, because what? For one guy it's an income, for another guy it's an expense. You could have easily done this. But because of this substance over legal form concept, the whole thing changed. If lessee is showing that asset, means at what value should he show? Okay. If lessor is showing receivable, means at what value he should show. Like this whole new things came into play. That's the reason they had to build a lot of concept behind AS 19. Okay. So first of all, they said, okay, since there is these sort of dramas involved and all, no? Okay, first we need to check, because here in my example, I've given the lease term and useful life to be same. It may be quite possible that the lease term could only be for 3 years, 4 years, 1 year. In that case, what you have to do? There could be some confusion. Hence, that's the reason they said whenever there is a lease, you categorize that lease. There are two types of lease that they categorized into. One, the lease could be either a finance lease or an operating lease. Lease could be either an operating lease or a finance lease. So when can you say it's a finance lease? They brought in certain indicators, not condition. These are indicators. They define whether the lease is a finance lease or an operating lease. One, if the present value of MLP as in minimum lease payment, all these questions we have done in our regular class, quickly I'll run through. Present value of minimum lease payment, if it approximate, meaning if it is more or less equal to fair value of the asset, then it is a finance lease. First of all, what is MLP? MLP means the payment made by the lessee to the lessor. Whatever payment lessee makes to the lessor, that we call it as minimum lease payment. What payment do you think lessee will make to the lessor? One, he will pay lease rent, yes or no? One, he will pay lease rent, monthly, yearly, quarterly, whatever. Along with this, he will also pay something known as GRV, as in guaranteed residual value. Now, what happens on leases? Now, if you take the previous example only, A Limited gave the asset on lease to B Limited for how many years? 5 years. Useful life is 5 years. At the end of the asset, okay, what will happen? Once the 5 years is over, the asset will become more or less outdated. So, the end of the useful life, A Limited will sell the asset because it has become outdated, no? So, you'll sell the asset. Let's say that residual value is 10,000. The value you're going to get at the end of useful life only, we call it as a residual value. Yes or no? Okay. Alright. Now, what happened is, due to leasing arrangement, who's using the asset? Lessee. If lessee carefully uses the asset, if he uses the asset very carefully or diligently, the chances are that lessor will get higher residual value, because if the condition of the asset is good, then the residual value will be higher. If lessee has used the asset pathetically, anyway, he thought I am not the owner of the asset, so let's not worry about usage. Bindas we will use. So he is using it left, right, center. Okay. So if he pathetically uses that, then what will happen to residual value? Residual value will fall. So based on lessee ka usage, residual value is getting determined. Yes or no? That means lessor may tell the lessee, boss, look, since you are using the asset, if you don't use the asset carefully, residual value may go up and down. If you use it very carelessly, residual value will come down. So hence lessor may say the lessee, you have to give me some guarantee. Lessor may tell the lessee, you have to give me some guarantee that residual value, about some residual value. Lessee told, no problem, I will give you a guarantee that residual value, I'll give you a guarantee towards residual value of 7,000 rupees. Meaning lessee is saying, no matter what, minimum 7,000 rupees I will give it to you as a residual value. That to be called as guaranteed residual value. This is also payment made by the lessee to the lessor. The payment made by the lessee to the lessor only, we call it as minimum lease payment. That will consist of two components, that is lease rental and guaranteed residual value. Okay. Now lease rental, in my example, you will pay over a period of 5 years. Okay. This guaranteed residual value you will pay at the end of 5th year, because residual value and all you will get it only at the end of the useful life. No? That means all these values are what, sir? They are all future values, but you are doing the lease accounting now. Hence, you need to find out the present value of these payments, which is present value of minimum lease payments. Okay. So compare, let's say the present value of minimum lease payment is 10 lakh. Compare this with the fair value of the asset. That plant and machinery was taken on lease, no? On that lease date, find out the fair value of the asset. Let's say the fair value of the asset is also 10 lakh. If these two are almost equal, then it is an indication that it is a finance lease. Okay, if present value of minimum lease payment, if it is approximating, meaning more or less equal to fair value of the asset, then it is a finance lease. That is one indicator. Second indicator, if the lease term is more or less equal to useful life of the asset, the lease term and the useful life of the asset, if it is more or less same, okay, then it again is an indicator that it is a finance lease. If the asset is of specialized nature that only lessor can use it without, only lessee can use it without making major modification. Lessor has bought the asset. That asset only lessee can use it, because lessor bought the asset only to give it on lease to the lessee. Others can't use it because it is a customized asset. If that is the case, means such a lease becomes, or such is a character of a finance lease. That's one more indicator. If the asset is transferred to the lessee at the end of the lease term. Here, my example, the lease term was 5th year, no? So lessor is telling the lessee, at the end of 5th year, you only keep the asset. I'm not interested. Okay, meaning lessor, the asset is automatically getting transferred to the lessee at the end of the lease term. If that feature is there, not necessarily all this has to be there. If it is there, then it indicates that it is a finance lease. The last one is lessee has an option to purchase the asset at the end of the lease term, or lessor has an option to purchase the asset at a value significantly lower than fair value. Let's say here there is an option. Okay, in the lease, your lease term is 4 or 5 years. Let's say lessor has given an option at the end of 4th year. Okay, let's say lessor is saying the lessee, at the end of 4th year, I will give you an option. If lessee wants, he can buy the asset for, let's say, 8 lakh rupees. Lessor is telling the lessee, at the end of 4th year, I'll give you an option. If you want, you can pay me 8 lakh rupees and buy this asset. Let's say the fair value expected at the end of 4th year is, fair value is 11 lakh rupees. The fair value of the asset at the end of 4th year, let's say, is 11 lakh rupees. All these are just assumed numbers. But lessee has an option to purchase it just for 8 lakh rupees. That means, what do you think lessee will do? He's interested. Lessee only is interested in the asset, no? So what do you think he will do? He'll exercise this purchase option, more or less, yes or no? If this feature is there, if lessee has an option to purchase this asset at a value lower than its fair value, then such is an indicator of finance lease. Something which is not a finance lease automatically becomes operating lease. So why is this important? So if it is a finance lease, then what you have to do, I've called out over here. If it is a finance lease, then lessor is just a financier. He's not interested in the asset. If it is a finance lease, then it's an indication that lessor is just interested in the money, meaning lease rental. He's not interested in the asset. So what will happen is, lessee, the guy who is interested in the asset, he will show the asset. If it is finance lease, then lessee will record this asset in his books. Lessee will show this asset at what value? At present value of minimum lease payment or fair value of the asset, whichever is lower. If it is finance lease, lessee will record the asset in his books at a value of present value of minimum lease payment or fair value of the asset, whichever is lower. Okay, and since lessee only is recording the asset, he will only charge depreciation on this asset. Okay, let's say the total lease rental lessee is paying is 50 lakh rupees. Total lease rental. Okay, let's say he's paying a lease rental of 10 lakh rupees every year for 5 years as a lease term. So that means totally he's paying 30 lakh rupees. But for to conclude finance lease and all, what do we take? We take lease rental or present value. We have to find out MLP. How do you get MLP? That is nothing but present value of lease rental plus present value of guaranteed residual value. Let's say guaranteed residual value is 0. Only lease rental lessee is paying. Guaranteed residual value is not there. For simplicity, I have left it out. So this 50 lakh lessee will pay over how many years? 5 years. That means what is this? This is the future value. Find out, use a discount factor and find out its present value. Let's say that comes to 27 lakhs, or maybe let's make it as 30 lakh rupees. The present value of lease rental is 30 lakh rupees. Okay, and this is how you get this. Lessee is actually paying how much? 30 lakhs. But he has recorded the asset at MLP of how much? 30 lakh. The difference between these two, this 50 lakh minus 30 lakh difference is how much? 20 lakh. That lessee will record it as finance charges. It's like he has purchased. He is showing this asset, no? So it's like telling lessee has purchased this asset. Though he has taken it on lease, it's like telling lessee has purchased this asset by taking a finance, by taking a loan. Okay? The loan value, today's value is 50 lakh. Over 5 years, he needs to pay 50 lakh. Today's value, today, it's like telling today lessee has taken a loan of 30 lakh. At the end of 5th year, he will repay 50 lakh rupees. So the difference between those two is nothing but on loan, what do you pay? Interest charges. That only we call it as finance charges over here. So lessee has to record, in my example, this 20 lakh is nothing but the finance charges which the lessee has to record over a period of 5 years. How to record this and all, I've showed you in the class only. We have done 4 or 5 problems on this. But these are things which are not tested that often in the examination, but still we have done enough problems in our classes. Okay, simple. Okay, so if it is finance lease, all this drama will happen. One, lessee has to record the asset at the fair value of the asset or present value of minimum lease payment, whichever is lower. Okay, all right. The difference between the total lease rental and the MLP is nothing but the time value of money, the interest component, which lessee will record it as a finance charges. So what will lessor do? Lessor is currently showing the asset. He will de-recognize the asset, meaning he will cancel the fixed asset in his books. He'll stop because only same asset cannot be shown by both the parties. If lessee is showing means lessor has to de-recognize. What is lessor interested in? He's interested in lease rentals. Yes or no? He's interested in receivables. Let him show the receivables. Okay. The difference, he will record that receivable at net investment value. We say like here. Let's say instance. Let's say what do you think lessor is interested in to recover? He's interested to recover lease rental. How much is lease rental over here? 50 lakh. And he's also interested to recover residual value of the asset. Yes or no? These are the two things he's interested on the asset. He wants lease rental and he wants residual value. Let's say residual value is 0. Okay, that means how much is he totally interested to recover? 50 lakh plus 0, which is what? 50 lakh. That we refer to as gross investment. This is the total recovery which the lessor is interested to do. If the lease term is 5 years means lessor will recover this 50 lakhs over a period of 5 years. That means this is what? Future value. The present value of this if you find out, the present value of gross investment if you find out, that only we call it as net investment. And let's say we find out the present value of this is 30 lakh rupees. So lessor will show receivable today. The moment he gets into this finance lease arrangement, today he will cancel the asset and he will record a receivable to the extent of net investment value, which in my example sake is 30 lakh. But is he receiving 30 lakh? No, he's showing the receivables to the extent of 30 lakh. Lessor is a financer, meaning he's the guy giving the loan. It's like telling lessor has given a loan of 30 lakh rupees and after 5 years he will collect 50 lakh rupees. So the difference between these two, which is 20 lakh, is nothing but finance income for the lessor. For the lessee it was finance charges, for the lessor it is finance income that he needs to book. On a periodic basis he needs to recognize. This is the accounting. So all this drama you need to do when the lease is a finance lease. And indicators of finance lease, that's the reason testing the lease, whether it is a finance lease or operating lease, is very important because the whole accounting changes. So what if it is operating lease? If it is operating lease, then it is very simple. Bachpan will come into play here. In Bachpan mein, if you take any asset on rent or lease, what do you used to pass? For the guy paying rent, it's an expense. For the guy receiving, it's an income. That expense income accounting you will do over here. Okay, meaning if that is the case means lessor currently is showing the asset, he will still continue to show the asset. He need not de-recognize. He will only show the asset, meaning he will only charge depreciation. Lease rental, lessor will receive, no? So he will show it as an income. But one catch over here is this lease rental should be recognized on a straight line basis, meaning it should be recognized on an equal basis. Let's say lease rental is lease rental, I'll write it here. Year 1 is 10,000, year 2 is let's say 15,000, year 3 is let's say make it as 18,000. Okay, so that means what is the total lease rental? 10 plus 15 plus 18, that will be 43. 1 minute, just make it as 40. This will make it as 20. I think that will be better. This will just for the round off sake. That's all. Okay. Let's say this lease rental for third year is 20. That means the total lease rental will be 25, 45,000. What the standard says is, okay, total lease rental is 45,000. No? This lessor has to recognize it as an income, but he has to recognize it as an income on a straight line basis. Meaning same income he has to recognize every year. So 45,000 is a rental income for 3 years. So for every year, if you do average, 45,000 divided by 3 is how much? 15,000. So lessor will book 15,000 as a lease rental income every year, because that is what straight line method means. Okay. So you have to show same income every year. So but in the first case, first year he only received 10,000. Yeah. 15,000 is his income. He has only received 10 means balance is accrued income. Okay. Income has accrued but not yet received. If he has received more means he will treat it as income received in advance. Like that he will show. Same drama holds good for lessee also. For lessee it's an expense, right? He will not show any asset amount. So lease rental that he is paying, he will record it as an expense on a straight line basis, or any other reasonable or systematic basis is also acceptable. But for our problems, if they don't specify anything, lease rental expense, book it equally over the lease term. Now for lessee it's an expense, for lessor it will be an income. That's what you have to do. This is for operating lease. Okay. Alright. This is not much tested in the examination. The next aspect, that is sale and leaseback. This is quite popular as far as the examination is concerned. There are a lot of questions that has come from this particular topic. Let's see what this is about. Sale and leaseback arrangement. What happens here is, let's take the example. Let's say X Limited has sold the asset to Y Limited. X Limited has sold one plant and machinery, okay, to Y Limited. Okay, so X Limited is the seller and Y Limited is the purchaser or buyer. Okay. Now what would happen is, check the name of this, sale and leaseback. What happens is, first X Limited will sell the asset to Y Limited. After selling, X Limited will take the same asset back on lease. After selling, X Limited will take the same asset back on lease. This arrangement we call it a sale and leaseback. Sell it and then take the same asset back on lease. So why do they do this? Okay. Normally what happens here is, let's say X Limited sold the plant and machinery for 10 lakh rupees. X Limited sold this plant and machinery for 10 lakh. So when X Limited sell means, Y Limited will pay X Limited how much? Y Limited will pay X Limited 10 lakh rupees. Yes. So X received how much from this machinery sale? 10 lakh rupees. Okay. So he received the money right now. Then he took the same asset back on lease. That means he has become now the lessee because he has taken the asset back on lease. Who has given the asset on lease? The buyer, which is the lessor. Yeah. Okay. Let's say the lease term is 5 years. Okay. And the lease rental or the lease payment is, let's say, 2 or 3 lakh rupees per annum. Okay. This way what happens? Check. When X Limited sold the asset, entire 10 lakh rupees he received it immediately. Okay. Then when he's taken the asset back on lease, he has to pay lease rental. But this entire 10 lakh, is he giving it in one shot? X Limited received 10 lakh in one shot, but is he paying the lease rental also in one shot? No, he's only paying how much? 3 lakh every month. So by this transaction, what is X Limited being able to achieve is, he's using this plant and machinery as a base and raising finance. He's using this plant and machinery as a base and raising the money. So he needs money. Actually, he's not interested to sell the asset. Okay, he wants the asset, but he's using the asset as a base to raise the money. That is your sale and leaseback arrangement. Okay. Now, if it is a lease means you have to check whether the lease is a finance lease or an operating lease. First, check whether the sale and leaseback arrangement results into a finance lease or operating lease. If it is finance lease generally they don't ask much in the examination because there is no numb in this question. Okay, it's pretty straightforward. If it is finance lease, then any profit or loss, if due to the sale, if X Limited makes any profit or loss, let's say the book value of this plant and machinery is, let's say, 7 lakh rupees. X Limited currently is showing the plant and machinery in his books for 7 lakh rupees, but he sold it for 10 lakh rupees. Okay, that means he has made how much profit? He has made a profit of 3 lakh rupees. So due to this arrangement, if X Limited has made any profit, that profit will be deferred over the lease term. What is the lease term? 5 lakh rupees. So if it is a finance lease, due to the sale and leaseback arrangement, if this guy, seller, if he has made any profit, that will not be recognized immediately. It will be deferred over the lease term. That is what I have given over. Okay. The more interesting aspect is operating lease. Operating lease. If sale and leaseback result into operating lease, how it results into finance lease or operating lease, we already have indicators, right? test the indicators and conclude whether it is an operating lease or a finance lease. If it is operating lease, then you need to check. First check if the sale value is equal to fair value of the asset. Because normally fair value means market value of the asset. Normally when you are selling, no, you will sell the asset at its market value. Yes, so you will just check how much is the value of the asset as per the market terms or market condition, and at that value only generally you sell. So if sale is made at fair value, okay, then any profit or loss is recognized immediately. The lessee, the seller, if he has made any profit, if he has sold the good, if he has sold that asset at fair value, then any profit or loss can be recognized immediately. If the sale value is lesser than the fair value, okay, then the standard is giving the benefit of doubt to him. Ideally, the sale should be made at fair value. If sale is being made at a price lower than fair value, then standard is giving a benefit doubt that maybe it is a genuine sale. Maybe the company wanted to sell the asset soon. That's the reason they are giving a little discount and selling the asset soon. In that case, profit or loss, in that case also profit or loss can be recognized immediately. However, loss should not be compensated by a future lease rental. What does this mean? Let's say fair value of the asset is 10 lakh rupees. Okay, let's say book value of the asset. Let's say book value of the asset is 7 lakh rupees. In the books, the seller is showing the asset at 7 lakh rupees, but the fair value of the asset is 10 lakh rupees. That means ideally what the sale should be made at fair value only, but let's say the sale value or the selling price is, let's say, only 9 lakh rupees. Meaning, is the sale being made at fair value or selling price is lesser than fair value? Here selling price is lesser than fair value. Yes or no? How much is it lesser by? 1 lakh. Okay. If it is genuine sale, no problem. Okay, then it's okay. Profit or loss, you can book it, recognize it immediately, not a problem. Or maybe 1 minute, hang on. We'll make this to be 4 lakh rupees. Okay, let's make this as 4 lakh rupees. Okay, well, check sir. This is a seller. We are doing from seller perspective. The book value of the asset is 7 lakh rupees. He has sold it for 4 lakh. That means he made what, sir? He made a loss of 3 lakh rupees. Can I say that? 7 minus 4 lakh, which is 3 lakh rupees. Okay, he has made a loss of 7 lakh rupees. If it is genuine, it is fine. But you know what? It's a leaseback arrangement, no? So here X limited. The seller is X limited. What X limited is telling Y limited is, okay, X limited is telling Y limited. Look, boss, the fair value of the asset is actually 10 lakh, but I am selling it to you at lower price and making a loss. Okay, but I anyway have to pay lease rental to you. I only have to pay because I've taken the asset back on lease, means I have to pay lease rental to you or lease payment to you. Since I am selling it to you at lower price, I will not give you, what was the initial lease rental? 3 lakh. I will not give you 3 lakh. I will only give you 1 lakh rupees. Meaning this loss, we will adjust it in lease payments or we will adjust it in lease rental. If that is the arrangement that they are doing, means then you cannot record this loss immediately. You need to defer it. Okay. If it's a genuine sale, okay, if it's a genuine sale and whether you made profit or loss, then you can recognize immediately. But if this loss is getting compensated through future lease payments, if that is what they are arranged, if their arrangement is like that, then that loss you cannot recognize immediately. You need to defer it. That is what this particular case study is. Don't worry, we'll also apply it in one of the problem. Class may be also done quite a few. Okay, this is the thing. Next scenario. First scenario was sale value is equal to fair value. Second scenario, sale value is lesser than fair value. Last scenario, sale value is greater than fair value. If sale value is greater than fair value, then 100% something is wrong. Yes or no? Because sale generally has to be made at fair value. Fair value is a maximum price which you will pay. Okay. Beyond fair value, if you are selling and taking the asset back on lease, that means some jugaad or some arrangement you have done. Hence the standard says, if sale value is greater than fair value, up to profit up to fair value, I'll allow you to recognize immediately. Beyond that, if any profit is there, we will defer it over the lease term. Profit up to fair value, you can recognize immediately. Beyond that, you need to defer it. How to do that, I will tell you in one of the problem. And always in these sort of problems, check if there is any impairment loss. Impairment loss will only come if the book value of the asset is greater than the fair value. Let's say the book value of the asset is 8 lakh rupees. The fair value of the asset is only 7 lakh. Meaning in your books, you are showing the asset at 8 lakh rupees. But the market price of the asset is only 7 lakh. That means, are you not showing your asset at a higher value as compared to the market in your books? The asset can only fetch you. If you sell the asset, maximum value you will get is only 7. But you are showing the asset in your books at 8 lakh rupees. Unnecessarily you are showing the asset at a higher value, right? That hence, in that case, you have to book something known as impairment loss. So impairment loss will only come if book value is greater than fair value. So in this case, maximum value of asset you can show in the books is 7 lakh, but you are showing it at 8 lakh. That means you have to record an impairment loss of 1 lakh rupees. Actually, impairment loss comes in AS 28, or it's not there in your inter syllabus. It is there is an accounting standard 28 on that, and there is also Ind AS 36 on that. But you learn all this in your CA final syllabus, not here. But here only due to this concept, one extra fitting is done, so I'm discussing with you. Okay. Alright, so if book value is greater than fair value, then there arises a need to book some impairment loss immediately. Let's apply it in one of the question. This question came in Jan 2021 for about 5 markers. A Limited sold the machinery whose WDV, meaning book value, is 40 lakhs to B Limited for 50 lakh rupees. So that means this is your selling price. This is the book value. And the same machinery was leased back by B Limited to A Limited. First you are selling, then you are taking the asset same back on lease. The lease is an operating lease, so they have only told. If it is operating lease, you have to check which criteria it is fitting in. Whether the sale value is equal to fair value, sale value is lesser than fair value, sale value is greater than fair value, you need to check and accordingly give the treatment. So comment, you need to comment under these scenarios. They have given independent scenario, each of them you need to comment. Selling price is 50 lakh and it is equal to fair value. So we know the first scenario. If the sale value is equal to fair value means what? Any profit or loss, if sale is equal to fair value means then there is no manipulation, because you have to sell it normally at fair value only and you have sold it at fair value. So since there is no manipulation, any profit or loss can be recognized immediately. So what is the profit? In your books you are showing the asset at 40 lakh, the selling price is 50 lakh. That means how much is the profit you made? Profit of 10 lakh can be recognized immediately. That's what they've written over here. Okay, 10 lakhs of profit should be recognized immediately. You just need to comment like this. Since sale is equal to fair value, profit or loss should be recognized immediately. That's the first case. Selling price is 50 lakh, fair value is 60 lakh. That means what scenario here is it? Sale value is lesser than the fair value, because fair value is 60, sale value is only 50. If it is genuine case, then profit or loss should be recognized immediately. However, if it is a loss, that loss should not be compensated by future lease payments. Have they told that future lease payment is compensating the loss? No. First of all, check whether it is a loss or profit. Book value of the asset is 40. You sold it for 50. That means you made a profit of how much? 10 lakh. That means that you can recognize immediately here again. This is the second scenario. Profit of 10 lakh should be recognized immediately. Second scenario, okay, answer, because there is no manipulation. Third scenario. Fair value is 45 lakhs. Selling price is 38 lakh. That means sale value again is lesser than the fair value. Okay. Now check whether it is a profit or loss. In your books, you are showing the asset at 40, but selling price is only 38. That means now you have made a loss of 2 lakh. 38 minus 40, which is 2 lakh loss. Okay. Loss also you can recognize immediately, but that loss should not be compensated by future lease payments. Okay. You can write, give a subjective answer like that. Loss of 2 lakh can be recognized immediately in the books, provided the loss is not compensated by future lease payment. Like that you write. They have not given anything, so you can write the comment, loose-ended comment there. Okay. This is the third scenario. Fourth scenario, say fair value is 40 lakh, selling price is 50 lakh. That means sale value is greater than fair value. If sale value is greater than fair value, profit up to fair value you can recognize immediately. What is the fair value? 40 lakh. Meaning ideally you should sell the asset 40 lakh only. So profit up to fair value you can recognize immediately. Beyond that, if you are making any profit, defer it. WDV is 40 lakh, fair value is 40 lakh. So that means what is the profit up to 40 lakh? Profit up to fair value. Profit up to fair value is 0. That means you can't recognize anything immediately. So what is the total profit actually you have made? WDV of the asset is 40, your selling price is 50. So actual profit you have made is 10 lakh. Profit up to fair value is 0. That means the entire 10 lakh you will defer it over the lease term. That's what they have written over here. The entire 10 lakh profit should be deferred and recognized over the lease term. Okay. Next, fair value is 46, selling price is 50 lakh, meaning sale value is greater than the fair value. Okay. So how much is the actual profit you have made in this scenario? Book value of the asset is 40, selling price is 50. So the total profit you have made is 10 lakh rupees. In this, first find out what is the profit up to fair value. See, normally you have to sell the asset at fair value only, 46 lakh. But the book value of the asset is 40. 40 worth of asset, you have a chance to sell it at 46 lakh. That means profit up to fair value is what? Fair value minus book value, which is 6 lakh rupees. So out of this total profit of 10 lakh, 6 lakh profit you can recognize it immediately, because up to fair value, because sale price has to be generally equal to fair value. That's the reason. So if you had sold the goods at 46 lakh rupees, you would have got a profit of 6 lakh rupees. That would have been a genuine, no manipulation. That you could have recognized it immediately. But here actually you have made a profit of 10 lakh rupees. Higher and above that you have made. That means what? Beyond that, if you are having any profit, here this is 4 lakh. That will be deferred over the lease term. That's what they must have given over a check. Total profit is 10. In that 6 lakh profit recognized immediately. Balance 4 lakh profit is deferred over the lease term, meaning you cannot recognize it immediately. Last scenario, fair value is 35 lakh, book value is 40 lakhs. Book value is 40 lakh, fair value is only 35 lakhs. Check, is there any impairment loss? In all our previous cases, there was no impairment loss. Here there is. How? Sir, in your books, you are showing the asset at 40 lakh. But if you sell the asset in the fair value of the asset, fair value of the asset means market price. Market price of the asset is only 35, but you are showing the asset at 40 lakh. That means you are overstating the asset or showing the asset at higher value. So you have to book one loss. What is the difference between these two? 5 lakh. So book this impairment loss. Okay. So when you book this impairment loss ka journal entry is same as depreciation. For depreciation, what entry you will pass? Depreciation account debit to fixed asset account, right? Substitute depreciation with impairment loss. So the journal entry will be impairment loss account debit to fixed asset account. Since fixed asset account has debit balance and due to this impairment loss, you will credit fixed asset. You will pass the journal entry impairment loss account debit to fixed asset account 5 lakh, 5 lakh. Since you credited fixed asset, WDB, book value of the asset from 40 lakh, it will reduce by 5 lakh because you have credited fixed asset. No? So it will become, or the revised book value will become 35 lakh rupees. And the fair value of the asset is also 35 lakh rupees. Like that. This is the first entry you need to mask. Meaning impairment loss of 5 lakh you need to recognize immediately. Then what is your selling price? Selling price is 39 lakhs. Okay. Sale value is 39 lakhs. That means did you make any profit? Your fair value also, mind you, is 35 lakhs. That means what? Sale value is greater than the fair value over here. If the selling price is greater than the fair value, then what do you have to do? Any profit or loss, you should defer it. Yes. Book value of the asset, revised book value is 35. You sold it for 39. That means you got a profit of 4 lakh. This profit, since the sale value is greater than the fair value, it looks like a manipulation scenario. So hence this profit of 4 lakh will not be recognized immediately. Rather, it will be deferred over lease term. Recognize impairment loss of 5 lakh immediately. 4 lakh profit, you defer it. That's the scenario. Okay, impairment loss 5 lakh should be recognized immediately and 4 lakh should be deferred over the lease term. So why you, in the previous case, you did not check for impairment? Check in previous case also, if you want, you can just check. First case mein, fair value is what? Is equal to fair value is equal to selling price they told. That means fair value is 50 lakh. But in your books, you are showing only at 40 lakh. So is there any loss? Market price is 50, but you are showing it only at 40. So there is no loss. Second scenario, fair value is 60. Book value is only 40. Is there any impairment loss? No. Third case, fair value is 45 lakhs. Market price is 45 lakh, but you are showing only 40. So is there any loss? No. Fourth scenario, fair value and book value same. So there is no loss. Fifth case, fair value is 46 lakh. Book value is only 40 lakhs. So is there any impairment loss? No. So under these first 6 cases, there was no impairment loss. Impairment loss came only in the last scenario. Hence we tested that. So these are your comments. Okay. Generally, yes, for each comment, they will give 1 marks. Okay. So this question, as I told you, has repeated quite a few times from this particular topic. All right. Yes, that's it then. Thank you. Hello guys, welcome back. So next topic that we'll be starting with is Accounting Standard 20, which talks about earnings per share. This topic is totally numerical or number driven topic. So we'll solve a few questions and see. First of all, earnings per share as an EPS. There are 2 types of EPS. One is basic earnings per share, which we used to call in our class purpose as BEPS. Another one is diluted EPS as in DEPS. Okay. First, we will look into the basic EPS portion, that is BEPS. So basic EPS is given by the formula earnings attributable to equity shareholders divided by weighted average number of equity share. For class purpose, we used to call it as each divided by weights. Each as in earnings attributable to equity shareholders divided by weighted average number of equity shares. This is not the number ways, this is weighted average number of equity shares. Meaning you have to assign some weights. Okay, here the weights are assigned in months. Okay. Now, what do we mean by that? Let's say current year is 1st April 2022 to 31st March 2023. This is our current year. Let's say on 1st April 2022, company had 1 lakh shares. 1 lakh equity shares company had. Let's say on 1st July 2022, the company issued, let's say 75,000 shares more. Let's say on 1st January 2023, the company issued 50,000 or 50,000 shares more. Okay. So here what happens is, if the number of shares, if it is not same for the whole year, meaning if the company has issued any new shares or if they have bought back any shares in the current year, then you need to consider the time period, and then using the time period, then we need to calculate the basic EPS. So here, weighted average number of equity shares. Normally in our +1, +2 days and all, we used to do simple average, right? How you used to find out simple average? Add all the numbers divided by if you are doing added 3 numbers means divided by 3 used to do. Yes, but here we don't need simple average, we need the weighted average, and the weights are assigned in months. So how do you get variances? Okay, see, from 1st April till 1st July, how many shares the company had? From 1st April to 1st July, that is April, May, June, for 3 months the company had 1 lakh shares. So the weightage is 1 lakh into 3 by 12, like that. On 1st July, the company issued 75,000 shares, means now the company does not have 1 lakh shares. They have 1,75,000 shares because the number of shares increased. So 1,75,000 company 75,000 shares the company had from 1st July to 1st January. That means what it is, 1st July to January. So July, August, September, October, November, December. That is for the next 6 months. The company had 1,75,000 shares. Thereafter again it will increase, because on 1st January, company issued another 50,000 shares more. That means the total number of shares will become 2,25,000. From when? From 1st January till the end of the year. That is till 31st March. That is January, February, March. So into 3 by 12 you can do. So it will be what, 1 lakh into 3 by 12 if you calculate. This will be 25,000 plus this will be 1,75,000 into 6 divided by 12. That will be 87,500 plus 2,25,000 into 3 by 12, which is 56,250. So if you add everything, you're going to get the weighted average number of equity shares. That will be 25,000 plus 87,500 plus 56,250. That is 1,68,750 shares. So we need to take this number for our EPS calculation, not the plain numbers, but after assigning the weights, how much is the weighted average number of equity shares. So why do we assign weights? Sir, there is a huge difference. See, when the company issues shares, they will receive money. There is a huge difference between receiving the money on 1st April versus receiving the money on 1st January. Because when the company receives the money when they issue shares, they will use that money to do their business. Yes or no? Alright. See, if they receive the money on 1st April, that means they can use this money for the whole year. If they receive the money on 1st January, that means the money can be utilized only for 3 months. That is January, February and March. Yes or no? So that means what? Your earnings, the numerator is your earnings, no? Alright. If you have received the money for only 3 months, that means you can earn from that money only for 3 months. So your numerator considers the weights in terms of months. Hence your denominator also should consider the weights in terms of months. That is the logic behind why we take weighted average number of equity shares and not total number of equity shares. Okay. So that's how you get the basic EPS. So how do you get earnings attributable to equity shareholders now? First take earnings after tax or profit after tax. From that deduct preference dividend. Okay. Earlier on this dividend there used to be also dividend distribution tax. Now they are abolished in tax. Hence this may be irrelevant. This was relevant maybe one attempt before. So now you simply have to do earnings after tax. From earnings or a profit after tax, may say if you deduct preference dividend, you're going to get earnings which is available for equity shareholders or earnings attributable to equity shareholders, which only we call it as each. That's how you're going to get the numerator. In these sort of problems or from this standard, the numerator is very straightforward. In fact, in majority of our problem, they will only give numerator. It's the calculation of weights, that is the denominator, is the crux of this particular topic. Okay. Alright, that is one. Then, second type of problem that could be asked in the examination is bonus shares. Okay, what if the company has issued bonus shares? First of all, bonus shares means what? Bonus shares means additional shares are given by the company to the existing shareholders. Bonus shares is additional shares given to existing shareholders at free of cost. Absolutely at free of cost. The company is giving some more shares to the existing shareholders. Okay. So in bonus shares happens means what will happen to your wage, sir? Sir, since the company is issuing bonus shares at free of cost, there is no impact on your earnings because company is not receiving any money. If the company is receiving the money, means when they receive the money is very much important. If you receive the money for the whole year, then you can earn from it for whole year. If you receive the money only for 3 months, then you can earn from it only for 3 months. But in case of bonus shares, company is not receiving any money. So that means due to bonus shares, there is no impact on your EASH. That is earnings attributable to equity shareholders. That is the reason weights need not be assigned to bonus shares. Or in another way, if you want to do it, you assign full weights to bonus share or bonus shares. That is 12 by 12. You do, okay? Or another way to put it across is, all right, whatever weights you have assigned on original shares, because on original shares only you will give bonus shares. Okay, on original shares only they will give bonus shares. How much ever weights you are giving to original shares, same weight you give for bonus shares also. On original shares, if you are multiplying as 6 by 12, okay, then here also on bonus also you multiply 6 by 12. On original shares, if you are giving full weights, that is 12 by 12, and bonus also you give it as 12 by 12. Okay, so this is the simple way to do it. Okay, bonus shares you can assign full year ka weight, or whatever is the weight you have given on original shares, same weightage you give it. That's the first point. Second point is, whenever bonus shares are given, previous year ka EPS, not current year ka EPS, previous year ka EPS also should be restated for comparison purpose. Whenever bonus issue comes, previous year ka EPS also you need to restate for comparison purpose. Now what do I mean by that? Let's say current year, previous year. Current year, let's say EASH is, or let's say previous year the EASH is 10 lakh rupees. Current year also, let's say it is 10 lakh only, assumption. To calculate EPS, we require only two things, EASH and weights, right? Okay, let's say the company, last year the company had 1 lakh equity shares. This is your weights. Okay, the EASH was 10 lakh, weights is 1 lakh. That means what is your EPS, sir? Or the basic EPS will be 10 lakh divided by 1 lakh, which is 10 rupees. Yes or no? Current year, the company gave bonus in the ratio of 1:1. Meaning for 1 share, the company is issuing 1 additional shares as bonus. Okay, the company had 1 lakh shares already. On this only bonus will be given. No, that means what will be the number of equity shares in the current year? What will be weights in the current year? 1 lakh plus 1 lakh, which is 2 lakh. So why no weights? 1 lakh shares is there from the beginning. No, so that means 12 by 12. Even on this bonus 1 lakh, you will assign the same weights, that is 12 by 12. Even if you assign the weights, it will be same answer, no, sir. 1 lakh into 12 by 12 if you do, plus 1 lakh into 12 by 12 if you do, it's the same answer, no? Hence that just directly written over here. Okay, so the weighted average number of equity shares in the current year has become 2. So if you calculate the BEPS or basic EPS, that will be 5 per share. Yes or no? Alright. Now if somebody looks at this number, they will conclude that this is automatically a bad company. Why? Last year basic EPS was 10 rupee. This year it has become 5. That means the earnings per share has reduced by 50% in the current year. So it's a very bad company, is automatic conclusion they will draw to. But you check, has the earnings really reduced by 50%? Check what is the last year EASH? 10 lakh. This year also is how much? 10 lakh. Earnings is same. Only due to this bonus shares issue, your EPS is getting reduced from 10 to 5. Yes or no? Hence they said don't give this data, because normally in your financial statement, not only you give current year data, you give previous year data for comparison purpose. So if you give this data for comparison purpose, then there will be lot of hoopla and lot of buzz around in the market. On the share price will fall drastically because EPS is straight away reduced by 50%. Hence what the standard says is, whenever bonus issue has happened, you need to restate your EPS. You need to give a restated EPS of the previous year. Now how do you calculate that? EASH is still 10 lakh only. Okay. Think that the bonus shares, simple way to do that is, think that the bonus shares happened in the last year only. That means the number of shares has become, you will take it as 2 lakh and rework your EPS. How much will be EPS now? 5 only. Okay. Think that the bonus has happened. One simple way to remember is, think that the bonus has happened in the last year only and work out your EPS. That is what we mean by restated EPS. Because due to now bonus shares, there is no impact on your earnings. So that means there should not be any impact on your EPS also. So that's the reason. Alright, so we are doing this restatement so that you will get the right picture. Okay, that's all we need to, that's the logic of it. But the thing that you need to remember is, whenever there is bonus shares, you need, not only you need to calculate current year EPS, but also you need to restate previous year EPS. The simple way to do that is, think that the bonus issue has happened in the previous year itself and work out your EPS, you will get the number. So that's about the bonus issue. Alright, next is the right shares. So what do we mean by right shares? Right shares means additional shares given to existing shareholders, but this time not at free of cost, but at a discounted price compared to market price. Right shares means additional shares given to existing shareholders at a discounted price. Let's say the market price of the share is 150. Okay. The company is telling the existing shareholders, hey existing shareholders, I'll give you one option. If you want, you can buy more shares from me. The company is telling the existing shareholders, if you want, you can buy more shares from me by paying 120 rupees. Okay, meaning they're giving 20% discount. Okay, this is the rights ka exercise price. Alright, so when the option is given by the company to the existing shareholders to buy the shares at a discounted price, face value of the share is 10 rupees. Okay, alright, don't say Companies Act prohibits the shares to be issued at discount. What Companies Act says is no shares shall be issued at a price below the face value. Here we are not issuing the shares at a price below the face value. Right shares means when we say right shares are given at discount, the discount is from market value perspective. Okay, alright. Since the right shares are issued at discount, okay, since the right shares are not given at market price, rather there is a discount element, even right shares will also have some bonus element. In detail, my logic I've explained it to you in the regular class. For now, we'll just consider this. Right shares also has a bonus element because you're not giving the right shares at market price, you are giving it at a discount option. Hence, whenever there is a right shares problem, no, if at all they give right shares problem, indirectly there is a rights issue also, there is a bonus issue also, because right shares will always have an element of bonus. Here what you need to calculate is, you need to calculate something known as TERP, that is theoretical X right price per share, that is you can call it as TERP, that is nothing but average price. Okay, so how do you get that? Value of the shares before the rights issue, or the fair value of the shares before the rights issue, plus value of the right shares divided by number of shares before the rights issue plus number of right shares. If you do that, you're going to get the average price. Not only we call it as theoretical X right price per share. Okay, and just now I told you that right shares also has an element of bonus. To find out that bonus element, we find something known as adjustment factor or AF. That is given by fair value of the shares before the rights issue, fair value per share before the rights issue, divided by TERP, as in theoretical X right price per share. If you do this, you will get a number. Normally, this adjustment factor, it has to be greater than 1. It could be 1.01, 1.05, 1.25 like this. Okay. That adjustment factor, how to check whether your adjustment factor is right or not, or are you solving in the right direction or not? Adjustment factor has to be greater than 1. Why? So now one share is not worth 1 anymore. That because of right shares, there is some bonus element. Okay, if you say one share, if you get adjustment factor to be 0.1, that means what? That 0.1 represents your bonus element. Hence, adjustment factor should always be greater than 1. If you're getting a number lesser than 1, somewhere calculation may you have done a mistake. So there itself you can stop and check and then proceed. Okay, that's one way to remember. And then adjustment factor, you have to multiply it to the existing number of shares to get the weights purpose. And since this adjustment factor represents bonus element, and we know whenever there is bonus shares, previous year ka EPS also we need to restate. Hence, this adjustment factor we need to multiply it to the previous year existing shares also to get the weights for the last year. Okay, let's do a thing. Let's work out one problem on rights issue to get our understanding a little better. Let's take up this particular question. Following information is available for the company for 2 years. You need to calculate basic EPS, BEPS. Net profit for the year 12-13 is 25 lakh. For 13-14 is 40 lakh. So 12-13 is our previous year. 13-14 is our current year is what they have given. So both the years ka net profit they have given. So when they say net profit, actually it is profit after tax. Okay. So what do we want for our EPS calculation? We want each as an earnings attributable to equity shareholders, and that is given by profit after tax minus preference dividend. Okay, normally in these sort of problems, preference dividend adjustment and all will not be there, but once you can also have a look through of that. Okay, if preference dividend is not there, then this only will become PAT only will become each. Okay. Number of shares outstanding prior to rights issue was 12 lakh. Before the rights issue, the company already had 12 lakh shares is what they say. Rights issue, one new share for each 3 outstanding, that is 4 lakh shares. They are saying the rights issue is given in a certain proportion. Okay, in certain ratio. They are saying 1 share for every 3 outstanding. If the shareholders, if they are already holding 3 shares, if the shareholders are already holding 3 shares, then they are eligible to buy 1 right shares. If they are already holding 3, they are eligible to buy 1 right shares. That is what they are telling, not me. Do we have only 3 equity shares in our balance sheet? No. Before rights issue, how many shares are there? The company has 12 lakh shares. That means how much will be the right shares? So the number of right shares will be what? 12 lakh into 1 by 3, which is 4 lakh shares. That is what they have given over here. 4 lakh right shares is being given. We know right shares will not be given at free of cost. Company will charge some money. So that rights issue price is 22 rupees. Company on each right shares, the company is collecting from the shareholder 22 rupees. Okay. Last day to exercise the right is 30th June. So since they have given 13, 14, 12, 13 year and all, so that means current year, if you say, current year starts from 1st April 2013 and ends on 31st March 2014. So last day to exercise the rights is 30th June, meaning in the current year, 3 months are already over. On the end of third month, rights issue the company has come out with. Fair value of one equity shares immediately prior to exercise of rights is 28 rupees. So fair value of the share before the rights issue. Fair value of one share before the rights issue is 28 rupees. Okay. With this, you need to work out the basic EPS. Simple thing. First, we need to calculate the average price. That only we call it as theoretical X right price per share. You can work out this on a one share basis or a total basis. The answer will be same. I'm going to show you at one share basis. Now, sir, to get right shares, how many minimum shares you need to own? 3 rupees. Yes, to get right shares, minimum you should own 3 shares. Otherwise, you will not get. Okay. This is the number of shares. What is the price of each share before the rights issue? 28 rupees. So the value of one share is 28 rupees. How much is the value of 3 shares? That you will get the first component of your numerator. That is what? Fair value of the share before the rights issue. Fair value of the shares before the rights issue. If you don't want to take it as 3, you can always take it as total number of shares also. So total number of shares in this problem will be 12 lakh. Instead of 3, you can work with 12 lakh also. You will get the same answer. Answer will not change. Plus we need what, sir? Value of right shares. If you own 3 shares, how many right shares are you eligible to buy? 1 is what they are saying. We don't want the number of equity shares in the number of right shares in the numerator. We want the value. What is the value or the price the shareholders needs to pay if they want to buy right shares? 22 per share. That is the rights exercise price. If you do this, you're going to get the value of right shares divided by number of shares before the rights issue, which I have taken it as 3, plus number of right shares, which is 1. If you don't want to take 3, instead of 3, you can substitute with 12 lakh. Instead of 1, you can substitute with 4 lakh. Why 4 lakh? 4 lakh is the right shares. That way also you do it, answer will be same only. So if you do this, you're going to get the theoretical X right price per share to be 23. These are 84. 84 plus 22 divided by 4. If you do, I'm getting the theoretical X right price per share to be 26.5. This is the first step. Okay. Alright, our average price. Another way to check whether you are in the right direction is this theoretical X right price per share should always be lesser than the value of the share before the rights issue. What was the value of one equity shares before the rights issue? 28. TERP should always be a number lesser than 28. If you are getting a number higher than 28, you are somewhere in your calculation you have done wrong. So why should it be lower? Normally, companies is issuing the shares at right shares at a discounted price. Okay, they have received the money. For what purpose the company is going to utilize this money is little unknown. Hence, theoretically we say, whenever company comes up with a rights issue, the value of the share will fall down. Whenever company comes up with the rights issue, the value of the share, the price of the equity share will fall down, at least theoretically. Practically what happens, we don't know, because that is influenced by demand and supply. Theoretically, TERP should be number lesser than the fair value of the share. That's how to check. This is our first working mode. Next, we need adjustment factor. Adjustment factor is given by fair value of the share before the rights issue. The value of one equity shares before the rights issue is 28 divided by theoretical X right price per share. So 28 divided by 26.5, if you do, I'm getting 1.0566. I'm going to stick to 2 decimal point. So adjustment factor includes the bonus element. Hence, it should be a number greater than 1. I've got 1.05. Okay. Now the third point is your calculation of basic EPS. Excuse me. Since this right shares element also includes a bonus element, we need to restate previous year EPS also. That means we will calculate the EPS both for the current year as well as for the previous year. Current year, that is what? 2013-14. And then previous year, that is 2012-13. To calculate EPS, we only require few things, sir. Only 2 components. What are the 2 components we need? One, we require EASH, earnings attributable to equity shareholders, and then we require weights. That's all. With these 2 numbers, you can work out your basic EPS. Okay, each they have only given. For current year, we read the whole problem. There is no preference dividend. That means profit after tax itself will become each. Previous year it is 25 lakh, current year it is 40 lakh. Current year 40 lakh, previous year 25 lakh. So that's the number. Wage. How do you calculate wage over here? Okay, now just check. We'll do it first for the current year. Current year means, just for reference, I'll write the full year. 1st April 2013 it will start and it will end on 31st March 2014. So when did the company come up with rights issue? They came up, last day to exercise the rights is 30th June. That means, can I say from 1st April to 30th June, that is April, May, June. For 3 months, the company had 12 lakh equity shares. Number of shares before the rights issue is 12 lakh, they only given. For 3 months, they had 12 lakh equity shares. Yes? Okay. But on this only, the company came rights issue means this includes some bonus element. Because on this only, you would have, right shares includes bonus element. And right shares, bonus shares and all is given only on the original shares, no? So this you have to multiply it by adjustment factor first, because this includes bonus element also. Okay? For how many months 12 lakh was there? 3 months, hence 3 by 12. Then what happened? The company gave rights issue. How many right shares they gave? 4 lakh shares. That means 12 lakh shares will become 16 lakh shares. From when to when? From July 2013 till the end of the year. That is for the next 9 months, the company had these many shares. So work out this. 12 lakh into 1.05 into 3 by 12. If you do, my calculator is showing 3 lakh 15,000 plus 16 lakh into 9 by 12. If you do, and my calculator is showing 12 lakh. So the total will be 15 lakh 15,000 is the weighted average number of equity shares for this particular year. How do you get basic EPS? Each divided by wage. So 40 lakh divided by 15 lakh 50,000. If you do, the basic EPS will be 2.6464 is the basic EPS. Same data we need to work out for the last year also. Okay. Last year the company had 12 lakh shares, but on this only company has issued right shares in the next year. That means that on this only right shares includes bonus element. That means on this shares also there is a bonus element. So here also you need to multiply it by the adjustment factor, because adjustment factor means that includes the bonus element. So if you multiply 1.25 including bonus shares, how many shares you will get? 12 into 1, that 0.05 is the bonus factor. So if you multiply 1.05, you will get the total shares including the bonus shares, like that. This is there for the whole year. Yes, because last year nothing happened. So if you do that, 12 lakh into 1.05, you're going to get 12 lakh 60,000. So basic EPS will be 25 lakh divided by 12 lakh 60,000, which will be 1.98. So this is how you calculate the right shares ka problems. Alright, this is about the right shares. Next is something known as diluted EPS. As I told you, there are two types of EPS, basic EPS and diluted EPS. Diluted EPS means there is a reduction in EPS. Dilution means reduction, yes or no? Why will EPS reduce, sir? Sir, diluted EPS will only come into play if you have something known as potential ordinary shares or potential equity shares. Only if you have POS, that is potential ordinary shares or potential equity shares, only then there is a necessity to calculate diluted EPS. Otherwise, you need not even bother about calculating DEPS or diluted EPS. So what is this potential ordinary shares or potential equity shares? So potential equity shares means those shares, okay, which will eventually get converted into equity shares. Potential equity shares are those shares which will eventually get converted into equity shares. Right now they are not equity shares, but somewhere down the line in future they will get converted into equity shares. So what is the example of this? If you have issued convertible preference shares, convertible debentures, etc., etc. These are all known as POS, that is potential ordinary shares or potential equity shares. Because right now, if you have issued convertible debentures, right now they are debentures, but at some point of time in future, from debentures it will get converted into equity shares. That we refer to as potential equity shares. Only if this is there, diluted EPS calculation is necessary. Otherwise, it is not necessary. Okay. So how to calculate this? This is nothing fancy. So let's do a thing. Let's learn this with the help of a problem itself. Let's maybe take up this particular question. Divakar Limited gives you the following information. From this, compute diluted EPS. Net profit for the particular year is 2 crore. Number of equity shares outstanding is 40 lakh. Okay. Alright. So basic EPS is 5. They only calculate. How do they calculate? There is nothing but each. Okay, since if there is no preference dividend, the profit after tax, net profit means profit after tax, that only will become each. So if you have not issued any additional equity shares, that means what? The number of equity shares will be same as Wayne's. Okay. So Wayne's ka element is important when the company has issued some additional equity shares in the current year, or if they have bought back some shares, etc., etc. If from the beginning till the end of the year, if the company had same number of equity shares, then the weightage will be 12 only. No? You will do 40 lakh into 12 by 12, so you'll get the same number. So the number of equity shares itself will become Wayne's in those cases. Hence, basic EPS is 2 crore divided by 40 lakh, which is 5. Number of 11% convertible debentures. So convertible debentures only we call it as potentially ordinary shares or potential equity shares, because they will get converted into equity shares later on. So 11% debentures means these debentures carry an interest rate at the rate of 11% of 100 each. Each debenture is convertible into 8 equity share. If you have one such debenture, on that one debenture, it will get converted into 8 equity shares. And how many number of debentures we have? This is number, okay? We have 50,000 debentures. We have 50,000 debentures, and on one debenture will get converted into 8 shares. So 50,000 debentures will get converted into 4 lakh equity shares. Okay? Then interest expense on debentures means you will have interest. Okay? So if you just check, we have 50,000 debentures, each ka face value is 100. These are 11% debentures. So 50,000 into 100 into 11% if you do, you're going to get 5,50,000. That is the interest expense. Tax saving related to interest expense, taxes at the rate of 30% is 1,65,000. Why have they given this? Interest is an expense. No? When there is an expense means, because of expense, profit will reduce. If profit reduces means tax also will reduce. That means due to the expense, due to any expense, you will always get some tax benefit. So that's what they are saying over here. Due to this interest, no, you will get a tax benefit of 30%. So 5,50,000 ka 30% if you do, you're going to get 1,65,000. Because that is a tax benefit that you're going to get from the interest. So calculation of diluted EPS, how it gets, maybe we'll quickly solve off here. Particulars, basic EPS, dilution adjustment. We used to solve these questions in the same format in we have done 7-8 problems in a class. So we have kept the same format. So here also I'm trying to keep the same format. Why you are keeping BEPS, sir? They've only given some problems. They will not give you basic EPS and they'll expect you to calculate basic EPS and diluted EPS. That's the reason I'm doing. Okay, to calculate EPS, you only require 2 things. What are those? One, you require EASH, that is earnings attributable to equity shareholders. Next, you require weights. Then you will be able to calculate your EPS. EPS is nothing but 1 divided by 2. Okay. Alright, basic EPS data they have only given. Net profit is 2 crores, or I'll write it as 200 lakhs, and the number of equity shares is 40 lakhs. So 200 lakhs divided by 40 lakhs, your basic EPS is 5. Okay. Now diluted EPS means what are we trying to calculate here is, see, you have debentures now. What is diluted EPS trying to calculate is, if these debentures get converted into equity shares. If these convertible debentures get converted into equity shares, what will happen to your EPS? Your EPS will not be 5. It will change. That only is what we are trying to calculate in the form of DEPS. If this potentially ordinary shares or this potential equity shares, if they get converted into equity shares, what will happen to your EPS? That effect we are trying to call out over here. Okay. Now check. If this particular convertible debentures, if they get converted into equity shares, should we have to pay interest on those now? As long as you have debentures, you need to pay interest. If debentures get converted into equity shares means, is interest necessary? No. That means there will be savings in the form of interest. When expense will reduce means your profit will increase now. That means more earnings will be available for equity shareholders now. Because when expense reduce, so profit will increase. But just now we proved, due to the expense, you will also get some tax benefit. So if the expense is not there means, profit will increase. So that means corresponding tax also will increase. That's the reason you should always take here, not just the savings in interest, you should always take interest into 1 minus tax rate. After tax benefit only you need to take. Okay. Alright, how much is the interest they've only given in the problem here? 5,50,000 into 1 minus tax rate. Tax rate they told is 30%. Okay. 30% tax benefit also on that interest you will lose out, no? Because if interest is not there, that 30% tax benefit on interest also you will lose. That means what is essentially net benefit are you getting? Only 70%. That is what we are about to calculate here. 5,50,000 into 0.7 if you do, that is 3,85,000. Okay, that is what they have given here as tax saving interest. If you do 5,50,000 minus 1.65 lakh, 5,50,000 minus 1.65 lakh if you do, that is nothing but 3,85,000. That's what we got over here directly. In many problems they won't give you tax saving and all. In this problem they have given, hence I have worked out in the normal format. Okay, so if interest is not there, means your profit will increase. So this is your dilution adjustment. So that means for diluted EPS, each will be these two ka addition, 2 lakh or 200 lakh plus, or I'll write it in this only, 3.85 lakh I'll write. So that it will be easier to present. 3.85 lakh. That means what will be your each for diluted EPS purpose? These two addition, which will be 203.85 lakh. That is your the each for your diluted EPS purpose. Because if interest is not there, obviously earnings for equity shareholders will increase. So it will increase by 3.85 lakh. Hence the earnings has become 203.85 lakhs. Okay, that is the impact on your numerator. Correspondingly, there is an impact on denominator also. What is that? If you convert the debentures into equity shares, then will the number of equity shares still be 40 lakh? No, that will also increase. You have 50,000 debentures and each of them get converted into 8 equity shares they said. That means how many additional equity shares you need to give on conversion? 4 lakh. That means the number of equity shares will not be 40 lakh. It will increase by 4 and it will become 44 lakh. Now with this number calculate the EPS 203.85 divided by 44. If you do, I'm seeing 4.63. Check. Earlier, how much is what? It was 5. Now it has become 4.63, meaning EPS has reduced. That only we call it as diluted EPS. Okay, this is the funda. So suppose you have convertible preference shares, what to do? If you have convertible preference shares, same drama. Denominator and all will be the same working. Numerator mein, on interest you get tax benefit. Hence you do 1 minus tax rate. But on preference dividend, see if preference shares get converted into equity shares, then you don't have to pay preference dividend anymore. That means there will be savings in the form of preference dividend. So that preference dividend straight away you take. You don't have to do 1 minus tax rate because only on interest you get tax benefit. Because interest is a charge against profit. Dividend is appropriation of profit. Meaning after paying tax to the government only, then only you will declare dividend. So on dividend we will not get any tax benefit. So how much ever is a dividend? Let's say preference dividend is 5 lakh. Straight away here you write 5 lakh and do your calculation. That's the difference between convertible debentures and convertible preference shares. So this is about your AS20 earnings per share. Alright, moving on. The next topic is accounting standard 22. That is accounting for taxes on income. Now, what is the background behind this standard is? Okay. So accounting profit and taxable profit will not match. There will always be a difference. Accounting profit, meaning the profit that you see in your P&L, no, that we call it as accounting profit. That profit and tax profit means the profit calculated as per Income Tax Act of 1961. Those two will never match. There will always be a difference. Okay, to plug those differences or to fill in these differences, AS22, Accounting Standard 22 was introduced. Okay, so why will they differ? So accounting profit is calculated by keeping in mind the accounting standards, Companies Act ka provision, our institute ka guidance note, etc. etc. These things are considered for your P&L wala calculation, for your journal entry, accounting, disclosure, preparation of P&L. We consider these components. Okay, Companies Act, accounting standard, etc. etc. But to find out taxable profit, we have to apply Income Tax Act of 1961 ka provisions. Excuse me. There are many areas for which the accounting profit, the provisions are different. There are many areas where Income Tax Act will say one thing, accounting standard will say something else. That is the reason these two will not match. There will always be some differences. Okay. So to plug this only, we have AS22. That's the first thing. Then there could be, broadly, there are two types of differences. Due to two differences, your accounting profit, taxable profit will not match. One is known as temporary difference or also known as timing difference. Temporary or timing difference. So what is this? Temporary differences are those differences which come in 1 year or which come in 1 year and get reversed out subsequently. It will arise in 1 year and get reversed out subsequently. Okay, the differences could be on year-on basis, but at a total level it will be same. The example is depreciation. Okay, like if you know, like Companies Act, does not give you any. Companies Act of 2013, they don't give you any rate of depreciation for fixed assets or property, plant and equipment. They say the companies, you depreciate based on the useful life. If you are using it for 4 years, then you depreciate the asset for 4 years. If you are using the asset for 5 years, then you depreciate that asset for 5 years. That is what Companies Act says. Okay, even accounting standard, the 10 also does not give you any method. Okay, alright, it says you depreciate based on the benefit that you are getting from asset. Okay, but rate of depreciation, neither the Companies Act nor accounting standard 10, which talks about fixed asset, they don't provide. Okay, but if you check Income Tax Act of 1961, for each asset, for each fixed asset or property, plant and equipment, they have specified the rate of depreciation. So to find out taxable profits, you always have to consider depreciation and depreciation rate as called out in Income Tax Act. But for accounting purpose, there is no rate. Hence, year on year, there could be differences. Like here, if you just check as per accounts and as per tax, year 1, year 2, year 3. Okay, as per depreciation, in the first year accounts ka depreciation maybe 1 lakh, here it may be 80,000, here it may be 40,000. Okay, like this, or maybe I'll make it as 20,000. That means the total will be 1 lakh. But if you just, since Income Tax Act gives a rate of depreciation, if you calculate, it may not be the same number. It may be, let's say, here it may be 1 lakh, here it may be 70,000, here it may be 30,000. Quite possible that there could be some differences. Or maybe I'll just make it a slightly different. 80, 70 and 50 in 2 lakh. Okay, again that could be anything. I'm just giving you a random example. Okay, it could lead to this scenario, meaning year on year, if you just check depreciation as per accounts, here it is 1 lakh, here it is 80. There is a difference. Here there is a difference. Yes, here there is a difference. Yes, year on year there is a difference, but if you just check the total level, they are same. So these are temporary differences, meaning year on year there will be some differences, but later on at the end of the year, all those differences will get sorted out. If these are the differences, means we call it as temporary or timing differences. And only for temporary or timing difference, AS22 we will apply. Okay, only to plug this temporary difference, AS22 we apply, and that plugging is done by creating either a deferred tax asset or a deferred tax liability. To plug these temporary difference, we either create DTA or a DTL. Okay. What about permanent differences? Permanent differences means they are those differences which will arise in 1 year, but they will not get reversed out subsequently. Meaning the difference will always be there because the provisions are entirely different. One of the examples, if you just check cash disallowance under section 43A of Income Tax Act of 1961. They say, as per Income Tax Act, if you pay cash to a single person on a single day for an amount exceeding 10,000, it will be disallowed. Meaning as per tax record, you cannot claim this 10,000 as an expense. Because in Income Tax Act, they are trying to curtail the cash transaction as much as possible. Because more of cash transaction will lead to black money. Yes. So to curtail that, they have brought in all this concept. So if you pay on a single day to any person cash exceeding 10,000, that will be disallowed. But there is no such provision in our accounting standard or Companies Act. So in company, as per our normal books, as per our P&L, even if you pay 50,000 cash to any person, you will still pass the journal entry. Expense account debit to bank, P&L account debit to expense. That entry you can pass in accounts. But the same entry or the same component you cannot consider in tax because it is disallowed. So these are permanent differences. No matter what you do, you cannot sort out this. Okay. So for permanent differences, no DTA or DTL is required. Only for temporary or timing differences, we plug these differences by creating something known as DTA or DTL. Okay. So when to know we should create DTA or DTL? That is what I've given a small equation. We applied this in our classes also in many problems. Simple way to remember this is check. If the expense as per tax is more, if the expense as per tax record, if it is more, now we have two records, accounting records, tax record. Compare the tax records with accounting records. First we are doing expense comparison. If the expense as per tax record is more means, okay, higher the expense, what will happen to your profit? If the expense is more means taxable profit will be less. Yes, based on taxable profit only, the companies are expected to pay tax to the government. If taxable profit is less means the tax that the company has paid in the current year is also less. If taxable profit is less means the tax paid in the current year is also less. But these are temporary differences, meaning the differences will get sorted out later on. In the current year, you might have paid less tax, but in the future year, you have to pay more tax. In the future May, you have to pay more tax because these are temporary differences. Since in the future, you have an obligation to pay more tax, you create something known as a deferred tax liability, meaning you are liable to pay more tax, hence a DTL. Like that. One, if you know, all other equations you can drive on your own. Like next one is ulta. If the expense as per tax record is less, as per tax record, if the expense is less, then profit as per tax record is more. If taxable profit is more means based on taxable profit only you will pay tax. That means the tax paid in the current year is also more. But these are temporary differences. It will get sorted out. Current year you might have paid more taxes, but in the future year you will pay less tax. Okay. Alright, in the tax in the future year will be less, meaning you have already paid some tax in advance, prepaid tax it is. Okay, that is the reason you will create deferred tax asset. Okay, you will be able to get some benefit out of this, hence it is a deferred tax asset. Like that. Okay, similarly, income also you can define. If the income as per tax record is less, if the income as per tax record is less means taxable profit as per tax record is also less. Tax paid in the current year is also less, but these are temporary difference. So the tax payable in the future years will be more. You have an obligation to pay more tax. Hence you will create deferred tax liability. That's how to identify whether you need to create DTA or DTL. This is a question that gets often asked in the examination. Creation of DTA or DTL. Let's maybe learn it or apply it in one of the problems as well. First question from study material itself. Excuse me. Rama Limited has provided for the following information. Excuse me. Depreciation as per accounting records is 2 lakh rupees. Depreciation as per income tax record is 3 lakh rupees. Okay. Once I will read out the data. Unamortized preliminary expense as per tax record is 30,000. There is adequate evidence of future profit sufficiency. How much a DTA or a DTL, as in deferred tax asset or deferred tax liability, should be recognized? The tax rate is 50%. Okay. We'll do that analysis just now we did. First, for depreciation, 2 components they have given over here. Always compare accounting expense with tax income or tax expense with accounting income. Like that you do the comparison. Meaning, how much is depreciation as per tax? Depreciation as per income tax is 5 lakh rupees. As per accounts, how much is it? 2 lakh rupees. I mean, compare. Depreciation as per tax is 5, as per accounts it is 2. That means depreciation as per tax record is more. Meaning expense as per tax record is more. If expense as per tax record is more means what will happen to your taxable profit? Higher the expense, lower will be your profit. That means the taxable profit will be on the lower side. What will happen to tax paid in the current year? If your taxable profit is less means the tax that you paid in the current year is also less. But what about future mean? These are temporary differences. The differences will arrive year on year, but at total level they will be same, meaning they will get sorted out in future. So current year you might have paid less tax, but in future year you have to pay more tax. Hence, what do you need to create for this? You need to create deferred tax liability. Okay. So how do you create deferred tax liability? Check what is the difference. As per income tax, the depreciation is 2 lakh. Here account mate is only 2 lakh. So what is the difference? The difference is 3 lakh. On the differences, we don't create DTA or DTL. By differences, we are trying to plug here taxable differences. AS22 is trying to plug taxable differences. So we don't create DTA, DTL on the difference. On the difference, you multiply by the tax rate. The tax rate is 50%. Okay. So multiply it by 50% to get the amount of DTL. So that means here you will create a DTL of 1,50,000. That is what they have given over here. DTL you need to create for 1,50,000 due to first adjustment. That is depreciation. These two we have considered. Alright. The next one, unamortized preliminary expense. Sir, unamortized means that expense has still not gone to P&L. If expense has gone to P&L, we say it is fully charged. If some part of the expense, if it is still yet to be transferred to P&L, that we say, then we use the term unamortized. Amortized means transferred to P&L. Unamortized means yet to be transferred to P&L. So what have you not transferred to P&L? One expense, that is preliminary expense. Unamortized preliminary expense as per tax record. Only as per tax record that expense has not gone to P&L. Did they say even in accounts it is amortized? Unamortized? No. That means what? In accounts, entire amount you have transferred to P&L. As per tax, you have not transferred full amount. You have only transferred a little bit. 30,000 of the expense is still yet to be transferred. Why is this? This is backed by Section 35D of Company Income Tax Act of 1961. What Section 35D of Income Tax Act of 1961 says is, if you have any preliminary expense, meaning those expense which you have incurred for floating the company, for incorporating the company, that only we refer to as preliminary expense. So preliminary expense has to be transferred to P&L not in one shot. As per Section 35D, you have to transfer preliminary expense over 5 years or equally over 5 years. If you have incurred 1 lakh preliminary expense, entire 1 lakh you cannot transfer it to tax ka P&L. Only what? 1 lakh you have to amortize over 5 years. Meaning 1 lakh divided by 5 if you do, you're going to get 20,000. Every year you will transfer 20,000 to your P&L. Like this you will do it for 5 years. This is the provision that is there in Income Tax Act, that you have to transfer or amortize over 5 years. In accounts there is no such provision. Okay, if you have incurred a preliminary expense this year, entire expense can be transferred to accounting P&L this year only. How much ever preliminary expense you have spent, okay, how much ever you have incurred, entire amount you can transfer to P&L as per accounts. But as per tax, you have to transfer it over 5 years. So this is the difference. Because of this, there will be some differences. These are temporary difference only. Why? In accounts, you transfer the entire expense in first year. In income tax, you will transfer it over 5 years. That means what? By the end of 5th year, accounting record and tax record will show the same data. Entire preliminary expense would have gone to P&L. But in accounts, it has gone in one shot, in 1 year itself, first year itself. But as per tax, it has gone to P&L over 5 years. So hence, year on year, there is a difference. But at total level, it is same. Hence, to plug this, we need to create DTA or a DTM. Okay, let's say to match out this, they're saying 30,000. No? That means it will be what? 30,000 into 4 by 5, if I do 37,500. Okay, let's say total, just to prove it, I'm just taking this. Total preliminary expense, let's say, is 37,500 rupees. Why have I taken 37,500? I'll tell you. Let's say total preliminary expense incurred is 37,500. Now let's see what happens in accounts and what happens in tax. Company, to start a company, you have incurred a preliminary expense of 37,500. What journal entry you will pass in accounts? You will pass the journal entry preliminary expense account debit 37,500 to bank account 37,500. This is the first journal entry you will pass. Preliminary expense, all the expense will be transferred off to P&L. So second journal entry you will pass is P&L account debit to preliminary expense, entire amount 37,500, 37,500. Is it okay? Alright. That means what is the expense as per accounting record? The expense as per accounts is 37,500. Alright. Because entire amount you have transferred. But can you do the same treatment in tax record also? No, that is not permissible. Why? As per Income Tax Act says, that is 35D says, you have to amortize preliminary expense over 5 years. That means what will be the expense as per tax record? Expense as per tax record in the first year I'm talking about. In the first year, expense as per accounts is 37,500. How much it will be as per tax? Entire 37,500 you cannot transfer to first year P&L. You have to amortize this over 5 years. So 37,500 divided by 5 if you do. First year ka expense is only 7,500. Are you able to get it? That means, is there any difference? Yes, there is a difference. How much is the difference? 30,000. That is what they are trying to say over here. Unamortized preliminary expense as per tax record is 30,000. Okay. Unamortized means in tax may only 7,500 has been transferred to P&L. But in accounts may 37,500 has been transferred. So how much is yet to go to P&L as per tax record? How much is yet to go? In 37,500 only 7,500 has gone. How much is yet to go? 30,000. Okay, that is what they say. Hence they use the term unamortized. Alright. On this, what you have to do a simple check. Expense as per tax record is 7,500. As per accounts it is 37,500. That means expense as per tax record when you compare it to accounts is less. Yes, it is only 7,500. Here it is 37,500. So expense as per tax record is less means profit or taxable profit will be more. That means the tax paid in the current year also will be more. Yes, but these are temporary difference, so it will get sorted out. So current year you might have paid more tax, but in the future year you will pay less tax. That means what? You will get some tax credit. So you will get deferred tax asset on this. Okay. How much is the difference? Not only they are saying it is 30,000. On the difference will you create DTA? No. We created on the taxable difference. So multiply difference multiplied by the tax rate you do. That means it will be 15,000. Okay. So this will create a DTA of 15,000. Normally what you do is both DTA and DTL we will not create. We will just check. We'll compare and net it off. Which is higher among this? DTL is 1.5, DTA is 15,000. That means DTL is higher. So net deferred tax liability will only create it for 1,35,000. Okay, we'll net it off and create whichever is the component is the higher one. That is what they're trying over here. Net deferred tax liability is 1,35,000. That's how the calculation of these things work. This is quite important as far as the examination is concerned. They will take this, they will give you various expenses. You just need to figure it out whether you need to create DTA or DTL. That's pretty much the scope of this particular standard. Okay. Alright. Next, if you have any carried forward losses, then you will always create deferred tax asset on that. So what do we mean by carry forward loss? Let's say first year, no, the company, they made a loss of 2 lakh rupees. First year they made a loss of 2 lakh rupees. See, if company makes profit means on that profit they have to pay tax to the government. If company makes any profit, means on that profit they have to pay tax to the government. Suppose a company makes loss, will the government pay tax to the company? No, that will not happen. Yes, if that happens means everyone will start showing losses and unnecessarily they will start showing huge losses and try to recover the money. Okay, this is not the concept that is built. So what it is only when on the loss you will get benefit. What benefit you will get is, let's say second year you made a profit of 10 lakh rupees. Let's say tax rate is 30%. Okay, first year you made a loss of 2 lakh. Second year you made a profit of 10 lakh. Now normally on profit you have to pay tax. Second year, government will not expect tax at the rate of 10 lakh into 30%. 3 lakh tax you need not pay to the government. What they will give you is, they'll give you some benefit. Last year you made loss, no? What they will say is, set off this loss or adjust this loss from current year ka profit. From 10 lakh rupees, you will adjust previous year ka or years ka loss. Okay? Only on the balance. Balance is how much? 8 lakh. On that only you have to pay tax, meaning you have to pay only 2,40,000 tax. Okay, that's how this we call it a set off and carry forward of losses. You would have studied in your Income Tax Act subject. Yes. Alright. So if you have such carried forward loss, you will always create deferred tax asset, because due to this loss, tax in the future year will get reduced. You will pay less tax in the future. So it's like a prepaid tax element. Hence, since tax in the future year will get reduced, on carried forward losses, you will always create deferred tax asset. Okay. Then there is something known as current tax. Current tax means you pay tax on the taxable profit, right? On taxable profit, if you multiply tax rate, you will get that tax amount, no? That only we call it as current tax. On taxable profit, if you multiply tax rate, that you will get the current tax. That is actual tax which the company has to pay to the government. Alright, fair enough. Then there is also deferred tax now. We have deferred tax also. Yes. So we have something known as a tax expense. Tax expense is nothing but current tax plus deferred tax. Okay, meaning some portion of the tax company has paid it this year, some they have deferred it. Hence, if you add both the things, current tax plus deferred tax, eventually you will get the tax expenses. Again, these are not that important, but yeah, good to know. All right. So this is the scope of this particular topic, AS22. Alright, moving along. The next topic is AS24, that is discontinuing operations. AS24, that is discontinuing operation. Now, what is the funda of this standard is? Let's say one guy, Mr. X, he has a 10 lakh rupees with him. Okay, he has 10 lakh rupees with him. He wants to invest. Okay, he has some surplus money which he wants to invest. He has one funda. He wants to invest this 10 lakh rupees into those companies which are into steel. Whichever company produces steel, no, he wants to invest in that company because he feels lot of infrastructure development activities are happening. Government is constructing a lot of roads, flyovers, bridges, etc. To construct all this, we require steel. Hence, the companies which are manufacturing steel, their share price will increase too much. That is his thought process. So hence, he wants to invest this 10 lakh rupees into those companies which are into steel manufacturing process. Okay. All right. He came upon one famous company, that is Tata Limited. Yeah. Tata Steel is actually a different company. For simplicity's sake, let's take it like this. Let's say there is Tata Limited, the main company. Let's say Tata Limited has let's say a few divisions. One is TCS, software division. They have a software division, and let's say they have FMCG division, fast moving consumer goods division. Okay, then they are into cars, and let's say they are into steel. They are into a lot more. For simplicity or just for the sake of example, I'm taking this small, this illustration, that's all. Okay, let's say Tata company they have 4 divisions: software, FMCG, car, and steel. Okay, all right, let's say 40%, 30%, and 15%, meaning 40% of Tata ka revenue comes from software, 30% is from FMCG, car ka is 15, steel ka is 15. That is the revenue breakup I've given. All right. Okay. So now this Mr. X is thinking, should he invest in this Tata Limited ka share, because they are also into steel. All right. Let's do a thing. Let's say Tata Limited decided to discontinue steel operation. They decided to discontinue or stop steel ka activity because they feel it's too much headache. Government is interfering too much. Okay, so this is not worth it. So hence they want to stop the steel business. Okay, all right. Now, do you think if this Tata Limited is planning to discontinue, if this information, if this discontinuing information, if it is given to Mr. X, Tata Limited is planning to discontinue. I'm just giving an example. They are not, okay? Alright. If this information, if it is given to Mr. X, do you think he will invest this money in Tata Limited ka shares? No. Why? Because his funda is very simple. Whichever company is into steel, he wants to invest. Now, Tata Limited wants to discontinue the steel operation. So, obviously, he will not choose this. He may choose a different company. Yes or no? Correct? So, that is the intention of this particular standard. If any company, if they are planning to discontinue any of their operation, any branch, any division or any of their operation, if they are planning to shut down or stop, that information has to be given to the shareholders, because using this information, shareholders can take their decisions much more effectively. That is the background behind the standard. Okay, this is just a disclosure standard, nothing to do with accounting. Alright. So first, what is discontinuing operation, or we can call it as a DO for our class purpose. DO means discontinued operation, means any division or any component or any branch that the company through a single plan, a particular division, if the company is planning to sell it off. Discontinued operation means what? Any branch or division which the company is planning to sell off. The whole division they are planning to sell off in one go. If that is the case, means it is a discontinued operation. The whole division getting sold off. Or the whole division getting terminated by abandonment. Abandonment means simply stopping the work. They don't want to sell that division. They felt, to hell with it, let it be like that only. Abandoned. Okay, we've left it off. Okay, so that is another thing. That is also known as discontinuing operation. Or selling the assets and selling the assets of the division separately and settling the liabilities of the division individually. That is also discontinuing operation. So discontinuing operation means a branch or division which is getting sold off. The whole division sold off in one shot. That is one. Or a division ka asset sold separately, and using that money, division ka liability settled separately. That is also discontinued operation. Or you have just abandoned that particular branch or division. Those are all your discontinuing operations. Okay. Alright. But in order to call some operation or some division as discontinuing operation, it should be a major line of product or major geographical area of operation. It should be a major line of business or major geographical area of operation, like here. Now, Tata Limited, okay, 15% of their revenue is coming from steel. Is it a small number? 15% of revenue is coming from steel division. Is it a small number? No. That is what they're trying to say. This should be a major line of operation. Meaning from this particular division, you should be getting some major chunk of revenue. What is major? They have not defined it in percentage. You have to use your judgment there. Okay. So 15% obviously is by no account a small number. So that will be considered as a major line of business. Okay. Or it should be a major geographical area of operation. Meaning, let's say there is one company A Limited. Okay. They operate in, let's say, India, US and Japan. Okay. From India division, they get 70% revenue. From US, they get 10% revenue. From Japan, let's say they get 20% revenue. Okay. One product, no, they are dealing in 3 different countries, or they are selling in 3 different countries: India, US and Japan. This Japan ka division, they are not getting government support, let's say, from Japan. Hence they thought, okay, we'll stop selling our product in Japan. So Japan ka unit, they have a branch in Japan or division in unit which they want to discontinue or stop due to whatever reason. All right. So is it a discontinued operation? Yes. Okay. All right. It's the same product. Let's say company is manufacturing one product named product X. They're not discontinuing this product X. They're selling this product X in 3 different countries. Are they stopped dealing with this product X? No. Product X is still going on. But geographical operation of this product X in Japan, that they are stopping. That is also a discontinued operation only. In order to call a division as discontinued operation, it should be a major line of product. One product should be discontinued, or one major geographical area should be discontinued. Geographical area means, so how it is major? So major chunk of revenue should be coming from that particular area. What is major? Again, is a judgment based thing. Okay. And also operationally and financially, that operation or the division you should be able to distinguish from the others. Operationally and financially, you should be able to segregate or separate that division. Okay, how you can operationally segregate? No, obviously, if you have a unit in Japan, the Japan ka unit is obviously different from India and US, no? Because Japan and unit will have its own employees, will have its own factory, yes, will have its own process, yes. So if you have all this, if you have a separate process, separate manpower, etc., operationally it will get distinguished. Similarly, it should also be financially distinguishable. Financially, it should be distinguishable. How it can be financially distinguishable? You should be able to clearly tell from that particular division which you are about to discontinue, how much revenue you are getting, how much cost that division incurs. That division has how much assets, how much liability, all this data relating to that division you should be able to identify. You have maintained it and you are able to identify. These are there, then it comes under the ambit of AS24, that is discontinuing operation. Meaning if there is discontinuing operation, AS24 says you need to give some disclosure, which we will talk about it. Okay. So first, to give some disclosure, first you need to conclude whether it is a discontinuing operations or not. Okay. Alright. Then we saw what is discontinuing operation. Some activities need not be taken as or need not be considered as discontinuing operation. What are those? Gradually phasing out a product line or structure. Okay, or one product or service gradually if you are phasing out, okay, then it is not discontinuing operation. Meaning, now let's say the latest version of iPhone could be 13 or 14 or whatever. Okay, now in this year, do you think Apple, the iPhone manufacturer, will they manufacture iPhone 5, iPhone version 5? Do you think they will manufacture? No, iPhone version 5 has become outdated. That means gradually they have stopped it. Okay, that is not a discontinued operation, because they have moved on to a better version. From iPhone 5, they moved to iPhone 6, 7, like that, they have kept on increasing. Yes or no? So gradually, if you phase out the old products, that is not considered as discontinuing operation. Okay, that is one. Second one, shifting of production from one location to another. Let's say I have a factory in Bengaluru. Alright. Now, due to some reason, the company wants to shift its production facility, let's say from Bengaluru to Hyderabad. Okay, they want to move from Bangalore, they want to shift their factory from Bangalore to Hyderabad. So Bangalore office is obviously being shut down. That is not discontinuing operation. Meaning, shifting of production facilities is not considered as discontinuing operations. Closing down of facilities to achieve cost improvements. If you want to close down a particular division because it is consuming too much cost, okay, and if you want to increase the production, let's say Chennai division is manufacturing 30% of your products. Production capacity of Chennai is 30%. Bangalore, one more production facility is there, that is manufacturing 70%. Okay, the split is 30 and 70. Okay, all right. Let's say Chennai operations you decided to curtail. We thought we'll only manufacture 10% of the goods in Chennai, 90% of the goods we will shift it to Bangalore. So this is again not a discontinuing operation. Meaning closing down of a facility to achieve cost improvements. We feel we want to reduce this Chennai production activity because Chennai is proving to be more costly for us. So to achieve some cost benefits, if you are moving a production facility or setting it down, then that is also considered not as a discontinuing operation. Alright. Then, excuse me. Alright. So I told you if there is discontinuing operation, the companies just need to give some disclosure. Okay. Now, this discontinuing operation, it's easy to say company shut down an operation. Alright, company decided to shut down. But in case of big companies like Tata and all, if they decide to shut down an operation, that shutting down activity will not just be done in one day or 1 month, because there will be thousands of employees, thousands of creditors, debtors, hundreds of assets, everything you need to sell. You have to settle all your creditors, you have to settle all your employees, and there's a huge drama. Yes or no? Correct? So to do all these activities, it's a very time consuming process. Yes, so today they might have decided to discontinue, but actually by the time they fully completed it, it may be 1 year or 2 years also, sometimes maybe more, we don't know. Yes or no? So when will you give the disclosure? The day you started, or the day you planned for discontinuance, or finally when it gets discontinued? That was the question. Hence they said disclosure. Disclosure means giving some additional information in notes to accounts. You know, balance sheet, P&L, cash flow statement, notes to accounts, all this put together, we call it as financial statements. if any operation is getting discontinued, okay, then you need to give some information about it. You need to disclose that in your notes to accounts. Okay, when should you give that disclosure was the question mark. For that, the standard gives the answer as whenever initial disclosure event happens, IDE. Whenever IDE happens, that's when the disclosure starts, or when the company needs to give disclosure. Okay, so when does this IDE kick in, or initial disclosure event kick in? When one of the following event occurs. When one of the following events occurs, IDE comes into picture. One, when the binding sale agreement to discontinuing operation is entered. Let's say one of the division, the company wants to discontinue, they want to sell it off. Okay, when that sale agreement, when that agreement to sell that division is entered between two parties, on that day IDE kicks in. That is the initial disclosure event. When the binding sale agreement to sell that division or to sell that discontinuing operation is entered, or when the detailed formal plan to discontinue the operation is made and it is communicated. Before the company discontinues, no, they'll make a plan which division to shut down, okay, who are the employees there, how much compensation they will get, yes, okay, to whom we will sell, at what price we will sell, when it will get discontinued, like this and all. You should make a proper plan, and then only you can go and jump into those sort of activities. Yes. So when you make a detailed formal plan about this discontinuing operation, not only making that plan, you also need to communicate it to the respected parties. Okay, all right. Once you make that plan and you announce that plan, okay, that day you can say IDE has kicked in. Once IDE has come into play, disclosure becomes a necessary. Next aspect is a disclosure. Okay, once IDE comes in, you need to give a disclosure. What in all disclosures you need to give? You need to give a simple, what is the description of that discontinuing operation? Meaning you need to give a brief about that operation. Why are you discontinuing it? What is the rationale behind it? Okay, some data you give. Which division is getting discontinued? When it will be finally discontinued? Okay, how many assets does that discontinuing operation or the division has? Okay, all right, how much liability it has? All right, like all this data you need to disclose in the notes to accounts. Along with this, that discontinuing operation ka three components, three financial data you need to compulsorily give. One is profit before tax, another one is a tax expense, another one is profit after tax of discontinuing operation. These three data you need to give. Generally, these two data, profit before tax and tax expense of discontinuing operation, company has a choice to show it in notes to accounts. Okay, profit after tax, they have to show it in P&L. Now your P&L, no, the statement of P&L you say will have two sections. I've already showed it to you when we did Group 1 ka preparation of financial statement. Even in this topic, I think I showed you. The P&L will have two sections. One is from continuing operation. You know, do put in all the P&L, all the format you put in. Now that format you have to split into two things. One is relating to continuing operation. Another one is relating to discontinuing operation. So discontinuing operation ka you need to give profit before tax, less tax expense, and profit after tax. So you need to give the data for continuing operation and discontinuing operations separately. The P&L data. Okay. For continuing operation, you need to give all the data. You know the format, no, revenue, other income, you will call out on the income side. Expense side, you will show cost of material consumed, employee benefit expense, depreciation, other expense, blah blah blah, and all you will show. Okay, those sort of category, the full-fledged format you put it for continuing operation. Those operations which are getting continued, which the company is not planning to shut down, for that you give a detailed plan or the detailed format as given in Schedule 3. For discontinuing operation, in my example here it was steel division. For steel division, if Tata Limited shows how much is the profit before tax of that steel division, how much is the tax expense relating to that steel division, and after paying tax, how much tax profit remains. Only those three data if they give, that is sufficient. The whole income, expense and all is not necessary. If these three data, if they give for discontinuing operation in their main P&L, that is sufficient. Okay. So this is about your discontinuing operations wala data. Okay. So let's take a break for about 15 minutes and then come back then. Thank you. Hello guys, welcome back after the break. The next topic we'll be proceeding with is AS26, that is on intangible assets. Okay, first, the meaning of intangible asset. Intangible asset means it's an asset that should satisfy four features. One, it should be identifiable. You can say something is identifiable if you can separate it and sell it or rent it. Like if you own any software, can you sell software alone without selling your business? Yes, software alone as an asset you can sell. Trademark, copyright, patent, etc., etc. Yes, you can separate them alone and sell it or give it on rent. But how about goodwill? The goodwill of a business, can you separate it and sell it alone? No. Only when you sell the business, you can recover some money towards goodwill. Yes or no? So hence goodwill fails this identifiability criteria. Hence goodwill is not accounted under AS 26. Goodwill is accounted as per accounting standard 14, amalgamation. Okay. So goodwill ka provisions, AS 26 ka provision will not be applicable for our goodwill. One is that, because it fails identifiability criteria. Second, non-monetary asset. Non-monetary asset means whose value fluctuate. The value should not be fixed. Like if you have cash, if you have 500 rupees ka Gandhi note, it will be 500 rupees ka Gandhi note only throughout. Yes or no? So meaning its value is fixed. So cash is an example of monetary asset. Intangible assets, your property, plant and equipment, investments, inventory, all these are non-monetary asset because their value fluctuate. If you buy any software for 10 lakh rupees, after 1 year also its value will not be 10 lakh. It may be more than 10 lakh or it could be less than 10 lakh, meaning the value does fluctuate. That is your non-monetary aspect wala things. Next is without physical substance, meaning intangible asset should not have physical substance. Don't interpret this line to the full like that. What do they mean by without physical substance? Means like if you buy a software, that software you may get it in the form of pen drive or in CD, but the software element is what is having the value and not that CD or pen drive. So the value of that physical substance is very immaterial. Okay, physical substance may be there in an intangible component, but that value of that physical element is very immaterial or insignificant. That's what they mean by without physical substance. And fourth feature is it should be held for use. Held for use means it should be either held for use in the production of goods or rendering a service or administrative purpose or rental purpose. Meaning you should use that let's say I have a software. Software is an example of intangible asset. I should have used it to use that software to produce some goods or to give some service. Now right now we are giving coaching and we have our app, ArivuPro app. Yes, we are using the app to give the service. So that we are using that software or that app in the rendering of service. That's one. Or you can use it for administrative purpose, like your college. Some of you are in colleges, yes, or you might be working in your office. So yes, certain software I use to track the attendance of employees or students. Yes, attendance tracking app. All these are for administrative purpose. Or it can be used for rental purpose. You can rent out these intangible assets and earn some rental income. For one of the purpose, it should be utilized. Identifiable, so intangible asset means one, it should be identifiable, it should be a non-monetary asset without physical substance and should be held for use either in the production of goods or rendering service or administrative purpose or rental purpose. All the features should be satisfied for you to call an asset as intangible asset. Alright, that is one. And physical substance, I have already told you, intangible asset could have some physical substance, but the value of that physical substance is immaterial. Okay. Suppose a particular asset has both tangible and intangible asset. It has both, like the your laptops, your desktops will have the desktop or your keyboard, motherboard, etc., etc. All these are what, sir? The keyboard, mouse, and all, or the screen and all is the hardware element or the tangible element. But the software like Windows software, VLC software, etc., etc., all these are intangible asset component. So if you have both, if an asset has both tangible and intangible, what to do? Check which element among them is the dominant one. Normally when the people buy desktops or laptops, right, they are buying more for the hardware element. So the dominant element is the hardware. So if the dominant element is hardware, then the entire component will be treated as property, plant and equipment, meaning accounting standard 10 will apply for that component. If the dominant element, however, is the software element or the intangible element, then you will book it as intangible asset, meaning AS 26 will get triggered for those particular assets, like that. Okay. So we saw the feature of intangible asset, but if you want to show the intangible asset in balance sheet, there are two recognition criteria. 4 are the features of intangible asset. Okay. Alright, first 4 features we saw. But if you want to show that intangible asset in balance sheet, other than the 4 features, 2 other recognition criteria should be satisfied. One is FEB, as in because of that intangible asset, some future economic benefit should come to the entity. It's not necessary you should get the benefit right now. Even if you're getting the benefit in future, that is acceptable. But there should be some benefit because of that intangible asset to the entity. And by benefit, it's not necessary that only the sales should increase. Increase in sales is one benefit. Decrease in cost also is a benefit. But some benefit should come. Alright, that is the FEB. We call it as, in class purpose, we used to call it as FEB, as in future economic benefit. And the cost of that intangible asset, you should be able to measure it reliably. How much you have spent towards that intangible asset, clearly you should be able to maintain it. So these are your 2 recognition criteria. If you have acquired any intangible asset through exchange, okay, you bought a software, uske badle mein you did not pay cash or you did not pay money. You bought the software and instead of software, you gave another software. Okay, software 1 was exchanged with software 2. Okay, this is what we mean by exchange. If one non-monetary item is exchanged with another non-monetary item, what to do? That's a concept. So if you're doing this barter transaction or this exchange transaction, then as a thumb rule, you should account. Let's say you purchased a software 1. Okay, I'll write this as in. Software 1 is purchased, meaning it is coming in. Software 2 is going out. So you're giving away software 2 and paying purchase number software 1. So this is coming in, this is going out. So the software that is coming in or the asset coming in should be recorded as a thumb rule at fair value. Fair value means market value. Okay. So you can interpret fair value to be market value. More about fair value, you learn it in Ind AS 113 CA final, not here. Okay. For now, you can think fair value to be market value. As a thumb rule, these sort of exchange transactions should be recorded at fair value. You need not use fair value if either the software asset acquired or asset given up, both the asset ka fair value, if you cannot find out. If you are not able to find out a fair value of both the assets, then you can use the book value of the asset given up. Okay, of the asset given up. Okay, that you can use. Asset given up here, software 2, like that. Okay, as a thumb rule, we use fair value. If fair value of both the asset acquired as well as given up, both are if it is not available, then you can use book value of the asset given up. Okay, all right, and record whatever is the book value of the asset, software 2. Let's say the book value of the software 2 is 10 lakh. That means software 1 also will be recorded at 10 lakh. So the journal entry will pass as software 1 account debit 10 lakh to software 2 account debit 10 lakh. So no profit or loss will be recorded in case of, if you use book value, no profit or loss will be recorded. Okay. And another circumstance, second circumstance, you need not use fair value if the transaction lacks commercial substance. If the transaction lacks commercial substance, even in that case, you need not use fair value. And when can you say transaction lacks commercial substance? One, asset-wise cash flow should be same, and entity-wise cash flow also should be same. Meaning, whether the company uses software 1, let's say this is the company is X Limited, whether company uses software 1 or software 2, if they get the same revenue, then we say transaction lacks commercial substance. One is that. Asset meaning the entity-wise cash flow, whether entity uses software 1 or software 2, they are getting the same cash flow. That should be one criteria. And asset-wise cash flow, meaning software 1 ka risk, timing and amount of cash flow of both these assets should be same. Whether software 1, if you use software 1 ka asset, software 1 asset ka cash flow and software 2 ka asset ka cash flow should be same in terms of amount, in terms of risk, in terms of timing. All this, if it is same, then we say transaction lacks commercial substance. Meaning asset-wise cash flow also should be same. Entity-wise cash flow also should be same. We have discussed this in detail with a lot of examples for AS 10. This is mostly tested in accounting standard 10 concept, but here also it is there, so I've just brought this in. All right. Okay. That is one. And then what is the cost of intangible asset? What is the cost of intangible asset? First is purchase cost. If you have purchase cost, that could be treated as a cost of intangible asset. And when you purchase, if you're paying any import duty and other non-refundable taxes, you can add it. If there is any trade discount that you got at the time of purchase, reduce that. Okay, this is one component of your cost. Purchase cost and adding the non-refundable taxes and deducting the trade discount if any. Along with this, if you have any DAC, as in directly attributable cost, then that also can be considered, or that also can be added to the cost of intangible asset. So what is DAC? DAC are directly attributable cost, meaning they are those costs necessary to make the intangible asset ready for use. To make the asset ready for use, meaning to make the asset intangible asset ready for use, if you are incurring any cost, that we refer to as a directly attributable cost. Like, let's say you purchased the software, okay, but you want to first customize it and then use it. You purchased a software, okay, but you don't want to use it right away. You want to first customize it and then use it. So that customization charges becomes your DAC, because unless you customize it, the asset is not ready for your intended use. So any cost you incur to make the asset ready for use becomes your DAC. Alright, so that is one. If you have DAC, you can add it up. So these are your cost inclusion, meaning what and all can be considered as a cost of an intangible asset. Because initially all the intangible assets are recorded at cost. So unless you know the cost, you will not be able to pass the journal entry or proceed with your accounting treatments. Hence, to find out what is initially the cost of intangible asset is very important. So these two are your cost inclusions. There are certain components which are excluded, meaning cost exclusions. That is your general administrative and selling distribution overheads. Okay, so these are what? They are unrelated costs. So administration, selling and distribution overheads, initial operating losses, your relocation, reorganization expenses, training cost incurred to make the staff operate the asset, advertisement, marketing expense. All these are unrelated costs. They are not related to intangible asset. These are general costs. Hence, they all go off to P&L, meaning you cannot capitalize all this cost. In detail, we've explained all this in our regular class, so quickly just listing it out for your reference here. Alright, next, if any intangible asset is acquired through government grant, meaning government has given you some intangible asset, if it is the case, government has given you some software at free of cost, or they have given you some liquor license at free of cost assumption, okay, then what to do? If you have received an intangible asset at free of cost from the government, then you will show that intangible asset in your books at nominal value. The nominal value could be 1 rupee, 100 rupee, 1000 or whatever. Just for control purpose, you will show that intangible asset in your books. Even though you receive that asset at absolutely free from the government, still you need to show it in your balance sheet or in your books at some nominal value. Okay, 1 rupee, 100 rupees, whatever. This is just for control purpose. So that the shareholders will come to know that yes, you have received some asset from the government. That is one. Suppose you have not received it free of cost, but you have received it at a concessional price, meaning let's say the market price of that intangible asset is 10 crore, but the government told, give me let's say 7 crore rupees and you can buy that asset from me. The market value of that intangible asset is 10 crore, but the company paid just 7 crores to the government and purchased this intangible asset. In this case, what to do? So you will record this, since you bought this asset at concessional value, no? So you'll record this intangible asset at concessional price itself, meaning in this example, you'll record it at 7 crore itself, like that, okay? Alright, next is internally generated intangible asset. Not quite happens sometimes. Many companies, they don't buy the intangible assets from outside. They may develop their own intangible asset, like they may develop their own patents, softwares, quite possible. So if you have any internally generated intangible assets, first you need to check whether it is a goodwill, whether it is internally generated goodwill or other assets. If it is internally generated goodwill, it is not recognized. You remember in your golden days, partnership firm you used to do in your 11th and 12th standard. There you used to find out goodwill under average profits method, super profits method, capitalization method, etc. etc. Yes, those are all we refer to as internally generated goodwill. They cannot be shown in our balance sheet. Okay, they are not recognized at all. Okay, because you are not paying any money for it. It is just internally you took profit and find out its value. Hence, they are not recognized. If it is other internally generated intangible asset, meaning other than goodwill, such other assets are broadly classified into two things: research phase expenditure and development phase expenditure. Other internally generated intangible assets are categorized into research phase and development phase. At research phase, if you are incurring any expenses, then research phase expenditure are not capitalized as intangible asset, rather they are transferred to P&L. All the research, if they say in the problem research phase expenditure is 1 lakh or 1 crore, it doesn't matter. That entire 1 lakh or 1 crore rupees, in one shot it will be transferred off to P&L. Why? At research phase, you cannot demonstrate, one, the existence of intangible asset, two, you cannot demonstrate how much FEB, as in future economic benefits, you will get from that intangible asset. To give you an example, during COVID time, many pharmaceutical companies were doing research to find out the vaccine, COVID vaccine, yes or no? Every company, was it successful or no? So when you do some research phase is a knowledge, it's a phase or it's an activity conducted to gain some knowledge. Okay, so the research, there is no guarantee that research will be 100% successful. Research may be success or research may be failure. Hence, as a thumb rule, at the research phase, since you cannot demonstrate the existence of intangible asset, because research could also be a failure. Okay, so hence at research stage, you cannot say that there is an intangible asset. Okay, only if the research is successful, meaning one company, they did the COVID vaccine research, only if that research was successful, meaning they produced a tablet or vaccine, if it was able to cure that COVID, right, then only you will start developing it, yes or no, then only you will get the patent, etc, etc, then it becomes intangible asset for you. Hence, at research phase expenditure, whatever you are incurring, we will transfer it off in one shot, all that expenditure to P&L. Okay, alright. If the research is successful, then what you will do? Then you will, if company is doing, pharmaceutical company, one company, they did COVID research, okay, they did it for let's say 1 year. After 1 year, the research was successful. Then what do you think they will do? Then they will start developing those vaccines, yes or no? Yes. To develop those vaccines also, they will incur a lot of expenditure. Many scientists they need to hire, yes. So many expenditures they will incur during development phase also. So what about development phase expenditure? Can you capitalize that? Meaning, can you treat it as intangible asset? The standard says yes, development phase expenditure can be recognized as intangible asset provided certain conditions are satisfied. All these below mentioned conditions should be satisfied. That for our class purpose, we used to call it as TIFRC. TIFRC. T for technical feasibility. I for intention to complete. A for ability to use or sell. Okay, and then F for future economic benefits from that asset. R for technical, financial and other resource exist. C for cost measurement. If all of these conditions are satisfied as in TIFRC, then you can go ahead and capitalize the development phase expenditure. If any of those conditions fails, then the expenditure, meaning the development phase expenditure, will be transferred to P&L. Technical feasibility, meaning see, once you see to develop that COVID vaccine, right? If you want to develop, right, you need a lot of technical resources. Yes, no, you need a lot of scientists, you need a lot of other technically it should be feasible for you to go ahead and produce that particular product. First do that feasibility study, whether do you have the capability to produce it, because when you're talking about COVID vaccine and all, no, billions and billions, not even millions, billions of people need it. Yes, so you should be able to produce that much in a very short span of time. Is it feasible for you to produce, or is it viable for you to produce that much quantity? First you just check. That is your technical feasibility wala study. I for intention to complete. Okay, your research is successful, wonderful, but do you have the intention to complete it? Because there is a lot of pressure, especially when you're dealing with these sort of vaccine activity and all. Every government will pounce upon you saying give me the vaccine first. So check whether do you have the intention to complete that, because development also will not happen within 1 month or 2 months. Development phase also may get stretched out for 2 to 3 years, quite possible. Yes, especially if you're producing COVID-19 vaccine for so many billions of people. To produce so much, you have to work day and night, and even then you require 3 to 4 years to produce that many vaccines. So check whether do you have really the intention to complete it. Okay. A for entity. Okay, they produced it. After producing, what you should do? You should be able to sell it to billions of people. Check whether do you have the ability to market that product or use that product. That is also a different skill set. Yes, check whether you have that. F for from that development phase expenditure, check how much benefits will flow to the entity. That is your F, as in future economic benefits. You should be able to call out how much benefit you can expect from this development phase expenditure. R for to do this development activity, you need a lot of resources, technical resources, financial resources, etc., etc. Check whether all those resources do you have in place. All the machinery, etc., etc., what you need, do you have it? First check. C for cost is measurable. How much you have spent towards this development phase expenditure, you should be able to clearly quantify or clearly measure. If all of them satisfied, then you can capitalize the development phase expenditure. Otherwise, it goes off to P&L. Okay, and once the expenditure is transferred to P&L, let's say in year 1, you already transferred development phase expenditure to P&L because this TIFRC condition was not satisfied. In year 1, TIFRC was not satisfied, so you transferred to P&L. In year 2, this condition TIFRC got satisfied. Year 1 it failed, year 2 it got satisfied. Then, sir, year 1 ka expenditure can I reverse from P&L and then capitalize? No. Once you have transferred to P&L, it is like Tirupati Hundi, temple donation. Once gone means gone. So once you have transferred an expenditure to P&L, you cannot reverse that expenditure and again capitalize it in the following year. That is not permissible. So this is about the internally generated intangible asset, quite an important topic as far as the examination is concerned. Okay, then on tangible asset you calculate depreciation. On intangible asset, obviously what will come? Amortization. Okay, so amortization, will it come on all intangible assets, sir? No, sir. If amortization, if you want to charge on intangible asset, then two things should always be present. One, DA should be positive, meaning depreciable amount should be positive, and the intangible asset should have a limited useful life. DA should be positive and the asset should have a limited useful life. So what is this DA? DA is nothing but carrying amount minus residual value. From carrying amount, if you deduct the residual value, what we get is what we call it as DA or depreciable amount. This should be positive. Only if it is positive, then we will do the amortization, otherwise no. To give you an example, let's say one particular company, they have a liquor license. Okay, liquor license, that is an intangible asset. Okay, let's say they bought this liquor license by paying 50 lakh rupees. Okay, you know how liquor license works, right? It's not that that freely available. It is less in supply, more in demand. There is a lot of demand for it, but government does not give liquor license to every Tom, Dick and Harry. There are a lot of conditions. But the person who has acquired liquor license, if he wants, he can sell it or he can transfer this license to another person. Okay. Let's say one person, one company X Limited, they purchase this liquor license by paying 50 lakh rupees, assumption. Okay. This much they paid. So that is the cost for them. Let's say they want to use this liquor license for 5 years. They want to use this and produce some alcohol or breweries. So they want to use it for about 5 years. After 5 years, they feel they'll sell off this license to somebody else. Okay. Company feels at the end of 5th year, aram se they can sell this license for 75 lakh rupees. At the end of 5th year, if company decides to sell this liquor license, they feel they can easily sell it for 75 lakh rupees. Okay, what is this? This only we refer to as a residual value or salvage value. The value that the company gets when they sell their assets at the end of useful life. Whatever value you get when you sell the asset at the end of useful life, that only we refer to as salvage value or residual value. Yes? So now just check what is the depreciable amount. You bought it for 50 lakh, you are able to sell it for 75 lakh means, is your DA positive? How do you get DA? Cost, carrying amount. Initially, cost only will be your carrying amount, right? So 50 lakh minus 75 lakh you do. How much you getting? Minus 25 lakh. That means we will do negative amortization, sir. No. Okay, only if this DA is positive, then only you will depreciate it. Because here it's not a depreciating asset, rather here it is an appreciating asset. So why should you depreciate or charge amortization on this? Yes, only on depreciating assets we calculate depreciation or amortization. Yes, so this is not a depreciating asset, rather this is an appreciating one. Hence, amortization is not necessary. That is what I said by DA to be positive. And 2, asset should have a limited useful life. Because if you want to charge amortization, you want to know the period, no? Yes. That means if you want to use the asset for 5 years, then you will amortize it for 5 years. If you use that intangible asset, if you are planning to use that intangible asset for let's say 20 years, then you will amortize over 20 years. So the life should be known. DA should be positive and life should be known. Then only amortization will come into play. Okay. And this DA should be allocated on a systematic basis over the useful life of the asset. Meaning here, let's take another example. Let's say company has purchased a software by paying 10 lakh rupees. Useful life is 5 years. Let's say residual value is 0. Okay, residual value of the software is 0. That means what is the depreciable amount for initially? 10 lakh minus 0, which is 10 lakh rupees. Yes. That means will you calculate amortization? Yes. How much will be amortization? Can you tell me? Let's say under straight line method. What will be amortization per annum? Original cost, which is 10 lakh minus salvage value, which is 0. This only we call it as a DS, guys. Okay, you do original cost minus salvage value. No, this only we call it as DA. Divided by what? Useful life, which is 5 years. That means you will get the amortization to be 2 lakh per month. Yes. So what AS 26 says is this amortization should be charged for every year for a period of 5 years. It is not a choice. Like company purchased the software 10 lakh. Useful life is 5 years means company is telling first year I will charge amortization. 4th year I will charge amortization. 5th year I will charge amortization. 2nd and 3rd year, I have too much work, I am busy, or my accountant went on leave, so we will not do amortization. That is not acceptable. Okay, so this amortization you have to charge it on a systematic basis over the useful life, meaning for all the 5 years you need to amortize. You can't club and do amortization as per your own whims and fancies. That is not acceptable. That's what I call out by here. Okay, and AS 26 presumes that the life of intangible asset does not exceed 10 years. It's a presumptive life. So if the life of intangible asset is not given for your examination, you can take that to be 10 years and do it, because this is what AS 26 assumes. But IFRS, you'll also learn this in your CA final also, where it is Ind AS 38. Ind AS does not have any presumptive life wala concept. Only AS 26 has this presumptive life wala drama. Okay. Okay. Next one is, which method of amortization will you follow, sir? Will you follow straight line method, WDV method? Which method? Again, standard doesn't prescribe any method. Standard does not tell you do this, you do that. Any method it does not prescribe. What it says is, it is telling the company, hey company, you choose your amortization method. Whether you want to go for straight line or WDV, you only choose. But how you should choose, that choice should be based on pattern of economic benefits. So accounting standard says, based on the pattern of economic benefits, companies should decide whether should they go for straight line method or WDV method. What does this mean? Sir, if you have any intangible asset means you will get some benefits from that intangible asset. Otherwise, why will the organization even buy those intangible assets? Yes. Check. If let's say a company feels the useful life of this intangible asset is 5 years. One company feels every year they will get same benefit. One company feels by using this intangible asset, every year they will get same benefit. That means they will go for which method of amortization? Straight line. Since the benefit is same, which method of amortization gives you this? Which method gives you the same amortization every year? Straight line method, right? So you will go for straight line method. Let's say company feels initially benefit will be more and then benefits will go on reducing. So in that case, the company will go for WDV method. This is how companies choose whether they'll go for straight line or WDV based on the pattern of economic benefits. Alright. Amortization method, the straight line method, WDV, whatever you have chosen, that amortization method, useful life, salvage value, etc., etc., you companies have to review it annually. Every year every year end they need to check to see if there is any change. Okay. If there is any change in the above, if there is any change in the pattern of economic, if pattern of economic benefit changes, okay, initially the company felt they will get same benefit, so they followed straight line method. Okay, first 2 years it went as per prediction. First year benefit also same, second year benefit also is same. Third year onward benefit started reducing. Okay, company thought they will get same benefit every year, so they are amortizing under straight line method. But from year 3 onwards, benefit started reducing. Do you think company will still follow straight line method? No, they will have to shift over to what? WDV method. That is what we are seeing. If any change in the above is there, if any change in the amortization method, salvage value or useful life is there, that is considered as a accounting estimate change and done applied prospectively. We did this in ES5 also, because all these are judgment based, right? Okay. Since these are judgment based, any change in these is treated as accounting estimate change and they have done it prospectively as per accounting standard 5. That's it done. Alright. And next is residual value. Generally, intangible asset ka residual value, we assume it as 0. Usually, we take the residual value of intangible asset to be 0. Why? Sir, if you own a mobile phone, that is a tangible asset, can you sell it easily? Yeah, there are 101 platforms, OLX, Snapdeal or whatever. Yes, Quicker, Picker, you have so many places through which easily you can sell those. Like same goes, if you have building, if you have car, etc., etc., those are all easily sellable because we have a market for it. Yes, but if you own software, patents, etc., these are niche assets. Yes, everybody will not use such asset. It may be only company specific asset. So there may not be an active market to sell intangible asset. Hence, as a thumb rule, generally for most of intangible asset, we take residual value to be 0 for most of them. Okay, but for some intangible asset, residual value still will exist when if any third party guarantee is there. Let's say I have a particular patent. Okay, I want to use it for 5th year. One person came up to me or one company came up to me and told, after 5th year, okay, I will give you 10 lakh rupees. You transfer this patent to me. Okay, one third party has given me a guarantee that he will buy this patent from me at the end of 5th year. My useful life of the patent is 5 years. At the end of 5th year, a third party has given a guarantee that he will buy this patent for 5 lakh rupees. So that 5 lakh you can take it as residual value because third party guarantee is available. That is one way. Alright. Or if there is any active market for intangible asset, and like especially as a liquor license and all, there is a market for it. In fact, there is a huge demand for it. Yes. So if there is any active market for your intangible asset, and if you feel that market will be still available, that market will still be there at the end of asset ka useful life. Suppose I want to use that liquor license for 5 years. Okay. If I feel there is an active market for it and that active market will still exist even after 5th year, then using that active market, I can figure out how much is the residual value. I can check in that active market and then see what is the price of that particular asset in that active market. That becomes your residual value. So from these two conditions, or if any of these conditions are there, then intangible assets could have residual value. Otherwise, we take residual value of intangible assets to be 0. Okay. Next is, when will you derecognize intangible asset? Derecognition means cancelling of intangible asset. 1. To recognize intangible asset, you should have FEB. Yes, only if you have future economic benefits, you will recognize intangible asset. So if FEB stops, then intangible asset also you will stop recognizing, meaning you will cancel it from your books. Or if you have conventional method, if you have sold off the intangible asset, if you have sold that intangible asset, then also you will derecognize or cancel. These are things. Then some disclosures are not important. There are some disclosures you can give, like which method of amortization you are following, what is the life of intangible asset, etc., etc. Those disclosures also needs to be given with respect to intangible asset. So this is all with respect to AS 26. Okay, moving on to the next topic, which is AS 29, which talks about provision, contingent liability, and contingent asset. So AS 29 covers only three things: provision, contingent liability, contingent assets. Okay, all right. Okay, first, AS 29 is not applicable for executory contract. If you have executory contracts, then AS 29 is not applicable for such contracts. So what do we mean by executory contract? Executory contract is a contract wherein the parties in the contract, let's say there are two parties in the contract, both the parties in the contract have not performed their obligation, or they have performed their obligation to equal extent. Such a contract we call it as executory contract. Let's say, okay, you have become a chartered accountant now. Okay, assumption, let's assume anyway you will become. So let's assume that you already become. Okay, so you joined one company, let's say Infosys. Okay, Infosys told, okay, we are pleased to have you on board. So 3 lakh rupees we will give you as joining bonus, JB. Okay, among various offers, you selected our offer, Infosys is telling. So they're saying we are very happy. So we want to give, other than your normal salary, we want to give 3 lakh rupees as a joining bonus for you. Today they told, you asked when should I join? They told next month you join. Okay, alright, that is an executory contract. Why? Has Infosys given you the joining bonus? No. When will they give? After 1 month. First of all, and that is the Infosys obligation pending. What is your obligation? To get this joining bonus, you should join the company. Yes or no? And have you joined, or you will join next month? Next month. That means you have also not completed your obligation, meaning the joining date completion you have not done. Infosys also has not paid this joining bonus. Such a thing we call it as executory contract. And for such executory contracts, AS 29 is not applicable. That is one. Okay. Another key area is, right, always you need to check if there is obligation. If there is you need to check if their obligation exists. Only if obligation is there means there arises a need to create provision and contingent liability. If there is no obligation, then neither provision nor contingent liability will come. So first thing you need to check is whether obligation exists or not. So what do we mean by obligation? Obligation means entity has no realistic alternative but to settle the obligation, meaning company cannot escape from. No escape scenario we refer it to as obligation. I'll give you an example as well a little down the line. Okay, if there is no escape scenario, or maybe now only I'll give it off. Let's say B Limited has filed a case against A Limited. B Limited has filed a case against A Limited. B Limited is saying A Limited has stolen my patent. Okay, there are some patent infringement. That's the reason B Limited has filed a case against A Limited demanding a compensation of 10 lakh rupees. Okay. Now we want to check whether A Limited, we are doing from A Limited perspective here, we are checking whether A Limited has an obligation. Does A Limited have obligation here? Does A Limited have obligation? Yes, there is obligation. Obligation means no escape scenario. Can A Limited escape from this? No. Case is already filed by B Limited. That means the matter is in whose hands now? Is the matter in A Limited or B Limited hands? No, matter is in whose hands? Court. Yes or no? Can A Limited escape from that court proceedings? Can they say I will not come to court, I will not come for hearing and all? That is a judicial proceedings. Nobody is above the law. Yes, at least theoretically. Yes. So yes, so that means A Limited cannot escape from that. Whatever is the court ka verdict, A Limited has to order, and the only court will decide now what needs to be done. So that we call it as obligation, meaning no escape scenario. If that no escape scenario is there, then only we think about creating provision or disclosing contingent liability. Only if obligation is there, no escape scenario. And this obligation could be of two types. Whether it could be a legal obligation or constructive obligation. So what is legal obligation? Those obligation which arise as part of contract or law, we call it as legal obligation. What is it, sir? Suppose you purchase a goods under warranty. You purchased your one mobile, okay, you were happy, okay, so you purchased one mobile phone. And the mobile phone has a warranty period of let's say 1 year. That means what? If there is any repairs, okay, during that warranty period, if that phone breaks, or if not breaks, if it's not functioning the way it should, it is frequently hanging, okay, it's not switching on, okay, like this, if it is there, not as your mistake, like software got corrupted within the warranty period, then what you will do? You will go back to the vendor where you purchased from and ask him to repair it or replace it. Yes or no? Correct? Alright, because you have a contract to do so. The other person cannot deny it, because that's what is the contract about. Such an obligation we call it as legal obligation. That is arising as part of contract, because that's what the contract says. Within 1 year, if there is any repairs, The vendor has to do it. He cannot escape from it. Yes, because that's the contract. So such a thing we call it as legal obligation. So what can be arising out of law? Now, if you're working in a company, if you complete 5 years, the company has to give you gratuity, because as per the Gratuity Act, companies have to comply by it. Can they escape from it? No. So that means what? They have an obligation arising due to law. That also we call it as legal obligation. Okay. Or obligation could also be constructive. Constructive obligation means those which arises as part of previous trade practices or customs. Like, just to give you a small example, let's say we at ArivuPro, we have a small practice. Let's assume that any student who gets a rank, okay, we give them a cash reward of 10,000 rupees. That's our practice, let's assume. Okay. Okay. So whenever new student comes, nowhere did we disclose it to him. We don't tell him get a rank and we'll give you 10,000 rupees. We have not had any contract with him or any dialogue with him in this regard. Alright. But he has checked with his seniors. He told, do they really give? The senior told, yes, I had got a rank and I got cash reward also. That means what will this new student think? If I get a rank, I will also get this reward. Yes or no? Correct? That means one mindset or one component is already set in his mind. That sort of obligation, meaning here I am obligated. ArivuPro is obligated to pay to that student, because that we call it as constructive obligation, meaning arising out of trade practices. Okay, we did not have any contract with a student, but student already knows about this practice. It is our practice to give away this cash reward. Okay, that practice is generally known in the market and this new student knows, and still we have an obligation to pay to that student. That we call it as constructive obligation. This is just an example. Okay, all right. So again, those obligation which arises due to the previous trade practices or customs, we refer to as constructive obligation. As I already told you, contingent liability and provision will only come into play only if obligation is there. If obligation is not there, both this will not come into play at all. Okay. Next is, sir, when will you recognize a provision? If you want to show any provision in your books, if you want to pass a journal entry for provision, 4 features should be satisfied. Only if all the conditions or 4 features, if it is satisfied, then only you will recognize provision, otherwise no. 1, there must be a present obligation arising out of past event, which will result in probable outflow of economic resources and a reliable estimate of the outflow. If all of these are satisfied, then only you will go ahead and make the provision, otherwise no. Let's maybe take a small example and understand this. We'll go with the same example as we told before. B Limited has filed a case against B Limited has filed a case against A Limited demanding a compensation of 10 lakh rupees because B feels A Limited has stolen his patent. Okay, let's see whether A Limited should recognize provision or not. Provision means I told 4 features, sir. What is it? 1, it should be what? Arising out of 1, there must be a present obligation. First is present obligation. Obligation means no escape. Does A Limited have no escape scenario here? Yes, because the matter is in court's hand. It's not in A Limited or B Limited hands here. It is left to their hands. Yes. So A Limited has a present obligation because already court case is running. So they have a present obligation. 2, it should arising out of this obligation should arise out of past event. We don't make provisions for forward-looking events or future events. Provision will always make it for past event. Now, why did B Limited file a case? Because B Limited felt that A Limited has already stolen his patent, okay, and got some benefit out of it. That is the reason B Limited now has filed the case. Yes, no? That means this filing of a case is as a result of past event only? Yes. So answer to this is also yes. Third one, it should result in probable outflow of economic resources. Because of this obligation, there must be a probable outflow of economic resources. Economic resource means cash, etc., cash or any asset. Asset we call it as economic resources. Because of this obligation or to settle this obligation, meaning if A Limited has to settle this case means, okay, check whether, what will A Limited has to do? Okay, A Limited has to pay money and settle it, yes or no? Check whether the outflow of that economic resource is probable. Probable means more than 50% chance of outflow. In all this court case, what do you think will happen? A Limited will consult his lawyer, yes no? Because matters in the court means the lawyer is the best person to give his opinion on. A Limited asked B Limited, what is the scene? What do you think will happen? What about this court case? What will happen? A Limited told, or lawyer told 70% chance that we will lose the case. Okay, B Limited has a very strong evidence. There is a good chance, there is a 70% chance that we will lose the case, not win. He told we will lose the case. Okay, Now check, if there is 70% chance of losing the case means, then A Limited has to pay the compensation. So outflow is probable. What did I say is probable? Probable means there must be more than 50% chance of the outflow. Here is it 50%? Yes, there is a 70% chance of outflow. So it is more than 50%, right? So if it is more than 50%, we call it as probable. Actually, this percentage and all, AS does not use it. Okay, there is IFRS books use this. Alright, hence I brought in the percentage. In your books, they will only say what is probable, possible and all. They will not give you percentages. But just for you to kind of easily connect with, I'm giving you this percentage. Probable means more than 50% chance of outflow. Here is it? Yes. Yes. And the reliable estimate of the outflow. How much will be the outflow? You should be able to reliably estimate it. Here, yes, no. They have only estimated that it is to be 10 lakh. Yes. If all of them, if you are able to satisfy, if all these conditions get satisfied, then the company will recognize something known as provision. Meaning they'll pass the journal entry for provision. Otherwise, no provisions will be recognized. Present obligation arising out of past event, which results in probable outflow of economic resources. And fourth one, you can reliably estimate how much is going to be the outflow. Okay. Alright, sir. Provision and contingent liability are overlapping. If there is a more than 50% chance of outflow, you recognize provision. If there is more than 50% chance of outflow, you will recognize provision. If it is 50% or less means, you disclose contingent liability. That's it. With more than 50%, you recognize provision. At 50% or lesser, you disclose contingent liability. Contingent liability is not accounted. It is only disclosed. You have already done in your Bachpan mein or 11th standard mein, what you used to do? Contingent liability, contingent asset, you used to show it in footnote. Yes, outside the balance sheet. Not only we call it as notes to accounts. So that's what we mean by disclosure. So no journal entry or no accounting treatment for contingent liability. Only disclosure. Okay. Alright. Okay, if you want contingent liability definition. So contingent liability means, okay, it should be a possible obligation. Yes. Because if it is probable, it will become probable means more than 50% chance. Yes. So here you'll write possible obligation. Possible obligation means 50% or lesser chance. Possible obligation arising out of past event. The existence of this is confirmed by happening or non-happening of an uncertain future event not within entity's control. That is the actual definition of contingent liability. That is what I have written in simple words as possible obligation which depends on uncertain future event. Now here only you just check. B Limited has already filed a case against A Limited. No? Yes. Okay. So again, it's a present obligation arising out of past event. Okay. But whether A Limited will pay the money or not, it is decided by whom? Court ka verdict or judge ka verdict. Yes or no? Is judge ka verdict or court ka verdict within A's control or B's control? No. That is what I said over here. It is dependent on whether the A Limited will pay the money or not. It is dependent on uncertain future event. Event here is court ka judgment. And that court ka judgment is not within entity's control. That is the definition of contingent liability. Okay. Basically, obligation is not probable but possible. Fair enough. That is one way. Or probable obligation. Probable obligation means more than 50% chance of outflow. That means you should recognize provision, or sir. Let's read it. Probable obligation not recognized as provision. Probable obligation only. But you are not recognizing provision because there is no outflow of economic resources. Okay. Here B Limited has filed a case against A Limited. A Limited told the lawyer what will happen. Lawyer told 70% chance of losing the case. That means what? A Limited has to make provision. Lawyer also told we will lose the case, but judge will tell first time maafi. Judge will tell you don't have to pay any compensation. This is your first offense, so I will leave. It's okay. First time offense, I will do maafi. You don't have to pay any compensation. If that is the case, means you will not recognize the provision. It is probable, but there is no outflow. If there is no outflow of economic resource expected, meaning if you don't have to pay any compensation, we lost the case, but still if you are not paying any compensation, then provision need not be recognized. One is that. Or how much is the outflow if you cannot estimate it? Because to recognize the provision, what is the last criteria? You should be able to reliably estimate the outflow. By chance, if you are not able to estimate the outflow, which is very, very rare, okay, in case you conclude that you are not able to estimate the outflow, then you can disclose it as contingent liability, meaning no journal entry or no provision is required, just disclose it as contingent liability. That's what I have given over here. Contingent liability is not accounted but only disclosed in notes to accounts. Okay. Next one is contingent liability over, two component over. What is the third one? Contingent asset. So in this example, for A Limited, it is contingent liability. Yes. What about B Limited? Contingent liability means outflow scenario. Contingent asset means inflow scenario. In this, if B Limited wins the case, means he will pay the money or get the money. If B Limited wins the case, means he will get the money, right? So for him, it will be a contingent asset. That is what I've given over here as contingent asset. So it is what contingent asset means. If you want to define, it will not be obligation. It will be a probable asset arising out of past event. The existence of this is confirmed by happening or non-happening of an uncertain future event, not within entity's control. Not an obligation, but here it will become an asset. That's all. Again, like contingent liability, contingent asset are not recognized, meaning no journal entry, only disclosure. Okay. And in this table, I've given you a summary. Okay. On the liability side, what you have to do, asset side, what you have to do. If it is virtually certain means more than 94% chance. Okay. Then you will, on the liability side, you will recognize the liability. On the asset side, you will recognize asset. Virtually certain, if you are 100% sure that liability is going to happen, means recognize liability. If you are virtually certain about asset, then pass the journal entry for asset. Okay. Then if it is probable means more than 50% chance. On the liability side, you will recognize provision. On the asset side, if it is probable asset, then you will not pass a journal entry. You will disclose it as contingent asset. In order to show contingent asset, it should be probable, not possible. Don't be misled there. For contingent liability, it is possible. For contingent asset, it should be probable. Okay. If it is virtually certain, you will book it as asset. If it is a probable asset, you will disclose it as contingent asset. Next, if it is possible obligation, meaning there is 5 to 50% chance, then on the liability side, you disclose contingent liability. On the asset side, you can ignore, meaning you don't have to do anything. No booking the entry, no disclosing as contingent asset, simply move on. Alright. If it is a remote means less than 5% chance, then here also ignore, there also ignore, meaning you don't have to do anything for this. They will only tell you, they will not give you percentage in the question at your level. They'll only directly tell you whether it is virtually certain, probable, possible or remote. They will only tell. But that IFRS uses these percentages, for them. Okay. All right. Next is onerous contract. Onerous contract. So loss-making contracts, we call it as onerous contract. So what is it? Let's say A Limited has entered a contract with X Limited. A Limited has entered a contract with X Limited saying A Limited will purchase goods worth 10 lakh rupees from X Limited in the next 1 month. In the next 1 month, A Limited will purchase goods from X Limited worth 10 lakh rupees. Meaning X Limited will sell goods of worth 10 lakh rupees to A. They have already freezed the price. This transaction has not happened now. It will happen the next month. After A Limited entered into this contract, economic condition turned bad. Let's say COVID came. Okay. January, they entered this contract, January 15th. Okay, then suddenly in February, lockdown, COVID, the whole scene broke out. Okay, 2 years back data. Lockdown came. Then what do you think will happen? Since the economic conditions has turned bad, A Limited feel, if at all they go ahead and purchase this contract, after purchasing, A Limited will sell, no? Okay, A Limited has to purchase by how much? They have to purchase these goods by paying 10 lakh rupees. A Limited feels, if they buy these goods now, okay, they will be able to sell it. The sale value of the goods is only, let's say, 7 lakh rupees. Because the economic conditions have turned bad, there is not much demand for this product. Maximum we will be able to get 7 lakh only from this product. That means they will have to incur a loss of 3 lakh rupees. This contract is not yet completed. Okay, it is just entered now saying A will purchase. Okay, now there is also one more component in this contract. There is one more feature in this contract saying if A Limited backs out of the contract, if A Limited doesn't keep up his word and if he backs out from his contract, there is an exit penalty or there is a penalty of, let's say, 1 lakh rupees. If A Limited does not buy these goods of 10 lakh rupees from X Limited, then A Limited has to pay a penalty of 1 lakh rupees to X Limited is the contract clause. Okay, obviously this is an onerous contract. Yes. Alright, because if you go ahead with this contract, you will make a loss of 3 lakh rupees. If you exit the contract, you have to pay a penalty of 1 lakh rupees. Either way, you will make a loss. Yes, such a contract, we call it as onerous contract. And if it is onerous contract, you will make provision at lower of these two amounts. If you execute the contract, how much loss you will make? 3 lakh. If you exit the contract, you will pay penalty of 1 lakh. You will incur a loss of 1. If you execute the contract, meaning if you go ahead with the contract, you will make a loss of 3. You will make the provision at lower of the amount. That's what I've written here. The provision should be made for OC as an onerous contract at lower of a contract exit penalty or cost minus benefit from contract. Cost here is 10 lakh, benefit is 7 lakh. So if you do 10 lakh minus 7 lakh, you're going to get 3 lakh rupees. So that's on the onerous contract kind of a thing. Alright. Next is reimbursement. Reimbursement, let's say, take an example, let's say A Limited, B Limited, customer. Let's say A Limited is the manufacturer of mobile phones. Okay, A Limited manufactures one brand of mobile phones. B Limited is a dealer of that mobile phones. Okay, A Limited will sell these goods to B Limited. Okay, A Limited will sell these goods to B Limited, and B Limited later on will sell these goods to customer. That's the arrangement. B Limited will purchase from A and he will sell it to the customer. Okay, that's the arrangement. It is there. Alright. These mobile phones now have 1 year warranty period. Meaning if there is any defects found within 1 year, then okay, what the contract says is B Limited has to rectify this. Has to rectify this mobile, has to incur this rectification cost. Because if B Limited has sold this goods to customer, no, if the goods is defective, okay, let's say B Limited has sold one of the mobile phones to a customer with warranty period of 1 year. Okay, within 1 year there is some repair cost. Mobile phone is not switching on; it is off only. Don't know why. Okay, customer came to B Limited and told mobile is not happening. Please repair it and give. B Limited told no problem, I'll repair it. Okay, he repaired this mobile phones at a cost of let's say 10,000 rupees. He repaired this phone and give it off to the customer because it was under warranty period. Okay. What A and B have agreed is, if their customer comes up with any defect, meaning if on the product, if B Limited has to incur any repair cost, then B Limited will collect 80% of that repair cost from A Limited. Meaning B Limited will get reimbursement of that repair cost to the extent of 80%. That is the arrangement that they have. Okay. B Limited will buy the mobile phones from A Limited. After buying, B will sell it to the customer with a warranty period of 1 year. Within the warranty period, if the goods is found defective, then B only will repair that and give it to the customer. Okay. After repairing, how much ever is the repair cost, from that repair cost, 80% of that repair cost, B will get it reimbursed. Meaning A Limited will pay 80% of that repair cost to B Limited. That is the arrangement that these guys have. Okay. Now you just check. Let's say one of the customer came out with a defect and the repair cost was 10,000. So that means what? B Limited has an obligation to do this repair because it is under warranty. That means B Limited has to make a provision because he has an obligation. He cannot escape from it. Okay, because he has sold the goods under warranty, and within the warranty period, if goods are defective, he has to rectify that defect. He cannot escape from it. So yes, and outflow is also probable. All the provision, the condition is getting satisfied. So he will recognize a provision for 10,000 rupees, the repair cost. Okay. Now check. Will B has to pay entire, B incurred a repair cost of 10,000 rupees. After that, what will happen? He will get 80% of this from A Limited because that's the arrangement. Whatever is the repair cost, 80% of it, he will get it as a reimbursement. So 8,000 rupees, this is all B Limited. B Limited will make provision for 10,000 rupees. He'll also recognize an asset. You can call it as reimbursement asset or whatever. Okay. He will recognize the asset also for 8,000 rupees. Okay. So that is what they're saying here. Reimbursement, you will record it as a separate asset provided it is virtually certain. Already told you, if you want to record an asset, it should be virtually certain. Meaning there should be a more than 95% chance that you will receive that money. Here, yes, there is a clear-cut contract that A Limited will pay B Limited. So it is virtually certain. So what B Limited has to do is, this 8,000 he has to record a separate asset. This 10,000 he has to record separate liability. He cannot net off these two. He cannot net off these two and show only provision at 2,000. This is not acceptable. Provision he has to show it separately. Okay, and reimbursement asset you need to show it separately. You cannot net off those two is what this provision is all about. That's your reimbursement wala transaction. Lastly, restructuring. Restructuring means changing the way in which you are operating, like change in management structure, if you are closing down any division, etc., etc. All that we call it as restructuring. So when you do all this restructuring, if you close down a division and all, there will be a lot of employees in that division whom you have to fire. And when you fire them, you can't send them kali hath, empty-handed. You have to give them some termination pay or severance pay or some package you need to give them. Yes. So yes, that's what we mean by that. So if you have any restructuring activity, then enterprise should can recognize the provision for committed cost of restructuring. Whatever is the cost that is coming due to that restructuring plan, to that extent provision can be made. Okay, like here firing the employees with 2 months salary. Let's say company told one division they want to close down. There are about, let's say 100 employees in that division. The company told those employees, we want to close down this division, so we are firing you. But don't worry, we will also give you 2 months salary as a compensation. Okay, so that 2 months compensation which the company has agreed to pay, that for that cost you can make provision because it is related to committed cost of restructuring. Are we fine? All right. So when should we make this provision? When the binding sale agreement for this restructuring arrangement is entered. When this restructuring plan, when you are selling this division, you should have entered into a sale agreement with somebody else. The moment that binding sale agreement is entered, on that day you need to recognize the provision for restructuring expenses. All right. So, but no provision is made due to restructuring if you are relocating any staff, if you are investing in new project, okay, if you are doing any marketing, for those and all you cannot make provision because they are not related to restructuring and all, they are related to something else there. So for these you cannot make provision. Hence also for future operating losses you cannot make provision because provision is always made for the past events. Okay, so this is about restructuring and that's all we have relating to AS 29 as well. Okay, all right. So with this, if you think all the topics of advanced accounting ka revision we have completed. I'm not sure how much time we really take there. Yes, I hope our session was helpful to you. If our session was helpful to you, you can share it with your friends as well, and you can let us know in the comment section how you felt about it. Okay. Again, wish you guys all the very best, people. Make sure that you rock the paper. Doesn't matter what it is. Always keep the head high. Confidence should always be high. Okay. So again, take care. Stay safe. All the best. Bye bye.